Yeah, hi. Good morning. Am I audible? So, welcome to day two of your CA final marathon of FR. Today, we'll try to complete all the remaining chapters. By chance, if one or two things are left out, don't worry. I'll take it up either tomorrow or I'll take it up online. I cannot commit you right now the exact thing because already my flight is booked for tomorrow morning. But if it is possible to reschedule it, I'll reschedule it. So I'll take it tomorrow in case something is left out. I feel one or two topics might be left out, like say your financial instrument and 116. Or else I'll do one thing. If you want that to be covered first, I'll be covering up that first. So don't worry about that. Okay? Now, just sharing a new thing which we have started at Unacademy Subscription. Earlier, we used to have only that group-wise subscription. Now, a student can opt for subject-wise subscription as well. Now, this lectures will not be live classes, but they will be high-quality studio recordings. Now, whenever studio recordings are there, students have a question, how do we have a doubt solving? Doubt solving, there will be a live, dedicated doubt solving sessions on a weekly basis. Plus, there will be this kind of revisions which will be interacting on a regular basis. Printed books are available, as well as you'll have an evaluated test series. Now, evaluated test series we are giving over here for Plus subscription as well as Iconic subscription both. Like you all people also, if you want to write a test and you want to get it evaluated, for you there is a free evaluated test series which we have kept today. So at the end of this session, you will be getting a test paper. You can write and upload it. They will check and give it to you whatever marks you are getting. Now, this is just a QR code you can scan and understand how the sessions basically are there. The glimpse of the recorded video is basically given over here. I'll just try to open up a small video with the link. Okay, there's some problem with my internet connectivity over here, so I'm not going for it. Just if case you want to watch the video, you can just scan the QR code and the video will come up. It's just a glimpse of how do we have these lectures. Now, the Plus subscription, you'll have all the lectures, live dedicated doubt solving session, as well as evaluated test series. Iconic, you are getting a printed book and you have a dedicated doubt solvers also, other than the faculty, who will be also helping you out in doubt solving. The rates for FR subject, the FR subject is already launched. So if anybody wants to buy the FR, which is the latest one, which is based on the latest ICI material, plus we have covered up RTPs till November 22. We have covered up suggested answers till May 22. So everything updated, new latest recording is available. FR subscription for 3 months is 7199, 6 months is 7999, and 12 months is 9799. This is only for FR. Same way for other subject also, the pricings are there. So let's move on to today's work. We come back to our session. Now, yesterday we completed one, that was your share-based payment. Second, we completed our Ind AS 1 together with your Schedule 3 as well as your analysis of financial statement, Chapter 15. Then we completed Chapter 16 and 17, integrated reporting as well as your corporate social responsibility. Then we completed our Chapter 13, that was your business combination. And then lastly, we started with our consolidated financial statements, but it was not completed. We'll continue with the consolidated financial statements. Okay, we reached till the point of loss of NCI. So this is your unit number 4. The unit number 4 may loss of NCI. Now tell me one thing. We know that NCI appears in your balance sheet. Now NCI on DOA. NCI on DOA can be by two ways, either proportionate net asset or by fair value of NCI. That's on DOA. But subsequently, can I say subsequently, NCI is always what? Their share of post-acquisition profits or losses are added to them. Even if they are at fair value, we don't fair value them every year. Now, because of the post losses related to NCI, later on of NCI becomes negative. Question, do we show NCI as negative in books? If later on NCI becomes negative, do we show NCI as negative in books? Answer is yes. So under your AS, if NCI becomes negative, it will appear as negative. But under your Ind AS, it will be negative. AS may it was not shown as negative. So afterwards, if NCI becomes negative, we will show NCI as negative. Just a minute, where did it went? Okay, fine. So if NCI becomes negative, we'll show it as negative. That's the only point. Now, next point is the chain holding. This is important. Now, under your chain holding means what? You don't have a direct holding. You're having what? Indirect. So A to B 60%, B to C 60%. Now, if I ask you a question, A to B 60%, B to C 60%. So now, how much percent voting power in C can be by the way we want? How much percent voting power can be by the way we want? Now, can I say we hold 60% in B? So, can I say B will take the decisions what we say? Now, B holds 60% in C, so indirectly our 60% of the voting power. How much percent of voting power? Voting power 60% in C is the way I tell. Whatever I say, that will happen. How much of percentage? 60. So for determining whether control is there or not, I will check in C. A to B is 60, B to C is also 60 now. So direct or indirect, both the holdings are considered. So indirectly 60 ho gaya, it's fine. But now when I come to that balance sheet part, do I have a right over 60% of net assets of C? No. If you think from a group as a whole, okay, B has a right over 60%. But now can I say we have a right in B only 60%? So indirectly in C, our share of right will be 36%. So for deciding control is there or not, we'll see full 60. Because decision for 60% share can be taken in a way we want. But whenever we are understanding how much percent of net asset belongs to us, then we don't say 60%, then we say only how much percent? 36. So can I say when we are doing our working note 1, analysis of reserves and surplus of subsidiary, after that reserves are analyzed pre, post, total, we bifurcate between the parent, that is holding company A, and the NCI. So we will take our share as not 60%, we will take our share as 36%. That is only the thing which you need to take care. That's one. Okay, now second, C 20 and B holds in C 40. So how much decisions we can take? We hold 20, B is holding 40. So indirectly we can have 60% voting power exercise, control is there. But now share of net asset, we hold 20 directly, that's fine. But via B we are holding how much? 40. So that I need to make 40 into 60%. So that will become 4 6 are 24 plus the 20, total will become 44%. Okay, so in your working note 1 we are required to take care about that. Okay, second, sometimes what happens, A acquired B on a different date, B acquired C on a different date. That is possible. So I need to understand when do we get a control over them. If A acquired B today, B acquired C next year, so can I say on C we are getting control not in this year but in next year. Okay. Now, the problem one comes up is whenever we are preparing a consolidated balance sheet, assets and liabilities of B and C will come up, and can I say investments in B and C will go away. Now, investment in B and C goes away, assets and liabilities of B and C comes up, investment in B and C goes away. Now, B had invested for how many percentage shares in C? B had invested for how many percentage shares in C? 60. So now the thing is, investment goes away is 60% shares, but the net assets which we are adding is 36. So can I say that's a mismatch? Investment going away is 60%, but the net assets which we are adding is only what? 36%. So what will happen over here is the extra 24% net assets has gone to NCI people. The same way the cost of that 24% should also go to NCI. So our investments, whatever was there, that represented 60%. So 60% of investment is this much. So what will be 24% of investment? That much value of cost has to be borne by NCI. So that much value has to be deducted from NCI, and it will be deducted from our cost of investments. So two things. One, while we are deciding our share in NCI, we have to take our share as 36%, and NCI will be 64%. And number two is investment was 60% shares, but net assets we are adding is only what? 36%. So can I say 24% of our investment cost, we should not bear it. NCI people should bear it. They got extra assets. So that will be given to NCI, that cost. It is removed from our cost of investment. While calculating goodwill capital reserve, our cost of investment for B2C will not be the full amount. It will be minus that cost which is transferred to NCI people. And that is deducted from NCI. Let's see a question over here. Okay, if you check over here, question, there is PSSS. P holds in S 16 lakh shares. Actually 16 lakh ki jagah make it 32 lakh, I think. And this is out of 400 we are having, out of 40 we are having 32. So can I say it becomes 80%? And S holds in double S. S holds in double S. It's not 12, it becomes 24. So 320 and 24. 320 and 24 is coming how much? 75%. So A to the P to S is 80%, and S to double S is basically 75%. But now whenever I'm basically deciding how much voting of double S is in my hand, 75%. But how much net asset of double S is with group? It's not 75%. It's 75% into 80%. That will become 60%. So when I'm in my working note 1, this is analysis of reserve surplus of S. I want to go to double S. In double S, analysis of reserves and surplus, if you see group is not 75%, group is 60%, and NCI is 40%. Did you understood this? Okay, number two. Now problem is, when I consolidate, I'm adding their net asset 60% with me, and 40% went to NCI. But the cost of investment which I incurred was for how many percentage shares? 75%. So 75% shares was 75% shares ka cost is 280. Okay, so 15% will be how much? Because we are having 60, 15% will go over there, 56. So 56 will be removed from our cost of investment, and 56 cost will be borne by NCI. If you check our NCI note, so in the NCI note, this 56 cost they have to bear, it's deducted from NCI. And second, that 56 will be deducted from our cost of investment. In our goodwill capital reserve, the consideration by acquirer is not 280, it is 280 minus 56. Did you understand? So for chain holding, this is the important point. The one when we are bifurcating pre and post, the total, our share in C will not be taken 75%, it is 75% into 80, that is only 60% to be taken. And number two, we are including 60% net asset, but the investment was for 75%. The extra 15% investment per cost has to be borne by NCI. Yes, you had it out. No, over there is no adjustment required. The NCI which we are taking is acquisition. The date of acquisition, basically the NCI which we are taking is at fair value. If you see the question says the NCI is at fair value. No, the thing is, when we are taking over here, if you see, it's based on how many percentage written? 40%. So we are taking only 60, they are taking 40. So when I'm transferring, if it was based on net asset, the capital will be based on 40%. Anyways, the pre-reserves are also based on 40%. It's not based on 7 to 25, it's based on 40%. So they got 40% net asset, they should bear a cost also of 40%. Okay, next we have preparation of consolidated P&L. Now see, consolidated P&L generally doesn't come in your CA final. It's basically an inter topic. In your intermediate also the same chapter is there. So people generally ask over there. I just take up one point over here. We know mutual income and expenses will be eliminated. My question is, if at all I acquired a subsidiary during the year, imagine I acquired a subsidiary on 1st July onwards. So would I include the full year sales, purchase, expense, income in P&L? No, I'll include only from 1st July. So then 9 months sale, purchase, expense, income will be in. Plus whatever your consolidated profit comes, because the consolidated profit has your share as well as NCI share, we need to have a allocation. Yeah, the clear? Okay, if there's some unrealized profit in stock, so we know stock may say it is reduced, opposite effect comes in your profits. The subsidiary ke profits may say, या parent ke profit may say we needed to remove, it will be coming where? It will come in changes in inventory. So practically it will come in change in inventory. Then consolidated cash flow, will cover it together with your Ind AS 7. Let's go to unit number 5. Let us go to unit number 5. With those who are attending online, is the audio fine? Those who are attending online, is the audio fine or there's some issue? Okay, now let's go to this unit number 5. Unit number 5 is joint arrangement. It is Ind AS 111. Now see, joint arrangement is an arrangement where the parties have which type of control? Joint control. Joint control means unilaterally you cannot take the decision. It is 2 people or 3 people who are taking decision jointly. That is basically a joint control. Okay, now so that's a unilaterally agreed sharing of control between the investors. Now, joint arrangements are divided in 2 parts: joint operation, joint venture. We need to understand first of all that joint arrangement is of which type. If it is JO, accounting is different. If it is JV, accounting is different. Now, when do I say it is JO? Under JO, the parties have a right over assets and liabilities of that operation. So whenever we have a right over that assets and liabilities of that operation, I can take my share of asset, I can take my share of liability, then it's always a joint operation. But when it's a joint venture, now you do not have a right over assets and liabilities of that joint operation, say a joint arrangement. You don't have a right over assets and liabilities. For example, A Limited, B Limited, they combine and form AB Limited. The joint venture is formed, wherein A holds 50%, B holds 50%. Now, can A say that 50% of AB ka asset is mine? Can they take away asset? No. See, whenever you are a shareholder, imagine I have shares of Reliance. Can I go and tell to Reliance, give me one machine? So I don't get a right over their assets and liabilities. I don't get a right over their assets and liabilities. So if at all a new company is formed, AB Limited, and wahan pe A Limited, B Limited cannot take away their share of asset, their share of liability, then in that case it is a joint venture. Under joint operation, you have a right over the assets and liabilities. Under joint venture, you don't have a right over assets and liabilities. Okay, now for a joint arrangement, if new entity is not formed, it is always JO. If new entity is not formed, then it is always JO. But if new entity is formed, so generally it is JV, but we still need to check out. Okay, the new entity is not formed. The separate vehicle is not there, it's always JO. Separate vehicle is there, then I need to check out. So what do we have? If I just see over here, not structured to separate vehicle, joint operation. Structured to separate vehicle, then you have to see the new entity created, uska legal form. If new entity created is a company, I don't have a right over assets liability. But imagine a new entity created was a partnership firm, a normal partnership firm. Can I say normal partnership firm may the partner's liability is unlimited. Firm is always known by partners. Wahan pe you will have a right over assets and liabilities. So then in that case, even though new firm is formed, it will become JO. Plus agreement between both of us. Many times we have an agreement, even though a new company was formed, but we have an agreement. In case dispute happens, you can take away half asset, you can take away half liability. If agreement is such, then again it will become a JO. So if no new entity, it is JV. If a new entity is formed, mostly it will be JV, but still it can be JO. Now how do we account? If it's a joint operation, how to account? If it is a joint operation, accounting in your SFS, I repeat, accounting in SFS, you have a right over assets and liability. So all assets and liability pertaining to you, you book it in your books. My share of machine, my share of loan, my share of other assets, all will come in my SFS only. The question, whether in your SFS we have investment in JO? No. Our share of asset only comes. So suppose day one, I gave money to JO. So it's basically investment in JO to bank. But against the investment, what will come in is your share of assets and liabilities. Okay, so include your share of assets and liabilities basically coming from JO. Same way, your share of revenue, your share of expenses, everything you book it in SFS only. So now question, in SFS only my share of assets liabilities are there. So because of JO, do I need to prepare a CFS? No, because of JO, you don't have to prepare CFS. So CFS is not required because of JO. But if you are preparing CFS because you have some subsidiary, associate or some JV, some other, uske karan you are preparing CFS, then the figures of JO which are there in SFS will continue the same in CFS. Okay, if you see this question, they have given over here clearly. P has all right to machine and bank loan. Others may you have 50%. So machine and bank loan you will record fully in your books. Other may cash, other loans that you will record half, 50% in your books. So check out what we will record. Machine is full, bank loan is full. Cash is half, other loan is half. The first, when I invest money in JO, it's investment to bank, and then against the investment, all these assets and liabilities come in. This is all in my SFS only coming in, and the same figures will continue in CFS. But because of JO, I don't have to prepare CFS. Okay, done. Next, this all is fine, not relevant. Accounting for JV. Okay, now joint venture. Remember in assets and liabilities, and JV will always be what? A separate entity created. So there's a separate entity, AB Limited. We have 50% share, someone has 50% share. How will I show that? In my SFS, it will appear as investment in JV. In my SFS, it will appear as investment in JV. And if you remember, Ind AS 27, separate financial statement. What did Ind AS 27 say? Your investment in subsidiary associated at cost or as per Ind AS 109. Or as per Ind AS 109. So mostly this will appear in your SFS at cost. Now, because of JV, do we need to prepare a CFS? Yes, because of JV, I need to prepare a CFS. Now, how JV is accounted in CFS, that is given under your Ind AS 28. So, यहाँ पे how to account them in SFS, it's either at cost or as per 109. How to account them in CFS, it's the equity method which is covered under Ind AS 28. Okay, next. Now, we already had 30%. We acquired additional 30. Okay, can I say we had 30? We acquired additional 30. Now control came in. Pehle control was not there. So remember, control comes in stage. Isko bolte step equation. The previous equity interest needs to be remeasured. Okay, earlier it was JV 50%. Plus we acquired 30. Can I say now it became 80? Earlier joint control was there. Now control. So can I say now the control came? So again the previous interest will be remeasured. And third one, JO becomes a subsidiary. What becomes a subsidiary? Okay, if it was a JO, in our SFS, can I say assets and liabilities were there? And now it becomes a subsidiary. Now, pay attention. Now it becomes a subsidiary in SFS. Whether assets and liabilities will be there or investment in subsidiary. Okay, so whatever we had, so suppose JO was there, earlier we had our share of assets liability in SFS. I'll come to CFS later. Our share of assets and liabilities were there basically in SFS. Now it becomes a subsidiary. Can I say investment in subsidiary should come in? So our share of assets and liabilities which were there in SFS, they go away. Investment in subsidiary will come in at same amount. Plus if you paid extra for getting some extra share, that will also be coming under investment in subsidiary. The investment in subsidiary will come in at same amount unless you paid something extra. Now coming to CFS. Your share of assets and liabilities were already there. But now if it becomes a subsidiary, can I say you should include only your share of assets and liability or 100%? 100%. So now we'll be including 100% assets and liabilities. Okay with this? Okay, this is done. Going to the next unit, unit number 6. Going next unit, unit number 6. Now, unit number 6 is talking about associates, whether we have a significant influence or not. And then second thing what they're talking is how do we account if it's an associate or a JV in our CFS. So Ind AS 28 is covered over here. First of all, associate is an entity over which we have what? Significant influence. Significant influence is not we can take the decisions on our own. We just have a power to participate in decision making process. Okay, what is the normal presumption? When do I have a significant influence? It is when you are holding 20% or more. This is normally, but if contrary, sometimes I hold 30%, but I don't have a say in management. I hold 30%, but I cannot basically have say in management. I don't have a power to participate anywhere. Then in that case, even with 30%, you don't have significant influence. Normally, it is with 20% or more, you have a significant influence unless a contrary is proved. Now, this is basically done. Now, if at all I have an associate or I have a JV, if at all I have an associate or a JV, can I say we are required to have an equity method for our CFS? Now, how does that equity method work? The investment will remain as investment, but our share in post-acquisition profits and losses are included in our CFS. So profits में आ गए. Opposite, I have not received cash, so I'll put it where? Investments. But now imagine later they give me dividend. Now dividend will be out of the profit only. Now profit I've already added, and opposite I'd added where? Investments. Now if they give me cash, that will be cash debit, investment credit under your CFS. Because it was only under CFS the profits were included. In your SFS the profits were not included. So under CFS, later if they give me dividend, so earlier my share of profit I already included, opposite I added in investment. Now if they give me money, cash, so cash to investments. Okay, so check over here. How does equity method work? First of all, day one, it will appear as investment in associate only. It's there at cost in our SFS. It will start in CFS at same value. We invested 100 rupees, CFS also it will come 100 rupees. Achha, now question. If it's an equity method, do we need to find goodwill capital reserve? If it's an equity method, do we need to find goodwill capital reserve? Answer is yes. You need to find goodwill capital reserve, but that goodwill capital reserve which you find will not appear as goodwill or capital reserve in your balance sheet. It will be, like simple I tell you, I got 30%, their net assets are 300. Their net assets today are 300. When I say my share of net asset 300, 30%, 90, but I paid how much? 100. Investment will appear 100 only, but bracket mein will write including goodwill of rupees 10. What will write? Including goodwill of rupees 10. So we'll find out goodwill capital reserve, but it is not to be shown as goodwill capital reserve. It will appear under the investment only. Bracket mein we just write including goodwill of rupees 10. Clear with this? ठीक है. Cost of investment is compared with proportionate net asset. We find out goodwill capital reserve, not to be shown as goodwill capital reserve, just we are required to show it as investment only, but bracket may including goodwill of rupees 10. Now later they earn some profit. They earn some profit. Can I say my share of profit I'll include in CFS, not in SFS, in CFS. SFS income comes only if they declare dividend. So CFS may I'll include my profit, and I have not received cash, so opposite side the effect will be given in investment. Investment debit to your share of profit. But if they have a profit in PNL, I'll add in PNL. If they have a profit in OCI, I'll add my share in OCI. Okay? That's why it's written in PNL or in OCI. Clear with this? Okay. Now, if JV has made loss, opposite entry will be there. Now, later on, if they give dividend, now SFS may if they give dividend, bank to dividend income. But in CFS, can I say our share of profit was already included and dividend is out of that profit only? So I cannot record dividend income again because I have recorded already my share of full profit. Out of that only dividend is given. So it will become 2 times. So I have already recorded, I had added in investment. Now if I get cash, it will be bank to investments. So later if they are declaring dividend, it will be bank to investments. So what is the investment appearing in your CFS now? Day 1 it was 100 including goodwill of 10. Then your share of profit 12 you added. Later if they give dividend, that will be deducted from investment because that goes in cash, and now your investment appears at 100. Are you clear? Okay, next. This question is fine, simple one. Now come to question over here, this green limited. Come to question of green limited. Yes, please. Can the balance of investment in? Answer is no. Under equity method, if at all you have associate or you have a JV, equity method mein investment cannot appear as negative. Maximum it can appear as 0. NCI can appear as negative under your Ind AS 110. Yahan pe no, it will come up. Okay, now check this question. Blue acquired 25% of green. Okay, for how much rupees? 125. Their net assets are 3 lakh, but unka fair value of net asset is 4 lakh. Okay, the goodwill capital reserve I should consider based on book value of net asset or fair value of net asset. Fair value. Goodwill capital reserve is always based on fair value of net asset. Okay, the net assets fair value 4 lakh. So when I say 4 lakh ka 25%, my share of net asset is 1 lakh, but I paid 125. So investment will appear 125 bracket mein including goodwill of rupees 25. Did you understand this? Okay, now. This extra 1 lakh fair value was due to some building which has increased and uska life is 20 years. Building which has increased, whose life is 20 years. So now indirectly your investment represents what? Indirectly your investment represents your share of net asset over there plus goodwill of 25,000. My share of net asset is 1 lakh plus what? Goodwill 25,000. So can I say investment practically represents my share of net asset in associate plus the goodwill. And now my share of net asset, which I've included, okay, in the name of investment I've included, but can I say it's based on fair value? If my share of net asset is based on fair value, so can I say in CFS the depreciation should also be based on fair value? Yes, no? Now in SFS of that associate, they have not done any changes. So they have a PP of 3 lakh only, but ours may the PP is 4 lakh. So can I say now extra 1 lakh ke upar depreciation will come? Life is 20 years. So 1 lakh divided by 20 years, extra depreciation will be 5,000. So now they earned a profit 40. They earned a profit 40 and OCI 10. Okay, profit normal P&L 40, OCI 10. My share I have to include. Okay, 40 they earned, my share 25%. 40 ka 25% is what? 10. 40 ka 25% is 10. Did you understood? But the thing is, in that 10, 40 is 25% is 10. But in that 10, they have not considered the new depreciation. What is the new depreciation? 5,000 extra, but 5,000 my share is only 25%. My share is only 25%. The 1250 is extra depreciation which I have to bear. So my share of profit is not 10,000, it's 10,000 minus 1250. So my share of profit is 8750. And now my share of OCI they earn 10,000, 10,000 into 25%. My share of OCI is 2500. Now investments. The investments 125 including goodwill 25 day 1. Then my share of profit, my share of OCI, this is coming closing investments. Did you understand? Shall I move ahead? This was important question. Reason is very simple. See, simple is the investment represents what? It's nothing but your share of net asset over there plus the goodwill. The only thing is that net asset doesn't appear in the name of assets and liability. It appears in the name of investment. But you have included your share of net assets based on fair value. As the net asset is based on fair value, the new depreciation should also be based on fair value. Extra depreciation 5,000. No, sir, 5,000 is for the my share is only 25%. Okay. Next, exemption. Which entities are exempted from applying equity method? One is your intermediate parent, which we already covered. Now, second, if you are an investment company, which company? Investment company, and if you carry your investment in associate as well as JV at fair value through P&L, then can I say you are exempted? Now, third one is kind of interesting. Pay attention. Where an entity has an investment in associate, portion is held indirectly through a venture capital organization, mutual fund, unit trust, or similar entity. The thing is, A Limited has a subsidiary B Limited. Say they hold 100% in B, and they hold 10% in C, and C holds 15% in B holds 15% in C. If I tell you how much voting power of C, A will control 25, 10 directly, and 15 is via subsidiary. But now A is a non-investment company, but B is an investment company. So can I say some portion is C is held through investment company? The portion which you hold directly, for that you have to follow equity method. But for the portion which is held through an investment company, for that you may not follow equity method. For that you can directly value it at fair value through PL. Let's see the word written for that portion. So which is the portion which you are holding through an investment company? 15%. So for 15% you don't follow equity method, but for the 10% you need to follow equity method. Okay, check over here the question related to it. MNO, you hold 15% in DEF. MNO holds how much percent in DEF? And now PQR mutual fund, which is a subsidiary of MNO. So you hold 15 directly, your subsidiary holds 10, and subsidiary is a mutual fund. Can I say investment entity? So how much you are holding in that associate via a investment company? 10%. So for that 10%, you may not follow equity method. For your direct holding of 15%, you have to follow equity method. So check over here. For 15%, follow equity method. For the 10%, which is indirectly through a mutual fund, you either follow equity method or you can have fair value through. Did you understand? Shall I move it? Okay, next, now what is your share in associate? What is your share in associate? How much percentage my holding in associate is there? It's very simple. You directly plus through your subsidiary is considered. You directly plus through your subsidiary is considered. Did you understood this? Now, okay, so me directly was 15, through my subsidiary 10, so it is 25% holding in associate. Now, can I say I have to include 25% profits of associate with me? I need to include 25% profit of associate. Question: associate has a subsidiary. Who is a subsidiary? Associate has a subsidiary. I need to include 25% of their which profit? SFS profit or CFS profit? They have a subsidiary. So when I say they will also be preparing CFS, na? I hold in associate 10 directly, 15 through my subsidiary. So total we are holding 25. That is done. Total we hold 25%. Now we hold 25% in C. C has a subsidiary D. So C will also prepare a CFS. Now I should include 25% of C with me. I should include 25% of C with me. I should include 25% of their SFS profit, or I should include 25% of their CFS profit. CFS profit. So I need to include 25% of their CFS. So see, when associate JV has a subsidiary, who has a subsidiary? Associate JV has a subsidiary. So your share in profit, OCI, net asset should be based on CFS figures of associate and J. Clear? Okay. Now, it should be based on CFS figures. Now, just tell me one thing. I told you that my share of profit, if they have profit in PNL, I'll add my share in PNL. If they have a profit in OCI, I'll add my share in OCI. Now, if they have included some profit directly in other equity, if they have included some profit directly in other equity, my share I'll add directly in other equity. For example, I told you associate had a subsidiary. Associate had a subsidiary. They were holding 80%. Now out of 80, they sold 10. Okay, can I say they had a subsidiary? 80. Now they sold 10. Can I say they still will have a subsidiary? Okay, so just think from associate angle. For them, can I say it is nothing but a change in proportion of NCI? And remember, if change in proportion of NCI, I told you yesterday that uska profit loss was in other equity. It was directly in other equity. So they sold some 10% in their subsidiary. Can I say they would have recorded uska profit loss directly in other equity? So if associate had some profit in the normal PNL, my share I'll include in normal PNL. If associate had a profit in OCI, my share I'll include in OCI. But if associate had some profit directly in other equity, my share I have to include directly in other equity. So now here we had an associate B. Now B had a subsidiary, they sold off some portion in subsidiary and they have recorded some profit directly in other equity. So if you see यहाँ पे, in consolidated financial statement of B, they have some profit which they have recognized, which is in other equity. Equity transaction with non-controlling interest, uska 100 rupee profit. Uska 100 rupee profit. Now can I say I hold 20% in B, so I need to include 20% in my other equity. To check, A should recognize 20% in other equity. Did you understood? Next, upstream downstream is fine over here. It's just that whenever you are having this associate or JV, if I sell to them, can I say 25% is me only over there? I need to record profit only related to other venturers' share. I need to record profit related to other venturers' share. Check karo. You need to record gain loss only to the extent of unrelated investors' interest in associate or JV. If I sold something to associate, now 25% in associate is me only. So I should not record the full profit. I should record only profit of 75%. Clear? This is not relevant from exam purpose and just skipping it. Okay, next is your question. Long-term interest in associate JV. What is this? Now, one is you have invested in equity shares of associate. You hold 25% shares. Now, second, imagine you have given a loan to them. You also given a loan. And loan is such that the terms are not finalized. They can repay whenever they want. And in a foreseeable future, I feel money is not going to come. So when I say effectively, that is also a kind of investment only. Usko consider karte hain net investment in associate only. It's a part of net investment in associate only. Did you understood? So if I have a trade receivable, trade payable, that doesn't come in net investment in associate. But if I've given a long-term loan to them, or if I've invested in their preference shares, which are a kind of irredeemable one or a very long-term one, so can I say they are also indirectly your investment in associate? Now, how do we account for that? How do we account for that? So remember, we follow equity method. Under equity method, that loan given doesn't give me any percentage holding. The percentage is still 25 only. Don't think that loan given means percentage increased. No, percentage is still 25. But now, because of that post-acquisition losses, my investment in equity, what was there? I started with 100, then my share of loss came 20. Can I say now it became 80? My share of loss came 50. Now it became 30. Now my share of loss again come 50. So now can I say it becomes minus 20? Okay, so ये zero करो. If there is any other long-term interest, you can deduct from that any other long-term interest, and then you can have other long-term interest also became zero na. Then you cannot show anything as negative. Your investment in associate can be maximum zero. Now equity वाला investment खत्म हो गया. You can use investment which is a kind of that long-term वाला. You can deduct from there also. But if that is also over, then you show it as negative. Further losses you will not book. So check. There might be some receivable which are kind of a long-term interest. If it's a loss-making associate, the loss may exceed the interest in associate. In such case, you discontinue the further recording of losses. We discontinue what? Further recording. However, if we have some other long-term interest, the equity method when you're using, you can also, this investment is over, so other long-term investments may say you can also deduct. But now tell me, I have given a loan to them or I have some preference shares of them, uska accounting will be done as per your Ind AS 109. Every year they are first accounted as per Ind AS 109, and then the treatment, then there is a loss over here, it can be shared to them, but they will first be accounted always as per 109 because they are as such a financial asset which is covered under 10. Okay, so check over here. It should be noted that entity should first apply 109 to such long-term interest. The entity should first apply what? 109 to long-term interest, and then if some yahan pe losses are coming, this investment gets over, I can adjust against the long-term interest, then this allocation of long-term interest ka share in loss can be taken. Yes, please. Correct. Correct. Okay. Now his question is, sir, I had given a long-term loan to my associate. Loan was as per Ind AS 109 amortized cost. The loan given was an asset. Interest accrues, we receive something, closing. Interest accrues, we receive something, closing. Kind of that way it was there. Now suppose now what happened is interest accrued, they pay me the interest. Interest accrued, they pay me interest. Okay, so loan remains same. Interest accrued, they pay me interest. What happens? Loan remains same. That is how it was. But now this year there was some investment in associate also, and now loss came up. Equity loss is becoming, equity investment became zero. So can I say now I adjusted the loss against long-term interest? So now the loan ka amount is reduced. Loan ka amount is now reduced because that loss is there. So now his question is, now that interest will be on that reduced amount or interest will continue on original amount? Interest will be on reduced amount. What is now there in your books? Clear with this? Shall I move ahead? But such question is not there in your syllabus, don't worry about it. Okay, now suppose that long-term interest was not there. Imagine you don't have a long-term interest, you just have investment in equity. Investment in equity became zero. Would you record further losses? No, so I'll not record further losses. Subsequently, whatever loss I have not recorded, that much profit also I should not record later. Okay. Now when should I stop using the equity method? If investment becomes your subsidiary. So associate my investment 30 tha, extra 30, so it became subsidiary. Now you stop using this, but isse hoga kya? Already 30 was there, another 30 acquired. I need to remeasure the earlier interest when I'm now accounting as subsidiary. Okay. And retain interest in former is just a financial asset. Imagine out of 30% you sold off 20. Out of 30 I sold off 20. Can I say now it became only 10? Okay. So now how to account for this? Bank debit, I got money for 20%. 10% remains. That investment will continue at today's fair value. Which value? Today's fair value. And two, whatever investment 30% you were having as per equity method, that will go away. Difference is your profit or loss. Only one thing goes directly in other equity, that was changes in proportion of NCI. Other all things will go in P&L. Okay, so fair value of interest retained and bank. So you got money, bank debit. Some investments are retained 10%, they will appear at fair value. Earlier investment which was there in books goes away, difference is profit or loss. Done. Reduction in interest is okay, not relevant. Classification of investment in associate JV as held for sale. Okay, if investment in associate JV is classified as held for sale. Okay, now over here we have just classified it as held for sale. Now till the time you actually dispose of, equity method continues. Till the time it is actually sold. Classified as held for sale नहीं, जब तक बेचते नहीं हो, the equity method is going to continue. Yeah, that clear? Now once basically the portion is sold off, how to account for remaining portion? How to account for? If remaining portion is still an associate or JV, imagine out of 40%, 10% sold. You're going to say remaining 30% is still what? Associate or JV. So what do you continue? For them, equity method is still continue. But if remaining is now a normal investment, out of 30, 20 sold off. But now it should appear directly at what? As per Ind AS 109. Now it will appear as per Ind AS 109. So it's basically when you classify it as held for sale, equity method will not stop. It will continue till it is actually sold off. Then this was basically your unit number 6. Unit number 7 is just a disclosure which is not relevant for exam purpose. So consolidated financial statements are over. Integrated reporting done. Corporate social responsibility done. Come to chapter number 7. Come to chapter number 7. Online people, is the audio clear now? Actually, the settings are fine. I don't know what's the problem. Yes, any doubts? Yes, please. Means? They have a question on that? Can you show me that question, please? Let me just check.
At last, they have given.
Okay. There is no interest actually. This question, this is just a note given by the author. Actually, I'll come back to this. Okay, in the last time. Okay. Now coming to chapter number 7, unit number 1, which is your Ind AS 2 on inventory. I'm not going for the definition of inventory. Everybody knows the definition. Only thing is, if at all there are some spare parts, machinery spares, etc., if they fulfill the definition of PPE, they will go under PP. If they don't fulfill the definition of PPE, then they are accounted under inventory. Like there are some machinery spares. For example, machine needs a blade. That blade is to be replaced every 2-3 days. If blade is to be replaced every 2-3 days, can I say it cannot be used for more than 1 year? So it's not a PP. The stock of blade will be accounted under your inventory. Fine. Now this question is there wherein they are telling materials and supplies awaiting use in production process, whether packing material, publicity material are covered in that. See, packing material, primary packing is included, secondary packing is not included. Like product is there, the box of product, that is included. But now shipping ke liye you use another box. Shipping purpose you put it in another box. That secondary packing is not included. And marketing material are never a part of cost of inventory. ठीक है. Now scope is fine, not relevant for exam purpose. Come to measurement. Your inventories are to be measured how? The inventories are to be measured at cost or NRV, whichever is lower. Now see, NRV is always entity specific. NRV is for entity. There's another word called fair value. Fair value is not entity wise. Fair value is based on market participants. Fine. Now, how do we find the cost of inventory? The cost of inventory includes your cost of purchase, cost of conversion, and your any cost incurred in bringing the inventory to present location and condition. Now, your cost of purchase will include your purchase price, duties and taxes on which credit is not available. If credit is available, you basically don't include it in your cost because you show it as GST receivable. It's shown as an asset, GST receivable. It is not to be included under your cost of inventory. Other expenditure directly attributable to the equation, trade discounts, rebates, duty drawbacks, etc. are to be deducted. Trade discounts, rebates, duty drawback, etc. we are getting, they are deducted from your cost. Cost of conversion. Now, conversion may two things. We bought raw material. Can I say we are converting into finished goods? So there will be fixed production overhead. There will be variable production overhead. Variable production overhead always goes based on actual units which has been produced. It goes on the actual production. But fixed production overhead are allocated to your inventory how? So they are allocated to inventory based on normal capacity. Which capacity? Normal. But sometimes we have high production. If you have a high production, then what happens is if I still go based on normal capacity, then the per unit cost will go down. But that will be a wrong picture. That will be a wrong picture. So what happens over here is if basically you are having it normal capacity or actual capacity, whichever is lower. See, if at all you are comparing basically overhead per unit, fixed production overhead per unit based on normal capacity or fixed production overhead per unit based on actual capacity, whichever is lower is to be taken. But I'm not telling basically the capacity lower. I'm telling is per unit, fixed production overhead per unit based on normal capacity. Imagine your fixed production overhead is 1 lakh and normal capacity is 1 lakh. What is the fixed production overhead based on normal capacity? 1 lakh divided by 1 lakh, that is coming 1 rupee. Now actual production is 80,000, so it will come 1 lakh divided by 80. Can I say it is coming more than 1? Now it is coming more than 1 because you were not able to make the proper production. So can I say it is due to your wastages, etc. So then in that case you can't take under inventory more than 1. You have to take it 1 only. Okay, but imagine you are able to produce 1,20,000. If you are able to produce 1,20,000, the 1 lakh divided by 1,20,000, it is less than 1. So in that case, you take less than 1. So it is fixed production overhead per unit based on normal capacity or actual capacity, whichever is lower. I'm not telling normal capacity or actual capacity lower. I'm telling fixed production overhead per unit based on normal capacity or based on actual capacity, whichever is lower. Did you understood? Okay, variable is always on actual. Other cost is fine. Now, if you check this question, first they are telling we have some 30 lakh is fixed and 10 lakh is the normal capacity. So, can I say 30 divided by 10, 3 rupees per unit cost based on normal capacity. If you are producing less, it will come more than 3. Then will not take more than 3, will take only 3. Will take only 3. So, 750 into 3 will be allocated to inventory cost. Extra is your wastage, which will go in your PL. But if you produce 15 lakh, can I say you produced more? If you're producing more, if I take still based on 3, stock will be overvalued. So now we have to do is 30 lakh divided by 15 lakh, which is coming as what? 2. So based on normal capacity, it was 3 per unit. Based on actual capacity is 2 per unit. I have to take whichever is lower. So now I'll take 2 per unit. Did you understand? Okay, done. Next. This question is as such a similar, but only thing is यहाँ पे the capacity is given in terms of hours. So full capacity, no, I don't have to take full. I have to take what? Normal capacity. Normal capacity is 7500 hours. Now actual hours are 6500 actual hours. And if you see actual unit produced is also, so I can understand 1 unit takes how many hours? 1 hour. 1 unit takes 1 hour. Fine. Now your fixed production overhead is 1500. 1500 divided by normal capacity 7500 hours. So can I say it becomes 0.2 per hour? Okay, if I go based on actual capacity, it's 1500 divided by 6500. 1500 divided by 65, it's coming more than 0.2. So I should take 0.2 or this one, whichever is lower. So it will be 0.2 per hour will be allocated. So 0.2 per hour will be allocated to inventory. Extra is your wastage, which will go directly in your P. Now your opening unit was 2500. You produced 6500 and you sold 6700. What is the closing? 25 plus 65 minus 67. Can I say closing inventory is 2300? Closing inventory is how much? 2300. Now 2300 into variable is based on actual. Variable cost is it given? Yeah, 2600. 2600 divided by, what should I do? 2600 divided by 7500 or 6500? 6500. So 2600 divided by 6500, can I say 0.4? Plus fixed is based on normal capacity, actual capacity, whichever is lower, it was coming 0.2. So 0.4 plus 0.2 is 0.6, and you have total 2300 units. Now 2300 units into 0.6 is per hour. And how many hours are there? 1 hour per unit. If suppose there were 2 hours per unit, now the answer may into 2 had to be. So over here it is 0.4 and that was coming as 0.2. Total will become inventory is 2300 into 0.2 plus 0.4 into 1 hour. Now what is not included in the cost of inventory? Abnormal wastages are not included. That's why if you see now, if production was less, we did not had that basically 2.5 covered, we just had this 2 only covered. We took 0.2, we did not took 0.25 wala thing. Reason is that is abnormal wastage. Abnormal wastages are not a part of cost of inventory, they go directly to your P&L. Second, your storage cost. Your storage costs are not to be included in inventory because we store once the goods are ready. But sometimes storage is a part of process. If it's a part of process, like inventory needs to be stored in between before further processing, then in that case such storage cost will be included in cost of inventory. Admin overheads are not included, selling overheads are not included, interest and finance costs are not included unless it's a qualifying asset as per your Ind AS 23, then they are included. Fine. Joint product, byproduct. Now tell me, byproduct, whatever is the NRV of byproduct, we deduct it from the cost of main product. NRV of byproduct is deducted from the cost of main product. Now suppose in your main product you are getting 2 main products. If 2 main products are there, can I say total cost has to be divided between 2? So the total cost will be divided between 2 how? The total cost will be divided between 2 how? In a reasonable basis. If you see over here, the word written over here is allocated on a rational and a consistent basis. Now rational and consistent basis is one is sales value at split off point. Sales value. Sales value is what? The units which are coming multiplied by the selling price per unit. The sales value at split off point or sales value upon completion. Suppose many times at split off point they cannot be sold, they will be further processed and then sold. So either the sales value at split off point or the sales value at completion. Better is always the sales value at split off point. Better is sales value at split off point. Okay, check this question. First of all, you are getting MP1, MP2 and you are getting one byproduct. Can I say byproduct cost I have to deduct from the main product? Okay, now byproduct they have clearly given over here. Byproduct can be sold at 20. So can I say 2000 into 20? But we need to deduct NRV of byproduct. Okay, is there any cost which we have to incur? Profit nahi. But we have to incur further processing cost 8000, packing 2000 and scrap realized is a separate thing that you ignore it. So 8000 and 2000 is the further processing cost before I can sell off the scrap. Not scrap, byproduct. Before selling byproduct, what is the cost to be incurred? 8 and 2. So NRV, what is NRV? Estimated selling price minus estimated cost to complete the product minus estimated selling expense. So what is the selling expense of byproduct? This byproduct over here 8 and 2. So out of 48 and 2 will go. So can I say byproduct is to be valued at 30,000. So 30,000 I'll deduct it from the cost of main product. Plus I'm getting a scrap ka 5,000, that also will be deducted from the cost of main product. So profit on byproduct which will come, that is to be ignored. Usko kuch nahi karna hai. So we have already deducted NRV of byproduct. Scrap is separate from byproduct. Scrap is separate from byproduct. From your main product cost, see NRV of byproduct deducted, and the scrap value other than byproduct we are getting 5,000. That is also deducted. Now your total cost. Your cost is 1, 2, 3, 4. These 4 things are given: 150, 90, 65, and 50. So now your total cost is 320. How many products we are getting? 2. Which are the 2 products we are getting? MP1, MP2. Okay, MP1 5,000 unit. So should I divide into 5:4? No. It should not be based on units. It should be based on sales value. So it is 5,000 into 60 and 4,000 into 50. 5,000 into 60, that is 3 lakh. 4,000 into 50 is 2 lakh. To divide it in the ratio of 3:2. The total 320 allocated in 3:2. And now the closing stock we are having of basically all the things, that is your MP1 and MP2. So this is the cost allocated to them. This is for how many units? We already know the units was 5,000 and 4,000. The per unit cost is also available. That will be the base for calculating your closing stock. Did you understand this? This is an important question. 2-3 times it has been asked. Now, technique for measurement of cost. Your technique for measurement of cost. Just 1 minute. How many units? We already know the units was 5,000 and 4,000. Okay. Now, see, if the inventory is not ordinarily interchangeable, means one inventory and other inventory are separate. Like we make customized machine. So can I say one machine, other machine is different? It's all customized machine. Or we have some different types of machine. One machine cannot be replaced with other one. So if I have some stock of 2-3 machines or WIP machines going on, can I say each of that machine will have their own separate cost because they are made as per the specifications of customer. So then in that case, that each of the machine has to be valued separately. But if the inventory is ordinarily interchangeable, we make benches. Can I say all benches are of same type? So now the thing is, we might have made a lot number 1, then we might have made a lot number 2, then we might have made lot number 3, but can I say all are of same type? So in that case, they are ordinarily interchangeable. If they are ordinarily interchangeable, they will be valued. The cost will be either based on FIFO or weighted average. Okay, we can use standard cost method or retail method if it approximates the actual cost. Now, what is the standard cost method? We use some standard. I know bench cost is average 2,000 rupees. So I value it at 2,000. But now, whenever plywood cost increases or steel cost increases, can I say I have to revise my standard? And retail method is you're having lots of items. You can't basically go into cost of all that things. But I know I have a similar margin. My product has 20% margin on MRP. So do one thing, whatever stock lying with you, MRP ka total karo minus 20% becomes your cost. If you have a 20% margin on sales, so deduct 20%. If you have a 20% margin on cost, so ye sales value tha, so you can't deduct minus 20%. Then you are required to do is 20 by 1. Okay. So this is fine. This line is important. Inventory with a different nature or use, the different cost formula can be used. So I have 2 inventory, different nature. So one may I use FIFO, other may I use weighted average. Is it okay? Answer is yes. Okay. Same inventory, different location. Same type of inventory but different location. Can I use different cost formula? Answer is no. It's different nature or use. If they are just different location, answer is no. Next is NRV, we already understood. Now one more thing. Suppose, which is the thing which gives you evidence about the NRV? The sales which happen after the year end. What gives you a better evidence of NRV? Sales which happen after year. Now after year end, if the prices have fallen, remember adjusting, non-adjusting event wala thing. Now prices have fallen because a new product was launched. Now see, we know Apple launches their iPhone every time on 14th September. Their new product launch hone hi wala tha, price of old one were going to go down only. Was I knowing it? Yeah, that's a normal thing. And I know some companies have a tendency to launch their product in April. So every now and then few people launch the product. So uske karan, if the prices of old product have gone down, it is a adjusting. General market changes are all adjusting event. Now, unless something extraordinary happened, like say earthquake happened and the goods are destroyed, uske karan now there will be some extra repair cost required, then in that case it is not an adjusting event, that's a non-adjusting because that earthquake happened in April. 31st March ko they were not damaged. Did you understood? Okay, so that also is to be considered. Plus, if you have any firm contract, imagine, normally this can be sold at 100 rupees, but I already have a contract to sell at 110, so my NRV will be based on 110. To the extent I have a firm contract. I have a firm contract for 5,000 unit, stock mein there are 7,000 unit. For 5,000 unit, 110. For remaining 2,000, I'll take not 110, I'll take only 100. Okay, this is fine. Question 6 is okay. Question number 7 over here. The cost of spare part is 10 million and expected selling price is 12. However, due to market fluctuation, okay, market fluctuation is normal or abnormal? Normal. That is known. That is known. Is it adjusting or non-adjusting? Adjusting. Now the price is reduced to 8 million. So 12 ki jagah it became 8. Cost was 10. We should value at 10 or 8, whichever is low. So can I say they are valued at 8? Achha, 8 may be estimated selling price is 0.5. So 8 being 8 is 7.5. So it is 7.5 or 10. So can I say we recorded a loss of 2.5. So it will be valued at 7.5. 2.5 is the loss to be booked. Now later on, what happened is the market conditions have improved. And now inventory is worth 11 million, but 11 may say 0.5 will be the selling expense. So can I say now it's 10.5? Okay, can I bring back to 10.5? No. Can I bring back to 10.5? No. Cost was 10. 10 or the revised NRV is 10.5. Whichever is lower is 10. So whatever I had booked previous 2.5 will be reversed. Previous 2.5 loss will get reversed. Next is NRV of raw material. Now is raw material held for sale? Is raw material held for sale? No, raw material will be used in production. Raw material is not for sale. The price of raw material has gone down, don't see that. We have to see the raw material are to be used in finished goods. If the finished goods in which the raw material are to be used, if they are to be sold at a loss. If finished goods in which the raw material are to be used, they are to be sold at loss. So can I say then the loss will come? Then you include the raw material. Then the NRV of raw material is its replacement price. Then the NRV of raw material is its replacement. Kab dekhna hai? If the finished goods in which the raw material are to be used, that finished goods are to be sold at a loss, then the NRV of raw material is the replacement price. But if the finished goods in which raw material are to be used, they are to be sold at or above cost, so can I say profit will be there? Then in that case, NRV of raw material is considered to be more than it cost only. Then in that case, you value the raw material at cost. Okay, so I have to see finished goods are to be sold at profit or loss. That is the most important. Okay, if you check over here, finished goods are to be sold at or above cost. So raw material ka NRV is considered to be higher than cost. The raw material will be valued at cost. If finished goods are to be sold at loss, so NRV of raw material is what? Replacement price. And then now to value at cost or NRV, whichever is low. And NRV of raw material is the replacement price. Okay, now I have product A, product B, product C. Cost, NRV. Cost of product A, NRV of NRV. Cost of product B, NRV of product B. Cost of product C, NRV of product C. Would I compare the total cost and total NRV or item by item? Item by item. Then reversal, we already did it. Question number 8 is important. You had supplied, there was some order which was received by you, and you were basically making an order for the customer. Now customer has a liquidity crunch, and customer told you to postpone the delivery schedule. I was making goods for a customer. Now customer has a liquidity crunch. They are telling me, sir, now don't make more. The problem is already we have a WIP for that customer. We have started making 85. We already have some finished goods of 55, and we already sold something and have to receive from that customer. Debtor is 65. Now this was, can I say, specifically for a customer, and they've written over here design supplied by customer. So this 85 and 55 inventory which I'm having, this was the goods I was making for some customer, and now customer is telling me, sir, don't supply to me right now. Now if I'm able to sell it in market, and assuming I'm able to sell it at my cost only, so can I say NRV is same? So you can then show continue at 85 plus 55, that will become 140. But if this was specifically designed from someone, it cannot be used anywhere else, then the NRV is 0. Then in that case, you should value it at 0. This is for inventory. And about the debtor, if I feel customer is not going to pay, I should make a provision. Okay, so check over here. So in absence of NRV, if you assume the cost is lower, NRV is higher, you continue at 140 lakh. But if you assume that there are no buyers, the NRV will be nil, then in that case you will be valuing it at nil. Done. This was your Ind AS 2. Let's go to Ind AS 16. Now going to Ind AS 16, which is your PP. We'll do Ind AS 16, Ind AS 38 together because PP and intangible asset both are kind of related ones. Now PP is nothing but a tangible item which are held for use in production or for supply of goods or for rental to others or for admin purpose, and they are going to be used for more than one. Like suppose I tell you many times we have a punching machine. You might have seen attendance ke liye biometric machine. So they are basically for which purpose? Admin purpose. But they are going to be used for more than 1 year. So that biometric machine which we are having, that can also be capitalized. It will be coming under your PP. Okay. Now, what is investment property? Investment property is nothing but, first of all, it's a property. Property has to be land or building. Land or building, and uska purpose is to earn capital appreciation or investment income, rental income kind of it. That is basically the purpose. Okay. If I have a building which is for use, it's a PP. If I have a building which is for rental to others, investment property. Okay, if I have a machine for use, PP. If I have a machine for rental to others, PP. PP, because investment property has to be a property, and property is only land or building. So machine which is for use or machine for rental, both are PP. Building for use, PP. Building for rental, investment property. So building for rental is investment property. Machine for rental is PPU. Fine. Now, when can I capitalize a PP? So there are two things. One, we have to see the definition of asset. Can I say future probable economic benefits? So future economic benefits are probable, and second, you should be able to measure the cost reliably. These are the two conditions whenever you have to record something as an asset. So future economic benefit should be there, cost should be measured reliably. This I need to check whenever the costs are incurred. If you incur initially, subsequently if I do extra cost, so again you have to check subsequently whether you get future economic benefit, cost can be measured reliably, and does it fit the definition of PP. Fine. Day-to-day servicing. Day-to-day servicing always goes in your PN. Replacement of part ka replacement, yes, can be capitalized if it meets the definition of PP. Part has a life more than 1 year, so then you capitalize the new part. Carrying amount of old part has to be removed. Carrying amount of old part has to be removed. Okay, regular major inspection, they are accounted as a replacement. So that is basically a kind of replacement of part ki tarah, they will be accounted in similar way. Now, what value to capitalize? Initially, they are capitalized at cost. So day one, if you buy a PP will always appear day one pay at cost. Subsequently, you may do a revaluation, but day one is always cost. It cannot appear on day one at fair value except the PP coming under business combination. Remember, they are accounted at acquisition date, fair value. Only business combination wala PP, they will be acquisition date fair value. Otherwise, if you buy a PP, day one, it will always appear at your cost. Now, what is cost of PP? Your purchase price. I have non-refundable taxes, non-refundable credit I am not getting, they are included in cost. Any cost incurred in bringing the asset to present location condition and initial estimate of dismantling. This is important. So imagine I put up a machine. I know after 20 years I have to remove the machine. After 20 years I have to remove the machine, and there will be some removal cost. So that initial estimate of dismantling is also included in my cost of PP. So the thing is, they just want that dismantling cost should not come in 20th year. The dismantling cost should come over a period of 20 years. Because if you capitalize, can I say it will be now in form of depreciation over 20 years. Okay. Examples which are directly attributable: employee benefit, the employee cost related to making that PP, site preparation, delivery handling, installation, professional fees. Okay, cost of testing. I'm making a machine in-house, it's developed. So can I say I do a testing also before using? Now when I do testing my cost is involved, but can I say some testing my products also will be generated? Okay, so what is the accounting for that product which is generated out of testing of PP? Uska selling price is deducted from cost of PP. So whatever is the product which is coming in testing, we sell that product, whatever money comes is deducted from the cost of PP only. Now I have a question. Testing cost is 1 lakh, product generated is sold for 120. Testing cost is 1 lakh, product generated from testing is sold for 120. So can I say we got extra 20,000? Should I deduct that extra 20,000 from PPE or should it go in PNL? Did you understand the question? Yes, no? Now there's amendment over here. There's amendment over here. If basically that cost of testing is there 1 lakh and you got some money which is by sale of product of costing and sale of testing product is more than 1 lakh, that extra 20 you received will also be deducted from the cost of PP. Will also be deducted from cost of PP, and this is a carve out from your IAS 16. They want it in PNL. We were also having in PNL, but this year they came out with the amendment. Now only, if you just check out the latest RTP, November 2020, November 22, in that latest RTP, this amendment is given. Let me just open up for you. 1 minute it will take. Okay, this is the November 2022 RTP. I'll just go over here. If you see this PP, Mila, Ind AS 16 has been amended. What? The excess of net profit from sale of item produced during testing will not be credited to PNL. Will not be credited to PNL. It will be deducted from the cost of PP. So excess money which comes from testing may, if I am getting more, it's deducted from PP, will not go to PNL. Shall I move ahead? Okay, going back. Not this. Now, what are not included is a cost of PP. One, if you're starting a new business, you are doing some inauguration, etc. That all is not covered in the cost of PP. Cost of introducing a new product, kind of advertising, etc. is not. Cost of conducting a business in a new location. You are shifting from here to another location. That cost is not included. Admin, general overhead are not included. Fine. If it's a self-constructed asset, internal profit should not be there. One department gave employees to another department. One department gave employees to another department for constructing a PPE, and that department has made a profit. So for a company as a whole, when I'm recording PPE, internal profits are to be eliminated. Abnormal cost will not be included. Interest will be included in the cost of PPE if it's a qualifying asset as per Ind AS 23. Fine. We have this question given. I'll just take the important ones over here. If you see over here, there's a maintenance contract. So together with basically machine, I also bought a maintenance contract. The amount which I paid for maintenance contract, can I capitalize? No, because that's not for machine. That's for servicing, which I'll be getting after I bought the machine. So that will go directly to your PNL. Okay, trade discount is 10%. So that will be deducted when you're finding the cost. Okay, settlement discount. If you pay money within 1 month, they will give you 5% extra discount. That will not be deducted from the cost of PP. It will be going to your other income, basically your PNL separately. So trade discount is deducted. Settlement discount is not deducted. Reason: settlement discount is not for machine. It's not for machine. It's basically for making payment early. So machine के लिए है ही नहीं. ठीक है. Next, we have the question over here. In this question, if you just check, material costing 1 lakh had been spoiled and therefore wasted, and 150 was on account of some faulty design. Can I say this 1 lakh wasted, 150 wasted, and because of this the work had stopped and 22,000 labor was also extra. So this all is what? Wastage. If all this is wastage, can I say wastage is not included in your cost? So from your material cost, I'll deduct this 1 lakh and 150, 250. From your direct labor, I'll deduct 22,000. That all will be deducted. The material may say 250 deducted, labor may say 22,000 deducted. Achha, now over here we have taken a loan. We have taken a loan for construction. Loan is at 8%, and loan is taken on 1st April 2000. For purpose of construction. As the given, construction also started on 1st April. Construction started 1st April, loan is also taken on 1st April. So can I say capitalization starts from Okay, construction started on 1st May. So May the capitalization start. Okay, construction started 1st April, loan taken on 1st May. Then also capitalization starts from 1st May. Because see, for capitalizing, there should be interest cost. Na? Interest cost hai to capitalize karoge. April mein loan only was not there. So then there cannot be capitalization. So if construction started late, from the date of construction capitalization. Loan taken late, still from the date of loan only, the capitalization will start. Here it is starting from 1st April 2000 only, and it was completed in January, brought to use in April. See, brought to use is not required. When is completed? January. So 1st April 2000 to 1st January 2001. Can I say 9 months it will be capitalized? Now some people argue, sir, 9 months is not a qualifying asset. For qualifying asset, it has to be 12 months. But the word written is generally a period of 12 months. So if it is 9 months also, ICI capitalize, we also will capitalize. Okay, fine. Now if payment is deferred beyond normal credit term, normally the credit period is kind of 1 month, but they have given you a credit period of kind of 3 years. So then in that case, can I say that whatever I'm paying, someone buying machine paying now, and I have to pay over 3 years, definitely I'll be paying a bit extra. That is towards interest, not for machine. So I have to basically recognize the extra amount paid as interest over the period. Okay, incidental operation. Building was getting constructed. Now till the time building is getting constructed, together with building there's some open plot also. So the open plot is given as parking lot to someone. If that is given as a parking lot to someone, that income will go directly in your P&L. It will not be deducted from your cost of PP. So incidental income coming out will go in P&L. It's recognized in P&L. When should I stop capitalizing? When should I stop capitalizing? The word written over here is when the asset is capable of operating in a manner as intended by management. What is the word written? Asset is capable of operating in a manner as intended by management. It means the way I want to use it, it's ready. The way I want to use it, it's ready. The way I want to use it, it is ready. Now sometimes what happens, it's ready, but I started using after 3 more months. If I started using after 3 more months, that is not to be seen. I'll stop capitalizing the day when it is capable of operating in a manner as intended by management. If you put to use later, that doesn't matter. Okay. Now cost incurred. Following costs are not included. Which are the costs not included? It's capable of operating in a manner as intended, but you're put to use later. That is not included. Initial operating losses, cost of relocation, they are not included. Okay. Now see, there's a soft opening of park to the public. We came out with some amusement park, Wonderla, and imagine your Wonderla has started, but first 3 months they operated at 60% capacity. We want to be sure the things are running fine. Then we go to 100%. Okay, now when you are having a real people coming over there, is it really a trial run? No. So don't say it's a trial run. Yeah, you want to operate at 60%, that's your lookout. That is basically you want to see whether you're able to manage a lot of crowd or not. It is not like the asset is not capable of operating in a manner as intended. The rides are capable of operating in a manner as intended. So there was a soft opening. They started at 80% capacity. It doesn't mean that it is not capable of operating. It is capable of operating in a manner as intended. Now you cannot capitalize anything. Now the capitalization should stop. Okay, next, exchange of PP. Okay, one PP exchange with another. One PP is exchanged with another. Okay, imagine I bought some machine and I gave a land. I bought a machine, I gave a land. Machine will be debited at what value? Fair value of machine coming or the fair value of land given? Fair value of machine coming or the fair value of land given? See, normally it will be always at fair value, and fair value of asset given up is to be taken because वो हमारा asset है. I know much more than someone else. So दूसरे का asset I don't know, but my asset I know. So it is fair value of asset given up. But if fair value of asset given up is not prevalent, then in that case we go for fair value of asset received. Okay, that is fine. But they've given if the transaction lacks commercial substance, like your car exchange with my car, तो उससे कोई cash flows पे फर्क नहीं पड़ेगा. See, machine coming ना, can I say it will have impact in business cash flows? But I have an old Swift car, you have an old i20 car, we exchange. So I just wanted to feel how Hyundai is driving and you wanted to feel how Maruti is driving. Otherwise, cash flows of anyone will not change. Then can I say it does not have a commercial substance? If the exchange does not have a commercial substance, then in that case, or the fair values of both cannot be determined only, then in that case they will be accounted how? At the carrying amount of asset given. The new asset is recorded, the carrying amount of asset given. Fine, this is done. This question is okay. I'm not going into the question related to this. Now, how do we measure the PP after recognition? Day one, can I say we recognized at cost? Now balance sheet date comes. So how do we have it? Either you have a cost model being followed or a revaluation model. Under cost model, what will happen? It will appear at your cost less accumulated depreciation, less accumulated impairment. Impairment is covered under Ind AS 36. I'll come to it. Okay. Second is revaluation model. Under revaluation model, what will happen is, like, suppose if you would have revalued it, so now the revalued amount is there. The revalued amount less accumulated depreciation, less accumulated impairment, which came up after the date of revaluation. Now, revaluation, if a model I'm following, is it necessary that I have to revalue every year? No, you have to revalue in a manner that the book mein aapka value and the fair value is not too much different. It's not too much different. If at all there's an asset whose value doesn't change much, you can follow revaluation once in 3 years, once in 5 years. If there is an asset whose value changes frequently, then you can follow a revaluation on yearly basis. Okay, next. Okay, question number 7. Now they have given revaluation should be based on class of asset. What is the word written? Class. Entire class has to be revalued. Imagine I have 2 types of building: office building, factory building. If I follow revaluation model, can I follow revaluation model only for office building, not for factory building? Can I follow revaluation model for office building but not for factory? Factory building is cost. Yeah, chalega, because they are 2 separate class. 2 separate class. But I imagine I have 10 laptops. All are similar. Can I follow revaluation model for 2 laptops and 8 laptops I follow cost model? No. All entire laptops has to be by same. Did you understand? Okay, so this is a question wherein the class of assets are to be found out. How many classes of PP are there? How many classes? Okay, the one, you have a vacant plot where you will be constructing something. Second, you have a plot which is a landfill site. You put all your scraps over there. That's a landfill site. Third is a plot where you already have a headquarter. Fourth is a plot where you have a sales office. Then property E1 to E10 are retail outlets. Then equipment A is computer system, which is at HO. Equipment B is a point of sale computer system, which is at retail outlet, and there's some fittings, furnitures in admin, headquarters, shop fittings and retail outlet. Okay, so how many class? So one, you have some vacant plots. See, vacant plot and constructed thing, they are 2 separate things. So they are 2 separate class. One, something is vacant and something is constructed. Now constructed means HO and your retail outlet, you may take them as separate class, HO building separate and retail outlet as separate. That is up to you depending on their nature and use. You may take them as separate class. Now coming to over here, the equipments, computer system, it is at HO, and point of sale computer system, which is at retail outlet. But see, computer system at HO are integrated with the point of sale computer system in retail outlet. If they are integrated, they are 2 separate class or 1 class? 1 class. So then this 2 equipment A and B are 1 class. The furniture at HO and furniture at retail outlet will be different. Retail outlet, you will have shelves, you will have display wale materials, all that kind of thing. But can I say in corporate office, you will have kind of sitting with table, chairs, and that is a different thing. The furniture fittings, which is at HO, furniture fitting, which is at retail outlet, they are 2 separate classes. Then accounting treatment of revaluation. Okay, we understood revaluation. Now how do I account for the revaluation? Yeah, then we can take equipment A and equipment B as a separate things. Different types of computer as a month. Okay, software, this is separate use, this is separate use software. It's always basically, Ind AS are all principle based. It's all basically going on how you feel. But exam purpose, you have to feel what ICI feels. Okay, now coming to accounting treatment of revaluation, it's simple. Whenever revaluation is upward, we take it into what? OCI. Remember, OCI may say an accumulated in other equity. Revaluation first time is downward, it goes in P&L, because in OCA the word was revaluation surplus. Okay, first time was upward revaluation. First time was upward. Later it is again upward, again in OCA, later downward. So to the extent balance is available in revaluation surplus, we debit over there. Extra will be debited to P&L. Okay, first time was downward. First time was downward, went in P&L. Again downward, again goes to P&L. Now upward. So to the extent you've taken in P&L, that much will go in P&L. Extra upward will go in OCA. Extra upward will go in OCA. This is a simple thing, we know about it. So I just go ahead, and important is this presentation of revaluation. Okay, there's a revaluation upward. How do I present it? There are two ways of presenting. So imagine cost was 100, accumulated depreciation was 40, and can I say asset was 60? Cost 100, accumulated depreciation was 40, and net was 60. Okay. Now we revalue to 80, so 20 goes up. So how should I increase? One option is cost and accumulated depreciation, both you increase proportionately. How do you increase? Cost and accumulated, both you increase proportionately. 60 is becoming 80. Cost was 100, so 100 will be how much? 60 becomes 80, so 100 will become how much? So 100 into 80 by 60 karo. 100 into 80 by 60, 133. Same way, accumulated depreciation was 40. Okay, 60 became 80, so 40 should become 40 into 80 by 60 karo. 53.33. So cost becomes 133, accumulated depreciation becomes 53, and net became 80. So can I say both cost and accumulated are proportionately increased? That's one way of presentation. Both cost and accumulated are proportionately increased. Second way of presentation is you remove accumulated depreciation fully. Okay, how much is accumulated depreciation today? 40 है ना? Remove कर दो. Accumulated depreciation as a credit balance. So accumulated depreciation debit to asset. Accumulated depreciation debit to asset. Accumulated depreciation became 0. An asset was 100 minus 40 accumulated depreciation now removed from there. So now asset became 60. Increase asset by 20. The entry will be asset to OCI. Asset to revaluation reserve OCI. It will become 20 rupees. So now cost will be 80. Accumulated depreciation 0 and net is 80. So one option is you increase cost and accumulated both proportionately. Second option is you remove accumulated depreciation fully right now. So we removed it. Now asset became 60. Now you make the asset as 80. Did you understood? Okay, these are the two methods which are there. Okay, now question, if I do a revaluation, we put it under revaluation surplus. Now question is, subsequently because of revaluation, can I say depreciation will increase? Subsequently because of revaluation, earlier depreciation was on 60 rupee or 100 rupee, now depreciation will be on higher amount. My question is, if subsequently the depreciation has increased, the additional depreciation, do I need to set it off against the revaluation reserve, or the full depreciation will go in P&L only? Okay, because of revaluation the depreciation has increased, still the full depreciation will go to P&L. But amount equal to additional depreciation, you can, it's not mandatory, you can remove it from revaluation surplus and transfer that much to retained earnings. Depreciation will go in P&L only, but amount equal to extra depreciation, if you want to remove from revaluation surplus and transfer it to retained earning, you can do it, but it's not mandatory. Some of the surplus may be transferred. What is the word written? May be transferred. The amount equal to additional depreciation, you can transfer it. Kahan se kahan? From revaluation surplus to retained earnings. But there is no transfer done in P&L. Depreciation 100% goes in P&L. From P&L it went in retained earnings. Correct now? From P&L everything goes in retained earnings. So extra depreciation, you want to remove it from revaluation surplus, transfer it to retained earnings. That much also you can do. That's up to you. Now check RTP 19, RTP 20. This question was there. Gross 200, accumulated 80, net was 120. Now the net became 150. So can I say 30 is increase? Now how do I present it? One option is gross and accumulate, both have to be increased proportionately. How to increase proportionally? 120 became 150. So gross 200 will become how much? 120 becomes 150. So 200 will become 250. Same way, 120 become 150. So 80 will become how much? 100. So that is how one way. Second option is we remove the accumulated depreciation fully, and then The asset became 120. Now make the asset as 150. So now gross is 150, accumulated will be nil, net is also 150. There's a second P. Both basically answers will remain same. Okay, now depreciation, we follow component method of depreciation. What is a component method? If in a BP, a component, a part has a separate useful life, then that part will be depreciated over its life. Like out of a car, you can have tires and battery. Their life is 5 years, and entire car has a life of 10 years. So tires and battery you can depreciate separately in 5 years, and the remaining car you depreciate over a period of 10 years. Always has to be bifurcated because land has unlimited life. It is a non-depreciable thing. Building always has a limited life. So you need to bifurcate between both. Fine. This question is good. Check. You have purchased at 1 CR with no breakdown of components available. No component breakdown available, and you bought it for how much rupees? You bought it for 1 CR. Life is 10 years. End of 6th year. End of 6th year. One major component, turbine, needs a replacement. Okay, turbine needs a replacement. Can I say new component, new turbine will come in? New turbine ka cost will be added. And can I say carrying amount of old turbine needs to be removed? Now, day one, was I able to bifurcate the turbine cost? Why no? No breakdown available. No breakdown of component approach was available. So 1 CR was there. We were depreciating over 10 years. So can I say in 6 years, 60 lakhs is depreciated. How much is remaining? 40. Now, in this 40, there is something old turbine. How much? I don't know. We'll find. Today, new turbine is 45 lakhs. Today, new turbine is, and the interest rate, discount rate they've given is what? 5%. Now, today it is 45 lakh. To 6 years back, what would have been the turbine cost? So 1 divided by 1.05, you take for 6th year. 1 divided by 1.05, you take it for which year? 6th year. 1 divided by 1.05. First year, second year, third year, fourth year, fifth year, 6th year. Into 45 lakhs. It is coming 3357. Yeah, 3357, 969. So today it is costing 45 lakh. To 6 years back, it would have costed 33 lakh. It would have costed. Now, it would have costed 33. Does it mean that it is 33 in your books? You depreciated everything 10 years. So into 6 by 10 is depreciation. So into remaining is what? 4 by 10. So 3357 into 4 by 10. What is the old turbine value now? 13 lakh. So based on today turbine available at this rate, so I can understand turbine at that time would have been 33. We have depreciated for 6 years out of 10 years. So today the turbine left old wala is 13 lakh 40,000. 1340? 1340, whatever. So 13 lakh rupees is basically the old turbine. So what I should do now? Today we are having a value total 40 lakh. Remove old turbine 13 and add 45 lakh of new turbine. Did you understood? Only thing is old turbine cost was not available, which we are trying to figure out based on new turbine's cost. New turbine today is this much. Old turbine 6 years back would have been how much? Next, we have this question. I just take the few important things again over here. See, one is overhead incurred directly on construction of factory. Do I include it in PP? Overhead incurred directly on construction of factory. Do I include it in PP? Yes. Second, ongoing overhead allocated to construction project. No, that is not to be taken. It's not specifically for that. It's just allocated. So, wo nahi lenge. Okay, income received from temporary use. Remember that plot we have temporarily given it for car parking. That will go in PN. That is not to be taken. Cost of relocating? No. Opening ceremony? No. This all is not to be taken. And now there is a total life of how many years? 40 years. There is a total life 40 years. However, it is estimated the roof will need a replacement of 20 after 20 years. So can I say out of total building, roof ka life 20 years, remaining building 40 years. So we have to follow which approach? Component approach. And roof cost is 30% of total building. So once you find a total cost, 30% is roof, 70% is remaining. Roof you depreciate over 20 years and remaining you depreciate over 40 years. Fine. And there is a loan which is taken. We will capitalize the interest for that basically. And one more thing, The loan taken was temporarily invested somewhere, so we got some money from temporary investment of loan that will be deducted from the cost of capitalization. Take it, fine, this was okay. Accounting treatment of depreciation. Depreciation always goes in your P&L. Now the word depreciable amount and depreciation method. Now depreciable amount, do I need to depreciate the full cost? No, I don't have to depreciate full cost. I need to depreciate in a manner that the end of useful life it comes to its scrap value. The depreciable amount is cost minus scrap value, which I have to amortize it over the useful life. Fine. Which is to be allocated on a systematic basis over a useful life. Okay, now review of residual value and useful life. Whatever is the useful life taken or the residual value taken, you need to review it at the end of each year. And if there is a change, the accounting will be done prospectively. Accounting will be done prospectively as a change in accounting estimate. Okay, when will the depreciation start? The day when it is capable of operating in a manner as intended by management. So the word written is available for use, not put to use. When should I stop depreciation? One, when the asset is classified as held for sale or the asset is derecognized. Derecognized माने आपने बेच दिया, sold off, so that's basically derecognized. So either it is classified as held for sale or derecognized, whichever is earlier, that is to be taken. Depreciation method, whichever method you want, you can follow it. It should reflect what? A pattern in which the future economic benefits are coming to you. The pattern in which the future economic benefits are coming to you, that is to be seen. Now, if you feel the benefits will come evenly, you depreciate it straight line. If you feel the benefits are going down slowly and gradually, you follow WDV method. But now I have a question over here. Imagine we thought that the benefit will be coming even, but later on now the benefits are not coming even, the benefits are declining. When I have to shift from SLM to WDV, so whenever I change my method of depreciation, this is nothing but your estimate regarding the pattern in which benefit is coming is changing. Earlier you estimated a pattern of benefit evenly, now you are estimating a pattern of benefit declining. So actually it's not a change in method of depreciation, it's actually a change in estimate in which the benefits are coming. So this is accounted as change in estimate, not a change in policy. So this will be accounted as change in estimate. And estimate always has which effect? Prospective effect, not the retrospective. Okay, now question is, you constructed some railway sidings, roads, bridges, but the thing is others can also use it. You constructed some railway sidings, roads, bridges, but others can also use it. The question comes, can I capitalize it as an asset in my book? Yes. Can I capitalize it as an asset in my book? Yes, sir, we can. See, if you see the definition, they just said future economic benefit should flow to the enterprise and the cost can be measured reliably. So because of this railway siding, bridge, road, there will be some future economic benefit to me. If I don't construct that, the raw material cannot reach to my factory only properly. So I can capitalize it. Others are using, it's fine. It doesn't mean that others are using, I cannot capitalize. Now some people will tell me, sir, control. Yeah. Some people will tell me the word what? Control. The asset is an basically resource which is controlled by an entity. Now see, control is basically when you want to use it in a manner what you want, you can use it. It doesn't mean that control is always not preventing others. Control is what I want to do, I can do it. If I want to use it in a manner, I can use it. Others are using it together, that is absolutely fine. So you can capitalize it over here. The question was whether this can be capitalized. Answer is yes, the future economic benefit will be there, you can capitalize it. But it is possible, you are constructing this so that people can come to your refinery or plant. Now plant ka life and road ka life can be different. If life is different, road will be depreciated separately, entire plant will be depreciated separately. If the life is not different, it will be depreciated together with the life of plant. Next, this question is good. You are having three property. Property 1, 2, 3. This is factory, let out building. Okay, let out building. Building let out is what? Investment property. Investment property, there is only cost model allowed. They are following revaluation model is wrong. Okay. Now this both are factory building. If both are factory building, they fall under same class, different class. Same class. One के लिए cost model, one के लिए revaluation model is also wrong. Did you understand the mistake? Go investment property, revaluation model wrong. यहाँ पे either both should be cost model or both should be revaluation model. Fine. Plus, they've given one more thing. The company did not depreciate any property because fair values are more than the carrying amount. You did not depreciate because the fair values are more than carrying amount. That again is not to be seen. The reason is the PP are not for sale. They are for use. The fair value has gone up. That's why you're not giving depreciation. Answer is wrong. That still depreciation has to be given. But I have a question. If the estimated scrap value is more than cost, I repeat, estimated residual value, not today. When I will be selling in future, residual value which I'm expecting is more than cost. In that case, there will be depreciation 0. Reason is cost minus scrap value. I have to bring it to scrap value. Scrap value is more than cost. Then in that case, depreciation will be. But I don't have to see today's variable. I have to see the residual value ka fair. Okay, next question. Derecognition is either on disposal or when you feel no future economic benefit is going to come. If future economic benefit are not going to come, we just have to write off that asset. So then it will be derecognized, and whatever is profit loss coming, that will always go in your P&L. Fine. Now, changes in existing decommissioning or restoration liability. Pay attention. This is good. What's the word written? Changes in existing decommissioning or restoration liability. Can I say already there's a liability? When I constructed, say for example, we are extracting oil from sea. If we are extracting the oil from seabed, so we would have basically built a rig over there, some machines which we would have put. Wahan se we are extracting oil, all that things. Now, as per the contract with government, I am allowed to extract for 5 years. After 5 years, I have to remove all my things. I have to restore the seabed. So that dismantling cost, restoration cost, remember we have to make a provision, and the opposite effect is included in your PP. In the PP, the site restoration, dismantling, present value is included. Okay, so day 1, the present value of site restoration, dismantling, etc. was included in your PP. Opposite, there is a provision for that. Yahan tak theek hai? Provision was at which value? Present value. Now what happens is provision was done at present value. Every year unwinding of discount will happen. Every year interest debit to provision, interest debit to provision, interest debit to provision. The provision was not done 100, provision was done 60. With interest after 7, 8, 10 years it became 100 and then we pay 100. But question over here is if in between the provision goes up or down. If earlier you thought 100 rupees, but now you're feeling it won't be 100, it will be 120, or you feel that it will now be 200 rupees. So if that goes up or down, how to account for it? Now, if your asset is carried as per cost model, which model? Cost. Now, suppose you had a provision 60 in your book. With interest, it became 70 after 2-3 years. Now you feel it won't be 75. Now you feel it won't be 70 rupees. It will be 200 after some time. Those ka present value is now 120. Books may you have 70. Now in books it should be 120. The books may, can I say provision increases by 50? The liability increased by 50. Opposite effect. If the asset is carried at cost, the opposite effect will come in asset account. Liability increased, asset will go down. Liability decreased, asset will go up. I repeat, liability increased, asset will go up, not down. See, entry is liability going up, so you credit liability, and debit I have to do what? Assets. So liability will go up, asset will go up. Liability will go down, asset will also go down. So entry will be basically asset debit to liability if liability goes up. If liability goes down, the liability debit to assets. Simple words, the corresponding effect is coming in your asset. But if the asset was carried as per revaluation model, then increase decrease in liability will be treated as your revaluation increase decrease. Okay, liability going down, can I say it's a profit? It's an upward revaluation. Liability going up is a loss. It's treated as a downward revaluation. If it is carried at cost, the opposite effect comes in asset. If it is carried as per revaluation model, it's treated as revaluation increase or decrease. So check over here. If it is basically cost model, it is addition to cost or deletion to cost, it will be treated as that. If it's a revaluation model, it will be treated as a revaluation increase or decrease. Okay, come to the question over here. 13th one is good. You have 100 million of asset. 100 million of asset. costing, and life is 10 years. You also have a contractual decommissioning site restoration 5 million, which is at the end of 10th year. What's the today's value? 1 divided by 1.08. 10 years ka. First, second, third, fourth, fifth, sixth, seventh, eighth, ninth, 10. 0.4631 into 5 million. Is it coming 2.31 or 2.32? So what should I do with 2.32? Can I say I need to include it in PP? And opposite, it will appear under my provision. So today, what will be the entry today? PP debit 102.32. To bank 100. And to provision for dismantling 2.32. Yeah, that clear? Okay, so now your asset has become 102.32. Now this 102.32 is to be depreciated over 10 years. Every year 10.23, 10.23, 10.23. This all comes for 10 years, and after 10 years asset became 0. Did you understand? Now 2.32 was the liability day 1. Every year what will happen? Unwinding of discount. So 2.32 into 8% is interest. First year 0.18 came, added, now liability became 2.5. Now next year interest will be 8% of 2.5. It becomes like this. So with interest, after 10 years it became 5 rupees. And then 5 rupee will be paid off. Did you understand this? This is if there is no change. This is if there is no change. Now the first thing is if there is no change. We did the question. Second, if at the end of 4th year, okay, end of 4th year, what is the liability at the end of 4th year? 3.15. From no change wala table, we'll get it. So 3.15 is the liability in books. And at the end of 4th year, asset is 61.39. End of 4th year. Fine. So 3.15 is there. Now they are telling site restoration will not be 5 million, it will be 8 million. But when? End of the life. Okay, this is 4th year end. Both 10th year end. So can I say 6 more years? Okay, so do one thing. 1 divided by 1.08, 6 years equal to. After 6 years, it will be 8 million. So can I say today's value is 5.04? 8 million is after 6 more years. So today's value is 5. So the liability should be 5.04. In our books, it is 3.15. The liability is going up by minus 3.15. Did you get 1.89? Liability goes up by 1.89. Liability credit, asset debit. So liability goes up, asset also goes up. Okay, so now asset was 61.39. Asset was 61.39. In asset also, this is added. If you see 61.39 plus 1.89, it became 63.28. And liability, what was it? 3.15 plus 1.89. Liability became 5.04. Okay, now this 63.28, can I say I have to depreciate over remaining 6 years? This is remaining 6 years, 10.55. Did you understood? And now this 5.04 is the liability today. Every year unwinding of discount will take place at how many percent? 8% unwinding discount. Now this, every year you do this, and afterwards it reaches to 8, which will be then paid. Clear? Okay, next. Okay, next question. We have a kind of bit similar, but it's okay, fine. This was more important. Ye chalega. Similar, you can study it. Going to the next one, Ind AS 38. Yes, please. What will be the life of new turbine? Now, that question you're asking, the turbine was replaced. See, if question doesn't give you the life of new turbine, we will depreciate. See, as such, suppose they say life of new turbine is again 6 years, but this machine itself will be for remaining 4. So that turbine will also be depreciated over remaining 4 years, because it cannot exceed the overall life now. Without that, turbine is of no use. Remaining 4 years. So it cannot exceed the overall life now. Without that, turbine is of no use. Okay. Now going to Ind AS 38, which is on intangible assets. We did PP, now we're going to this intangible. Now, intangible asset, we saw the definition when we did a chapter of business combination. Remember intangible coming under business combination? I told you it is an identifiable non-monetary asset without physical substance. Identifiable, we saw it has to satisfy any of the two things. One is your separability criteria, or it is a contractual or a legal right. That is fine. This control is okay. Just come down, which is relevant for exam purpose. Recognition. When do I recognize an intangible asset? It's again the same thing which was given under your Ind AS 16. Two things. One, future economic benefit should flow and the cost should be measured reliably. Okay. That is fine. Now, measurement of intangible initially at cost. Can I say same way? Okay. And cost, how to find out? It is again same as per your Ind AS 16. How to find cost? I'm not going into it. Next, we have this question over here. If you check this question in this, entry tax 10% recoverable later from department. Recoverable later means the credit is available. Would it be included in cost? No, it will not be included in cost. And if you check over here, we are paying 6 lakhs immediately and 4 lakh we are paying in 1 year time. So can I say after 1 year I have to pay, and the cost of capital is given to us, so that 4 lakh I need to include it at present value. Extra what I'll pay, that will go as interest cost in your PN. Okay. Now this is important. If the intangible is coming as a part of business combination, if it comes as a part of business combination, it will be recorded not at cost, it will be recorded at acquisition date fair value, and I'll record it irrespective of whether it is recorded in their books or not. Okay. It is irrespective of asset whether it is there in their book or not. Fine. Check over here. Earth paid 50 lakh for 100% interest in Sun. Sun ka net asset had a fair value 30 lakh. In addition, they had some other rights also. So whether the 30 lakh includes this? No. In addition, there's a trademark valued at 180 and some distribution right where you will be getting 150 for next 6 years. 150 for next 6 years, and the discount rate given is what? 10%. The total is 4.36. So 150 into 4.36. Can I say it's coming 6,54,000 the value? Okay, so simple words, net assets are 30 lakh, but the 30 lakh does not include 180 of trademark and sole distribution right, which are worth 6,54,000. Actually, can I say the total net assets which is coming under business combination is 30 lakh plus 6,54,000 plus 1,80,000. Is it coming 38,34? Okay, 38,34, and how much I'm paying for it? 50 lakhs. So goodwill will be 11,66,000. Did you understood? Fine. Exchange of asset is same thing. We have to record at fair value. Fair value of what? Asset given. Okay, so this is the same thing. Internally generated goodwill cannot be recognized in book because the cost cannot be measured reliably. Okay, internally generated other intangibles. Internally generated other intangibles you can record in your books. Two stages are there: research, development. Research stage, whatever you spend always goes in P&L. Development stage you can capitalize subject to 6 conditions. Fine. Now question. Say for example, there's a company, they have done a lot of research. They spent 500 crore rupees on research. Now I take over that company. Okay, they spend 500 crores on research. So do they have an asset in their book? No, in their book asset is 0. But can I say their research comes to me? Okay, their research comes to me. Does it have any value to me? Yes. Yeah, no? Because if I don't have that research, I have to spend myself 500 crores. But I know this all they have spent, this is useless. I should not spend. So that indirectly is leading to my savings. Huh? I will not spend because whatever research ka result is there, that is basically helping me out. So the thing is, if at all under business combination, the research phase of other company is coming. Under business combination, the research phase of other company is coming. Can I record that as an asset in my book? Yes. If I do research, it cannot be recorded. But if some other company has done research and I take over that company, then that company ka research work ka fair value. The fair value of the research work today, I can record as an asset in my book. Did you understood? Okay, now the fair value of the research work, what they had done, I record as asset in my book. Now I continue the research, further research. I continue with further research. I spend something on further research. Can it be capitalized? No, but I can spend something on development further. Yes, that can be capitalized. So check, this line is important over here. Just 1 minute. 2. Okay, so if you check over here, If an enterprise cannot distinguish research and development phase, everything is research. Now, in a business combination, we record asset irrespective of the matter whether it was recorded over there or not. So we record separately some project coming from there which meets the definition of intangible. So acquiries in process research and development meets the definition. If it's identifiable, if it is basically meeting definition, so I can record that as an asset. Fine. Next, cost is fine. Cost is same thing what we have done. Now check this question. Check this question on X acquired Y Limited 30th April. X is acquired Y on which date? 30th April, and purchase consideration is 50 lakhs and fair value of intangible is, sorry, fair value of tangible asset is 45. Plus there's an in process research coming of 10 lakh. Can I record that? Yes. So total 45 plus 10 became what? 55. I am paying only what? 50. So can I say 5 lakh rupee will be gain on bargain purchase? Now further you spend another 5 lakh on research. Can that be capitalized? No. Okay, you spend to establish technical feasibility. To establish. Once technical feasibility is established, then you can capitalize. And 7 lakh for further development after technical feasibility. Yes, that is your development cost. The total which you can capitalize is 5 lakh may no, 2 lakh may no. Yeah, this 10 lakh yes, this 7 lakh yes. Total is 17 lakhs. Okay, next question. This is basically 2 times it was basically asked. There's a company which you're acquiring 100% shares of ABR Limited and PC given is 35 crores. The fair value of net asset is 15, but it does not include, the net asset does not include following what? Now they have a patent. They have a patent and the fair value of the patent is 10 crores. But there are some tests still pending. Some clinical outcomes are still pending. If they are successful, then the fair value will be 15. Okay, as of today, what is the fair value? 10. So I should include in my net assets how much? 10. So 15 was there plus 10. Okay, next. They have developed a new drug, got it patented, and which has been approved for clinical use. Cost is 12 based on early sales success. It's a new thing. So based on assessment of early sales success, the valuer feels the market value is 20. Now, here there are 2 answers by ICI. One in their material, one in their RTP, 2 separate answers. One guy is telling like, see, the fair value of intangible should be based on active market. What's the word? Now they are telling clearly this is a new drug and based on early assessment of sales success. So I can understand there's something new. So can I say it doesn't have active market? It doesn't have active market. So one guy said that fair value, you don't take it based on early sales success wala, it should be based on active market. So one answer of ICI says rather than taking at 20, what do? You take it at cost 12. So one answer of ICI takes 12 rupee, telling that the active market is not available. We assume it is equal to the cost. Another answer of ICI takes it 20. The valuer has said the fair value 20. Under business combination, we record at fair value 20. So if you take 12 also, 20 also, both are fine, but the reason what you write, that becomes important. Without writing reason, if you take 12, then it is not correct. But you have written a general sentence, business combination, everything comes at fair value, and you have taken 20, so chalega. So 20 will be fine. 12 if you are writing, you have to substantiate why 12 is taken. So better is take 20. So plus 20. Now third, there's a manufacturing facility has got a favorable inspection, and because of that you got a government ke paas se license to make a new vaccine. Okay, imagine you got a license from government to make vaccine. So can I say that license is something great, but government has given you for free. So can I say it's a kind of government grant, intangible asset received under government grant? Okay, now if you remember, government grant, if I'm getting, I have to amortize it over the period in which the cost is to be incurred related to it. Okay, they said you got to manufacture vaccine, but they put some condition, like you have to sell this much vaccine to government at this much rupee. Like remember that when Bharat Biotech etc. made that COVID ka vaccine, they have to sell 80% of the vaccine only to government, and that too at a fixed rate. So can I say some conditions are attached? If conditions are to be fulfilled over next 5 years, so that grant will go to PNL over a period of 5 years. So day one they'll record intangible asset debit, license account debit. 2, deferred government grant, and the deferred government grant will go to P&L over a period of 5 years. So day 1 we record an asset also, we recorded a liability also. So we'll record 10 asset, 10 liability. So if I just go over here, it is plus 10 minus 10. So now see the net assets, 15 plus 10 plus 20 plus 10 minus 10, ignore it. So what is this total coming? 40, 45, and the net assets is basically 45. We paid 35. Your capital reserve is coming 8. 8 are right? 10. Yeah, capital reserve is coming 10. Someone had taken instead of 20, 12. If someone had taken not 20, someone had taken 12, then their capital reserve will be coming 2. So if you see answer, yahan pe the capital reserve is coming 2. Someone has taken 20 instead of 12, then for them the capital reserve will not be 2, capital reserve will be coming 10. No, the reason is that trial ke results came later. So it is a fact which came up later. No, it's not relevant. Now see, I tell you one thing. I have given my product for testing. For test ke results are something which is coming up on a later date. So that thing was not prevalent on balance sheet. Okay, next is recognition as an expense. Your Ind AS specifically says the following should be directly recognized as an expense: expenditure on research, startup cost, training, advertising, promotion, relocation. Okay, afterwards, how do we have the intangibles? Same way, the cost or revaluation model, we already did it. I'm not going for again. Accounting treatment of revaluation is also same. Presentation of revaluation is also same. Now coming to the useful life. Now, intangibles, we amortize it over the useful life. If nothing is given, generally the scrap value or residual value of intangible is nil. Now, can an intangible have a indefinite life? Can an intangible have an indefinite life? Yes, possible. Now, earlier in your AS26, they say that the maximum life can be taken 10 years. That's AS26, not under Ind AS. Ind AS mein intangible can have a indefinite life as well. If a intangible has a finite life, fixed life, you depreciate over the life, you amortize over the life on a rational and consistent basis. But if at all it has an infinite life, it will not be amortized, it will just be tested for impairment. Okay, to check if finite life is amortized, indefinite life it is tested for impairment. Fine. Okay, now how do we amortize? The depreciable amount is to be amortized, and you remember depreciable amount is nothing but the cost minus the residual value. Generally nothing given, residual value will be nil. Residual value is generally 0 unless there is a commitment by third party or there is a active market जिससे हमें लग रहा है कि afterwards there will be some value. Amortization कब start होगा, stop होगा is all same. Amortization method is also same. Leave that all thing. Indefinite life we just tested for impairment. Okay, now check this question number 6. Now expenditure on a new production process. 1st April to 31st December you spend 2700. January onwards you spend 900. And if you check over here, it meets the recognition criteria for development on 1st January. So can I say before 1st January was research? So that has gone where? PL. And now 900 is capitalized. 900 is capitalized. Okay. And 900 capitalized, and the recoverable amount is 1000. Remember, impairment, we compare the carrying amount with the recoverable amount. So carrying amount we have capitalized 900, recoverable is 1000. Is there any impairment loss? No. Okay. The book mein value is 900. Now next, expenditure incurred again on development 6000. So can I say 900 plus 6000 total became 6900. An asset is brought to use on March 31st, 03. Okay, which date the asset became ready after development? Last day. Okay, if it became ready on last day, can I say no amortization comes in this year? See, development phase mein there is no amortization. Amortization starts once it is available for use. Yaad aaya? So last year 900 development going on. Now again 6000 development going on. Now 6900 and the last date is ready. Which date is ready? Last day. The last day 6900 is now the value and now it is ready. Now next year there will be amortization. 6900 you divide it by how many years is the life? 6 years. So what will be depreciation? 1150. So at the end of 04, 6900 minus 1150, can I say 5750 is the value? And now the recoverable amount they're telling is 5000. So now recoverable amount is 5. So 750 will go as impairment loss. Clear with this? Okay. Next, retirement disposal is fine. This is your Ind AS 38. One more we do. Come to Ind AS 40, then we take a break. Keep smiling. Okay, now Ind AS 40 is investment property. Investment property, I told you it is a property which is basically for capital appreciation of earning rentals. That is basically the purpose. But if at all I have a machine given on rent, that doesn't fall here because it has to be property. Property is only land or building. Fine. They've given some examples of investment property. Land which is for long-term capital appreciation. Second, land which is for undetermined future use. If you have a land, I don't know what I'll do. I'll give it on rent. I don't know. I don't know means it's for capital appreciation. I don't know means it's for capital appreciation. Now, building I have and I've given it on operating lease. But now question, I have a building, I've given it on finance lease. Then, no, reason. If building is given on finance lease, it goes out of the books only. If it goes out of the books, आपके book में asset ही नहीं है, then there's no classification coming now. So if it is given on operating lease, it comes. Okay, then building which is vacant, but it is to be leased under operating lease. Organize it is again for rental purpose. Building which we are constructing, but which will be used for investment property. So under construction hai, but it will be used for investment property. It will continue to come under investment property. Okay. Following are not investment property. Building which is for sale, it will come under your inventory. Second, owner occupied for use, PP. Leased out under finance lease, it goes out of the books. Okay. You have more than one purpose. Imagine you have a building, part building is owner occupied, part building is rented. What should I do in that case? Part hai to. So they are telling if the part can be sold out, leased out separately under a finance lease, you can sell it. So in simple words, if that part can be sold separately, then in that case you find out the value of both of them separately. But if that part cannot be sold separately, then they are telling you account it fully as investment property if only insignificant portion is used. Imagine 95% is given on rent, 5% is used. So then you can account 100% as investment property. But 70% is basically let out, 30% use. Is it insignificant? No. Then you have to bifurcate. Fine. Sometimes we give ancillary services. Imagine I give a building on rent with a service, with a security guy. I give an entire building on rent with what? Security guy. So does it make it owner occupied? No. Still it is what? Investment property only. It will come as investment property. But I can do one thing. Out of the rentals which I receive, I may classify something towards security services. Remaining is towards my rents. But property will be classified as investment property. But imagine I have a building, I start PG. I start a PG over there, I appoint 2-3 cook, I appoint 2-3 maids, I have a lot of furniture which is purchased, I basically run the PG entirely. Now, can I say it is a business started over there? So now that PG is kind of used in business, so now it becomes a PP. Now that building will go in PP. So you need to understand the services provided are what? Does it have kind of impact wala service or just a negligible service? Negligible service, then it is still an investment property, but impactful service, then it becomes a PP. Now, property leased to other group members. Now, see, parent have a building which is given on operating lease to subsidiary. Parent has given a building on operating lease to whom? Okay, the parent has a building given on operating lease. So, can I say for parent it's an investment property? But for a group as a whole, can I say it is used within the group? So for CFS, it will be PP. For CFS, it will be PP. Clear? Okay, next. General principle is the same. Future benefit should come. Cost should be measured reliably. Subsequent cost is fine. Now, measured initially at cost. All the costs are the same thing what we did over there in your Ind AS 16 and 38. Now, let's see this question. expenditure are there, purchase price is fine, non-refundable taxes are added, legal costs are added, advertisement to get the tenant, no, opening ceremony, no, day-to-day repair, no. Okay, this is the total cost. Now this total cost is basically for 6 houses. Total cost is for 6 houses. One of the house is for office purpose and staff member, remaining 5 are rented. So can I say total cost ka into 1/6 is PPE into 5/6 investment property. Okay, next, expired to exchange is the same what was there under your Ind AS 16. It's fair value of asset given up, which is to be taken. Next, you come to measurement after recognition. Okay, now in your Ind AS 16 and 38, remember we used to have cost model, revaluation model. For PP only, sorry, for investment property only, cost model is allowed. But one thing, the fair value of investment property will be found out every year just for the purpose of disclosure in notes to accounts. Okay, transfers. Okay, now if a investment property later on I decide I'll use it for my purpose, so can I say from investment property it gets shifted to PP, or later I decide I want to sell it off, so now it converts to inventory. So transfer to investment property or transfer from investment property, this will always happen at carrying value. This will always happen at which value? Carrying value. So from investment property it will get converted into PP, or from investment property it will get converted into inventory at carrying amount. So check over here, they do not change the carrying amount of the property transferred. Fine, disposal is okay. Come to this question number 6. You are engaged in construction industry. 1st April you purchase a large property, 2 crore, and you began to lease the property. Okay, you began to lease. It's what? Investment property. The 2 CR is investment property, operating lease you are giving. Annual rental at 20 lakh, whatever annual rental you're getting, they will go in PN. Now 31st March, the fair value is 260. Okay, do we fair value the investment property? No, fair valuation was only for the purpose of disclosure. Books may still it will be 2 crore less the depreciation if any was given. Under the terms of lease, why was able to cancel the lease by giving 6 months notice? Why gave a notice on 31st March? So can I say vacated property in September? The vacated property in September, annual rental was 20 lakh. So can I say you would have given rental till September? So 10 lakh in this year. So that 10 lakh rental will go in PN. Okay, now September 05 property is still 2 crores, assuming no depreciation. Assuming no depreciation because they're not given life. Now the fair value is 29, 2 crore 90 lakh, again of no use. 1st October you convert into 10 flats. Okay, you started constructing flat for sale. So can I say investment property got converted into inventory? It will get converted into inventory at carrying amount, which is 2 crores or 2 crores only. Now on inventory you spend 60 lakh more, so 2 crore plus 60, the total cost is 260. The cost of inventory 260. Now NRV of inventory, you feel that every flat could be sold at 50 lakhs. Every flat could be sold at 50 lakh, 50 into 10 flats, 5 crores. But you have to spend some 40 lakh rupee to complete the project. So can I say NRV is 460? NRV is 460, cost is, no, NRV is 460, cost is 260. So inventory will be valued at cost or NRV, whichever is lower. It will appear at 2 crore 60 lakhs. Check the answer. The flats will be measured at cost 2 crore 60 lakhs and it will appear as inventory in your balance sheet. Disclosures, the fair value of investment property is to be disclosed basically in your notes to accounts. Plus, how did you do a valuation? आपके जो valuation के norms थे, that all are to be disclosed. So disclose the fair value of investment property. If any restrictions are there on sale, you can't sell it, some loan is taken against it, etc. That is to be basically given. Plus you have entered into contract with someone to construct a new investment property. You entered into a contract with someone to construct new investment property. That all are to be disclosed. We have this question over here. Question is as such simple, but question also tells you there are no contractual restrictions. Then they've also given over here the key inputs for valuation. So this all things which are there, this is only for the purpose of disclosure. So there are no contractual restrictions. The fair value is based on the report of a registered valuer. Key norms which are used in the valuation. So this all is only for, and the fair value is 10.5. This is only for disclosure. Otherwise building will come as, otherwise your building will come as. So whatever you had the building, you depreciate it over its useful life, the balance will come in your balance sheet. And now whatever rental income you got, that will go as income in P&L. Sales promotion fees, ground rent, this all will come as expense in P&L. So this two are income in P&L, remaining all are expense in P&L, plus the depreciation will also come as expense in P&L. So if you see yahan pe, this is rental income, these are all expenses, this is profit before depreciation, then there is a depreciation. And this is all a disclosure on the note. The fair value is this much, it is performed by independent valuer, the norms which are used are this much, and there are no restrictions on it. That all is basically given. The question would have asked you, check, what would be the treatment of building A and B in balance sheet? Provide detailed disclosures. That's why the disclosures were given. Any doubts? Anybody with this? Then this is investment property. After the break, we are starting with Ind AS 23. We take a break of 15 minutes. So we are meeting back at 10:38. 11:38. Yeah, 11:38. Enjoy your break. Okay, now no noise, please. Let's move ahead. We go to Ind AS 23, which is your borrowing cost. We go to Ind AS 23, borrowing cost. Directly, the definition of borrowing cost. Borrowing cost includes your interest as well as your other cost. Now, interest which is to be capitalized should be based on your effective interest rate. Anyways, your interest which we calculate in your P&L is also based on effective interest rate. Interest in respect of lease liability can be capitalized subject to, there are some conditions. And third one, see, sometimes you have taken a foreign currency loan. If foreign currency loan is taken, the foreign currency loan, the purpose is to save interest. The purpose is to save interest. So to the extent of savings and interest, that much of exchange loss is regarded as your borrowing cost. So to the extent of savings and interest. If you had borrowed in India, the interest would have been 10 rupees. As you borrowed abroad, so can I say interest is only 2 rupee? But now the dollar rate went up. Because of the dollar rate going up, can I say you're having exchange loss? So to the extent of savings and interest, that much exchange loss will be regarded as your borrowing cost. Fine. Check question related to that. You've taken a loan of USD 20,000. For constructing, interest is 5%. When you took a loan, the rate was 45. Now the rate became 48. In India, you could have borrowed at 11%. Okay. Now the day when you took, it is 20,000. The day when you took the loan, can I say it's $20,000 into 45? Can I say amount wise you've taken a loan of 9 lakhs? Amount wise you've taken a loan of 9 lakh. In India, if you have taken a loan of 9 lakh, it will be 9 lakh into 11%. So interest would have been 99. But abroad you took, so it is basically the interest which is coming is on dollar terms. 20,000 into how many percentage? 5. $1,000. $1,000 and the closing rate is 48. So interest abroad was only 48. So there's a savings and interest. India may would have taken, it would have been 99. There's a savings and interest coming up over here is 51. Now what is your total exchange loss? Let's see the total exchange loss. $20,000, 45 became 48. The loan has gone up by 3 rupees. The total exchange loss is 60. So out of 60,000 total exchange loss, 51,000 will be regarded as your borrowing cost and remaining 9,000 will go in for exchange loss only under your other expense. Okay. Next, recognition of borrowing cost. They say borrowing cost which is directly attributable to acquisition, construction, production of a qualifying asset is capitalized. So if borrowing cost is related to what? Acquisition, construction, production of a qualifying asset, then it can be capitalized. Now, qualifying asset may be your PP, qualifying asset may be your investment property, qualifying asset may be your intangible asset, qualifying asset may be your inventory also. It may be your inventory also. Fine. Okay. Qualifying asset is an asset which takes a substantial period of time to get itself ready for use or for sale. The inventory is also covered. And over here, the period is not defined. This is a substantial period of time. It's generally a period of 1 year. But if it is less than 12 months also, in ICA sums they capitalize, we will also capitalize. Fine. Now, coming to the next one, which is the borrowing cost which is eligible for capitalization. The borrowing cost which is directly attributable to acquisition, construction, production of qualifying asset, that is capitalized. Now, borrowing can be two types. Either it's a specific borrowing or it's a general borrowing. If it's a specific borrowing, then whole of the borrowing cost can be capitalized, but temporarily, like I took a loan, specific loan for construction of building. I took a loan 50 lakh, construction of building started, but see, day one I don't need 50 lakh. So temporarily I had invested in some other securities, I got some return from there. So that amount will be deducted from the borrowing cost to be capitalized. So if it is specific borrowing, the total borrowing, actual borrowing cost can be capitalized less any income from temporary investment. Okay, if it's a general borrowing, like I have borrowed money, like it's a general working capital loan, plus I have some, it can be used anywhere. The general borrowing are used somewhat in normal business, purchase of goods, somewhat are used basically for this construction of qualifying asset also. So only the portion which is used, that much can be capitalized. So loan might be of 1 CR, but out of 1 CR I'm using only 20 lakh for this construction of qualifying asset. So can I capitalize on 1 CR? No, I can capitalize only on 20 lakh. The general borrowing, the portion which is used, on that only the capitalization can happen. That's amount of borrowing cost will be basically based on the rate to the expenditure on that asset. And the rate has to be which rate? Weighted average capitalization rate, because you might have 2-3 general borrowings. Now 2-3 general borrowing may say which one is used for this. So you do one thing, weighted average rate into the spending which is done on the asset. That way you can capitalize it. Okay. Next over here, the expenditure to which the capitalization rate is applicable. The expenditure is the amount of expenditure which you have made on the qualifying asset. Now just tell me one thing, I purchased certain materials for my site. Is it an expenditure done? Answer is yes. It's not necessary I have to pay cash. If material purchase for the site, payment is pending, still okay, you can start capitalizing on that. It's not necessary the cash should have been paid. So it's include your cash transfers, it includes assumption of interest bearing liabilities or other assets also. But I imagine we are constructing a building. Building is as such for sale, but building will take a substantial time. Building takes substantial time. Can it be qualifying asset? Yes. Construction of building, loan is taken. Interest is to be capitalized. Now, I have spent 5 crore rupees till now, but some customer have booked the flat and they have given me some progress payment. Whatever progress payment is received, can I say that much money I have not used from loan? So I cannot capitalize on full 5 crore which I have spent. Out of 5 crore, 1 crore is progress payment received. Capitalization can be only on 4 crore. Okay? And the average carrying amount of asset also includes the previous borrowing cost. Means this year I spent 5 crore rupees, I capitalize on 5 crore. Next year again the loan is there, again the spending is there. Now the spending will not be considered 5 crore. Next year the beginning spending will be 5 crore plus the previous interest. Simple words, interest on interest can also be capitalized, but that will come up in next year. We don't have any sum on that, but interest on interest can also be capitalized. Okay, now check this question. 18% bank loan, 16% term loan, and debentures. Debentures are issued to fund the construction of office building. Can I say debentures are specific? Okay, they are specific borrowing. On 1st July we have taken, but development is yet to be started. Okay, if development is yet to be started, can I capitalize anything? No. The reason the word clearly written is development is yet to be started. Now, on 1st April 2001, Beta began construction of a plant. अच्छा ये plant है. ऊपर क्या था? Office building. Office building development is yet to be started. That's why we cannot capitalize anything. Interest will go completely in PN. Now, plant construction, this is out of existing borrowing. When I say plant construction is out of general borrowing, which are the general borrowing? This two, 18% and 16%. Okay, we need to find a weighted average capitalization rate. 18% into 1000, that is 180. 16% into 3000. So interest comes for the year divided by total loan of the year. You get a weighted average capitalization rate. The interest for the year divided by loan for the year, weighted average capitalization rate is 16.5. And amount which will be capitalized is amount which you have spent. How much you have spent is 5 lakh you spend on 1st April, full year ka capitalization. 25 lakh you spend on 1st January, 3 months capitalization. Did you understood? Okay, next. You construct a new HO building and direct attributable expenditure at beginning of month are 1 lakh in September, 250 in each of October, November, December. Okay, so we have spent 1 lakh on 1st September, 250 on 1st October, 250 on 1st November, 250 on 1st December. So total, can I say we have spent 8,50,000? Okay. You do not have a specific borrowing. Okay, what are the general borrowing available? 10% debenture, face value 20 lakh. OD is 5 lakh, which is increased to 750 in December 1. And interest is paid 15% on OD till 1st October, and rate of interest on OD was revised to 16%. Okay, pay attention. You are required to find the capitalization rate for this thing. Now, whenever I'm finding a capitalization rate, I need to find for that period. How many months? 4 months. So how do I find that capitalization rate for the period? So if you see in that period, can I say debentures were there? How much debentures were there? 20 lakh. Okay, to find out 4 months ka interest, September, October, November, December. These are the 4 months. So 4 months interest on debenture. It is 20 lakh, 10% into 4 by 12, 66667. Now coming to bank OD. Bank OD was 5 lakh. Bank OD was 5 lakh. September month. October, November also 5 lakh. December is 750. But problem is, October mein rate has changed. So do one thing. 5 lakh is bank OD in September. Find interest only for September. 5 lakh into 15% for 1 month. Did you get 6250? Now 5 lakh is bank OD in October, November also, but October, November the interest rate will be 16%. Okay, that is, can I say 13333? And now 750 is OD at 16% for December. Okay, so can I say this is the interest for that 4 months? This is interest for 4 months. And how much is the money which is used for 4 months? So for debenture, can I say it is 20 lakh into 4 by 12? For bank overdraft, it is 5 lakh used for 3 months and 750 used for 1. So this is the weighted average money used. This is interest. The interest for 4 months is 4 months on based on annual basis. So your interest rate is coming is 11.27%. Now 11.27% is an annualized rate. It is which rate? Now if you open up ICI book, you might find out what they have done is, like debenture money is used for 4 months, they would have done 4 by 4. Then 5 lakh is used into 3 by 4 and 750 into 1 by 4. If you do that way, the aapka rate will come 11.27 divided by 3. It will come as 11.27 divided by 4. 3.756 is the answer coming. But that 3.756, whatever comes, it's basically 4 month ka rate. This is actually a rate of per annum ka rate. I personally prefer finding always per annum rate. That's why I do it this way. If someone finds basically divide by 4 karke, they are not wrong. So 4 months basically what is the interest expenditure, and 4 months what is the money which has been used up into 4 by 12, 4 by 12. This is the money which has been used up. We are getting an interest. This is an annualized interest. Okay, next one. Question number 5. One, we are having a special loan of 1 lakh, and then we have a general loans, 2 other loans. Other loan is 5 lakh, 9 lakh, 11 lakh, 11% and 13%. Okay. The expenditure that were made on the building project, January, April, July and December, they have given, and they don't say, so we assume it's at beginning of the year. Okay, how much did we spend initially? 2 lakh. Okay, how much is specific borrowing? 1 lakh. 1 lakh is specific borrowing, and remaining 1 lakh is general borrowing. Okay, then next 250 is all general borrowing. This is also general borrowing. This is also general borrowing. Okay, so day 1, 1 lakh is specific borrowing. Uska interest into 10%. It's used for full year. And remaining 1 lakh is general borrowing. General borrowing we will find a weighted average rate. These are the loans. These are the rate. The weighted average rate is coming 12.28. Simple one. So 12.28. 1 lakh into 12.28. This is used for full year. But if you see second 250, this is spent on 1st April. Can I say this is only for 9 months? This 450 is on 1st July. Can I say this for 6 months? And this 120 is on 1st December. This is for 1 month. So then this is for 9 months. This is for 6 months. This is for 1. Did you understand? Shall I move ahead? Okay, next, when should I commence capitalization? Three things should happen. Three things should happen. One, you should have started doing expenditure. Like we just had a question, debentures were issued for specific purpose, but development was yet to be started. Can I say we did not capitalize? Loan le liya, but development was yet to be started. You should have started doing expenditure. Second, the borrowing cost should have been there, means the loan also should have been taken. And third, the activities are undergoing for the purpose of creation of that asset. The activities are not halted. If activities are halted, then you have to stop capitalization. So you have started spending, loan is also taken, and the activities are going. Three things. Okay, now check over here. You have ordered 3 ships for the fleet, and payment, it pays a down payment, something we already paid. Take out of a long-term borrowing. The delivery is yet to commence. The maker informs that it has commenced production of 1 ship. Okay, so can I say maker is telling he started producing only how many ships? 1. So can I say the development has started only for 1? So capitalization can happen only for 1. And 2 others may there's no progress at all. So over here the qualifying ke liye you can just capitalize only related to one of the ships. So check, borrowing cost relating to 1 ship has commenced on 1st of March. That can be capitalized for 1 month. Other all are expensed. Now, when should I suspend the capitalization? If you see 3 conditions were given, first of all, for capitalizing. Expenditure has started, loan ka borrowing cost has started, and activities are going on. If activities are temporarily stopped, during that period, the capitalization has to be suspended. But if the activities are stopped, which is a routine one, like day when rain comes, we cannot do construction. So can I say that's a routine thing? If it's a routine thing, part of the project, then in that case you continue capitalization. But if our workers have gone for strike for 20 days, so that 20 days work was stopped, 20 days capitalization should also stop. Okay. Cessation, when should I stop capitalizing? There's a difference between suspending temporarily and fully stopping. Okay, when should I stop it fully? So when the asset is basically ready, it's kind of substantially all the activities necessary to prepare the qualifying asset for intended use or sale are completed. Now imagine we are making 3 towers. If 1 tower ready, I should stop capitalizing for 1 tower. Did you understand? Okay, fine. Other relevant concept, this is a group borrowing cost. Now, group mein many time it happens, parent took a loan, they gave money to whom? Subsidiary, and then subsidiary is creating a qualifying asset. So who took a loan? Parent. Now, if you see standalone books of parent, they incurred borrowing cost, but can I say they are not doing any expenditure? So they are not capitalizing. So standalone books of parent, there is no capitalization, but for group as a whole, the money is used for the purpose of qualifying asset. It should be capitalized. Did you understood? Okay, we have a question on this, which is good. If you check question 8, company P has 3 subsidiaries. A, B, C. A is a real estate company, B is a construction company, C is a finance company. Okay, parent company has no operating activities. Okay. Financing activities, cash management are coordinated centrally. Finance company is used as a vehicle for raising finance. All are following in days. Okay, now real estate company, they were borrowing 10 lakh with 7% interest, and they were expenditure on qualifying asset, how much rupees? 1540. See, my borrowing is 10 lakh. So can I capitalize on 1540? No, I can capitalize maximum on 10 lakhs. Fine. And all the construction work were performed by construction company. The real estate company had spent 1540 on construction, but construction was done by whom? My group company only. And group company has charged a profit of 10%. It is 14 lakh plus 10%. If I want to see group's cost is not 1540, group's cost is actually 14 lakhs. 14 lakh plus 10%. Okay. Standalone purpose for real estate company, they were borrowing 10 lakh, they've spent 1540, they'll capitalize on 10 lakhs. Construction company, there are no borrowings. If there are no borrowings, can I say no borrowing cost? And the finance rupees 10 lakh of expenditure on qualifying asset through their own cash. Finance company, they've raised 20 lakh. Issued a loan to parent for general corporate purpose at a rate of how many percent? 8%. Fine. And parent has used the loan to acquire a subsidiary. Parent has used the loan to acquire new subsidiary. No qualifying asset apart from this is there. Parent did not issue any loan to other entities. Fine. What is the amount of borrowing cost which is to be capitalized in all the four entities? Okay, coming to first standalone. Financing company. If you check financing company, they just have raised money. They don't have expenditure. No capitalization. Okay, if you check real estate company, can I say 10 lakh is borrowing, spend 1540, but they will capitalize on 10 lakh. So real estate company, they will capitalize 10 lakh ka how many percentage? 7%, 70,000. Okay, third one, construction company. If you check construction company, the construction company has no borrowing, so there is no capitalization. And now coming to CFS. What will happen in CFS? Okay, so in CFS, what happens is the total borrowing for a group. What is the total borrowing for a group? Finance company ka 20 lakhs and 10 lakh is the borrowing with real estate. The total borrowing is 30 lakhs. Now, how much is the spending? Yeah, 1540, but for a group as a whole, it's not 1540 because the work was done by group member. Internal profit needs to be eliminated, 14 lakh. Okay, and then we have any other expenditure? Yeah, 10 lakh. They finance 10 lakh of expenditure on qualifying asset using its own cash. So can I say 10 plus 14 total becomes 24 lakh expenditure, and loan was what? 30. Loan is 30. Now problem is, if loan is 30 but the expenditure is only 24, can I say I can capitalize only on 24? At what rate? Weighted average rate. Okay, so now first one was 7%. First one was how many percentage? 7. And the second one is also 7%. They raised at 7. Then they gave it to another group member at 8%. वो नहीं देखना. They raised at 7. So both the loans are at 7%. Should we capitalize on 30 lakhs or only on 24 lakh? 24 lakh ka 7% will be capitalized. It will be 1,68,000. Clear with this? The simple word is, it is possible parent took a loan, gave it to subsidiary. Subsidiary is constructing asset. Subsidiary is constructing asset. So group as a whole, qualifying asset is there, borrowing is there. But for a parent, borrowing is there, expenditure is not there. For subsidiary, expenditure is there, borrowing is not. The individual books, there might not be capitalization, but CFS mein there can be capitalization. Next one we have is Ind AS 36. Okay, Ind AS 36 is on impairment of asset. Now, when do I say asset is impaired? We are required to compare the carrying amount and what? Recoverable amount. Recoverable amount is nothing but higher of value in use and fair value less cost to sale. Fair value less cost to sell. Now, every year, do I need to do impairment testing? No, only when there is indication. Every year you need to check whether there is an indication of impairment or not. If there is an indication, then you find out value in use, then you find out fair value less cost to sale, and then you try to do impairment. So don't try to find every year fair value less cost to sale, value in use. That's only when there is a indication. But following are to be tested for impairment annually, mandatorily. Which are the following things? Intangible having infinite life, intangible which is not yet put into use, and goodwill which came up under your business combination, that is to be tested for impairment. That will be tested for impairment annually, mandatorily. Okay, fair value less cost to sale is fine. Now value in use is also fine. Now value in use may see, whenever I'm finding fair value less cost to sale, so fair value is basically market participant based, and cost to sell may the tax will not be considered. Many times what happens is, I sell a product, my tax rate is different. You sell a product, आपके लिए the tax rate gets different. Because I fall in slab, I fall in basic exemption limit, I might be exempted. You might be falling in 30% tax slab, you have to pay 30%. So they say that tax expense will be ignored when you're taking cost to sell. And value in use is whatever future benefits we are going to get, uska present value which we have to take. Now question, the present value rate. The present value rate, how I should take it? It should be entity specific rate or asset specific rate? Entity specific rate or asset specific rate? Say I tell you, if at all you're buying a car, you know car loan is available at 8%. But imagine entity wants to borrow some money for some general purpose. Would they get it at 8%? The reason is whenever someone is financing a car, now suppose they financed 80% of car value, you don't pay EMIs, they can take back the car. They know car can be sold at this much rate. But if I give for some general purpose to you, I don't know how much your assets will realize. So वहाँ पे the rate is always high. So यहाँ पे when we are finding impairment, can I say impairment testing is of asset? So rate which we are taking for discounting also has to be asset specific rate. Rate which we are taking for discounting has to be asset specific rate, the appropriate discount rate related to asset. ठीक है. Now we have to project the future cash flows. Uska present value is basically your value in use. So whenever you're projecting future cash flows, future revenues, future expenses, whatever is there, that is to be considered. Acha, future maintenance, etc. is going to come. That also is to be taken. But I feel that future I'll buy a new machine and increase production. I feel I'll buy a future new machine and increase production. That is not to be considered. If at all you feel that future may do something new, that is not to be considered. So they are basically from continuing use of asset, uske related inflow, uske related outflow. Okay, day-to-day servicing you can take. What is not to be included? Future cash outflow or related cost saving that arise from future restructuring. That is not to be taken. Cash flows that arise from improving or enhancing the asset performance. So after 5 years I'll replace this and then my productivity will improve. That is not to be considered. Then outflows relating to financing are not considered. Tax payments are not to be considered. So can I say the future cash flows are pre-tax? The discount rate which we use should also be pre-tax. Cash flows are pre-tax. The discount rate should also be pre-tax. Did you understood? Okay. Now suppose if I have a cash flow coming in foreign currency. If cash flow is coming in foreign currency, so how I will find the value in use? Should I convert the cash flow into INR, then INR में discount करेंगे? No. The cash flow you keep it in foreign currency, discount them. Discounting should be based on appropriate discount rate for that currency. Appropriate discount rate for that currency. Then simple words, you have cash flows in foreign currency, discounting done. Can I say now you got one figure? Now you convert that figure at spot rate. Now you convert that figure at which rate? Spot. So next 5 years projected cash flows in foreign currency are there. Discount karke I got one figure in foreign currency, converted into today's rate pay. So that is the value in use today. Okay, check over here. Now these are the cash flows expected. I have to find present value. Now India ka 15%, US ka 10%. Cash flows are of US. So discount rate should be used of US. 10% I have to use it. So 10% pay I discounted. Now this is basically the $170.40 into the rate going on today. This we are doing on 31st March. So 31st March ka rate is 45. Multiply by 45 is your answer. This is the value in use today. Okay, next. Discount rate should be pre-tax. We already did it. Discount rate should be based on asset specific rate. Asset specific rate not available, then you can use your weighted average cost of capital and other things. But if asset specific rate is there, always use what? Asset specific rate. Okay, now check this question. If you see here, machine was purchased by you and the vendor is charging 10% per annum. Okay, vendor charging 10% per annum. Is it an asset specific rate? Because in this question you have a rate 10% and last में दिया है यहाँ पे entity has determined a pre-tax discount rate 8%. So should I use 8% or should I use 10%? I bought a machine, vendor charged me 10%. Vendor charged me 10%, but entity has determined a pre-tax rate of 8%, which reflects the market assessment of time value of money and risk associated with this asset. Should I take 8% or 10? 8. See, reason, vendor, someone is charging 10% to you because it will depend on your financial condition. Your CIBIL score is not good. Can I say you have to pay more rate? So that is not asset ka rate. That is your. We have to take which one? Asset. So 10% is of no use over here. We just have to take is 8%. Then they've given how will be our sales, how will be our purchases. The future wala will be found out. It will be discounted at 8%. Other things are fine in the sum. That was important. Acha, one or two things. Regular maintenance, which will I consider while finding the future incomes? Yes, regular maintenance are considered. We expect to invest in a new technology. Would that be considered while finding value in use? Answer is clear. Regular maintenance are covered. Expect to invest in new technology is not covered. Now, recognizing and measuring an impairment loss. Your impairment losses are recognized where? The impairment loss will be recognized in P&L unless the asset is carried at revalued amount. If the asset is carried at revalued amount, the impairment loss will be treated as a revaluation decrease. The asset is carried at a revalued amount. We already have some OCI may revaluation reserve recorded. So then this is a revaluation decrease. Okay. Next, tell me, we booked the impairment loss. If I book the impairment loss, can I say asset went down? Okay, this we booked it right now. Whether income tax people allows me right now that expense under deduction. No, income tax made is not allowed as deduction right now. It will be allowed as deduction in future. Something which will be allowed as deduction in future. Future I have to pay less tax. I should create a DTA. So in your books, asset has gone down, income tax made has not gone down. So you will create a DTA. Okay, let's check over here. Now, you acquired a machine on 1st April for 10 crore. Useful life is 8 years. Straight line made is depreciated. In 14, the carrying amount was reassessed at 7.10. Okay, carrying amount is reassessed at 7.10. Let's do one thing. What is the carrying amount as at 31st March 14? We acquired at how much rupees? 10 crore. And can I say residual value is nil? We have to depreciate over 8 years. So 10 crore divided by 8 years, 1.25. And 4 years are gone. 5 gone. So remaining was 5. But now it is revalued to 7.1. So revaluation upward is 2.1. Now it is 7.1. Did you understood? Okay. Now the date is 1st April 14. And can I say now depreciation will be on 7.1? 7.1 is to be depreciated over remaining 4 years. Okay, now year ended in March 16. Okay, the 2 years gone. So what is 2 years depreciation? 7.1 is to be depreciated in 4 years. So 2 years will be half. Can I say 3.55? And now the balance is also 3.55. Balance is 3.55 and now we feel the recoverable amount is 1.09. Okay, so 3.55 minus 1.09. What is the impairment loss coming? 2.46. Now how to account for this impairment loss? If we already have a revaluation surplus available, can I say it is debited to revaluation surplus? Now there's one line given in question. Check. KAPC Limited has a policy of writing down the revaluation surplus by transferring additional depreciation from revaluation surplus to. Now I told you that whenever you revalue, depreciation will be on revalued amount. Now you have an option. What is the option? Additional depreciation jitna bhi aa raha hai na, that much you can transfer from revaluation surplus to retained earnings. Are you transferring? Are you transferring? They have a policy of writing down the revaluation surplus. Means you are transferring that. Okay, now before revaluation, depreciation was 1.25 every year. After revaluation, 7.1 divided by 4 years. Can I say it's 1.775? Okay, earlier it was 1.25. The extra depreciation is 0.525, which we have given for how many years? 2 years. So when I say 1.05, 1.05 we would have removed from revaluation surplus, transferred to retained earnings. Okay, what was the total revaluation surplus? 2.1. Out of that, 1.05 was transferred. How much is remaining in revaluation surplus? 1.05. So now the loss is 2.46. 1.05 is adjusted. Set off against revaluation surplus is 1.05 and the balance is going in. Did you understood? Achha, if that line was not given, that we have a policy to transfer additional depreciation to retain earnings, then in that case the revaluation surplus available will be 2.1. So then 2.1 will be set off against revaluation reserve and the balance 0.36 would have gone to P. Are you clear? Okay, next. CGU. Now what is the CGU? Many times what happens is for an individual asset, we are not able to determine the value in use because that individual asset is not generating cash flows individual. So if at all we are not able to find the value and use of an individual asset, we can't test that individual asset for impairment. Then we find the smallest group of assets which are capable of generating cash flows independently. We take a smallest group of assets which are capable of finding out generating the cash flows independently, and then we do a testing of impairment. So if equipment A alone does not generate cash flow, equipment A and B together generates. So can I say now we have equipment A and B which will be tested for impairment together. Now if impairment loss comes, so can I say it has to be bifurcated between equipment A and B? How to bifurcate between them? Based on the relative carrying. Based on the relative carrying on. So sometimes individually it's not possible to find recoverable amount of the asset. Then in that case we find a smallest group of asset which is capable of generating cash flows independently. Fine. Next, this question is okay. Now check. Okay, take it. There are two plants. We have plant X, we have plant Y. Okay, plant X is selling all the goods to plant Y only. Plant X wala goods goes to plant Y and plant Y does a further processing. If plant X ke goods can be sold in market, so can I say it is capable of generating cash flow on its own? Then it is a separate CGU. Then plant X is a separate CGU, plant Y is also a separate CGU. But if plant X ka goods does not have active market, so plant X will give to plant Y will do further processing, then only sales will happen. So can I say now they both have became linked? So then in that case, the smallest group of asset capable of generating cash flow individually is plant X plus Y together. Okay, so check. If X could sell the product it sells to Y in an active market, then plant X is also a separate CGU. But if there is no active market for product X, then plant X is not a separate CGU. Then X and Y together make up a CGU. Now, allocating goodwill to CGU. See, goodwill is always linked to business. Can goodwill generate revenue on its own? No. So goodwill is always linked to business. So whenever I want to check out whether goodwill is impaired or not, it has to be via a CGU. The goodwill has to be allocated. Goodwill kisko allocate karna padega? Other assets ko. And normally what happens is, if suppose goodwill is coming from this subsidiary, so it is allocated to the assets of that subsidiary. If goodwill is basically I paid more for them, it will be allocated to the assets of that subsidiary. That is how basically the allocation of goodwill happens. See, goodwill will never be there in your standalone. Goodwill will always be there in your CFS. Business combination mein CFS mein what will come is goodwill mostly. If it was acquisition by way of net asset, I took over your assets, liabilities, and you're shut down. You are shut down. Then in that case, in your SFS there can be a goodwill. But again, in SFS, unke assets liability will be there. So goodwill relates to their assets and liability. It's allocated to their assets and liability. Generally. ठीक है, तो goodwill cannot be tested for impairment individually. Goodwill will always be tested in a group of assets, which we call it as a CG. Now, if goodwill can be allocated to individual CGU on some rational basis, non-arbitrary mane rational, arbitrary mane irrational. So if it can be allocated, then I'll allocate goodwill to CGU A, B, C. I've allocated. Now, if at all goodwill is allocated to someone, remember goodwill is to be tested for impairment annually. If goodwill can be allocated to CGU A, B, C, then CGU A, B, C will be tested for impairment annually. But if goodwill cannot be allocated on rational basis, there is CGU A, B, C, I cannot allocate goodwill to them, then what will happen is CGU A, B, C will be tested for impairment only when there is indication. But a group CGU A, B, C plus goodwill, that will be tested for impairment annually. So if it can be allocated, impairment testing of individual CGUs will be done annually. But if it cannot be allocated, to individual CGUs will be tested only when there is indication. However, a group CGU A, B, C plus goodwill total, that is a group CGU. Group CGU will be tested annually. Okay, now we had this goodwill allocated, impairment testing is done. Now impairment loss comes. If impairment loss comes, first allocate the impairment loss to goodwill, and then it will be allocated to other assets in the CGU on the basis of their carrying amount. So first the impairment loss goes to goodwill, then to the other assets on the basis of their carrying amount. Fine. And now you need to ensure that individual asset in a CGU, there's one there are 4 or 5 assets. individual asset cannot go below its fair value or its recoverable amount or zero. I cannot have asset zero, मतलब negative नहीं हो सकता. Plus asset individually cannot go below its what? Fair value, or assets cannot go below its recoverable amount. That we need to just take care. Okay, now goodwill impairment when there is a NCI. Okay, goodwill impairment when there is NCI. This is important. Tell me, remember NCI can be as per two ways: proportionate net asset or fair value. If NCI is at proportionate net asset, goodwill is only related to our share. If NCI is at fair value, goodwill is related to both. Okay. If suppose NCI is at fair value and now there is an impairment of goodwill, so that impairment will be allocated to us also, NCI also, because NCI is at fair value, goodwill related to both. Okay. But if NCI is at fair value, impairment will be attributable to group share as well as your NCI. But if it is at proportionate net asset, can I say goodwill is only related to us? Okay, now goodwill is only related to us, but the problem is when you're finding a recoverable amount, can I say you are trying to consider what the entire business will earn in future, uska discounting you're doing. So recoverable amount is for a business as a whole. The recoverable amount is for business as a whole, but goodwill was recorded not for everyone, it was recorded only for me. The simple words, goodwill was recorded for 80%, but the recoverable amount is for 100%. Goodwill was recorded for 80%, but the recoverable amount was only for 100%. So now what they are telling is, if at all there was NCI based on proportionate net asset, NCI share of goodwill was not recorded. But when recoverable amount is there, it is for the entire business, it's based on 100%. So do one thing, you gross up the goodwill notionally. What do? Gross up the goodwill notionally. Suppose goodwill came 400. Now 400 was your share, 80%. 80% is 400, so 100% goodwill will be how much? 5. Gross up the goodwill notionally. No journal entry, just notionally the goodwill is to be grossed up. So now goodwill is basically 500 plus other assets in CGU were something, and now you do an impairment testing because the now assets, goodwill and other assets are 100%. Recoverable amount is also for 100%. You gross up the goodwill notional. But when grossing up is required, only when NCI is at proportionate net asset. If NCI is at fair value, already their goodwill is also there. Now impairment loss comes, it will be shared by us as well as NCI. Okay, check this question. We have Sun Limited with various subsidiaries. They acquired 80% in Pluto. Let me directly take, they measure NCI how? Sun Limited measures NCI at fair value. If NCI is at fair value, can I say 100% goodwill is already there? So do I need to do grossing up? No, grossing up not required because 100% goodwill is already there. Now what happened is, they would have found out that goodwill can be allocated. So carrying amount before allocation, this recoverable amount, fine. Now afterwards, when you are trying to find, goodwill was 260, okay. Impairment testing may, whenever you're doing, impairment loss is coming. Now whatever is impairment loss coming, in total impairment loss, remember the impairment loss will be towards first goodwill. Now if 56 is the impairment loss coming in goodwill, goodwill belong to you also, it belong to NCI also. So can I say we both have to share it? So this 56 will be divided. 56 is goodwill ka impairment. 21.2 will be allocated to NCI, balance is allocated to the shareholders of, because यहाँ पे goodwill was, NCI was at fair, no grossing up. But now see the next question. You acquired 80%. Now check over here. You decide to measure NCI at proportionate interest of net asset. Okay, if we are measuring at proportionate net asset, so can I say goodwill is only our share? Okay, now let me just go down. Goodwill 500 related has been allocated to other CGUs with the parent. Okay, how much is goodwill? 500. Okay. So you acquired 80% at 2100. You acquired 80% at how much rupees? 2100. Net assets have a fair value 1500, and you choose NCI at proportionate net asset. Okay, so NCI will be 1500 ka, can I say 20%? 300. So this becomes 1500 minus 20%, 300. Our share of net asset 1200, we paid 2100, right? So goodwill will come total how much? 9. Total goodwill is 900. Okay. Now total goodwill 900 hoga, it will be allocated to various things. They have clearly given goodwill of 500 related to those synergies are allocated to other CGUs within the parent. And parent determines the recoverable amount of CGU is 1000. As such, your goodwill is total 900, but currently we have allocated 500 to something. 400 remaining would have been allocated somewhere else. So over here, if you check out, the goodwill is coming as 900. 500 has been allocated to other CGUs within parent. Now parent has determined the recoverable amount of CGU is 1000. Okay, now recoverable amount of CGU is 1000 and carrying amount of net asset subsidiary is 1350. Now pay attention. Out of 900, 500 be allocated to other assets of parent. Remaining 400 will be allocated to the assets of subsidiary. ये दो word आपको समझना पड़ेगा. This is allocated to other CGUs within parent. The remaining 400 will be allocated to the assets of subsidiary. Okay, now for a group as a whole, I have certain assets of parent also, I have certain assets of subsidiary also. To the assets of parent, how much goodwill allocated? 500. To the assets of subsidiary, how much goodwill allocated? 400. And now that subsidiary is one CGU for us. Okay, so to that subsidiary ka net asset is 1350 plus 400 goodwill allocated. And unka, what is the recoverable amount given? 1000. Okay, now pay attention. But goodwill was only related to our share. 400 was only related to our share. So we have to gross up the goodwill. 80% is 400, 100% will be how much? 500. So after that, grossing up ke baad, goodwill became 500. The carrying amount of net assets of subsidiary is 1350. Total became 1850. Your recoverable amount is what? 1000 and impairment loss is 850. Now impairment loss coming 850 doesn't mean we have to record 850. Reason, we had grossed up goodwill by 100 notionally, so that 100 rupees not to be booked also. So now you think out of 850, 500 goodwill gone. Actually goodwill is not 500, goodwill is actually 400, but that is gone. And now remaining 350 will go from other assets. Remaining what will go from other assets? 350. So over here 500 goodwill gone, 350 gone from others. So now goodwill became 0 in books, 350 gone from others. So others will become 1000 and 1000 will be carried in your batch. Now someone will say, sir, why did this grossing up? Otherwise we would have directly kept 400 plus 1350 is 1750. 400 plus 1350 is 1750 and now recoverable is 1000. So loss is what? 750. 400 goodwill mein se gone, 350 yahan se gone, answer will remain same. Even if you don't do grossing up over here, answer will remain same. But in this question, let's see next question. So that's the reason why grossing up is required. Let's see the next question. You acquired 80% shares at 3200, the net assets was 3000 and you elected NCIs at proportionate net asset. So can I say 3000 ka 80% is your asset? So your share of asset is 24. You paid 32. Can I say goodwill came 800? Goodwill came 800. Now, next year, the B Limited's carrying amount is reduced to 2700 excluding goodwill. So now that CGU, subsidiary is a CGU, they have a carrying amount 2700 excluding goodwill. Goodwill is how much? 800. Now recoverable amount is 2000. Now I cannot compare 27 plus 8, 35 with 2000. Reason, the problem is recoverable amount is for 100% assets and liability, whole business. But net assets which you have taken, usme other assets are 100%, but goodwill is only 80%. So if I gross up the goodwill, 80% is 800. The grossed up value of goodwill will be 1000. 1000 plus other assets are 2700. 1000 plus 2700 becomes 3700. 3700 we are comparing with 2000. There is a loss coming of 1700. Out of 1700, 1000 goodwill gone. 700 from other things gone. 1000 goodwill gone. 700 from other things are gone. So 700 from other things are gone. So now other things will appear at 2000. Now here also, if you do grossing up, don't do grossing up, answer will remain same for this A point, but now B point. Case B, how much is the recoverable amount? 2,800. Now, if after grossing up goodwill was 1,000, other assets are 2,700. Can I say total becomes 3,700? 3,700. This is 2,800. Loss is coming 900. Loss is coming 9. Now we have goodwill after grossing up 1,000. How much goodwill will go away? 900. 900. Now don't say 100 goodwill will remain, because books में 1,000 goodwill ही नहीं है. Books में how much goodwill is there? 800. Books में how much goodwill is there? 800. If goodwill was 1,000, 900 would have gone away. Can I say 90% goodwill goes away? If goodwill was 1,000, 900 will go away. So how much goodwill goes away? 90% goodwill will go away. You have in your books goodwill 800. What is the 90% of 800? 720 goodwill will go away and 80 goodwill will remain. Others will remain as it is, because anyways full goodwill only doesn't go, so others में there is no loss to be borne, and now it will be 2,780. यहाँ पे if you don't do a grossing up, what will be your answer? 800 plus 2,700. 800 plus 2,700 comes as 3,500, and recoverable amount is 28. So you will have an impairment loss 700, and you will write off 700 from goodwill. Actually not 700 goes. How much goes from goodwill is 720. So here if you don't do grossing up, your answer will come. After grossing up goodwill 1,000, other assets are 1,700. Total becomes what? 2,700. No, other assets are 2,700 and 1,000. Total becomes 3,700. Recoverable is 2,800. So 900 to be written off. Okay, if goodwill 1,000 है तो 900 to be written off. But in our books we don't have goodwill 1,000. We have how much? 800. So 1,000 होता तो 900 to be written off. 90%. 1,000 का 900 is 90%. So 90% goodwill you remove from books. Did you understood this? Okay, next. Allocating corporate asset. This is important. Sometimes there are some corporate asset like HO building. Now tell me whether HO building generates revenue. No, revenues are generated from what? Branches which are actually working. HO building is helping all of them out. Same way research works. Someone doing research is never generating revenue. Research को use करके some other department, can I say they will generate revenue? So these are called as kind of which type of asset? Corporate asset. So again, corporate asset cannot be tested for impairment individually. If you cannot test them for impairment individually, they have to be tested in CGU. If they can be allocated to CGU, if I can allocate them on a non-arbitrary rational basis, so it is allocated to CGU A, B, C, and then that CGU A, B, C will be tested for impairment. But if they cannot be allocated, then can I say they will be a part of group CGU, and then group CGU has to be tested for impairment. So if they can be allocated, then basically I will allocate them. Then CGU A, B, C will be tested for impairment, including that corporate asset. But if they cannot be allocated, then first individual CGU A, B, C, they are tested without the corporate asset, and then the group CGU is A plus B plus C plus corporate asset. Everything together will be tested for impairment. So this is actually similar to goodwill wala thing, but only difference over here is in case of goodwill, if there's an impairment coming, can I say the first it was written off against goodwill, balance went to the others. यहाँ पे it is not like that. If basically a corporate asset was allocated, now in a CGU there are two other assets and a corporate asset, three assets are there. If there's an impairment loss, all three assets will be bearing it proportionally. Goodwill tha, so goodwill was bearing first, but corporate asset is allocated doesn't mean they will bear first. They will be bearing proportionately based on their carrying amounts. Okay, question number 9 is fine. Come to question 10, which is important. November 18, November 20. Check over here. We have 3 CGUs A, B, C, and these are the carrying amount of 3 CGUs and the remaining life of 3 CGUs. Carrying amount of 3 CGUs, remaining life of 3 CGUs. Now corporate asset X 600, it can be allocated. It can be allocated on a reasonable basis. Now reasonable basis doesn't mean carrying amount. If they say it can be allocated on the basis of carrying amount, you allocate between A, B, C on the basis of carrying amount. Now reasonable basis, what ICI has done is they have taken a ratio of carrying amount into the useful life. What they have done? So we have ABC का carrying amount, ABC का useful life, multiply करो, So 500 into 10, can I say this 5,000? 750 into 20, this is 15,000. 1100 into 2, this is 22,000. So in the ratio of 5 is to 15 is to 22. So they were allocated in the ratio of 5 is to 15 is to 22. But now the second one cannot be allocated. Okay, the first one can be allocated. So do one thing, 600 you allocate between A, B, C. So now A, B, C, this is A, B, C, we allocate this. This is allocated to A, B, C. A was 500, allocated 72, it becomes 572. B was 750, allocated 216, 916. C was 1100, allocated 312, total is 1412. Now you test ABC for impairment. You have to test ABC for impairment. This 572, 966, 1416, and these are tested for impairment. Impairment comes over here in B and C. But B may 966 is the carrying amount. Out of 966, can I say the corporate asset was 216, others was 750. So now that impairment loss came 66, don't take full 66 to corporate asset. That will be given to corporate asset and the other assets in CGU proportionately. Then we यहाँ पे 12 came. There is a corporate asset, there is other asset. That will be allocated to corporate asset and other asset proportionately. So यहाँ पे allocation to corporate asset X and other asset is like this proportionately. It's not like goodwill they getting first. But now only corporate asset X was allocated. Can I say Y still left out? Now how do I test Y for impairment? So now we have to have a group CGU. So A, B, C are already tested for impairment individually. Now coming to group. So now A, B, C, X. A, B, C and X. What is the value of A, B, C, X now? Can I say यहाँ पे it was 572 only, यहाँ पे it became 900, यहाँ पे it became 1400. You make the total of this. This is A, B, C and X plus you add Y. A, B, C, X and plus you add Y. A, B, C, X and plus Y. After we do it, we'll be getting carrying amount is 3072. Did you get this? 572, 900, 1400. This A, B, C and X after their individual impairment done. Plus karo Y. Y was how much? 200. So you'll get total of 3072 and the carrying amount of a group CGU they would have given, check question, 3200. Entire company they already given is 3200. So now in group CGU there is no impairment. Now if in group CGU also there was some impairment coming, then that impairment will be borne by whom? Y, X, A, B, C, everybody will be bearing it in proportion. Everybody will be bearing in proportion. But the problem over here is, okay, they will bear proportionately. But if A, B, C, I tell you, यहाँ पे, if someone is already at the recoverable amount, can I say I cannot bring them below the recoverable amount? That I need to take care. But this question doesn't have, so we are not going into complication. Next one, reversal of impairment. Now we booked some impairment. Later on, recoverable amount increased. The recoverable amount went down. Later on, the recoverable amount has increased. So can I say there might be a reversal of impairment? Okay, the reversal of impairment can be recognized, but goodwill ka reversal is not allowed. Which impairment reversal not allowed? Goodwill. Goodwill impairment reversal is not allowed. And now, whenever I'm reversing, how much I can have it? After reversing, how much I can have it is the revised recoverable amount, or had there been no impairment loss recognized earlier, what would have been the carrying amount? Usme se whichever is low. Now the revised recoverable amount is 100, but if there was no impairment earlier, uska carrying amount today would have been 90 only. So I can bring back asset not to 100, I can bring back only to 90 rupees. Achha, just one more thing. Whenever there is a reversal of impairment, now it has to be a real reversal. Now, what do you mean by real reversal? There's an increase in service potential of an asset. There's an increase in. Now imagine recoverable amount was value in use and basically your fair value less cost to sell, whichever is higher. Value of future cash flows ka present value. Imagine there was some cash flow which was going to come after 2 years. Big amount. Now 1 year is gone. Can I say now it's not after 2 years? Now it's only after 1 year. So earlier uska discounted value was too less, but now uska discounted value will become higher. So recoverable value in use mein values have not changed, but due to that discounting factor, now that value is going up, that is not a reversal. वहां पे वो reversal नहीं करेंगे. Check. Reversal is impairment loss is not reversed just because of passage of time. For example, here 10,000 was due to come after how many years? 3. Third year में I used to get 10,000. First year में 100 था, second year 1,000 था. Now after 1 year is over, can I say now next year 1,000 and next to next year is 10,000? So now the present value earlier and now, so now the present value is increased. But this is not due to increase in service potential. This is just that 10,000 which was to be received after 2 years, now that 10,000 will be received after 1 year, because 1 year has already elapsed. So this does not lead to a reversal of impairment because the service potential has not gone up. Okay, increased carrying amount shall not exceed the carrying amount had there been no impairment. Okay. Now when we are reversing a impairment of a CGU, goodwill impairment cannot be reversed. Okay, now other assets of CGU, they had borne loss, I will reverse also in that proportion. They borne the loss in carrying amount, the reversal is also in carrying. Achha, now one thing, corporate asset ka allocation. Corporate asset allocation was on reasonable basis in our question. So it was not based on carrying amount, it was carrying amount plus into useful life. Allocation. But if impairment loss comes now, and impairment loss is to be borne, impairment loss will always be borne on the base of carrying amount. Allocation was done on other basis, but impairment loss will always be based on carrying amount. Fine. Now check this question number 11. Check the question number 11. Elia Limited is a manufacturing company which deals in manufacturing of cold drinks, beverages. You have a plant across India. Machinery A is in Baroda, which is used for bottling. Another machine is machine B, which is clubbed with machine A. Machine A can individually have an output, can also be sold in open market. So can I say machine A is individually a CGU? So we can test machine A separately for impairment. B cannot be sold in isolation, so B has to be clubbed with A. So B cannot be tested for impairment alone, B will be tested with A. So A can alone be tested and then AB can together be tested. A can alone be tested and then AB can together be tested. Okay, the company considers a group of asset as a CGU. In that CGU, inventory also comes, goodwill also comes. Inventory 2 lakh, goodwill is 1.5 lakh. Machine A was purchased for 10 lakh rupees, residual value is 50,000. So can I say 950 to be depreciated? B was purchased in 2015 for 5 lakh, no residual value. Both of them have a life of 10 years. So when I say machine A, 950 to be depreciated over 10 years, it's 95. And for machine B, 5 lakh to be depreciated over 10 years, can I say it is 50,000? Fine. The incremental borrowing rate of the company is 10%. Cash flows which are expected from machine A. Cash flows which are expected from machine A. Can I say I can test machine A separately? These are the cash flows expected excluding residual value. Residual value will also come at last year, how much rupees? 50,000. So we try to find the value in use of machine A. Now the professional valuer has estimated the current market value of machine A is 7 lakh. Okay, fair value mila. Okay, valuation fee is 1 lakh. Is it cost to sell? Valuation fee is not cost to sell. Here the valuation fee is for valuation. It's not for selling. Okay, there is a need to dismantle the machine before selling. And dismantling cost 150, specialized packing cost will be 25,000, legal fee will be 75,000. Is this the selling cost? Yes, so this all are selling cost. Okay, the fair value was determined 7, but 7 may say dismantling 1.5, 25 special packing and 75. So 2.5 will go away. Can I say your 4.5 is fair value less cost to sell? Okay. Inventory is valued in accordance with Ind AS 2. Recoverable amount of CGU is 10 lakh, March 18. Next year the recoverability has becomes 11 lakh. And recoverable amount of machine A is 450, A and B together is 760. Okay, now first of all 2018 tak. Let us find carrying amount of machine A 2018. When did we bought machine A? No, not 15, 13, machine A. Machine A is 1413. 1413 we started with how much rupees? 10 lakh. 1413 we started with 10 lakh. Okay, 14, 15, 16, 17, 18. 5 years gone. 95,000 into 5. How much is the depreciation? 4,75,000. So can I say the book value today is 525? Machine A is 525 and machine B was 5 lakh. 3 years are gone. 150 depreciation gone. Can I say it will be 350? Okay, so if I just go over here, machine A today is 525, machine B today is 350. This is simple calculation, just we have deducted depreciation. Important starts now. Now we test machine A for impairment. These are the future cash flows of machine A, including the residual value. This is the value in use of machine A. Fair value, we just now found out, fair value less cost to sell is 450. So 450 and this is 489, whichever is higher is the recoverable amount. The recoverable amount is 489, carrying amount is 525. Difference will be the impairment loss of machine A. Machine A done. Now we can also test machine A and B together. This was A. Achha, A and B ka fair value is given? No, 18 mein A and B's fair value together is not given. 18 mein A and B's together the fair value is not given. So now I'll directly go to the group. So now group के अंदर it will be A, B, inventory and goodwill. Okay, so A I can directly take after impairment. How much is the amount? 489. I can take directly this of A, 489. For B you can take 350. यहाँ पे you can directly take 489 for A, चलेगा. Answer will remain same. For inventory is 2 lakh and goodwill is 150. So if you just make a total of this and then you compare with the recoverable amount which is given 10 lakh, you will find out 489,650 plus 489,650 plus 350 plus 2 lakh plus 150. Is it coming 1189,650? And this is 10 lakh. So can I say 189,650 is the loss of group CGU? Okay, 189 में से first who will bear? Goodwill. So goodwill में 150 you give it. How much remained? 39,650. Inventory doesn't bear basically impairment loss. Inventory is covered under AS2. Now bacha plant 1 and plant 2. But plant 1 is, can I say, already at its value in use. So now plant 1 cannot bear it. So remaining 39,650 is borne by plant 2. Remaining 39,650 is borne by plant 2. And now this is the value. Now next year what happened? The value has became what? 11 lakhs. But before that, I need to give depreciation of next year. Now, this plant is 489,650. Based on that, depreciation is given. 401 is the balance. This plant is basically 310. After this, it was 310. 310 ke upar depreciation given. This is the value. Inventory is still 2 lakh. Goodwill is now nil. This is now the value. And now the recoverable amount is what? 11 lakhs. Recoverable amount is what? 11 lakh. This is the carrying amount, recoverable 11. So can I bring back everything 11? Goodwill reversal is not allowed. Leave that. Now coming to machine A and B. Machine A and B together, they have given you 7 lakh 60. Machine A and B together is 760. Now let's, machine A is how much? 450. And see, individually asset you cannot make it more than basically the individual recoverable amount. So it is 450. Now had there been no impairment, what would have been machine A today? Had there been no impairment. Now 2019 came, right? We bought it at 10 lakh. We used to give depreciation for how many years? 6 years. How much is 6 years depreciation? 95 into 6, 5 lakh. Had there been no depreciation, no impairment, can I say uska carrying value would have been 430. Okay, 430 had there been no depreciation, and the recoverable is 450. I have to take whichever is lower. I can make machine A 430. I can make machine A 430. Now in your books, machine A currently is 401,720. I can make it 430. So reversal is coming. How much rupees in machine A? 20? 28,280. This I can do. And now coming to machine B. Machine A plus B together, the recoverable amount is how much? 760. उसमें A का recoverable amount was 450. So can I say B's recoverable is 310. B का recoverable 310. Now had there been no impairment in B, we started with 5 lakh. 5 lakh, 6 years depreciation, 50, 50, 50, which was 3 lakh. So can I say today it would have been 2? Had there been no impairment, 2 lakh. Okay, what is the recoverable amount coming? 310. Okay, so can I say I can make it up to 2 lakhs? Okay, I can make it up to 2 lakh, 3 lakh. Okay, 3 lakh or 310. So this 3 lakh, and what is the recoverable was how much? 260. This is 310 recoverable, and carrying amount would have been 3 or 2 lakhs. Acha, 2015 it was bought. The 4 years are gone. So 50, 50, 50, 50, 3 lakh. 3 lakh and 310. I have to make it whichever is lower. I can make it up to 3 lakh. Okay, I can make it up to 3 lakh. It is 266,014. 266,014 minus 3 lakh. Can I say it will be 33986 increase over here? Impairment of goodwill cannot be reversed. So check out how much reversal happened. Total 28280 and 33986. Total reversal is 62266 is your answer. Any doubts? Yes. This is not the report. Any doubts? Anybody with this? This is your chapter of impairment. Let's move on to the next one. Is Ind AS 105. Keep smiling. Now, unit number 8, Ind AS 105, non-current asset held for sale and discontinued operation. There are two things. One is non-current asset which is held for sale. Second is what? Discontinued operation. Okay, now going to first of all, what do we mean by the word non-current asset held for sale? To be an asset treated as held for sale, there are two requirements. One, now it is held for sale. If it is held for sale, we are trying to recover money by using it or by selling it. So the thing is, it's basically the amount is principally recovered through a sale rather than use. And to be treated as held for sale, one thing is it must be available for immediate sale. If someone buyer comes today, I'll give it to him. I will not say, sir, still my order is pending, come after 10 days. No. If I say my order is pending, I have to still manufacture goods, come after 10 days, then it is not available for immediate sale. And second, the sale must be what? Highly probable. Highly probable, they've written it should be completed within a period of 1 year. Suppose by chance it did not got complete within 1 year, it's still okay. It doesn't mean that no, sir, nahi hua, aap kya karenge? It's still okay if you still have the intention of selling it off. Okay, so this is basically, it is available for immediate sale and the sale must be highly probable. Okay, now just come down. Just come down. If I have an asset which is basically abandoned. What do you mean by the asset which is abandoned? Is I am not selling also, I am not using also. If I am not selling also, I am not using also, that is called as abandoned. If an asset is abandoned, would it be classified as non-current asset held for sale? No, because abandoned may we are not going to recover money by selling, so it is not coming under non-current asset held for sale. Okay, we understood when does it come under non-current asset held for sale. If it is a non-current asset held for sale, what do we do? How do we measure it? So non-current asset held for sale, if it's a non-current asset held for sale, depreciation stops. If you just recall Ind AS 16, depreciation stops when it's classified as held for sale or upon disposal. Aisa tha? So the thing is, depreciation will stop. So now onwards, how it will be measured? It will be measured at carrying amount or fair value less cost to sale, whichever is low. Carrying amount or fair value less cost to sale, whichever is lower. And fair value is always based on market participants approach, not your entity specific. Okay. Depreciation will be stopped immediately, and suppose we are not able to find out, say for example, a fair value less cost to sale of an individual asset. So again, what will happen is we can't basically see whether there is a decline or not. So again, we'll be doing it in case of a group. And sometimes it's not an individual asset held for sale, it is all a group held for sale. Uske related liabilities are also held for sale. So if there's a group held for sale, so that again the checking carrying amount and basically fair value less cost to sale will be done for a disposal group. Now check over here, whenever there is a disposal group which is held for sale, individual asset in the disposal group will be measured in accordance with the respective index. I repeat, individual assets in the disposal group will be measured as per respective index. And before it is getting classified as held for sale also, all assets will be first measured as per the respective index, and then they fall under index 105. And upon classification of held for sale, now they are valued at carrying amount and less, and your fair value less cost to sale, whichever is low. Okay, now suppose fair value less cost to sale is coming lower than the carrying amount. Can I say some loss is booked? This loss is also known as impairment loss. I repeat, this loss is also known as which value? Impairment loss. And you know impairment loss goes where? P&L. If the asset was carried at a revalued amount, we had a revaluation surplus, then in that case that impairment loss will be adjusted against revaluation surplus. The same thing. Now, come to question number 1. And same over here also. If it was a disposal group, there is a loss coming. In the disposal group, if goodwill is there, the loss is first allocated to goodwill, then to the other assets on proportionate basis based on their carrying amounts. Okay, now we have a question over here. This is a carrying amount at the reporting date. Can I say balance sheet date? Before classification is held for sale. This is the carrying amount as remeasured immediately before classification. Remember, immediately before you classify, they are to be measured as per the respective index. Like if today it is classified as held for sale, depreciation will stop from today. But can I say till today depreciation will come? So ye jo tha, this was reporting date, like 31st March. And this is 1st July when we are classifying it as held for sale. Okay, so now this all difference, this 16 and 14,900, this difference will go as per the respective index. So from 31st March to today, the accounting is done as per respective index. Now today the value is 14,900. Now this is the carrying amount today. What is the fair value less cost to sell today? Now what is the fair value less cost to sell today? If fair value less cost to sell, we need to check. It's 13,000 given in next question. So 14,900 minus 13,000, 19. That will be recorded. 1900 recorded as impairment loss as per index 105. So earlier this 16 becoming 14,900, this is as per the applicable index. Now that 14,900 is basically the carrying amount and the recoverable of the fair value less cost to sale is 13,000, then this 1900 will be as per index 105. Now let's see in the group who are there. Who are there in the group? 1500 will go in goodwill only. Oh, goodwill chala gaya. Now PP, building, they are non-current asset. Inventory and investment in equity, they will not be bearing anything. This too will bear the remaining 400 rupee in proportion. 4,000 is to 5700. So first 1500 goes to goodwill and remaining will go to the non-current assets which are there, that is 4,000 and 5700. In this too, the remaining 400 will be apportioned. Check. Okay, now next question, they are telling next year the fair value less cost to sell increased to 15,500. Next year the fair value less cost to sell is increased to how much? 15,500. Now we cannot reverse full 1900. Goodwill reversal is not allowed. So goodwill reversal will not be allowed and 1500 reversal cannot be there. Only we are able to reverse is 400, which was that other assets which were there. Okay, question number 4, which was asked in November 19 exam. Check. First 31st July, board approves and becomes committed to the plan to sell. Okay, when it is approved and we are going to sell off the things, 31st of July. However, we are required to take a approval, but they say the approval is kind of customary and will be received. मुझे मालूम है approval is kind of customary. Customary is kind of traditional, मिल ही जाता है. Is approval to be taken a main thing or kind of subordinate? Subordinate. Then in that case, this approval is of no use. So when do I say the asset is classified as held for sale? From July itself, 31st July itself, because the word written it is customer. And sale is expected to be done by March. ठीक है. Now these are the values as at December last year, and now these are the carrying amount as at held for sale wala classification. So from December till July, this accounting would have been done as per the applicable Ind AS. The 2750 became 2600. This is as per applicable Ind AS. Now the role of 105 comes. Now this 2600. ठीक है. What is the fair value today? Fair value today 1850. Cost to sell is 100. So can I say 1750? So 2600 is becoming 1750. How much is loss coming? 2600 minus 1750. It is 850 loss. Out of 850, goodwill will bear 500. Plant and machinery will bear. Building will bear. Debtor, inventory, creditor will not bear. So this two will bear the remaining 350. So check out यहाँ पे. This is 500 and this two are bearing the remaining 350 rupees. Clear with this? Now what they have given further. This is done at the date. Okay, now at the end of the year, what happened at the end of the year? The disposal group is not sold at 31st March 1 and the fair value is lower than, fair value as on 31st December 1 is lower than the carrying amount. Okay, now next time again the fair value is lower. Again the fair value is lower. When I say again loss comes. But now who will bear the loss? Goodwill to gone. The other two which were bearing, they will again bear it in proportion. Check out this answer they would have given theoretically. So measurement will be done on similar lines. Other debtor, inventory, they will be measured as per the respective Ind AS. And if still the value is lower, then that will be borne by the same assets in the same way it was shown earlier. The values are not given. That's why values are not given in solution also. They've just given a theoretical thing. Okay, now changes to the plan. Earlier I thought I want to sell off the non-current asset which is held for sale. Now the plan is cancelled. Can I say if the plan is cancelled? If the plan is cancelled, we should start depreciating again. Okay, now question is, if plan is cancelled, what value it will come back? So now whenever it was classified as held for sale, you put it separately under current asset. It's held for sale, usko separate kar denge. But now can I say again it will go back in PP? So it will go back in PP at what value? The carrying amount, had it not been classified as held for sale. If it was not classified as held for sale, what would have been the value? And the recoverable amount on the day when you have decided not to sell, usme se whichever is low. It will come back in PP at which value? The carrying amount, had it not been classified as held for sale, or today's recoverable amount, whichever is low. Okay, this is fine. Next question. Okay. Just 1 minute. Okay. So one more question I have. If at all you classify something as held for sale, earlier it was in PP, now I'll put them separately under current asset. Okay, with the previous year's figure, maybe the PP is to be removed and put in current asset. I repeat, this year it's classified as held for sale. I remove from PP, I put it under some current asset. The previous year it was under PP, the previous year figures are to be reclassified. Answer is no. Answer is no. So when non-current asset held for sale, usme this year from PP it became current asset, or if plan is changed from current asset it becomes PP, the previous year's figures are not to be reclassified. But if it's a discontinued operation, the data is to be given separately. This year if it becomes discontinued, can I say last year it wasn't continued, then the previous year figures are to be reclassified. When something is becoming a discontinued operation, the previous year figures are to be reclassified. Yahan pe they are not to be reclassified. Again please. No, disclosures are required. I'm telling, in your balance sheet the previous year's figures are not reclassified. In previous year column it will still be under PP. In current year column it will be under non-current asset held for sale in current assets. Okay, now let's go next. Questions are fine over here. This is presentation disclosure, which we already discussed. Previous year's figures are not to be reclassified, and something which is non-current asset held for sale or uske related liabilities are also to be shown separately from the related asset. So now you cannot show them under PP, you have to show them separately. So check यहाँ पे see under current asset they've written non-current asset held for sale. Same way, under current liability, liabilities associated with non-current asset held for sale, they are to be shown separate. Now comes the word discontinued operation. Now, what do you mean by the word discontinued operation? See, discontinued operation is a component of entity. One asset is not discontinued operation. Operation क्या होना चाहिए? Component. It's a component of entity which is a major line of business or a major geographical area of operation, and it is to be disposed of under a single plan. Single plan में the full that division is to be disposed of, or full operation of US are to be disposed of. It's under a single plan. And if a subsidiary is acquired exclusively to sell it off, if subsidiary is acquired exclusive to sell it off, that subsidiary is also classified as discontinued operation. So it has to be a component. One single asset is not a component. ठीक है. Now, whenever there is a discontinued operation, so what will be the impact? Impact is only in presentation. There's nothing in accounting. The impact is only in presentation. We know that in our P&L, the profits which we had, first of all, continuing operation, and then came discontinued operation. Achha, discontinued doesn't mean you stopped. If it is meeting the definition of non-current asset held for sale, what is definition of non-current asset held for sale? It should be available for immediate sale, and the sale is highly probable. Then also it can come under discontinued operation. But the thing is, it has to be a component. It cannot be a one single asset. Did you understand? Okay, now check this question 7. If I was setting a paper, I'll ask this. As such a simple one, but student has to understand whether this is a discontinued operation or asset held for sale, or both. Whether this is a discontinued operation or non-current asset held for sale, or both. First, M&O disposes of a component of entity by selling the underlying assets, and the component is to be disposed. The sale is incomplete. अच्छा, अभी तक sale हुआ नहीं है, but can I say you're ready to sell it? Available for immediate sale. Okay, so then it is an asset held for sale also, and it's a component that is also a discontinued operation. Achha, if sale is already completed, so can I say it cannot be held for sale? It's already sold. तो नहीं आएगा यहाँ पे. So check same over here. You ceases activity. You already completed the sale. If you already completed the sale, you cannot call it as asset held for sale because it's already sold. So it can be no. It will be no over here. But it's a discontinued operation. Discontinued में either it fulfills definition of non-current asset held for sale, or it has been discontinued. Stopped हो गया, sale हो गया, तो भी it is a discontinued operation. Okay. First, you have ceased activity that meets the definition of discontinued operation without selling any asset. Okay. Is it possible I shut down the activities, I stop it, finished? Yeah. So that is discontinued operation, yes. But am I going to sell the assets? No. So can I say assets are held for sale? Answer is no, because we are not going to sell it. So यहाँ पे we are not going to sell. यहाँ पे third one में it's already sold. Okay, last one. We will sell the asset, but will not discontinue the operation. One of the asset will be sold off, but a component is not sold. But the component is not to be stopped. So can I say it's a non-current asset held for sale, but it is not a discontinued operation because the whole operation is not discontinued. Fine. Presentation is only basically the thing which will come up, and if you see over here we have the discontinued operation ka effect which is there. This is continuing. Discontinued may profit loss before tax, tax impact of that, and we have after tax impact. That's the only thing. This is only for presentation purpose. Then next one is chapter number 5, unit number 1 in days 20. Yes, please. Okay, now question is, subsidiary is classified as non-current asset held for sale. Whether the previous figures are to be reclassified? Answer is yes. It's only for that subsidiary classified as held for sale. Individual assets are classified as held for sale. Wahan pe it is not, because subsidiary is considered as what? A component. So indirectly it falls under your discontinued operation. Previous year figures are to be reclassified. Did you understood? Yeah, if like I tell you, last year it was continuing operation, this year it is discontinued. So last year that was there under sales also, purchase also, all expenses also, all that figures you have to remove it and you have to put that as discontinued. So previous year's figures are to be restated. For non-current asset held for sale, previous year figures are not reclassified, but for discontinued operation, the previous year figures are reclassified. If it falls under the definition of discontinued operation, the previous year's figures are reclassified. Okay, next one is chapter number 5, unit number 1, Ind AS 20, that is your government grants. Now, there are two things. One is called as a government grant, other is called as a government assistance. Now, grants which cannot be measured, grant which you are not able to measure it, they are all your government assistance. See, accounting will be only for grant. Assistance ka accounting will not be there, but assistant ka what will be there? Disclosure. So accounting and disclosure both are there for whom? Grants. So for grants we have accounting also, disclosure also. But for basically this assistance there is only disclosure. Okay, now let's move ahead. The definition of government grant. What is a government grant? They are assistance by government in form of transfer of resources, and you have to comply a condition. You already complied or to be complied in return of past or future compliance with certain condition. And grant excludes what? Assistance which cannot be reasonably well. For example, Adani group ke file BJP government mein, can I say they are processed on priority basis? Yeah, all their files are being processed on what basis? Priority basis. So now, is that a kind of benefit to you? Yes. That is a government assistance. You can't call it as government grant because you cannot value it reasonably. So my files are processed first. Bhale mera file last mein na to bhi mera upar aa jata hai. So that is which cannot be reasonably valued. Okay, transaction with government which cannot be distinct from normal operation. If I have some transaction with government which cannot be distinct from normal operation, then that is not a government grant. Okay, now due to COVID, government came out with some relief measures like GST was reduced, TDS ka rate was reduced. You all know 25% TDS ka rate was reduced. Is this all a government grant? No reason. GST reduced. How much benefit I'll have in future? Future sales pay GST less. Future TDS, whatever is there, uspe TDS is to be deducted less. So can I reasonably value it today? No. So that's not a government grant. So tax holiday, tax reduction, GST reduction, they will not be accounted as per Ind AS 20. Okay, now recognition of government grant. When I should record a government grant? One is when you have a reasonable assurance you are able to fulfill the condition. Reasonable assurance. I don't say condition should have been fulfilled. Reasonable assurance I'll be able to fulfill the condition, and reasonable assurance that the grant will be received. I don't have to wait till I receive the grant, but I have a reasonable assurance grant will be received. So generally upon obtaining sanction letter, I can record government grant. Now this is important. Forgivable loan and loan at less than market rate. What is forgivable loan? Forgivable means I don't have to repay. The government gave me a loan, I don't have to repay, then that's directly becoming what? Government grant. But government gave me a loan at less than market rate. So normal rate of interest going on is 8%. They gave me interest at what? 5. So can I say I have to pay them 5, 5, 5, 5, 5 and last year mein 100, so 105. Not is the normal rate going on 8. So I need to discount it at 8%. So whatever you will pay discounted by 8%, figure will be less than 100. Figure will be coming less than 100. Say for example, figure is coming 85. 85 you show it as loan in your books. Remaining 15, they gave you 100 now. That will be treated as your government grant. So 85 will be treated as your loan in the books, and on this loan interest will accrue in your books at how many percentage? 8%. In your books interest will accrue at 8%. Clear with this? So even though whatever you have to pay 5 and 105 discounted by the normal rate of interest, present value is actually the loan, remaining amount is a government grant. Okay, this is the question over here. The bank we got 50, loan mate comes 3750, 1261 goes in government grant. Now every year on 3738, that is 37,38,000, interest will accrue at how many percentage? The normal rate of interest which was there. Now how do I account for government grant? There are two approaches. One they call it as capital approach, other is called as a income approach. Capital approach may it goes directly in basically your balance sheet, it does not come in PN. Income approach में it goes in PN. ठीक है. But your Ind AS specifies only which approach? Income. Okay. So if you just recall your accounting standard 12, AS 12 was government grant. If you get a government grant in nature of promoter's contribution, remember you are taking in capital reserve. In Ind AS, nothing is going directly in capital reserve. Everything is all PN. All government grants go where? PN. There is only income approach. All government grant go to PNL. How? On a systematic basis over which the expense or the related cost for fulfilling the conditions will come. If a fulfilling condition I'll have to spend in next 3 years, so that grant will also go to PNL in next 3 years. Okay, expense already incurred, then you can take the grant to PNL immediately. If no future may cost to be incurred, already the costs are incurred and now I'm getting a grant, then you take it to PNL immediately. Fine. Non-monetary grant. Non-monetary is I'm not getting cash from government, I'm getting what? Asset. For example, just now, which company? There's one company in Gujarat, they're starting a new manufacturing plant. They are given a land at 1 rupee per square feet. They're given a land at how much rupees? 1 rupee per square feet by government. So can I say this is not in cash but in kind? So if you are getting a non-monetary grant, two options. Either you are getting free में, उसमें भी two option how to record. Either you record at fair value or you record at nominal value. But if you receive as concessional rate, like 10 crore ka land, they give you at 3 crore. Either you record at 10 crore only and the remaining 7 crore is a government grant, or you record at 3 crores. Or you record at 3 crores. Two options are available, either at fair value or at the concessional rate what you have picked. Okay, grant is related to fixed asset. If it's a depreciable fixed asset, the grant related to fixed asset deduct from the cost of fixed asset. A second option is we can treat it as a deferred income. If I deduct from fixed asset, what happened? Fixed asset 10 lakh, grant received 2 lakh. Can I say fixed asset 8? Depreciation will become 80,000. Depreciation will become 8. If I don't deduct from fixed asset, so fixed asset 10, so can I say depreciation will be 1 lakh? But now that 2 lakh which I received, I treat it as a deferred income, and 20,000 deferred income will go to PNL every year. So what happens indirectly? First वाले में depreciation 80, second वाले में depreciation 1 lakh, but there's a deferred income coming in your PNL 20, net again becomes 80. ठीक है? A grant related to non-depreciable asset. For non-depreciable one, you can't deduct from cost. For non-depreciable one, you can't deduct from cost. You only have an option of what? You show it as a deferred income. Take it to PNL over the period in which the cost related to fulfillment of condition will come. Okay, government grant which has no relation to your operation activity. If it has no relation to operation activity, still every grant goes in PNL. Everything will go in PNL. How? Over a period over which the condition related fulfillment expense will come. Okay, check question number 3. You got 20 lakh for starting a business without condition. Without condition, take to PNL immediately. 50 lakh for R&D is there. The drug will be available to public at 20% cheaper rate and in accordance with the quality given by WHO. So can I say I have to give at 20% cheaper rate to public? So I need to see for how many years I need to give it to them. Based on that, it will be taken to PN. That's a deferred income. See, generally what will happen is they will give you a condition. Condition will not be lifetime ke liye. It will always be for certain number of years. Like someone who developed that COVID ka vaccine, for a certain number of years the rate was restricted. Afterwards they can sell it at their own. 2 acres of land is given free of cost for setup of plant. Record either at fair value or at nominal value. Rupees 2 lakh received for purchase of machinery. It is a depreciable one. Either deduct from machinery or second option treated as a deferred income. Okay, next. A grant, when I say it goes in PNL, PNL mein how it goes, two options. Either you record as an income or you deduct from the related expense. Yes, please. Okay, now this what you are telling is a different government grant. What he is telling is like you sell to public at a lower rate, extra amount, whatever is basically there, government will pay back to you. So that cannot be recorded on day one. That I can't record because that is conditional upon making sales. Once sales happen, I can record a government grant receivable. So till that time, that will never be recorded. This is a different thing where I'm getting some upfront amount based on condition to be fulfilled in future. Okay, now we have a question over here. You received a grant in nature of exemption of custom duty on capital goods. You received something like exemption of custom duty on capital goods under your export promotion capital goods scheme. Okay, what is this? I imported an asset. They granted me free of custom. Otherwise, I had to pay what? Import duty. But they put me condition that I have to do certain exports. So today import was free for me without duty. Condition is I have to do certain exports in future. So today, can I say I have not paid the import duty? Is that a government grant? I did not pay the import duty. Is the amount measurable? Yeah. How much import duty I did not pay? I know it. Is it a government grant? Yes. But it is conditional upon what? Exports to be done. Okay, so I'll record, but today I'll be recording it as deferred grant receivable karke, and basically I'll be transferring it to PNL over the period in which that exports are to be done. Next. Acha, question. This I got an asset pay import duty was not paid. So is it a grant related to asset? Answer is no. For a grant to be related to asset, it is for purchasing an asset. The condition is to purchase an asset. Yahan pe condition is not to purchase asset. The condition is to do exports. Did you understood? Condition is not to purchase asset. Condition is to do export. So this is not a grant related to asset. This is a grant related to income. And if it's a grant related to income, it can never be deducted from cost of assets. Okay, next. There's a clean river project, and the grant relates to a clean river project which involves some research. However, no major steps have been taken by Rainbow to commence the research. Okay, I have done no major work. So if at all I feel the grant is to be refunded, can I say I should not record only in day one? But if at all grant is not to be refunded only, they have not put any conditions, chalega, then in that case you can directly take it in PN. Next one, the second grant relates to a development of a new equipment, and which is an eco-friendly substitute of the plastic product, and you are confident about technical feasibility, financial viability, etc. So this is for new equipment. Can I say I can deduct it from the cost of equipment only? Or second option, I can treat it as deferred. Fine, chalega. This is easy. Let's move ahead. Acha, this one is important. You are getting a government grant of 60,000 receivable over how many years? 3 years. First year 40, then 10, and then 10. First year 40, then 10 and 10. Contingent upon creating 10 new jobs and maintaining them for 3 years. You have to create how many jobs? 10, and then you have to maintain them. The employees are recruited at a cost of 30,000. Now recruitment cost will come in all the years or only first year? Recruitment cost only first. And can I say then wage bill, salary will come all the years. So the recruitment cost came 30,000 in first year only. Wage bill of first year is 1 lakh, rising by 10,000 each year. So first year 1 lakh, second year 110, third year 120. Okay, so if I see first year my total expense will come 30 plus 100. Can I say 130? Second year will be 110. Yeah, 30 nahi aayega, this will be 110. And third year will be 120. So can I say expenditure I have to do in this way? So grant should be amortized also in this way. So 60,000 is the grant. You'll amortize in which way? 130 by 360, 110 by 360. This is the grant income which will go in P&L. Now first year, how much you received? 40 you received. Out of 40, this much 21667 only has gone to P&L. Out of 40, 21667 has gone to P&L. So how much is deferred income appearing? 18333. Okay, next year again you got 10. So can I say total ho gaya 50? Out of 50, 21667 is gone plus 18333 will go on. So balance 10,000 will appear as deferred income in your balance sheet. And third year again you got basically 10. The total 60 ho gaya, and out of 60, so all 60 has gone into P&L. Now the balance will become nil. So see, there are two separate things. One is how it will go in P&L. Total 60,000 in the ratio of 130 is to 110 is to 120. How it will go in P&L. Now second is how much will be the deferred balance appearing in your balance sheet. 40, how much you have taken in P&L till now? 21,667. The 18333 will appear. Till second year you received 50. Out of 50, how much has gone in P&L? 21667 plus 18333. Balance 10 will appear. In third year you received full. You transferred to P&L also full. The balance will remain. The only point is this is important. Did you understand? Shall I move ahead? Shall I move ahead? Now what many students do is they basically say 60 usme se 21667 was taken to P&L. They will show remaining amount as receivable. They will show remaining amount as deferred. That is wrong. You have received only 40. 40 may say okay, you're taken to P&L is 21667. Balance 18333 will appear as your deferred. Disclosure in cash flow. Now grant depends. If grant is for fixed asset, so can I say you'll take it in investing activity? But if grant is basically for normal operations, you'll take it in operating activity. So depends where it is. Refund is opposite of what you have done. Refund is only what? Opposite of what you have done. Earlier it was deducted from fixed asset, added to fixed asset. Earlier it was treated as deferred income. So now earlier it was basically bank to deferred income. So now it will be deferred income to bank. But the problem is out of deferred income something might have already gone into P&L. So to the extent balance is available in deferred income, you debit deferred income. Balance you are required to debit is prepared uska period. Okay, if you are having a balance sheet, so balance sheet mein kya hoga? As at the current interim period. Okay, imagine current interim period is Q2. Q2 will be July, August, September. The July, August, September, the 30th September this and previous 30th September. Comparative. P&L this quarter 3 months July, August, September plus year to date. Year to date is April to September, and same way corresponding also 3 months and year to date. So check out current interim period, year to date, and with comparative same way 3 months and 6 months. Okay, statement of changes in equity you don't need for 3 months, you need cumulatively only for year to date and previous year also year to date. Cash flow statement also you need directly year to date, and the previous is also year to date. Did you understood? Only in P&L. What will happen in P&L? You will have this 3 months and you will have 6 months till date and corresponding also 3 months and 6 months. Achha, plus one more thing, if at all you have a business which is a kind of cyclical one, if cyclical business is there, in that case what will happen is you are required to give a 12 months revenue till date. So today and the preceding 12 months, that way. Okay, moving ahead. Come to accounting policies, etc. Now, accounting policy which you follow for your interim financial statement, can I say it will be the same policies which you're following in your annual financial statement? There's no change at all. If you change your accounting policy, the how to treat with it, we are required to do in your Ind AS 8. I'll come to that. Okay, revenues are cyclical. Imagine this. We have a firecracker store. So Ambika Fireworks, you might have seen, that's a kind of big, or Coronation or Standard is a company which are selling fireworks. So now that Standard company or Coronation company, can I say they will have majority sales in this month only? So whenever they are preparing the quarterly financial statement, can they bifurcate their sales, or they have to take wholly in this period only? Wholly in this period. So if at all your revenues are received cycle, they occur. Okay. They are not anticipated or deferred. Costs which are incurred unevenly, they are also not deferred at all, unless if something is allowed to be deferred for annually. For example, I pay municipal tax today. And that municipal tax which I'm paying today, it's from 1st October of this year to 30th September of next year. Now, in that case, can I say in yearly also something would have been prepaid? So in quarterly also you can consider prepaid. Okay. Now, bad debt came up in this year, a huge one. This quarter, there's a bad debt, huge one. Can I amortize or I have to take fully in this quarter? Fully in this quarter. Next, sales promotion expense, I did a huge one in this quarter. So, should I take it in this quarter, amortize? This quarter. Additional depreciation, this will not be there due to change in method of depreciation. That's a change in estimate. Whenever the estimate change, its accounting will be done prospectively. Extraordinary loss came up in this quarter. Take it in this quarter. Fine, this is over. Now, there's one line written over here. If you can just see, measurement for interim reporting period shall be based on year-to-date basis. Measurement for interim reporting period will be based on what? Year-to-date basis. Now, what is the importance of this? Come to question number 3 over here. See, the fixed production overhead for the year is what? 10,000. Normal production after plant maintenance etc. is 2,000. Now, can I say my normal production is 2,000? So, per unit, my cost of fixed production overhead is 10,000 divided by 2,000. Can I say it's coming 5? Okay. But when I'm doing a measurement has to be done on which basis? Year-to-date basis. How year-to-date? Normal expectation is 500 metric ton every quarter. Now, and fixed production overhead for the quarter is 2,500. 10,000, it's 25, 25, 25, 25. Now, how much is the production in first quarter? 400. Okay, so now the thing is, remember we absorb the fixed production overhead. How? It was based on fixed production overhead per unit based on normal capacity, or fixed production overhead per unit based on actual capacity, whichever is lower. Okay? So normal capacity is coming 5 per unit. Actual capacity यहाँ पे will come more, so I'll take only 5 per unit. So 4,000 into 400 into 5, so 2,000 rupees. I'll actually take it in cost, and actual incurred is 2,500. Extra 500 is my abnormal loss. So how much has gone to P&L? 500. So 2,000 is basically absorbed, and 500 is charged to P&L. But now when you come to second quarter, don't see second quarter alone. See cumulatively. Okay, till second, how much is your production? 1,000. 1,000 is the production. Normal is also what? 1,000. So can I say normal or actual will come same? So till date absorption would have been full. So full 5,000 is absorbed. Now the thing is, we have already put 2,000 absorbed and 500 in P&L. But now can I say till second year full 5,000 should have been absorbed only, and P&L made has to be nil. So what do you do is whatever you put in P&L has to be reversed. This is year-to-date concept. This is year-to-date. When I come to third, can I say it's 1,500 now? So again, nothing will come in P&L. First quarter we took 500 in P&L. Q2 may it got reversed. Q3 may also nothing goes in P&L. Now when I come to Q4, can I say now it's total 1,900. It's not 2,000. Now again 100 unit into 5, 500 rupee will go in again P&L. So Q1 में 500 went, Q2 में 500 was reversed, Q4 में again 500 goes. Next, okay, payroll taxes. Payroll tax is nothing but the TDS. Okay, TDS when I'm deducting, employee ka TDS when I'm deducting, it's always based on yearly salary. So I can't say what is the salary of this quarter. So quarterly salary must check karo, you have to check the salary of year. For the year, what will be his salary? What is the tax to be deducted for the year? Divided by 12, I'll get the monthly TDS to be deducted. Okay, income tax for the interim period. How will be the income tax for interim period? It's based on the annual effective tax rate which you will be having. It's based on annual effective tax rate. So whatever is annual effective tax rate into the quarterly income. So quarterly income into annual effective tax rate. Now suppose I have slabs. So first 250 is 0. 250 to 5 lakh is 10%, 5 to 10 lakh is 20%, and more than 10 lakh is 30%. Now suppose I'm having expectation my annual income will be 15 lakhs. So I have to calculate what my tax will come up. And on 15 lakh, what is the tax coming up? You find out a rate. That's called as an annual effective tax rate. The annual effective tax rate will be applied to your interim quarterly incomes. Check over here. First 20,000 is 20%, next 40,000 is 40%, the total 20,000, total tax 20,000 on 60,000, so your effective tax rate is coming 33.33%. Now Q1 profit, Q2, Q3, Q4 into 33.33%. Now suppose, pay attention, we earned 1,50,000 in Q1. Q2, Q3, Q4 will have a loss of 150 suppose. So can I say annually your tax total income will be what? 0. See, you have to do that effective tax rate only when there are slabs. Only when there are slabs or where you have some unabsorbed loss past wala. Then the effective tax rate comes into picture. It's just that annual income will become nil doesn't mean annual tax rate is nil. Tax rate is still how many percentage? 40. Income is nil. There's a difference between income getting nil and the tax rate becoming nil. So effective tax rate is based on slabs. Like suppose in this question, you earned 150 in Q1. Q2, Q3, Q3, you're expecting what? 50,000, 50,000, 50,000 loss. The total income will become nil. The yearly tax will become nil. That doesn't mean you don't book any tax in Q1. That doesn't mean you don't book any tax in Q1. Reason is there are no slabs over here. So question is directly given. The annual income tax rate is how many percent? 30. So Q1 income 150, you book a tax rate into 30%. Q2 में minus 50, you reverse that much. Q3 में minus 50, you reverse that much. Q4 में minus 50, you reverse that much. Clear? So यहाँ पे annual effective tax rate is not 0. Annual effective tax rate is already given 30%. You have to find it only when there are slabs or only when there are accumulated losses. Okay. Now sometimes they say that some losses are allowed to be set off only against a certain income, like capital gain wala. So we can set off capital gain wala thing only against capital gain. So we need to check out future में such kind of things will be there or not. Plus what happens is sometimes some income is taxed at a separate rate. When I'm calculating annual effective tax rate, leave that income. That income is at a specific rate. For the remaining one, you're calculating annual effective tax rate. Check this question, May 19 and November 20 exam. You have a gross income annual is 33. There will be a capital gain 8 lakhs. Okay, 33 ka bifurcation Q1, Q2, Q3 is 12 including 8 lakh and then Q4. Rate on capital gain is 12 lakh. Others pay. Okay, so can you say out of 33, 8 is your capital gain. Remaining others is what? 25. Okay, out of 25, first 5 lakh is 30%. Remaining 20 lakh is 40%. To find out the effective tax rate. Okay, 5 lakh ke upar 30% is 1.5 and 20 ke upar 40% is coming 8. 8 plus 1.5 is 9.5 divided by 25 lakh. Can I say it is coming as 38%? 38. Now Q1 7 lakh. Can I say it's all the normal income? So Q1 7 lakh into 38%. Q2 8 lakh into 38%. Q3 12 hai, but 8 is capital gain. So 4 into 38% and 8 into 12%. And Q4 6 into 38%. Okay, now last question of this. Suppose my year ending is different and tax ka year ending is different. We are following a calendar year. Can I say tax mein they will follow March? So now problem is when I'm having interim financial, if I'm following a calendar year, I will have January to December. But tax mein it is March to March. So my first quarter actually falls in last year of income tax and my Q2, Q3, Q4 will fall under next year of income tax. So Q1 is falling under this year of income tax, but Q2, Q3, Q4 will fall under next year of income tax. And is it possible the tax rate of last year and this year might be different? The department has changed the rates. Now, is that a basis to find the annual effective tax rate? No. So Q1 mein last year tax rate you apply, Q2, Q3, Q4 mein you apply next year's tax rate. If your and income tax department's tax rate, year ending are different, you apply the tax rate applicable for that period. Yahan pe you don't have to find annual effective tax rate. Okay, check question. See, your accounting year is December. Tax rate will be March. And if you check yahan pe, we are having a profit 10,000 every quarter. Annual effective tax rate is 25%, March 19th. And thereafter the tax rate has become 30%. So for my Q1 income, I'll take 25%. For my Q2, Q3, Q4, I'll take 30%. यहाँ पे don't find annual effective tax rate. Annual effective tax rate comes only under two cases. One is slabs and second is your brought forward losses. Done. This was your Ind AS 34. One more standard and then we take a break. Come to Ind AS 7, cash flow statement. Keep smiling. Okay, now your cash flow statement is nothing but a statement which shows how the cash is generated and how the cash has been utilized in your business. It's a statement which shows how the cash is generated and how the cash has been utilized. Your cash flow is divided into three parts: operating activity, investing activity, financing activity. That's fine. The format is also fine. Now, it shows movements of cash and cash equivalent. Now, cash ka definition is cash on hand, demand deposit with bank. Demand deposit, which I can get it back anytime. That is demand deposit with bank. And cash equivalents are what? Short-term, highly liquid investments, which are up to a period of 3 months, 90 days, and which has an insignificant risk of change in value. So suppose I invest in equity shares for 3 months, that is not cash equivalent because the values will change. Okay. Now, there's a question over here. Whether bank overdraft, they are treated as a part of cash and cash equivalent. Whether bank overdraft. Now see, if bank overdraft is basically a part of your cash management program and it is repayable on demand, then in that case, it will be considered as your cash and cash equivalent. So bank overdraft, don't take it under financing activity. Bank overdraft, take it under your cash and cash equivalent. Okay, now there's another word called cash credit. You might have heard this word, CC account. Okay, cash credit account is always negative. Bank OD में क्या होता है? It's linked with your current account, positive, negative, positive, negative. But CC account is always negative. CC account is never cash and cash equivalent. CC account will come under your financing activity. Okay, next. Just a minute. Okay, now check this question. We are required to tell whether it's a cash and cash equivalent or not. Okay, we have a FD with SBI, 3 years maturity. We have FD with SBI. Nothing is given. They are non-cancelable. If they are non-cancelable, they are not demand deposits. If they are cancelable, then they are demand deposits. So they are non-cancelable. So is it for 3 months? No. It is for how many months? 3 years. So this is no. The answer is no. Second one, FD with HDFC. Now we will get money in 3 months, but it was for 2 years. FD was for 2 years. Remaining period is 3 months. Is it a cash equivalent? No. They are short-term, highly liquid investment. Short-term investment means the investment has to be for 90 days. Originally, this was not for 90 days. This was for 2 years. Next one, we have some preference shares which we acquired in January, which is due for redemption. Due for redemption in April. Okay, 29th January, say 3 months if I calculate, 29th February, March, April. So it is coming within 3 months or after 3 months? It is coming after 3 months, but I think in question we had changed the dates because answer may they've given is within 3 months wala thing. So it's instead of April, you make it as March. Okay, cash balance at various bank, whether lying in India, whether lying outside India, in whichever currency, they are all cash and cash equivalent. Bank overdraft, it's a temporary payable on demand. Answer is yes. And treasury bill, which is for 90 days, which I have taken. Treasury bills are government bonds. The investment in government bonds up to a period of 90 days. Answer is yes. Next, operating activities are the principal revenue generating source of business. Investing activities are acquisition, disposal of your fixed asset as well as your investment. So purchase, sale of investment, purchase, sale of fixed asset, income from investment. The income from investment comes in investing. Okay, the rent received, dividend received, they will come under your investing. Okay, financing activity. What is this financing activity? That is due to a change in ownership structure and the borrowings. So I issue new shares, I issue new debentures, I take a loan, I repay a loan, they all will come under financing. And the capital, cost of capital attached to it. Can I say debentures, preference shares? we have equity. On that we have to pay dividend, we have to pay interest. That all interest paid, dividend paid will also come under your financing activity. Fine. Now you purchased a fixed asset for $1 lakh and you entered into a forward contract. Question: forward contract, how it will be classified in cash flow? Forward contract is for hedging purpose. You purchased a fixed asset, uske liye forward. So forward contract, which is for hedging purpose, is classified in the same way as the original. Okay, now original, it is for fixed asset. For fixed asset means, can I say investing? So that contract will also come under investing. But imagine I had a purchase of goods against which I did a forward contract. So goods will come under operating. So that forward contract will also come under operating. Next, how do we have the cash flows from operating activity? Operating activity may, we know there are two methods: direct method, indirect method. Direct method where all inflows are added, outflows are deducted, non-cash items are ignored. Under your indirect method we start with what? Profit. We'll start with PAT. It's profit after tax only we'll start, but before which item? Exceptional items. Exceptional items are to be shown separate. We start with profit after tax and we make adjustment for two things. First of all, one, non-cash item, items relating to other activities. Now we get cash flow from operating activity before working capital changes. Now we give the effect of working capital changes. Working capital changes may current asset goes up, cash goes down. Current asset goes down, cash goes up. There's an inverse relationship between current asset and cash. There's a direct relationship between current liabilities and cash. Now we have cash flow from operating activity before tax. We deduct tax, we get cash flow from operating activity net. If it is before exceptional item, we show exceptional item separate. Okay, this is basically the indirect method. It's a simple one. I'm not going into that. More important over here is the consolidated cash flow. What comes in CA final is always consolidated cash flow. I'm not going into this normal things. Acha, can I report my cash flows on net basis? One machine purchased, another machine sold. Can I show net purchase of machine? No, purchase of machine separately, sale of machine separately. It has to be on gross basis. Exception. What are the exception? When the cash flows represent the cash flows of customer rather than an entity. For example, I have an account in Zerodha Securities and I do investments through Zerodha. So imagine I put in my money in Zerodha, I withdraw money, I again put in money, I again withdraw money. So can I say wahan pe the money represents not Zerodha's money, it represents whose money? Customer's money. Then they can show net money received from customer or net money paid to customer. That is fine. And second is cash receipts and payment of items where turnover is quick. Amounts are large, maturities are short. I constantly purchase short-term investment, I sell it. Again purchased, again sold. Again purchased, again sold. But if it fulfills definition of cash and cash equivalent, it will go there. But if it is not fulfilling the cash and cash equivalent definition, can I say it will come under your investing activity? Now so many purchase sale are there, you can show directly net. And third one, this is for a financial institution. Financial institution, they accept deposits, they repay the deposits. So wahan pe they can show net directly. They have basically cash advances, they have loans made to customer, customer repaid the loans, they can show this on net base, but this is only for financial institution. Fine. Next one is foreign currency cash flow. Okay, now pay attention. I sold goods in foreign currency. If I sold goods in foreign currency, I got the cash right now only, but they gave me what? Dollars. So I have to convert it into what? INR. So cash flow may, I have to convert at what rate? The rate prevalent on the date of cash flow. What's the word? Rate prevalent on the date of cash flow. The day when you are getting cash, that date has to be done. Now suppose you sold goods this year, but the cash is coming next year. So can I say in cash flow it will come when? Next year. And cash flow, how much cash will come? It's the rate which is prevalent at the date of receiving cash flow. Now one more thing over here, you might have seen that if at all I have some items in foreign currency, debtors, creditors are there in foreign currency, do you bring them to a closing rate? Debtors, creditors, do you bring them to a closing rate? Yeah, we bring them to a closing rate. So what will happen when I bring them to closing rate? There is some profit or loss coming, but that is the debtor realized or no? No. So can I say there's an unrealized profit or loss on translation of the debtors to closing rate, creditors to closing rate? Okay, so some people say, sir, it's a non-cash item. Yes, no? It's a non-cash item. Now, under your indirect method, what do we do with the non-cash item? Add back. but don't do this. Its effect will automatically come under working capital changes. I tell you, debtor increased, foreign currency wala tha, uske upar some exchange, whatever it's coming. So if that has happened, debtor is same, exchange rate has increased. So you will feel debtor has increased. And you say that this is basically a unrealized gain loss coming, which is basically a your non-cash item. And if you add over here, problem is because of that thing, debtor is also increased. So when I do working capital changes, can I say debtor increase, cash has gone down? Effect will come automatically. Effect will come automatically. So the thing is, whenever I say there is basically a gain coming, debtor would have increased when foreign currency mein gain is there. Debtor would have decreased when there is a loss. If debtor has gone down, there is a loss. Loss tha, you were adding it, but debtor gone down, automatically cash goes up, automatically it gets added in working capital changes. So unrealized profit loss relating to debtor creditor. I repeat, it related to debtor creditor, that you don't take it as basically non-cash item because its effect will automatically come under working capital changes. Check unrealized gain loss are not cash flow. Indirect method. Indirect method, we have some debtors, creditors brought to that closing rate, uske related things will come, they will automatically come under working capital changes. But imagine I have a cash in foreign currency. Okay, whether that cash in foreign currency is there, dollar rate was 170, now dollar rate is 75. So can I say now 5 rupee gain is there? That 5 rupee gain has gone in PNL only. That 5 rupee gain has gone in PNL. Now, if I don't treat this as non-cash item and I show profit 5 and operating cash flow 5, cash is not received. So operating cash flow should not be 5. So that will be treated as non-cash item. Wahan pe it is added back 5 rupee because this cash and cash equivalent does not come under working capital changes. Working capital changes mein debtor creditor comes, right? So effect of unrealized gain loss on cash and cash equivalent is to be shown separately in your reconciliation. I repeat, effect of gain or loss on what? Unrealized gain or loss on cash and cash equivalent is to be shown separately under your reconciliation. Let's check a question. Let's check a question for this. Imagine you have a foreign currency mein US dollar 100, assuming no transaction, and equivalent to it was 4500. You have this 100 rupee gain on account of increase in rate. $100 rate was 45, so 4500. Now $100 rate became 46. So you brought it to closing rate. 100 rupee gain is there in your PN. 100 rupee gain is there in your PN. Have you received 100 rupee? No. So actually in cash flow it should come nil, na? So when we start with indirect method, we are starting with profit 100. But now this is an unrealized gain. This is what? Unrealized gain. Profit has gone up, cash flow should not go up. So what should I do? Deduct. Profit has gone up, cash flow should not go up. What do I do? Deduct. So why I'm doing this? Because cash and cash equivalent ka up down doesn't come under working capital changes. If it was related to debtor, I'll not take here. It's automatically coming under working capital changes. Again, if it was related to debtor creditor, it would automatically come under working capital changes. So yahan pe I'll basically do this. So operating nil, investing nil, financing nil, net cash flow nil, closing is 45. But now when I try to match 4500 with my balance sheet it's not 4500. Why balance sheet it's not 4500? The exchange rate had increased, so cash was appearing at a closing rate in balance sheet. The balance sheet is 4600. So that 100 rupee will be shown as a part of reconciliation. So check this reconciliation, cash as per cash flow. 100 rupee reconciliation mein this is cash as per balance sheet. Did you understood? Same way, whenever you take bank overdraft as cash equivalent under cash flow, balance sheet mein bank overdraft is not cash equivalent. Balance sheet mein bank overdraft is short term borrowing. So can I say cash equivalent as per cash flow and cash equivalent as per books? They are not matching. Yahan pe overdraft was taken as part of cash equivalent in cash flow statement, but in balance sheet it is shown under short term borrowing. So again there will be a reconciliation which will be prepared like this. The effect of changes, unrealized gain loss related to cash and cash equivalent, unrealized gain loss related to cash and cash equivalent will come in your working. So non-cash item ki tarah, they are removed from above and effect is given under reconciliation. But if it is related to debtor creditor, they are not removed as non-cash item. Its effect will automatically come under working capital changes. Next. Now, interest, dividend, etc. Now, for see normal company, interest received, dividend received. What is interest received, dividend received? Investing. Interest paid, dividend paid, financing. So we have to take in investing and financing only. IAS 7 also gives them an option to put it under operating. Who gives them option? IAS 7. We don't give an option. IAS 7 gives them option to keep it under operating. Next, taxes on income. Now we have an income tax. We have many times basically dividend distribution tax is now gone, but earlier we used to have a dividend distribution tax. Plus we have a capital gain tax. Now capital gain, can I say sale of fixed asset pay? Your sale shares that are sold, or basically land you sold, you have a capital gain. So capital gain tax is related to that investing item. It will come under investing activity. If they don't give anything, normal income tax or refund of income tax will come under your operating. Normal income tax, refund of income tax, operating. Now, investment in associate JV. Okay, investment in associate and JV, when I invest over there, can I say they might give me dividend? SFS may, they are already at cost, and if they give dividend, SFS may income is there. And if I get dividend, can I say dividend received will come under which activity? Investing. But now problem is CFS. In your CFS, you followed equity method. So can I say your share of profit loss related to associate and JV you included in profits? Okay, profit may you included, but has the cash been received? No. That is which item? Non-cash item. It's there in your profit, but cash made is not there. So I need to remove it from my cash flow. So profits have gone up. Operating cash flow should not go up. I need to deduct. Did you understand? Okay, so over here that is there. Now, investment in subsidiaries and change in ownership interest. Now, when you acquire a subsidiary, it's investment in subsidiary. That's an investing activity. When you acquire a subsidiary, it's investing activity. When you sell a subsidiary, it's also investing. When you acquire subsidiary, associate, JV, it's investing. When you sell subsidiary, associate, JV, it's also investing. But I had a subsidiary 80%, I sold 20. 80 may say 20 sold, or 80 may plus 10. So subsidiary still remains subsidiary. Can I say there's nothing but a change in proportion of NCI? What is the purpose of doing this 5-10% up down? What was the purpose of doing this 5-10% up down? Can I say I would need money, that's why I did it? Ye kyun kiya hoga? Subsidiary is there, I keep it as subsidiary only. The purpose was not selling subsidiary, purpose was to get some money. So wo financing ho gaya. Wo kya ho gaya? Financing. So whenever there is basically a change in proportion of NCI, usme you pay something, receive something, that will come under financing. But a subsidiary disposed of, then it will come under investing. So check over here. Cash flows arising from obtaining or losing control, it comes under investing. But cash flow from change in ownership interest, that will come under financing. Now in your CFS, I acquire a subsidiary. Can I say I paid cash? I have to show as outflow. Group has paid cash. I have to show outflow, investing. But now what comes in CFS? Their assets and liabilities. Okay, now in their asset, can I say their cash also might be coming? Their cash also might be coming. So in your CFS, the outflow will be the cash which I am paying minus the cash which is coming. Cash which I am paying minus cash which is coming. That will be treated as an outflow where? Under your investing activity in CFS. SFS mein, so their cash doesn't come. Remember, SFS may just appears as investment. So whatever I paid 100, it will appear as outflow in investing. Now I paid 100. In CFS, their assets and liability come. In their assets and liability, 10 rupee cash also came. So I will not show outflow 100. I'll show outflow as 100 minus 10. Did you understand? So whenever we are preparing a consolidated cash flow, the year when you acquire a subsidiary, whatever cash you paid minus the cash which came on DOA, that is to be shown as outflow under which activity? Investing activity. In the year when you acquire. Plus in the year when you acquire, you need to take care. While seeing increase, decrease in debtors, creditors, other assets, liabilities. Check. Now, if I go to this question number 10 over here, you acquire 70%. Cash consideration is 15 lakh, plus you are giving some shares. And the cash which is coming in is 250. So I acquire your subsidiary 70%. So in my CFS, I have paid 15 lakh cash, but how much cash is coming back? 250. So how much will be the outflow under investing activity? 12 lakh 50,000. 15 less 250. Clear with this? Okay, now further we acquire 10% afterwards. Further we acquire 10%. Can I say it is already 70 plus 10? This is only what? Change in ownership interest. This will go under financing. So this 8 lakh will be going under your financing. Upar jo tha, that went under your investing. Now, what I was telling is about this question. If you see this question, they have given a consolidated P&L to you, and they've given some consolidated balance sheet to you, and after that they've given all shares of B were acquired for 74,000 in cash. They acquired B for how much rupees? 74. And because of that acquisition, their assets and liabilities came. In that assets and liabilities, if I see there's one cash of 2,000 coming. Okay, so I paid 74. How much I got back? 2. How much should be outflow under investing? Okay, if I just go to solution, in your investing activity, there is 72. Clear? Any doubts till now? Okay, now pay attention. Now they've given you a consolidated balance sheet opening and closing. Generally, when I see debtors, okay, opening 50, closing is what? So you might feel that debtor has gone up by how much? 4. Debtor gone up, cash should go down, because indirect method mein debtor goes up, cash goes down. But the problem is, this is consolidated balance sheet. We acquired a subsidiary this year. The problem is what? This year figure, can I say, are including the figures coming from subsidiary. Now subsidiary ka asset liability came, I paid something which is already recorded where? Subsidiary's assets liability came, I paid something which I have already recorded. Where I have recorded? Investing. Subsidiary ke assets liability came, I paid something that is already recorded. You can't record that again, no. So now what I need to do is, debtor was 50. Debtor was 50 earlier. How much came from subsidiary? 8. Okay, 50 tha plus 8 came, and for this 8, whatever I paid, I already recorded. So 50 was there, plus 8, 58. 58 became 54. Did you understood? So accounting wise, you need to take care yahan pe. It's not 50 becoming 54. Reason, 50 was there, plus 8 came from subsidiary, which is already recorded separately. Remember, whatever I took assets and liabilities of subsidiary, I paid, it's already there where? In investing activity, I already taken 72 negative. So now 50 was there, plus 8 came, 58. 58 becoming 54, debtor went down by 4, cash will go up by 4. To check the solution, cash going up by 4. Mila? Same way for creditors. Next, inventory. 35 becoming 30. You might feel inventory has gone down. Inventory has not gone down. You don't compare like this. 35 hai. How much was coming from subsidiary? 4. 35 plus 4, 39. 39 became 30. The inventory has went down by 9. Cash will go up by 9. The cash is going up by. Did you understood? So don't directly compare the figures. This is only in the year where you acquire subsidiary. Reason is the assets and liabilities which came, for that I have paid something which is already accounted separately. So now when I'm seeing increase, decrease, now I need to take care. Okay, one more thing. Same way for loan. Check the balance sheet. In your balance sheet, do you see a loan 64 becoming 1 lakh? Or you might feel, oh, loan taken. New loan taken, you might say it is a financing activity, but no, 64 is there. How much came from subsidiary? 36. Okay, 64 was there, subsidiary ke paas se 36 came, which is already recorded. So it became 1 lakh, 1 lakh remained 1 lakh. Is there any change in loan? No. So in your balance sheet there is, in your cash flow there will be no effect related to loan. Same way, if I go to PP, 80 becomes 160. 80 becomes 160. You might be feeling, increase how much? 80,000. But now you don't compare like this. 80 was there. How much came from subsidiary? 110. 80 plus 110. How much it became? 190. 190. And if you check, depreciation is there in PN. How much is depreciation is there? 30, 30. Okay, so 80 was there plus 110 came. So it is total 190. 30 is depreciation. Net is what? 160. Is there any purchase of fixed asset or sale of fixed asset? No. But most of the people, what they will do, 80, and they will just compare this. They might take the effect of depreciation, but they will ignore the TP which is coming from subsidy. So whenever you are seeing increase, decrease in assets now, you just have to take care only in the year where you acquired subsidy. Because whatever came from subsidiary, uske related payments, whatever are there, it's already shown under investing activity 72. I cannot show them again. Because that 110 came, I already paid. I cannot show again that thing. No? So that's why you need to take care. Did you understood consolidated cash flow? Okay, now just one more question over here. I'll take the few points. If you check, this is same. You acquired 100% of S at 300, and the 300 how much cash is coming up? 20. 300 I paid. How much came up? 20. So can I say in my investing activity there will be 280 outflow? If I go to solution, investing activity is not asked. Question is asked only operating. Question is asked only operating. But nothing is, second effect is whenever I'm seeing increase, decrease in my assets, I need to take care. Like suppose if I go to my debtor, यहाँ पे debtor came 30 lakhs. If I go to my debtors, debtor is 180 and now it is 1250. So 1800 becoming 1250, but don't see that way. It was 1800 plus how much came from subsidiary? 30 minus 1250. So how much is basically debtor may change? 580. So if I go over here, the debtors change will be 580. It was there plus something came from subsidiary. Now you compare with closing. Now same in this question, you purchase some 30% in associate for cash on 1st April. If you purchase basically 30% in associate for cash on 1st April, it will again come under which activity? Investing. But now they have got a profit of 400 lakh. They gave you dividend also. Now dividend received will also come under investing. But I would have recorded my share of profit. Where I would have recorded my share of profit? In P&L. So it's there in the profit. But to profit, we start our operating cash flow with profit. Profit may our share of profit is included, but can I say cash flow may it should not come? So our share of profit which is there is to be removed. It should not be there under cash flow. The profits have gone down, cash flow should, profits have gone up, cash flow should not go up, deduct. How much? 400 ka 30%, 120. So if you see here, you will find share in profit of associate 120 I have deducted from operating. So I started with profit, profit already it was there. This has been now removed. Did you understood? Done. This is basically your Ind AS 7, which is on cash flow statement. We take a break of 30 minutes and we meet back after 30 minutes. It's 2:15. We are meeting back at 2:45. Now we are having a separate standard which is related to agriculture in our Ind AS. What do you mean by a word agricultural activity? It refers to a management by entity. Now what is entity managing? So one, biological transformation and harvest of what? Biological asset. Biological assets are nothing but living animals and plants. And why we are managing it? Either it's for the purpose of sale. Imagine you are raising basically cows, or you are raising basically some sheep and goats. Why? One is you want to sell them directly, or you want to extract some product out of them. Like sheep may say we get wool, from trees we are getting some fruits, vegetables, etc. So either for sale or for conversion into what? Agricultural produce, or for getting additional biological asset. So we try to basically have the biological asset to get some additional biological asset. To see purposes are given. Now imagine a living animal is kept in a zoo. Is it for sale? No. Is it for conversion into agriculture produce? No. Is it for additional biological asset? No. So then that animals which are kept in zoo, they are not covered under your agricultural activity. They are not covered under your agricultural activity. And if it is not covered under agricultural activity, it will not fall under your Ind AS 40. Okay. Now going just down over here, if you see over here, there's a definition of bearer plant given. Bearer plant is nothing but a living plant which is used in production, which will give you fruits, that is produce. And you are not going to sell that plant, you're just going to sell what? The agricultural produce which is coming out of it. This standard shall apply. When they'll apply? When they relate to agricultural activities. I told you if something doesn't fall under agricultural activity, this standard also does not apply. They will apply to one, biological assets. Second, they will apply to agricultural produce, but at the time of harvest. Okay, imagine from a mango tree, when you take out the mangoes, immediately when you take out mangoes, Ind AS 41 applies. Later on, now Ind AS 41 doesn't apply. Now later on, what will apply is Ind AS 2. So first time when you take out, what value the mango will come, that is Ind AS 41. Subsequently, they are measured as per inventory, that is Ind AS 2, because now they are held for sale in ordinary course of business. TK, and government grant related to agriculture, they are also covered over here. The government grant related to agriculture will also be covered. Fine. If I go down, ABC Limited grows wines, harvests the grapes, and then produces wine. Okay, now when you grow wine, can I say basically grow wine, winery is basically covered under agricultural activity? Okay, that will be covered. Second, you harvest the grape. When you take out the grapes, can I say immediately on taking out, what is the value of grapes? That is as per 41. But then from grapes you convert into a wine. That is basically not covered into agricultural activity. That is basically your inventory. You are converting a raw material into a finished goods. Okay, so wines basically they give you grapes for a longer time, so they are covered as bearer plant. Acha, bearer plant hai, so it is not covered under this standard. Bearer plant is a PP, so it will go under Ind AS 16. Grapes which are harvested, they form under Ind AS 41, and once basically they are harvested, you convert them, this kind of conversion of raw material to finished goods, that will go under your inventory. Okay, animals kept in zoo, is it covered under Ind AS 41? No, because it doesn't fall under agricultural activity. Fishing in the ocean, now they've given clearly one thing, harvesting of unmanaged resources. There are unmanaged resources, usme se you take out something like zoo, not zoo, but basically this ocean may say you take the ships, this fishes, or basically from a jungle you take out the logs. From a jungle you take out logs. Did you manage the jungle? No. If you see yahan pe, agricultural activity, the definition was refers to management by an entity. If you are not managing, then it doesn't fall under agricultural activity. If it was managed or owned by nature, then it's not coming under the word agricultural activity. So second one, fishing in ocean, answer is no. It is harvesting of unmanaged resources. Fish farming is yes, that is basically a small fish farming you are doing. Development of living organisms such as cells, bacteria, viruses. Now we need to understand for what purpose the development of living organism is done. If the purpose is basically to develop new organisms, it will be covered. If the purpose is something else, then it will not be covered. Growing plants which are to be used in production of drugs. Okay, so this is growing plants which are to be used where? Production of drugs. Okay, so growing plants is covered, but once the plants are taken out, uske baad it is not covered. Purchase of 25 dogs, but for which purpose? Security guard ki tarah, it is not covered. Managing animals in a zoo is no, fishing is no, fish farming yes, living organism we need to see for what purpose it is. Growing plants for drugs, yes, growing is yes. Once they are grown, you take out that, then you use it for drugs, then it is not covered. And security dog is no. Fine. Now, if something is a biological asset, how do we record that biological asset? To what value biological asset will appear? So they are telling the biological assets day one only. Now, I might have purchased 10 cows at certain rate. They don't appear at cost. Normally, PPAs appear at cost. Intangible asset appear at cost. This people, if I have biological asset purchased, I purchased 10 cows for 10,000 each. They are not going to appear at cost. They will directly appear at fair value less cost to sale. They will directly appear at which value? Fair value less cost to sale. Now, sometimes it may happen what? Basically, the day when you acquire that cows, you might have paid the fair value only, but they are not to be shown at fair value. They are to be shown at fair value less cost to sale. So this is one. And if the fair value less cost to sale cannot be measured reliably, then in that case you measure them at cost. Okay. Now agricultural produce. Remember I told you when we cut out the mangoes from a mango tree. Now what's the value of mango? So that mango is again valued at fair value less cost to sale. So everywhere over here is fair value less cost to sale. And agriculture produce, they say that you always have to do like this only. You cannot say that the fair value cannot be determined. Because agricultural produce will sell, so uska to pakka fair value will be there. Biological assets ka fair value might not be available, that is there. Biological asset is a living animal, but crop which is coming out, that is always fair value available. So you can't come and tell that crop ka fair value is not available. Okay. Now, fair value is always from market participants' point of view. It is not from your individual perspective. It is not from company's perspective. It is market participants. Now, check this question. You purchased a kettle at an auction on 30th June 19. Purchase price is 1 lakh. You get that kettle to your farm, 1000 rupees transportation, and sales price is 1 lakh 10,000, but this is at year end. Okay, so when did I purchase? First 30th of June. Normally what I purchase, I'll be purchasing at which value? Market price. So that will be generally the fair value. But the problem is, I incurred 1 lakh plus I incurred 1000 rupee transportation. And plus they say that you have to incur a similar transportation cost when you wanted to sell. Sell ke time you again have to incur a transportation cost. And in addition, there will be an auctioneer fee, which is how many percentage? 2%. Now, did they say auctioneer fee is only for seller? They don't say. So I assume the auctioneer fee is to be paid by buyer also, seller. This is what I'm assuming. If question is silent, there will be assumption. If they say clearly it's only for seller, you have not paid it today. If it is for buyer and seller both, can I say I would have paid it today also? So when I purchased, I paid 1 lakh plus 1000 transportation plus 1 lakh ka 2% auctioneer fee. So I would have paid total what? 1 lakh 3,000. So that is what I have paid. 1 lakh 3,000 is to bank. Okay, so would I write my kettle account debit to bank 1 lakh 3? No. Kettle will appear at fair value less cost to sell. Fair value is 1 lakh. What is the cost to sell? If I want to sell, similar transportation fee and auctioneer fee I have to pay. So out of 1 lakh, 1,000 will go, 2,000 again will go, total how much will go? 3. So 97,000 is the value at which I will record. I will record at 97. I have paid total 103. Difference goes in your P&L immediately. So can I say day 1 only the loss came? Because you paid 103, but you are recording not at 103, you are recording at 97,000. Fine, this is done. Yes, please. Cost will be this one, the fair value less cost to sale, which was taken on day 1. That will become the deemed cost for Ind AS 2. Okay. Okay, now gains and losses. Biological asset day 1 be measured at fair value less cost to sale. Subsequently, year end also they will be measured at fair value less cost to sale. Now, can I say fair value might have gone up also, might have gone down also. So subsequently, there might be some gain or loss coming. That gain or loss again will go in your P. Okay. Initial recognition, and from the change in fair value, whatever profit loss comes is going in P&L. Agricultural produce also same way, it goes in P&L. Now coming to government grant related to biological asset. Okay, government has given you a grant related to what? Biological asset. Now biological asset is measured at fair value less cost to sale. Normally it's valued at fair value less cost to sale unless that fair value cannot be determined. Okay, if it's an unconditional grant, you take it to P&L immediately. But if it's a conditional grant, tell me, they put some condition like I have to raise this cow in next 5 years in this way only, or I should not extract more than this much milk. So they put some condition. Now if you recall your Ind AS 20, what was happening under government grant? We used to record the grant right now only when I used to feel that I had a reasonable assurance that I'll be able to fulfill the condition. Okay, so did I have to wait till I fulfill the condition? I can book the government grant right now when I have a reasonable assurance I'll be able to fulfill condition. But here, for this biological asset one, they say that you should record it only when the conditions are met. Okay, the conditions are for 5 years. So 5 years ke baad I can record it. I cannot record it right now and take it over a period of 5 years. They will be recorded directly at the end of 5th year. Are you clear? Okay, so this is basically when biological assets are measured at fair value less cost to sale. Grant we record it only when the conditions are met. Okay, if biological assets are measured at cost, when this will happen? When we are not able to find the fair value, then only it will happen. If that is the case, then you apply not this standard, then you apply Ind AS 20 only, wherein you can record the grant when you have a reasonable assurance that the grant will be received. So if they are measured at fair value less cost to sale, you recognize only when the conditions are met. Fine. Check question number 4. You got some government grant of 20 lakhs and subject to condition you have to continue to engage in plantation of eucalyptus tree for how many years? 5 years. You have to continue to do plantation for next 5 years is the condition. Now what you have done is you have recognized a proportionate grant 4 lakh every year as per the principles of Ind AS 20. But I told you, if at all you have a biological asset, grant is received, it falls not under Ind AS 20, it will fall under 41, and here you should record only when the grant is only when the conditions are fulfilled. The conditions are fulfilled when 5 years stuck you have to fulfill, so you should record directly at the end of 5th year. But suppose the government says you have to do plantation for how many years? 5. If you did 1 year and now you are not doing, the refund will not be full 20, refund will be proportionate. If they say refund will not be full 20, refund will be proportionate, so then I can record 4 upon completion of first year. Again I did 1 more year, now refund will not be 16, now refund will be only 12. So then again I can book 4. If refund proportionately reduces, so I can book. But if I break the condition in any 4th year, I break condition, still I have to repay full 20, then in that case I should not book it right now. I should book only when condition is fulfilled at the end of 5th year. Okay, to check, until the 5 years are passed, you should not record it. However, if the terms allow to retain the part amount, you fulfilled 3 years, now that much you can retain, then in that case you can continue recording 44444. Clear? Okay, next, you purchased a land 50 lakh, you purchased some 200 dairy cows whose average age is how much? 2 years. You received a grant 1 million towards acquisition of cow which is non-refundable. Okay, do I have to give it back? No, then you can book it immediately in PN. Okay, and you incurred the following cost. 6 lakhs and 4 lakh is the cost which you incurred. That will also go in your PN for maintaining the condition of animal and for breeding. The first October 100 calves are born. Okay, so we get some new calves. We did not spend anything, but again, biological asset coming will be recorded directly at which value? Fair value less cost to sell. Fine. There were no other changes in the number of animals during the year. And as of 31st March 2, Moon Limited had 3000 liters of unsold milk. You have some 3000 liters of unsold milk. Milk came up. Okay, can I say milk is nothing but basically your agricultural produce? The agriculture produce immediately, how it will be measured? At fair value less cost to sell. It will be directly measured at fair value less cost to sell, and then onwards it will be Ind AS 2 applicable, and that fair value less cost to sale will become a deemed cost under your inventory. Fine. And the milk is sold off shortly after the year end at the market prices. The information about fair value is given. Land ka fair value opening 1st October, 31st March. New calves opening 1st October, closing. 6-month-old calf opening, middle and closing. 2-year-old cow opening, middle, closing. 3-year-old cow opening, middle, closing, and milk opening, middle and closing. These are the fair values given. Now which are relevant for us, that will become important. Now first of all, they are asking us extract of balance sheet and P&L. Okay, in your balance sheet what all will come? One is land 50 lakh. Okay, land nothing is given. I assume it's a cost model followed. So can I say in balance sheet it will continue at 50 lakh, and it's a non-depreciable asset, no depreciation will come. So land directly will be coming in your balance sheet 50 lakhs. We assume it's a cost model. Land is not covered under Ind AS 41. Land is covered under Ind AS 16. Okay, second what will come is your biological asset, the 200 cows. Okay, 200 cows, you bought it at 10 lakh. You bought it at 10 lakh. Now when you bought it at beginning of the year, they were 2-year-old. In balance sheet they are coming closing May. At that time they are 3 years old. So now their value in balance sheet will be, what is the 3-year-old cow at end? 5,500. Okay, so how many cows did we had? 200 into 5,500. The total comes to what? 11 lakhs. So if I go in balance sheet, your cows will come at 11 lakh. But now you bought it at 10 lakh. That time it was 10. Now it's 11. Can I say increase in value? 1 lakh. Increase in value 1 lakh will go where? In your P&L. Increase in value 1 lakh will go in your P&L. In your P&L, there's a change in fair value of cows. Okay, second, the calves. How many calves came up? Okay, grant has immediately gone in P&L. Third point, grant has gone immediately in P&L. This is the grant which we have received, 10 lakhs. After that, two expenses are given to you. That also goes in P&L, 6 and 4. So this is 6 lakh, 4 lakh in your P&L. After that, we are having 1st October, 100 calves are born. Now we are preparing balance sheet. Which date? Last day. Okay, the last day, can I say they were on 1st October newborn, but 31st March ko they are 6 months calf. What is the value of 6 months calf at year end? 1300. How many we are having? 100. 100 into 1300. Can I say in balance sheet they will appear at 1,30,000. The balance sheet mein they are at 1,30,000 and day 1, can I say 0 tha hi nahi. So 130 fully will go in P&L. We did not incur anything, the full 130 goes in P&L. ठीक है. Next one we have, they have unsold milk 3000 liters. Now 3000 liters of milk is agriculture produce. Milk would have came last May only. It cannot be like milk came up 6 months back, abhi bhi pada hai, so white ki jagah black ho gaya hoga. So nothing is, the milk has came right now only. So what is the fair value of milk on last day? 24. So 3000 liters of milk in your balance sheet will appear at 72. And the thing is, milk was not there, it came directly. So whenever you record an asset, opposite effect kya rakhoge? It will come in your P&L. Increase in inventory, you can say, that way also it is there. So this will come in your P&L 72. If you see all items in P&L are ticked, this is the net income. All items in your balance sheet are also ticked. It's extract, the balance sheet will not tally. Then this is your Ind AS 41. Let's go to chapter number 4. See, new calves day 1 when you are recording, the thing is yahan pe they are asking only the balance sheet and P&L. As they are asking balance sheet, P&L, balance sheet is of last day, P&L is for the year. So for the year, the change is 1,30,000. 0 se become 1,30,000. Full 130 is there in your income. Agar what you can do is, one option is when newborn calf, what was the October newborn calf middle? 1,100. So if you would have done basically 100 into 1,100, 1,10,000. So 1,10,000 went to P&L in that day, and then 1,100 became 1,300. So then 20,000 you take it to P&L later. So 110 and 20 you take, the total again goes to P&L is 1,30,000. Did you understand? Okay, now going to unit number 4, we finished chapter number 4, Ind AS 8. Okay, Ajay is asking, sir, where do we get this material? Ajay, wherever basically in my Telegram channel, I've uploaded any of the course pages. In the course page, the link of material is also given. And same way in the description box also, the link of material will be given to you. You can just click on that. This material will be available. But I'll recommend you to read the material which you have referred. This is just for your kind of revision. Okay, now chapter number 4, unit 1, Ind AS 8, accounting policy, change in accounting estimates and errors. Okay. Now 3 things are there: accounting policy, second one is change in accounting estimates, and third is your errors. Okay, coming to the first part is accounting policy. What do you mean by the word accounting policy? They are specific principles, basis, conventions, rules, practices applied by entity. Whatever you follow, applied by the entity in preparation and presentation of financial statement. Some specific principles or bases or conventions or rules or practices which you follow, that is your policy. For example, cash flow statement, operating activity. Can I say we can follow direct method as well as indirect method? Now what you selected, that is your policy. Inventory can be valued, cost can be either as per FIFO or as per weighted. What you follow is your policy. Did you understand? Applied by the entity is the policy. Okay, so for inventory, FIFO, weighted average, presentation of cash flow, direct, indirect, same way. Basically, valuation of financial statement. Now, in financial statement, remember, If I invest in equity, normally it is FPT PNL, but I have an irrevocable option. If you choose a irrevocable option, that's your policy. Can I say someone might not have chosen it? What you follow is actually your policy. Okay. Now, how do we select an accounting policy? तो उसके लिए there are guidance. One thing is, if at all standard says something, you always follow the requirement of standard. Okay, now question, if standard doesn't say anything, then I should go to the framework. What is a framework? Framework are the bases based on which standards are built. So then I should take the base of framework. Acha, framework may say also I'm not getting anything. Try to see what International Accounting Standard Board says. If our India says something, follow that. Our Indias are silent, try to use our framework. Our framework is also silent, go international. International Accounting Standard Board, what does it say? Plus, you can go to pronouncement of other standard setting body, and lastly, some accounting literature or industry practices, what is there. Based on that, you should have your policy. Acha, the sequence, which one I should prefer first? Indies. The ABCD is the sequence in which you should be following. Okay. Now, change in accounting policy. When I can change my accounting policy? When it is required by one Indies, or the change is going to give a more reliable and more relevant information. It's providing a reliable and more relevant information. Simple words, the change will lead to a more better presentation. That's the simple words. Okay. I can change that time. Now, suppose there was an old policy and new policy, that is kind of very much different. Like old policy provision was done on an ad hoc basis. Ad hoc means jo man mein aaya wo, whatever came in my mind, I did the provision. But now we come out with a proper system of making provision. So when I say earlier was ad hoc, now we come out with a proper system. So earlier there was kind of no policy only, and now you created a policy. Earlier was a kind of no policy, now you create a policy. That is not a change in policy, that is actually a new policy applied altogether. So if new policy differ in substance from previous occurring, then we call it as new policy only directly applied. Second, if I start a new policy which was not there only for transaction events which were not happening, like earlier I did not had a investment property. If I did not have an investment property, can I say I would not have any policy for investment property? But now I have an investment property, and because of that I have a policy for investment property. Is it a change in policy? Answer is no. Okay, now tell me. Earlier there was a building which was for use. Earlier there was a building which was for use. Can I say PP? And I had my PPE policies. Now that building is converted into giving it on rental. So can I say now that building became investment property? Earlier I was following a revaluation model which was allowed under PP. Okay, now can I follow revaluation model? No. So now I shifted to cost model. Is it a change in policy? No, it's not a change in policy because the substance of the transaction has changed. Earlier it was a PPE, now it is a investment property. Did you understand? That's the question which is given to you. You had a PPE, now you got converted into investment property. So earlier revaluation model, now it becomes a cost model. Is it a change in policy? Answer is no, it is not a change in policy. Okay, now how do I account for change in policy? Whenever I change the policy, the effect is to be given which type? Retrospectively. The effect is to be given which type? Retrospectively. What do you mean by retrospective effect? As if the new policy was followed from very beginning. Okay, very beginning means beginning of this year? Beginning of previous year? No, beginning of business. The day when business was started. Subset. It's not beginning of this year, not beginning of previous year, it's beginning of business. Okay, but the effect relating to that. Imagine you changed the policy today on 16th October. You have been following an old policy from 1/4/2012. You've been following old policy from which date? 1/4/12. And when did you change the policy? 16th October 22. Now, effect of change relating to period 1/4/22 to 16th October 22. Effect relating to 1/4/21 to 31st March 2021. Effect relating to 1/4/12 to 31st March 21. So we classified, actually I have to see effect from 1/4/12 to 16th October. I have to see this effect. But usme effect relating to current period, I'll give it in current. Effect relating to previous period, I'll change the previous year figure. And effect relating to period before previous year, I'll change opening balance of previous year. I already discussed this, but again, Okay, this is how retrospective thing has to be applied. And now whenever there's a new policy applied or there's a rectification of error of past, or when you reclassify item, remember we need how many balance sheets? 3. Current year end, previous year beginning. Okay. Now this is done. Okay, now whenever I'm changing the policy, effect relating to current year I gave in current year, effect relating to previous year I change the previous year figures, effect relating to period before that I change opening balance of previous year. My question, is it a restatement of financial statement? Remember, as per your section 130, 131 of Companies Act, section 130 is voluntary revision of financial statement. So is it like past financial statements are voluntarily revised? No, I did not go back to last year's financials and changed it. I changed this year financial ka previous year column. Did you understood? I did not go back to last year and last year ke financials are not changed. I changed in current year what? Previous year column. Did you understood? So this is not leading to a restatement of financial statement as per section 130. Yes. Correct. So as the policy is changed, as auditor also I need to check the effect of change in policy. You have given the effect as per Ind AS only. So I'll be checking whether that effect is given properly or not. Here the previous year figure you cannot check it by just comparing with last year's balance sheet. Last year's balance sheet, this year's will not match because there has been a change in policy. So I just have to see whether you've given the effect in this way or not. Yes, presentation wise it will be done in this way. Okay. Next is, check this question. You have an inventory valuation. Earlier you were using FIFO. Now you want to go to what? Weighted average, because you feel it's more appropriate. Because of that, 17 ka inventory goes up by 10, 18 ka inventory goes up by 15, and 19 inventory goes up by 20. And they've given you some revenue, COGS, GP, profit, etc. Retained earnings in 17 was 423. Retained earnings in 17 was 423. Now tell me, inventory of 17 increases by 10. Inventory increases, profit goes up, stock goes up. What will also go up? Profit. Now this year is 18-19, previous year is 17-18. Okay, so this year end, can I say March 19? Previous year end, March 18. And what is the previous year beginning? 1/4/17. Okay, 1/4/17. The 1/4/17, the profit should go up by 10. So that will be added in opening retained earning. So retained earning 1/4/17, 423 plus 10. It will become 433. This is 423 plus 10. It will become 433. Yeah, clear? Now coming to the effect in current year. Can I say this year 17-18? 17-18 profit will go up by 15, but profit will go down by 10 because last year closing stock is this year's opening. This year closing stock goes up 15, but this year opening stock goes up by 10. Net effect is 5. So this year ka profit is going up by 5. So 17-18 ka profit restated. 17-18 ka profit restated goes up by 5. Now profit goes up by 5. Check out how they have shown. Achha, stock goes up. So indirectly your COGS will go down. They would have done COGS last year was 164. They have written not 164, they have written 150. So profit went up by 5 rupees. See, 58 became 63. Now current year stock goes up closing 20, opening stock goes up by 15, net is 5. Again this year COGS 173, they will reduce by 5. Stock goes up, COGS goes down. So this is 168 and profit increased by 5. Okay, so now opening retained earning was changed. Then now this year's profit is 63, the corrected one, last year one, and this year profit is 73, the corrected one. Now it will be 560. Are you clear? Yes, no? Yes. Now limitation of retrospective application. What is this limitation? See, they say that you need to give an effect as if it is from very beginning 1/4/12 onwards. Now, is it possible I might not have a books of accounts of so many years past? Companies Act also tells you to keep your books of accounts for how many years? 8 years. Imagine they started business on 1/4/91. So from 91 to 22, so can I say it's 33 years ka retrospective effect, I might not have the accounts. So you might not have an account of some specific year because they were destroyed by fire or something, or you might not have account from like before 12, all are not available. Before 12, all are not available because we kept only last 8-year account. Uske pehle wale accounts are not there. So this is basically, one is called as a period specific, one is a cumulative. If I tell you before 2012, none of them are available, it's which approach? It's a cumulative. Period specific means only between one of the year it is not available. Did you understand? One of the year it is not available. If it's a period specific approach, if it's a period specific approach, so you need to have a retrospective application done in a manner. You need to have a retrospective application like the figures of new policy, figures as per new policy should be there in current year also, previous year also. Figures of new policy should be there in current year also, new year also. Now suppose if I tell you that 1/4/15 onwards all data is available, 14/15 data is not there. 14/15 data is not there. It is what? Period specific. Okay, so data is available from 1/4/15. So 1/4/15 can be the previous year from where the new policy can start. Reason, current year data, previous year data, both are required as per new policy. So 1/4/15 onwards it's available. So what will happen is, can I follow the new policy from 15/16? Yes. Can I follow the new policy from 15/16? Yes. Now I need data as per new policy in previous year also. If I say that 15/16 ka previous year is 14/15, so can I have 14/15 as per new policy? Not available. So 15/16 has to be the previous year. If I have data from 15/16, 15/16 will be previous year, 16/17 will be current year. From that 16/17 current year onwards, we have started following new policy. So whenever period specific effect is there, it has to be applied. The new policy should be applied from which financial year? You apply from that financial year wherein the previous year figures also can be given as per new policy. Wherein previous year figure also can be given as per new policy. This is period specific. But if it's a cumulative, one, then you can start following the new policy from which financial year? You can start following the new policy from the financial year in which data is available. Previous year need not be as per the new policy. Okay, now if I say previous year was required as per new policy, so I will start from 16/17 with a previous year 15/16. But if I say previous year is not required as per new policy, then I'll start with 15/16 with a previous year 14/15. Did you understood? So cumulative mein I'll start with 15/16 only with a previous year 14/15, which will not be as per new policy. So this is called prospective. This is called what? It's available from 15/16. Previous year may not be there as per the new policy. Chalega. So that is prospectively from the date when the new policy can be applied. This is cumulative wala thing. Now check question over here. Delta Limited, they changed the accounting policy and they started following component approach. Earlier they were not having component approach. Now they started having component approach of depreciation. The records were not fully maintained before 2002. Okay, before 2002 records were not fully maintained. It's a period specific problem or cumulative? It's a period specific or cumulative? Cumulative. Till 2002 data is not there. Now if it's a cumulative, I can start implementing the new policy from which financial year? Till 2000, before 2002 not available. So what happens is from 2002 onwards I can have now previous year 1 ka data can be as per old policy. Previous year 1 ka data can be as per old policy. But if at all it was a period specific effect, then I cannot start from 2002. Then I'll start from 2003 with the previous year 2002 also as per new policy. Okay, so yahan pe it is basically given cumulative is there. Now what happened over here? The management considered basically two aspects. They do not have basically the fuller component earlier. to apply the retrospective effect, the management concluded Delta should apply a new policy prospectively. Is it correct or not? It is correct. Now, question asked was, you're required to give a relevant note for disclosure. So whenever you change a policy, now you have to give a notes to accounts with some disclosure. The question is about note what you will give. Now, if I just go back to theory, whenever you're changing the policy, you are required to give in notes all the information related to change in policy. If I just read over here, there's nothing wrong done. Delta, as the start of 02, Delta changed the policy of depreciating PPE by more component approach. Management has taken a view that this will give a more reliable and more relevant information, and the figures will be kind of more of up-to-date proper figures. The company has started applying prospectively from start of 02 because the data was not available in past and it is not possible to apply it for prior years. The effect of on the current year is the carrying amount of PPE at the start of year increased by 6,000. Now PPE increased start of year. If PPE increases, so automatically asset has gone up, tax will come up. So what will up? DTL will come up. So DTL 1800 we recognized, and now there's a revaluation surplus. Actually, there are two change. One is component approach, and second we have decided to have their fair values. So earlier we were using cost model. Now we switched over to what? Revaluation. Had the revaluation model be followed from very beginning, what would have been the effect? So based on that, the surveys, the valuation came 17,000. In your books, it was 11,000. So can I say 6,000? The asset has gone up. 6,000, your asset has gone up. 6,000 ka tax rate, how many percent? 30%. 1,800 will also be your DTL, which is created on day 1. Later on, now onwards, basically the depreciation, 17,000 minus residual value is 3,000, it's 14. 14 will be depreciated over a period of 7 years. 2,000 will be depreciation. Earlier, the depreciation was 1,500. So this all data will be written over here. Increase in depreciation by 500 rupees and tax expense will reduce by this much rupees. Okay, this was change in accounting policy. Now, if it is a change in accounting estimate, the accounting will be done not retrospectively, the accounting will be done on a prospective basis, and we make estimates at various places, provision for bad debt, useful life of fixed asset, they all are our estimates. Acha, one more thing, change in method of depreciation. It's an estimate. Reason is, I told you, what that is not a change in method of depreciation, that is actually what? A change in pattern in which the economic benefits are expected. Okay, now change in method of making estimate. Change in method of making estimate. Earlier, I tell you, to determine whether stock is outdated or not, we used to use a kind of aging schedule. If the stock is more than this much old, it is outdated, and we used to make a provision. But now we started having a technical evaluation from expert. So now we don't go by aging, we go by technical evaluation of expert. So can I say method of making estimate is changed? The method of making estimate is changed, that is a change in accounting policy. Method of making estimate is changed, that is a change in accounting policy. Okay. We have to give a prospective effect, fine. Now, third one is error. Error is nothing but they are omissions from or misstatement in the financial statement of one or more prior period. The errors are related to what? One or more prior period, and because of failure to use or misuse the information which was available, or information which could have been obtained but you did not take into account. So you misused something and basically because of that the error came up, or you forgot to use something and that's why the error came up. And error also includes frauds over here. Error also includes frauds. If you remember in the accounting standard, prior period items may frauds are not included, but यहाँ पे the errors are also including frauds. But the thing is here, rectification, how it is done, like we found out in October if the error was related to May, can I say this year only, so I'll rectify in this year column. If error was related to last year, I'll rectify it in previous year column. If error was related to past years, I'll rectify the opening balance of previous year. Okay, same way. So treatment of errors, If error relates to comparative period, the comparative periods are figures are changed. If error relates to period before previous year, we'll restate the opening balance of previous year. If it relates to current year, we correct it in the current year. If it relates to previous year, we change the previous year column. If it relates to period before previous year, we change the opening balance of previous years. Next is limitation on restatement. This is again error happened in past. Now we have to rectify, but the data is not available. Data is not available. So how do we have retrospectively? Same way. If it's a period specific or a cumulative. Okay. Now one more thing. If the third balance sheet, if effect relates to period before previous year and it affects that thing, then you have a third balance sheet. If the error was related to last year, can I say I'll just change the previous year column? Do I need to add the third balance sheet? No. We did a similar question in our Ind AS 1 yesterday. The question was, would the entity be required to have a third balance sheet? Yahan pe answer is yes. Next question mein the error does not affect that period. That's why the answer was no. So yahan pe entity is not required in the second question. Next, we are having this question of Cherry Limited. Chalo, let's do it. Cherry Limited discovered that some product had been sold, cup 0304, but included in the inventory wrongly. Okay, you already sold off. Should you include in inventory? No. But what did we do? We included. So can I say inventory went up, profit went up? Which year? 3-4. 4-5, the sales is this, COGS is this, including 6500 for error in opening inventory. And the income tax is given. 3-4. 3-4 mein sales, COGS, tax, all that things. Opening retained earning on 3-4 was 20,000. Closing retained earning is 34,000. Cherry's income tax is 30%. No other income or expense. They have the number of shares this much. How basically this will be given effect in SOPL of Cherry as well as statement of changes in equity, and you're required to show the relevant notes as well. Okay. Now error relates to which year? This is actually a current year is 4-5. Current year is 4-5. Error was in 3-4. Can I say previous year? Okay, error was in 3-4. So what I'll do is 3-4 may I included something in inventory. If I remove from inventory, can I say profit will go down? Profit goes down means COGS will go up. The previous year ka COGS 53,500, this will go up by 6500. So previous year sales is same, but if you see this is changed. COGS went up by 6500. So profit before income tax is profit after tax, EPS. Now coming to current year. Current year mein the sales is 104, sales is 104. Now how much was given your COGS? 86,500. But now the thing is, this year opening stock went down. Opening stock went down, profit will go up. So profit goes up, COGS goes down. COGS 86,500 became 80,000. Last year closing stock went down. This year opening stock went down. And now you have this figures. This is how it will be appearing. Statement of changes in equity is share capital 50. Now opening balance of retained earning of last year doesn't change. Because error was last year, so last year's profit changed. Error related to last year. What changed? Last year's profit. Whether the opening balance of retained earning of last year ka opening balance changed? No. So retained earning that remains same, but our revised profit of last year is 9400. Then closing, then current year revised profit is 16,800, and now this is the retained earnings. So this is a statement of changes in equity. And this is some extract of notes because of change in policy, what all effect happened, you're describing in notes to comes. Then next is Ind AS 10. Next is Ind AS 10, events after the reporting date. These are nothing but events which come up when? After the reporting period. Now event after the reporting date are those events, but it has to be material. Actually AS was using the word those significant event. Here the word significant is not written, but they say those event which has to be material. Both favorable or unfavorable which are occurring after the balance sheet date, but till the books are approved by approving authority. Who is the approving authority for company's board of directors. Board of directors approves the financial statement and they will recommend the dividend. A dividend will then be declared by shareholders. Shareholders don't approve financials, shareholders adopt the financials. The board has approved it, they will give it to shareholders, shareholder will accept it. Okay. The approving authority is the board of directors. Fine. Now suppose the management of the entity has approved the financial statement for issue to a supervisory board. So management has approved financial and issued to supervisory board, and supervisory board will approve later. Date of approval of supervisory board is of no use. We just have to see the normal board of directors approve. Okay. Now your event occurring after the balance sheet date are divided in two parts. Which are the two parts? Adjusting, non-adjusting. Adjusting events are those which provide additional evidence as to the circumstances which was prevalent on balance sheet date, and non-adjusting event are those which were not giving any additional evidence as to the circumstances prevalent on balance sheet date. They are a kind of new event which has came up late. Okay, now just tell me one thing. If a fire happened on 29th March, fire happened, so can I say 31st March, I was not knowing how much claim will be approved because claim was not yet approved, but I know loss will come, so I've done a provision. Now 10th April my claim is approved, and now the loss which I booked is going up or down. Is it an adjusting event? Yes. I was knowing loss will come. How much is confirmed on 10th of April? But imagine 4th April there is a fire. 4th April there's a fire, 10th April the claim is approved, and now I know there's a loss coming. Is it an adjusting event? No, because 31st March there was no fire. Okay. Now I'm not going into examples of adjusting, non-adjusting. This is a simple thing. Directly come to few illustrations which are there. Achha, now tell me one thing. Closing rate of dollar. We had some foreign currency item. 31st March the rate was 70. Suddenly, before the books are approved, $70 became 90. Is it adjusting event? No, because we were not knowing that the dollar rate will go up. Same way, suppose there is some investment which is measured at FVTPNL, investment in equity which we measured at FVTPNL. The fair value on balance sheet date was 1 lakh. But something happened in company, and later on, by the time the books are approved, the fair value of that shares 1 lakh became 20,000 only. Is it adjusting? No, because I was not knowing that the prices will go down. Okay. Now, question over here. You are required to pay penalty for breach in performance of contract. Okay. You already done a provision for penalty, but now you approach the arbitrator to basically dismiss the case. Okay, sir, we should not be liable for penalty. Okay, we have done some provision, but we approach arbitrator and telling him that we are not liable for any penalties. You prepared financial statement which were approved in July. Arbitrator in June awarded the case in your favor. Okay. Before 31st March, had you already gone to arbitrator? Yes. So can I say matter was already prevalent? Before books are approved, has the decision came up? Yes. Before books are approved, the decision of arbitrator has came. And the decision says what? It's in your favor. So when I say provision which you have done is no longer required, what should I do? Reverse the provision. The provision is no longer required, and the arbitrator also decided the cost of the case should be borne by other party. Arbitrator also decided what? The cost of the case is to be borne by other party. Whether A is required to remeasure the provision, answer is yes. What would be the treatment of cost which you have to recover from other party? I've incurred some cost. See, when I went to arbitrator, can I say I have to spend money? Case file karne ka bhi charges are there, na? I spend the money, but now that case file karne ka charges I can recover from other party. Okay, can I show that as an asset in my book in this year only? Provision which I had done I will reverse because it's an adjusting event. Now arbitrator told me the money also I can recover from them. Now see, there's two difference. One is you booked a provision and you have to reverse a provision. Second is you book a separate asset. When you book a asset, okay, on 31st March, it was whether it was virtually certain that you are going to get money. No, so this was a contingent asset on 31st March. Contingent assets can be recognized only when they become virtually certain. 31st March ko cost milega ki nahi, it was not sure only, it was a contingent asset. It became virtually certain in month of June. So you should record that as an asset only in the month of June. again tell you two things. One, provision already done, usko reverse karna, and new asset book karna. Provision already done, you reverse, and second is new asset booking. New asset booking can be done only when it's virtually certain. Take it. So accordingly, you can have this provision reversed. That is fine. Regarding the cost of arbitration which you have to recover, it was a contingent asset as at 31st December. Contingent asset, they are recorded only when they become virtually certain. So they will be recorded directly in June, that is in next year. Okay. Now this one we already done under Ind AS 1. If you remember Ind AS 1, I've taken a long-term loan. If I bridge a terms, long-term loan was there, a term is bridged, some conditions are bridged. So can I say loan become repayable on demand? Okay, so as such, now it's a current liability. After year end, before books are approved, if I rectify the bridge and bank has agreed not to demand repayment, so remember it was adjusting event under India, but under IFRS it is a non-adjusting event. That's the same thing again given over here. This going concern point also we discussed under Ind AS 1. After the balance sheet date, before the books are approved, if we understand that we are no longer a going concern, then the year which is over still cannot be prepared as per going concern. It was simple like non-adjusting event which affects going concern, they are treated as adjusting. Now, check this question. XYZ was formed to secure tenders for telecom company, and they used to basically make some directories. They bagged the tender from Pune for 5 years. They have a profit in 1, 2, 2, 3, 3, 4, 4, 5. Okay. It has bid in the tender for other circles, and the result will be, and as per the result declared on 23rd April, company failed to get any of this. Okay, first directory was for how many years? 5. 1, 2, 2, 3, 3, 4, 4, 5, and last one will be what? 5, 6. Now, in 4, 5, you tried to get other basically circles, but none of the things you have got. So currently you have only one Pune directory which also will expire in next 9 months. Currently you have only one Pune directory which also will expire in next 9 months. So now can I say that 31st March ko you had applied for directories in other circles, but after year end, before the books are approved, I understood I don't have any projects at all. All new projects where I applied, they are all failed. None of them are allotted to me. So can I say now there's a clear indication that I might go bankrupt or I might shut down the business within 9-10 months. Okay, so this came up when? This came up on 23rd April, after year end, before the books are approved. If something comes up which makes you believe you will not be a going concern, then March 5 wale financials cannot be prepared as per going concern. Preparation of financial statement of March 5 on going concern may not be appropriate. Okay, question number 4. Okay, you won an arbitration award on 25th of April. Reverse provision, can we do it? Answer is yes. It's the same one which we did. Now, you are trading in mobile telephones. You are trading in mobile telephones, and basically the manufacturer of the phone has released a newer version on 1st March, but had not announced the price. Inventory was valued at 5,000. 8th April, the price is revised. And then because of that, the newer version came up, old price went down. Now see, 1st March only it was announced new version is coming. So can I say I was knowing the price of old version will go down? It's a adjusting event. Debtor, we had a 15 lakh provision and he was declared insolvent on 15th April. So we already had done a provision. So can I say I was knowing his condition is not good, and that's why it is adjusting. But imagine debtor was there 31st March, zero provision. Debtor became insolvent in May because of a fire at debtor's place in April. Debtor became insolvent in May because of a fire at debtor's place in April. Then it becomes non-adjusting. Fine. The company decided to restructure the operations, and this was thing, but there was no formal plan yet. There was no formal plan yet. So management announces they are going to go for this. Management plan is to reduce the redundancies, close the division. However, there is no formal plan yet. Do I need to make a provision? Answer is no. See, provisions are made for two things. One is called as a legal provision or contractual provision, and second is called as constructive. Constructive provision or constructive comes what? Constructive obligation. What is a constructive obligation? When you create some impression in the minds of people. So that is basically constructive. Constructive comes when you announce the thing and it's communicated to people, and now people will be expecting that thing. That's time the constructive obligation comes up. Here there is no formal plan yet. Should I make a provision? Answer is no, non-adjusting. Dividends we already done. Distribution of non-cash asset to owners. Now what is distribution of non-cash asset? This is a kind of offbeat point. Imagine A Limited has a subsidiary B Limited. A has a subsidiary B. Okay, so can I say who is holding the shares of B Limited? Who is holding the shares of B Limited? A. Now A Limited decides whatever shares of B we are having now, I don't want to keep it. I'll give it to my shareholders. So A Limited decides A is having shares of B. So rather than keeping the shares of B with themselves, what A has decided? I will distribute it to my shareholders. So shares of B now will go to shareholders of A. So can I say A has decided to give something to its shareholders which is not cash? So it is a distribution of non-cash asset to owners. So A was having shares of B Limited. Rather than keeping with themselves, A decided I'll give it to my shareholders. So now I will not hold directly in B. My shareholders will hold in B. Now think from A's angle. So A is distributing something to owners. If A is distributing something to owners, accounting will be done in a similar way as dividend. So whenever this is declared, you record dividend payable wala thing. You record what? Dividend payable. You have to book a liability. Okay, now dividend goes in P&L or dividend goes to retained earnings? Retained earnings. So whenever this is declared, day one entry will be retained earnings to liability for distribution, and this will be at the fair value of the shares. This will be at which value? Fair value of the shares today. Now till the time you actually distribute, this is your declared today. Till the time you actually distribute, this liability will be remeasured. So year-end pay, the liability is remeasured. Again, actual settlement day, the liability is remeasured. And remeasurement mein, this will go where? This will go in your retained earnings, because this was dividend type accounting. Okay, now you are settling. So liability goes away, is today's fair value. We had remeasured, it was today's fair value. Okay, but now asset goes away. You had investment in subsidiary in your book. Investment in B. And remember, investment in subsidiary can appear either at cost or as per Ind AS 1009. And normally I told you everybody will keep it at their cost. So what goes away, non-current asset goes away, this will be at cost in your book. And now difference is profit or loss. Which will go in PN. Okay, so day one when I declared that I'm going to distribute the shares of B to my shareholders. So can I say I'm doing some distribution to shareholders, I'm giving distribution to owners? So I have to record like a dividend. Entry for dividend was what? Retained earnings to dividend payable. So it is retained earnings to dividend payable at the fair value of that shares. Okay, now till I actually give them, every year end they will be remeasured. So first year end they are remeasured. Then on settlement date they are again remeasured. And now that liability goes away. What goes away of mine? Asset. Which asset goes away? The shares of subsidiary goes away. Now they were there in my book at cost, they will go out at cost, and difference is profit or loss. Clear with this? Next we have Ind AS 113. Next we have Ind AS 113. It's a fair value measurement. Now see, we saw many places that this item will appear at fair value less cost to sale, or this item will appear at fair value. So how to determine fair value? There's a specific standard on this. This standard is basically determining fair value. Fair value is what? It's a price that would be received on selling asset or paid on transferring a liability. It's a price which will be received on selling asset. Okay, so is it an entry price or is it an exit price? Is it an entry? Entry price is the price which you pay on purchasing. Is it price paid on purchasing? No, it's a price received on selling. It's a exit price. in an orderly transaction between market participant on measurement. And now this fair value is always not from entity specific, it's always from market participant specific. It's an exit price, that is also fine. And we need to see the restrictions or condition relating to asset, but we don't have to see the restrictions or condition relating to entity because it is market participant specific. Okay, now they've written it's a price that would be received on selling an asset or paid on transferring a liability in a orderly transaction. Now transaction can happen at two places. One is called as a principal market, other is called as a most advantageous market. Now principal market is a market where your shares are traded most or where your item is traded most. Like I know 90% of the shares or 95% time my shares are being sold on NSE. We have two exchanges, NSE as well as BSE, but 95% time my shares are always sold on NSE. So NSE is called as what? Primary market. If primary market is available, we should always take the rates from, that is principal market. If principal market is available, the rates are always from principal market. Where principal market is not available, like my shares are sold in BSE also, NSE also, sometimes BSE mein jada, sometimes NSE mein jada. So can I say now there is no principal market? Then the fair value will be based on what? Most advantageous market. Then the fair value will be based on most advantageous. So first, if principal market is there, fair value is always based on principal market. Not there, then it is based on most advantageous. Now I need to find which is the most advantageous. Most advantageous will be based on the net proceeds. Most advantageous will be based on what? Net proceeds. So what is the net I am getting from your basically market A, and what is the net you are getting from market B? Wherever you are getting higher, that is basically the most advantageous. Where you are getting most from market A or B, net I have to see after all cost whatever is incurred. Market participant is fine, price is exit price. Now two words, transportation cost and transaction cost. Okay, now transaction cost is not for asset. Transaction cost is for a transaction. वो transaction हुआ, sale हुआ, purchase हुआ, उसके लिए it's not for that asset. So when I determine fair value, when I determine which value? Fair value, transaction costs are not considered. The transaction costs are not the characteristic of asset. They are not included in fair value. But a transportation cost, they are based on asset. Imagine you have to take asset to the market for sale. You have to take the asset to the market. If asset is a bigger in size, can I say transport will be more? If asset is smaller in size, transport will be less. The transport cost depends on what? Asset. Asset is heavy, asset is light, asset is big, asset is small. So this will be considered when we are determining fair value. So while determining fair value, transport costs are deducted, transaction costs are not deducted. But while deciding the most advantageous market, we have to consider net. Net means after deducting everything. So for deciding most advantageous market, both are to be deducted. But for deciding fair value, only transport cost is deducted, transaction cost is not deducted. Okay. Now we have two active markets. Both the market mein transaction are done. Price is 26 in A. Transaction cost is 3, transport cost is 2. Market B, price you will get is 25, transaction cost is 1, transport cost is 2. Now suppose if A is a principal market, if A is a principal market, fair value will be based on market A. Okay, market A, I want to find fair value. 26, should I deduct the transaction cost? No. Should I deduct transport cost? Yes, so this becomes 24. Okay, but now if none of the market is principal market, first I need to find most advantages. For finding most advantages out of 26, should I deduct 3 and 2 both? Yes. So 3 and 2 dono deduct karte, it becomes 21. And out of 25, 1 and 2 we deduct both, it becomes 22. Where you are getting more? B. So market B is used to find fair value. Now market B mein, what will be the fair value? 25 minus 2. To determine most advantageous market, both are considered, but to determine fair value, only the transport cost are considered, not the transaction cost. Shall I move ahead? Okay. Next, if I have a non-financial asset like PPE, etc., how do I find the fair value of a PPE? If you have a land, how do I find the fair value of a land? So you need to use that PPE in a highest and best use. Uska highest and best use hoga, then what is the value we'll get? That is basically the fair value ka base. But suppose I'm not doing highest and best use. Like suppose I have a plot of land in a very prime location, wahan pe mall can come up, a big mall can come up, but I'm using it as a parking plot. Am I doing the highest and best use? No, someone can build a high end commercial premises over there, but I'm just using it as a parking plot. I'm not doing highest and best use. So one is you find out if you're using them as a highest and best use, whatever revenues you will get, uska present value can be taken. But if you are not doing highest and best use, do one thing. The fair value is equal to the amount which you will receive by selling it to a market participant who will do highest and best use. If you are doing highest and best use, the fair value is based on inflows, what you are expecting, uska present value. But if I am not doing highest and best use, then the fair value is equal to what? The amount which I expect to receive on selling it to a market participant who will do highest and best use. Take care. Now check. This is the question. It's okay. Coming to liabilities and equity. Coming to liabilities and equity. Now, how do I value liabilities and equity? Uska fair value. If they are listed, can I say the value is available from market? Okay. If they are not listed, so try to get the values of similar. Try to get the values of what? Similar or identical liabilities or equity instruments, and you basically use them. Similar liabilities or similar, like I have a debenture, my competitor also has a debenture. That competitor is in same line of business, we are a kind of similar company, we are having a similar kind of debt. So now I can use what is the value going on of his debenture. If mine are listed, I'll use mine, but mine are not listed, I can try to take the similar or identical one. Now if identical one is available, I may use them without adjustment, or I may have to do some adjustment, like their debt equity ratio was less, my debt equity ratio is bit higher. If my debt equity ratio is bit higher, in my company there's a bit more risk, so my fair value will be bit low. So that way basically I need to do some adjustments. Okay, but if identical or similar quoted is also not available, mine not there, identical similar is also not available, then what should I do? Then I should use more of observable data. Observable data means the data which is available to everyone, like the market में RBI rate of interest, yeah, RBI का repo rate, what is going on. If I'm using repo rate, can I say everybody knows the repo rate? So that's the observable data. But if that is also not available, then you're using some unobservable data. Unobservable data is basically only yours. It's not known to others. Okay, if I'm finding fair value based on cash flow forecast, whatever forecast of cash flows are there, cash flow forecast, who has done it? Me. Others are not having it. It is called as unobservable. And Ind AS 113 says you should always use more of observable data which is available with everyone rather than unobservable data. Take care. So direct quote is price. If they are not available, you should try to maximize observable, minimize unobservable. First use the direct quoted. When direct quoted are not available, use the quoted of identical or similar. If that is also not available, observable data, that is also not available, some valuation technique which will be using unobservable data. Valuation techniques may one, market approach. Now what is a market approach? I use someone else ka data, that is a market approach. So market approach may you use prices and other relevant information generated by the market transaction involving identical or comparable assets or liabilities. Okay, so for example, my shares are unlisted. The similar listed securities I'm using, that's a market based approach. Or my company is unlisted, similar company, they got a P multiple of how much? They got a P multiple, price earning multiple. So their price is how many times their earnings. If they have a P multiple 20, okay, my company may bit adjustment I may do based on risk involved, and suppose I say my P multiple should also be around 20, so my EPS into 20, that becomes my valuation. Okay, now there's a question over here. Check, you acquired 5% for how much rupees? 10 crores. And you are showing day one investment appears at 10 crore. Now year end, investment in equity, remember equity P&L, unless irrevocable option, तो यहाँ पे you are not choose an irrevocable option, so can I say you have to fair value it to P&L. So subsequently measurement I have to do a fair valuation. The problem is I don't have a fair value, it's not a listed one. So what should I do? You identified a similar transaction where 20% was acquired for how much rupee? 60, but 20% was acquired for 60 crore in between. It's not on 31st March. So don't directly say 20% is 60 crore, mine 5% is how much? Sir, some salt. But that was on that day when it was acquired. I want the data of which day? March. But they say that it was based on a EV EBITDA multiple of 8. I can use that thing. EV EBITDA multiple of 8. Currently the EBITDA is 40. Currently EBITDA is 40. So can I say multiple of 8 was given? So 40 into 8. 320 is the value of total company. I hold how many percent? 5. So my holding will become 16 rupees. ठीक है. But now someone took 20%. Can I say 20% में तो you get a power to participate? I hold 5%. Do I get a power to participate? No. So for getting 20 power to participate, someone might have paid something extra. So check over here. At the time of acquisition, the valuation was after considering 5% liquidity discount and 5% non-controlling stake. So they are telling that you are thinking for your stake, someone gave controlling interest, valuation ज़्यादा था. According to you, your case में the valuation will be less by 5%. And this company is not a listed one. Liquidity is pretty less. So liquidity discount is also how many percent? 5. So total 10% you are removing from valuation. This is how you are doing it. So your share, your part of value was coming 16 crores, but you will remove 10% out of it. You will value it at 16 minus 10% is coming 14.4. So check the answer is 14 point. Did you understood? Don't do unka 20% is 60 crore. So my 5% is how much? Because that 20% was acquired on some day, not on 31st March. Okay, next is income approach. Income approach is whatever is future probable income, you find out a present value. Now, future probable income का present value gives you the value of the entire business. वो किसका value देता है? Entire business. Now, the thing is, I want to find the value of shares. I want to find out what? Value of shares. So, I need net assets. तो वो तो पूरा business आ गया, assets, liabilities. Out of that, can I say first liabilities will be paid and remaining goes to equity shareholder? So whenever I do this way, future earnings were this, including the terminal value at the end when all assets will be sold off, that's terminal value. And weighted average cost is 11%. So when you find the present value, it is coming 2518. But this 2518 is basically cash flow from all years. Total of all years is not 2518. Total of all years is 3105. 3105 is all future may whatever I'll get, also including the sale of assets at the end of life. Everything I'll be getting is 3105. Now 3105 is a first of all what I need to pay? Liabilities. So remove all the debts. And 3105 is what I'll be getting in future, uska present value. I already have some cash today. I already have some cash today in business. So that is add. Plus if I have some asset which is not used in business. If I have some asset which is not used in business, that also will be add, because what I'll be getting in future is out of the asset which are used in business. If I have some asset which are not used in business, that also is giving me some money. So already some cash is available. The total equity value is 1746 divided by number of equity share you get per share. Okay, did you understood why debt is basically deducted and why cash and cash equivalent is added? Whatever I'm going to get in future, it's for the entire company. वो पूरा business है, उसमें से I have to first pay debt. We are finding the value for equity shares. We are finding the value for equity shares. That's why the debt is deducted. Now, this is what I'm going to get in future. But already some cash is there. Already some cash is there that you add. So this is money which you have for equity shareholders divided by number of equity shares is the answer. Next, your fair value hierarchy. They say level 1, level 2, level 3. What is a level 1, level 2, level 3? Imagine level 1. What is this level 1? It's if your quoted price are available, it's level 1. Or if your quoted are not there but identical, identical ka quoted price available which I can use without adjustment, which I can use. Okay, so either your quoted or identical one without adjustment, it's level 1. Okay, identical or similar is there, but I have to do adjustments. If I have to do adjustment, it's always level 2. And if adjustment involve use of substantial unobserved data, if adjustment involve what? Use of substantial unobservable data, then it will go in level 3. Okay, check over here the chart given to you. Is the price to be adjusted? If the price to be adjusted, no, it is level 1. Is the price to be adjusted? Yes. So normally level 2. Normally level 2. But does it involve a significant unobservable input? If adjustment involves a significant unobservable, then it goes to level 3. Otherwise level 2. Did you understand? Okay. Check this question. You hold equity shares. You are required to determine the fair value. You are using a discounted cash flow method. Discounted cash flow is future cash flows ka present value. Future cash flow prediction, is it available to everyone? No, it's what? Unobservable data. This will go under level 3. Clear with this? Okay, next. Done. Chalo, this standard is over. Going to the next one. Nine, 10, 11. Okay, now chapter number 9, unit number 1 is Ind AS 19. That's your employee benefits. Now, employee benefits are divided into 4 types: short-term employee benefit, post-employment benefit, other long-term employee benefit, and termination benefit. Short-term employee benefit, post-employment benefit, other long-term employee benefit, and termination benefit. Short-term is the one which will be settled in 12 months. Post-employment is the one which is paid at the time of retirement or after the retirement. It is at the time of retirement or after. Termination. Termination is one which I have to pay you because I am terminating you. Because I am terminating you, or voluntary retirement also is covered over there. Voluntarily, we come out with a scheme of voluntary retirement and I pay you something that goes under termination benefit, and remaining all which doesn't come under your first, second and fourth, they go under your other long-term employee benefits. Okay? Now, how do we account for it? First of all, short-term employment benefit, can I say they are payable within 12 months? If they are payable within 12 months, do I need to have any kind of discounting done? No discounting. There's no discounting, undiscounted amount, and they are the expense you directly record in what? PL. But if you are not yet paid, you show it as a liability. If you're paid in advance, you show it as an asset. If you are not yet paid, liability; paid in advance, it is a asset. Okay, now short-term paid absences. Short-term paid absences. Now, we give employees ko certain leaves. Sick leaves are there, privilege leaves are there, SL, PL, different kinds of leaves are there. Now, usme what happens is, if employee doesn't take the leave, one option is they can carry forward. If they can carry forward, it is known as accumulating. If they cannot carry forward, it is called as non-accumulating. So one, it is accumulating. Second, it is non-accumulating. Now, in accumulating also, it is carried forward. Usme bhi 2 options. They can use it in next year, or they can take up cash in future. One is they can use in next year. Second is they can take cash. Okay, if they can basically use it for taking cash, it is wasting. It is wasting. If it is basically not entitled for cash, they can just use it. It is called as non-wasting. Accumulating means which can be carried forward. Non-accumulating means which cannot be carried forward. Now, one which is carried forward, uske andar bhi 2 options. Whether I can take cash in future or whether I can use. If I can take cash in future, it is wasting. If I can just use it, it is non-wasting. Okay, now non-accumulating. Non-accumulating, can I carry forward? No. If I can't carry forward, there is no need to create any liability for it. If I can't carry forward, there is no need to have any liability for it. But for those which are carried forward, if I can carry forward, so can I say next year I have to pay them if it is wasting, or if it is non-wasting, next year they will not work, but still I have to pay them. So both the cases, either I'll pay them or they will not work, still I'll pay them. So I need to create a provision for accumulating absences. Which absences provision is required? Accumulating. Now question arises, sir, how much provision I should do for accumulating? Like suppose you are entitled for 10 leaves, you have taken only 6. So can I say 4 leaves you can carry forward? Now does it mean that next year pakka you will take that extra 4? No. So how much I am expecting that you will take? You have an entitlement of 4, but how much I am expecting you will take? That much I should create a provision. Did you understand? How much I expect you will take, that much I have to create a provision. Now pay attention. There are 100 employees. You are entitled for 5 days of sick leave for each year. Unused sick leave can be carried forward only for how many years? 1 year you can carry forward. And whenever it's carried forward, like this year out of 10, 5 they have given, na? Out of 5, suppose you took 3. So how many are carried forward? 2. But can I say next year again you will get another 5? Now, normally what happens is 2 is there plus other 5, total 7. Now, next year if you take 4, so generally what happens, last ka 2 pending tha, that I took, and out of this year's 5 I took 2. So now again how much will be carried forward? 3. But some companies what they do is, next year when you are taking, now first it will be deducted out of your current year, and then it will be deducted out of opening. And if you are not using that opening, next year end it gets lapsed. They have clearly written over here, the sick leave is first taken out of current year's entitlement. So it's not past wala use first, it is the new one use first. So it's not P4, it is LE4. The last one is used first. Okay. Unused tax and entitlement was 2 per employee. On the base of past experience, you feel 92 will not take more than 5 days leave in next year. Out of your 100 employees, everybody has 2 days leave pending. But now the thing is, next year, whenever they take leave, can I say first it is out of the current year, then out of opening? I feel next year ka 5 also they will not use it. So would they be using the opening ones? No. And then at the end of next year, the opening will get lapsed. So can I say 92 employees will not be able to use only that 2 days? So no need to make a provision. Remaining 8 I feel will use average 6.5 days. 6.5 may say 5 is this year, and opening they are using 1.5. So can I say only 8 employees will use 1.5 days out of opening? So I should make a provision of 8 into 1.5, that is 12 man days ka provision. Clear? Next, profit sharing and bonus. We give bonus to employees. We give profit sharing also sometimes. Like out of whatever is the profit, I'll give 5% profit to employees. Now, hota kya hai isme? I tell you I'll give 5% to employees. I'll give how many percent? 5% to all the employees. But a bonus is not given to you on 31st March. Bonus will be given to you in Diwali. Whatever is last year's profit, uska how many percent? 5. But bonus will be given to you in Diwali. But 31st go, I know that I have to pay the bonus. Already I have announced to people. So can I say 31st I have to make a provision? But now problem is it possible some employees may leave before Diwali? So can I say to them I don't have to pay? The effective bonus rate will not be 5%. The effective bonus rate will be less than 5. I have to pay as such 5% amongst 100 people. If 10 go away, I'll not pay that 10 to anyone. It's not that the other 90 will get more. Other 90 will not get more. It was to be divided between 100 people. So I had to pay you 50 rupees to 100 people. Now if 10 people don't take it, indirectly I have to pay not 50 into 100. I have to pay 50 into 90. So effectively, if I try to calculate the rate will not be 5%. It will be rate less than 5%. The provision I should make only for the amount which I expect to pay. Provision will be based on the amount which you possibility that some employees may leave. You just take the amount which you expect to pay. Okay, next comes your post-employment benefit. So this was short-term employee benefit. Now comes, okay, post-employment I have to pay when? At the time of retirement or after the retirement. Simplest example, provident fund, gratuity, that I have to pay at the time of retirement or after retirement. Now coming to PF. Now इसके अंदर there are two things. For post-employment benefit, one is called as a defined contribution plan, other is called as a defined benefit plan. Defined contribution plan, defined benefit plan. Now defined contribution plan is something wherein I just have to contribute a fixed amount, my liability is over. Like PF, remember 12% of salary, basic salary is contributed by employer and 12% is also contributed by employee. So I need to contribute that 12% and later on PF department will pay the employees. So my liability is just to contribute every year. How much percentage? 12 percentage. So this is a defined contribution. Then what will employee get? I don't care. What will employee get? I don't care because I gave to PF department. Can I say PF department will give interest also to employees on that? Now can I say they might keep on changing the interest rate? That all will all be a risk borne by employee. If PF department increases the rate, employee will get more. If PF department reduces the rate, employee will get less. So investment risk goes on employee. Second one is defined benefit plan. Under defined benefit plan, I have to give a fixed benefit to employee. Like whenever employee goes out, gratuity, I have to pay them. It is basically last drawn salary into number of years of service. The formula is defined. What is defined? Formula. And based on the defined benefit, the benefit which I have to give them, the formula is defined. Now, you have to make a provision for gratuity. You take a help of whom? Actuary. We do a P&L to provision for gratuity. Now, my question is, if I do only provision also, it is fine. P&L to provision. But when employee leaves, can I say I have to give him a big chunk of money? This many years he worked, उस सब का gratuity देना है. And at that time, I might not have cash in business. So what people do is, they don't just make a provision, they also do a investment. They don't just make a provision, they also do a investment. So one is you do a provision, P&L to provision for gratuity, and you do some investment so that when employee leaves, you can sell the investment, you can pay him. If investment you have done, then it is called as a funded plan. It is called as what? So if you don't do investment, it is unfunded. If you do an investment, it is funded. Yeah, that clear? And now what will happen is, you did a investments. You did a investments. If investment did well, it is good for you, not employee. If investment did not do well, it is bad for you. So can I say over here, the investment risk is on company, but under defined contribution plan, where I contributed to PF authorities, वहाँ पे the investment risk was on employee. Did you understood? ठीक है. Now, how to account for a defined contribution plan? How to account for a defined contribution plan? I have to do a fixed contribution. So whatever contribution I have to do every year, I should record it as an expense. If I have done a lesser contribution, that you show it as a liability. If you have done a more contribution, extra, you show it as a asset. Clear with this? Okay. Now check question number 2. Cisca Private Limited, they have a headcount of 1,000 employees. We give 35 days of privilege leave, 15 days of sick leave, 10 days of casual leave. Oh, I want to work in this company. Plus Saturday, Sunday off. Plus all public holidays off. If someone needs this kind of leave, become a Supreme Court ka judge. I tell you, yesterday only, there was one basically article which came up. The 23-24 next year, uske liye how many holidays are there for the Supreme Court judge, basically that was given. Out of 365 days, they are working for 190 days. Out of 365 days, they are working for 190 days. You know, in Supreme Court, there is a summer vacation. Like kids ko school mein hota hai na 1.5 month. Our Supreme Court gets shut down for 1.5 months. Then someone commented, yeah, see, our laws were built by Britishers. They had kept a summer vacation because they could not tolerate the heat of India, and they used to go to their countries at that time, and that's why they had kept 1.5 month holiday. But why the hell it is still continued? So 190 days is what they are working out of 365 days. So they are telling so many cases are pending and why they are not working. Okay. So this many leaves are there. Out of PL and SL, 10 PL, 5 SL can be carried forward. How many can be carried forward? 10 PL, 5 SL. Casual leave cannot be carried forward. Take it. On the base of past trend, 200 employees will take 5 PL and 2 SL. 800 employees will take 10 PL, 5 SL. Okay, let me just go back to first of all. 200 employees will take 5 PL. Oh, they are getting 35 PL, right? They are taking only 5. How many are left? 30. Can they carry forward full 30? No. How much they will carry forward? 10. So for that 200 employees, 10 will be carried forward. SL they are taking 2. Okay, 2 they are taking 15. 13 is pending. Can they carry forward 13? No. They will carry forward 5. For 800 employees, again PL में 10 will be carried forward. SL में 5. ठीक है. So let's just see over here. For Cisca will recognize a liability for 5 days of PL. Acha. Employees are given 35 days PL, 15 days SL, 10 days of casual leave. Out of PL, SL, 10 and 5 can be carried forward. 200 will take 5 days of PL, 2 days of SL. 800 will take 10 days of PL, 5 days of SL. Okay, now this is basically they will take this much in future. Okay, this is basically they'll take this much in future. It's not they've taken in this year, this is what they will take in future. Even though you're allowed to carry forward more, but if you don't use it, can I say I don't have to make provision? So they will be using a 5 and 2 and they will be using 10 and 5 in future. So I have to make a provision for this much. So for 200 employees, 5 days PL, 2 days SL. For 800 employees, 10 days PL, 5 days SL. This is what the provision is to be done. Fine. Second, company says will give a bonus of 4%, but some employees may leave before the bonus payout. So effectively, it will be 3.5. So should I make a provision 2,000 crores into 4% or 2,000 to 3.5? 3.5. Third, they have some post-employment benefit plan, which is in defined contribution plan, where they contribute 100 crores, which will fall due within how many months? 12. Company has paid only 20. Company has paid only 20. If out of 100 you paid only 20, remaining 80 should appear as a liability. So check over here. This 80 is a liability, 100 is your expense, and 20 you have paid. Then now coming to defined benefit plan, we also understood the word funded and unfunded. For the defined benefit plan, if I have done some investment, it is funded. If I have not done some investment, it is unfunded. Now, how do I account the defined benefit plan? Contribution was simple. You have to do contribution, that's your expense. If you are done to expense to bank, if it is pending, liability will come. If you have contributed more, asset will come. Now for defined benefit plan, can I say one, I have a liability in my books, provision for gratuity, and against that I might have done some investment. We call it as a plan asset. It is called as what? Plan asset. So one is liability, one is asset. You need to find net. Net liability is more or net asset is more. That is called as surplus or deficit. Okay, so one, you find the surplus or deficit. Surplus or deficit will come where? In your P&L or balance sheet? Balance sheet. This will come in balance sheet. Okay, so in your balance sheet, surplus or deficit will come. So determine the amount of benefit that employees have earned. They worked till now. They worked in past years, they worked in this year. So whatever total they worked, based on that, the actuary will tell me how much provision I should make. So this is basically there. Find the present value of the obligation. This is basically the liability. Determine the fair value of the plan asset, and the difference is surplus or deficit. Surplus is subject to asset ceiling. Now what is this? Surplus is subject to asset ceiling. Sometimes you have a surplus. You have done a more investment, but it might be a rule that extra investment is there. Uspe, if you're earning extra, you can't withdraw it, or you can't use it. If I can't use it, can I say then it is of no use to me? So then that you don't show it as an asset. The asset is subject to some asset ceiling norms which are applicable. Fine. So one is how much goes in balance sheet. Second, how much will go in P&L, how much will go in OCI. These are the three steps. One, how much goes in balance sheet, how much goes in P&L, how much goes in OCI. Now coming to the P&L part. See, suppose if I tell you every year employee works, he will get 100 rupees at the end of 10th year. He will get 100 rupees at retirement time. We assume retirement is after 10 years. Okay, first year he worked. So 100 accrues to him, but when I have to pay him? After 10. Today is first year end. I have to pay after 10th year end. So today in my books I should record an expense which is present value of it. So today's first year end, I have to pay after 10 years. So 9 years still pending. Not 10 years, 9 years is still pending. Okay, again he worked second year. Again 100 accrued at end of 10th. This is second year end. I have to pay 10th year end. So again I have to book an expense which is present value. So every year they work. Can I say something accrues? This is basically called as what? Your projected unit credit method. One year you work, something gets accumulated. Okay. So if you worked for this year, something will get accumulated at the end. I will book an expense today's present value. Usko bolte hai current service cost. Because you worked in current period. That current service cost will go in P&L. So I have to do some extra provision because you work for one more year. So that will go in P&L. Okay. Second, to find out this current service cost, we have an actuarial valuation, and they use which method? Projected unit credit method. Okay. Over here, if I just check, they've given employee benefit which is payable. Salary is 10,000, and I have to pay 1% of final salary. And I assume salary will grow by 7%. Salary will grow by how many percent? And I expect it will go after 5 years. Okay, so today is 10,000. Okay, it will go when? After 5 years. So plus 7%, plus 7%, plus 7%, plus 7%. So now take only 4 years. First year ye hai, second year and third year, fourth year, fifth year. So can I say it is coming 13107? Okay, so can I say whenever you leave, the last salary will be 13107 and I have to pay him 1%. So can I say 131? So every year he works, 131 get accrued at the end. Every year he works, how much get accrues at the end? 131. It's actually 1% of final salary. Final salary is expected at 13,107. Uska 1% is 131. So every year he works. Don't do into 5 times. You have to do only how many times? 4. Because first year is 10. Second year will be 10 plus 7%. Third year is again plus 7%. Fourth year plus 7%. Fifth year is plus 7. 4 times you have to do plus 7%. Okay, if he'll work for 1 year, 131 get accrues at the end of 5th year. Imagine he worked for first year. Imagine he worked for first year. I have to pay 131 when? At the end of 5th year. Today is first year end. So can I say after 4 years? Do one thing. 1 divided by 1.07 equal to not growth in salary is 7. 10% rate discount rate is 10%. So 1 divided by 1.1 equal to into 131. 89. So today I should make a provision of 89. Again he worked one more year. So can I say again 131 get accrues? That again 131 I have to pay at 5th year. This is second year end. So can I say after 3 years? 1 divided by 1.1 equal to into 131. So I have to record expense of 90. Again he worked one more year. Again 131 get accrued at the end of 5th year. But this is third year end. So can I say after 2 years I have to pay 131. Present value is 108. Again he worked one more year. 4th year he worked. I have to pay 131 but end of 5th year. After 1 year so 119. And 5th year he worked. Again I have to pay 130. So this is expense for each year. Did you understood current service cost? Okay, this is current service cost, every year's expense. This is not the total provision of balance sheet. First year you book the expense, that itself is a liability. But now there was an opening liability. On opening liability, unwinding of discount will happen. Reason is you booked present value. So आपको हर साल unwinding of discount. तो opening पे unwinding of discount, then extra liability added, closing. Again opening पे unwinding of discount, extra liability added, closing. Opening पे unwinding of discount, extra liability added, closing. Opening, unwinding of discount, extra liability added, and did you understood? Okay, fine. Next we have past service cost. Now what is this past service cost? One was current service cost. Every year you work, something gets accrued at the end. Uska present value, I'll book it as an expense in this year. Past service cost is, imagine, I told you I'll give you 1% of final salary. Yeah, 1% question में था. If I change my plan and now I say I'll not give you 1%, I'll give you 1.2% of past salary. We'll give you not 1%, we'll give you 1.2%. So can I say whatever expense you have booked till now was based on 1%, but now you have to change it and make it to what? 1.2. So can I say my liability will go up? So that whatever is coming is known as past service cost. Past service cost comes up due to plan amendment. It is coming up due to plan amendment. Or second word is curtailment. Now what is this curtailment? I come out with something like I shut down one division. If I shut down one division, so can I say all the employees of that division, they go out of the plan? If they go out of the plan, so can I say liability which is there in my books will drastically go down. Against that, I might have paid money to them also somewhat. Against that, I might have paid money to them, and the difference will be going in P. Did you understood? Okay, this is past service cost. Current service cost goes in P&L. Past service cost also goes in P&L. Third one, you have basically liability. On opening liability, unwinding of discount happens. The liability increases. Opening liability pe interest gets added, plus this year some extra liability booked and closing. The opening liability pe expense will come up, unwinding of discount. Same way on your plan asset, if you've done some investment, can I say you'll get some investment income? So uska interest will be a income. So on liability, interest unwinding will be expense. On that plan asset investment, the interest will be income. Net interest will again come in your P&L. So this is the third thing which is coming in your P&L. Did you understood? Now, they say that the asset, if you have done some investment, the investments are always to be fair valued. Now, you had opening investment, you added some interest, but that closing and the fair value might be different. So fair value is different. So can I say now you have some other than the interest income also? Other than the interest income, that will not go in P&L, that will go in OCI. Plus actuary changes assumption. Actuary changes assumption, and because of that liability going up or down, that will not go in P&L, that will go in OCI. Okay. Okay, the determining amount which comes in OCI, one actuarial gain loss, and return on your plan asset. On your asset, you get a return which is excluding interest. So on your plan asset, you have an income which is other than interest, that will go in OCI. Okay, so how many things go in P&L? Current service cost, past service cost, and net interest. On your liability, unwinding say expense comes. On your asset, interest pay income comes. What goes in OCI? Actuary changes assumption, and number two is return on plan asset other than interest. Now check this. Suppose your plan asset ka fair value beginning is 100 and plan asset fair value at the end is 118. Discount rate is how many percent? 10. So plan asset was 100 at beginning. On 100 interest will come 10. So it became 110. But what is the fair value? 118. So can I say extra 8 is a return other than interest. So interest will go in P&L, but extra 8 other than interest will go in OCI because that's based on fair valuation. Again, can I say it's an unrealized wala thing? That's fine. Okay, now pay attention. The fair value of plan asset, this useful for calculation is important. Fair value of plan asset beginning, uske upar you did some contribution, again you did some investment, so usme add ho jayega. Again if I do investment, additional investments plus return are added. If I sell off investment to pay the liability, the investment go down and this becomes closing. So how the investment will be there? Opening investment, again I did some investment is added. I had a return on investment, investment will go up. I sold investment to make the payment, so it goes down and closing investment. Now I just go down to the next page. Liability, there's an opening liability. Okay, they work for 1 more year. So can I say have some addition in the liability? Plus on opening liability, what will happen is interest. Opening liability by interest. Now they did some plan amendment. If plan amendment is done, so liability may go up or down. Then they went for curtailment. They went for curtailment or settlement. In curtailment or settlement, can I say the liability of theirs will go away, but I would have paid something to them. The difference is gain loss. That I need to adjust. Okay, that liability. Then if actuary has done your change in assumption, liability may go up or down. And if liability is paid off, can I say there will be payments? Now someone asked me that, sir, yahan pe gain loss on settlement and payment, why these two things are there? Now imagine simple, these two are actually combined. If liability in books was 100, I pay them 80. So payment mein how much came? 80 came. And gain how much is coming? Liability was 100, we pay them 80. So liability 100, we pay them 80. 80 payment comes, and gain how much rupees comes? 20. Indirectly from liability, how much I need to remove is 100. So this two together is nothing but the total liability getting removed. Shall I move it? Okay. So these two are actually to be seen together. Payment done and uska gain loss. So this is the liability getting removed. Okay, now check this question number 4. 1st April, we have a fair value of plan asset. How much is given? 2040. And 1st April, the liability is 2125. 2040, 2125. Now, generally what will happen is, they will not give you all figures. Something will be missing. And I tell you what will be practically missing is, one thing which will be missing is actuarial gain loss. And that will be missing in liability. Liability, remember, because of actuarial gain loss, liability goes up and down. So they have given opening liability, they have given closing liability, everything except what? Actuarial gain loss. And in asset mein what will happen is, interest income will be given other than interest income. That will be kind of missing. Okay, opening. Now, on 31st March, they received a contribution 425. Contribution received is additional investment done. Additional investment done. Can I say I'll add it in investment? Yeah, 425 added. Okay, next. And paid a benefit of 255. When they say paid a benefit, is liability paid, and always liability will be paid by selling investment. Without selling nahi hoga. So investment sold 255, liability paid 255. So investment goes down, liability also goes down. Next, current service cost is 510. Because of current service cost, the liability goes up. 510, liability going up. Okay, interest 5% is given on plan asset and plan liability. The opening investment tha, uspe 5% interest income. Opening asset. Opening liability pe 5% interest expense. So because of interest income, asset goes up. Because of interest expense, liability goes up. Okay? Then the fair value of plan asset last day is 2380 and liability is 27. So last day this is 2380, this 27. So now if you see asset mein what is missing? Opening asset is there, addition to asset is there, the use sold of asset sold is there, closing is there, interest income is there. What is missed out? Other than interest. This is a return on plan asset other than interest income is balancing. Now we check liability side. They don't have plan amendments, they don't have curtailment, settlement. To that you ignore it. So what is missing? Actuarial gain loss. This is balancing here, this is balancing here. Okay, now if I want to understand what will go in P&L, so current service cost will go in P&L. This will go in P&L. Okay, net interest will go in P&L. Net interest will go in P&L. Contribution received doesn't go in P&L. It's just a new investment made. Contribution paid, benefits paid also will not go in P&L. This two item will go in P&L. Which two will go in your OCI? Return on asset other than the interest, and actuarial gain loss is also going in OCI. So this two figure goes in OCI and upar wale figures are going in P&L. So check in P&L current service cost, net interest, and OCI is your gain on plan asset and other things. And balance sheet mein the net defined net liability, net plan asset, usme se net is appearing in balance sheet. This was basically your post employment benefit. Now coming to other long-term benefit. Other long-term benefit are again, they are not covered under short term, they are not covered under post-employment, they are not covered under termination. The question is, they are other than all that things. Now, if I tell you, whenever company completes 10 years, I'll give you 1 lakh. Okay. So is it at the time of retirement? It's just whenever you completes how much? 10 years. So you complete 10 years in company. You complete 10 years in company. I'll be giving you 1 lakh. So can I say for every year you complete, 10,000 get accrued at the end of 10th year? Again you complete one more year, again 10,000 get accrued at the end of 10th year. So iska accounting, how do we do? Same way as your post-employment benefit. Only difference is nothing will go in OCI. Only difference is nothing will go in OCI. So this is to be accounted in a similar way, a same accounting as post-employment benefit. Only difference is do not recognize anything in OCI. Done? Yeah. Even if यहाँ पे some changes in assumptions are done, assumption में यहाँ पे क्या होगा? It's basically fixed. यहाँ पे we don't have like more of controversial thing. वहाँ पे when you will retire, that will be, when you will go out, that was a question. What will be last drawn salary? That will be question. यहाँ पे that all will generally not come. And यहाँ पे we do investments or we don't do investments. यहाँ पे it is not mandatory to do investments. If you have done investment, the total return on your investments will go in PNL. Nothing will go in OC. You understand out? Done? Okay. Now check this question. There is some medical plan wherein company will reimburse 20% if employee leaves after more than 10 years but less than 20 years. And they will reimburse 50% if they leave after 20 years or more. If you leave in 10 to 20 years, I will bear how much percentage? 20% of your medical cost. If you leave after 20 years, I'll bear 50%. Okay, first of all, we need to estimate the medical cost per person. First of all, we need to estimate what will be the total medical cost. Imagine one guy's medical cost will come as 1 lakh. Okay, if that guy will leave in 10 to 20 years, I should bear how much? 20%. Okay, I should bear. And if he leaves after 20 years, I have to bear 50%. That is 50,000 per that person. And if he leaves within 10 years, if I have to, then the first thing I have to estimate is what will be the total medical cost? 1 lakh per person. Now, if that guy I'm estimating will leave within 10 years, I don't have to make any provision. Okay, if I am estimating this guy will leave in 10 to 20 years, so 20% is basically 20,000. Okay, 20,000, how I'll book? If he worked 1 year, assume uska 2,000 gets accrued. I'll book 10 to 20 and I'll book it in 10 years. Because if he works 11th year also, still I'll bear 20%. If he works 12th year also, still I'll bear 20. So can I say by working 11th, 12th, 13th, 14th, 15th year, is he getting any extra benefit? No. So expense is to be booked only for 10 years. So 10 years may I'll book. So I have to pay 20,000 afterwards. I'll book it over 10 years. 1 year he worked, 20 gets accrued, 2 gets accrued. Again 1 year he worked, 2 gets accrued. But if I'm expecting this guy to leave after 20 years, so I have to bear 50%. So can I say 50,000 rupees? 50,000. Okay, 50,000 I'll book it over 20 years. If he works 21 year also, still I have to bear 50 only. If he works 25 years also, still I have to bear 50 only. And that I'll book it only over 20 years. So check how will you measure this for employees who service for 20 years, 10 years, or who will go away within 10 years. Okay, first, the employee is expected to leave after 20 years or more. Whatever I feel 50,000 will be payable, that 50,000 you book it over 20 years. Okay, so 50% uska divided by 20 years, every year 2.5. I told you 50,000 divided by 20 years is 2500. Second, those who are expected to live between 10 to 20 years, I have to pay them 20%. I'll book that 20% over how many years? 10 years, 2% every year. And those who are expected to live within 10 years, can I say no benefit is attributed? Over. Next, the last one is termination benefit. Termination benefit is for the termination. If I terminate your service, I have to pay you termination benefit, how do I account? If I have to pay within 12 months, it's accounted like a short term. If I have to pay the termination benefit after 12 months, it will be accounted like long term. So if it is to be paid within 12 months, it's accounted like short term. If it is to be paid after 12 months, it is long term. Before 12 months, short term. After 12 months, you apply long term. Not expected before 12, long term. Check the question. Okay, now company wants to shut down, but they still want some employees to continue for some time. Each employee who stays and renders service until the closure, if you stay till the closure, you will get 30,000. And if you leave now, before closure, you will get 10. Okay, so everybody will get 10,000. If you stay till the closure, like closure may 3, 4, 5 months, 10 months, 1 year is pending. So if you stay for that till the date of closure, I'll give you 30. Okay, so now question. Did I give you 30 for staying? No. How much I gave you for staying? Extra 20. 10 though I was to give anyways. So 10 I am giving you for termination. Everyone. For everyone 10 I am giving for termination. For those who are continuing, I am giving extra 20 for continuing. So 10 for everyone I am giving, and I have already announced closure. So should I make a provision right now? Yeah, closure is already announced. So it is now. I cannot escape that liability. So I should make a provision right now. So how many employees do we have? 120. 120 into 10,000, make a provision right now. And for the remaining 20 employees who continue, we expect 20 of them to leave before closure. We expect 20 of them to leave before closure. So can I say 100 will continue? For that 100, extra 20,000. 100 into 20,000 is coming 20 lakhs. The 20 lakh rupees, I have to book it over the period of their service because that is for continuing. Okay, the total expense is 20,000 into 10,000 and 100 into 30,000. The total becomes 32 lakhs. Out of 32 lakhs, on 120, full 10,000 is booked immediately as a liability, termination benefit. And for the 100 employees who will continue, 100 employees will continue, extra 20,000, the total 20 lakh, which is extra, which is to be given, it is recognized basically during the period of 10 months service. Question would have given actually 10 months service. Where is it given? First line. Will close in 10 months. So those who are continuing, can I say I'm paying them extra 20,000 for continuing 10 more months? So that 20 lakh which I'm paying is to be divided over a period of 10 months. Any doubts? Anybody with this? Done. This was basically in days 19. Going to the next one in days 37. Yes, please. No, we'll consider. If at all I feel someone will leave within 10 years only, for them I'll not make any provision. The thing is, like, what will happen is, if for those employees we have made some provision and they go away, yes, we'll reverse it. Okay, now there's a question from Garima over here that, sir, you will not be able to complete the marathon today. You please take some more sessions. So we are not able to complete today. The remaining thing will be doing it tomorrow. Tomorrow there will again be a live class which will be starting at 3 o'clock. Garima, please take a note. It will start at 3 o'clock onwards. So 3 p.m. to probably 9 p.m. tomorrow, again we'll be meeting to finish up the remaining topics. According to me, what I'll say is, tomorrow if we are starting at 3 o'clock, you'll be more fresh. Rather, we finish all other things and we keep just the 3 big ones, 115, 116 and 109. You'll be more fresh. That is my personal recommendation. If you want me to cover 115 right now, I can do it. But the thing is, whenever you're fresh and you do that standards, it becomes more better. So my personal recommendation will be that we leave that 3, other all we complete. If time permits, out of 3 we complete 1 of them and 2 will definitely remain. Okay, now let's go to Ind AS 37. We finish this faster. Break 10 minutes, 15 minutes is standard. Then we take a break. Here we started at 3:15 only. Abhi to Okay, now provisions, contingent liability, contingent asset. First of all, provision is what? Provision is a liability, but with an uncertain timing or amount. I know liability will come, but how much I don't know, or when exact timing I don't know, then it is called as a provision. Okay, question, whether provision is a present obligation? See, they say it is a liability. Liability is always present obligation. So liability is always a present obligation. The provision is a present obligation. Now provision, for a provision to be recognized, there are three criteria. For a provision to be recognized, there are how many criteria? Three. One, there has to be what? A present obligation, and present obligation can be either legal or constructive. Legal is based on law or based on contract. That's legal. Constructive is, see, you have already created some image in the minds of people. Like every Diwali, I give one salary as bonus to all my employees. And this we are following since last 30 years. The 30 years say every Diwali, one salary is given as bonus to employee. Then I say now in the minds of employee it is fitted that Diwali may will get what? One salary bonus, and they would have planned their expenditure accordingly. Now if you want to say no also, now you won't be able to do it. So that is basically which obligation? Constructive. You're not bound legally, but that's what constructive. Constructive is based on your announcement, based on your past practices, based on basically your policies which you are following, which you published in your annual report. They are basically your constructive obligation. The one you should have a present obligation, legal or constructive. Second, the outflow of economic resources should be probable. Outflow should be probable, and you should be able to reliably measure it. Now, there's a litigation going on. I know I'll lose the case. There's a litigation going on. I know I will lose the case. So can I say chances of losing are more? So it is a present obligation. It's not possible. I know I lose. Possible means may lose, may not lose. But I know I'll lose. So this is not possible obligation. It is a present obligation. But I feel court will just give me a reminder and leave me. Next time, please don't do like this. The court will just give me a reminder. So what is happening is outflow of economic resources is not probable. The first condition satisfied, but second did not satisfy. And third, I know court will put a penalty also, but how much penalty I'm not able to measure only. If I'm not able to measure only, still I cannot record provision. For provision, there are these three conditions which are required. Okay, provision. You can't make a provision for operating cost of future. Okay, purchase to be done next year. I've already entered into a contract to purchase goods next year, but I cannot make an expense now. I cannot show it as a liability now. I have to show the liability in next year. Whenever they give me goods, then the liability can come in my books. So before goods come in, I cannot have a liability for goods to be purchased. So something related to future, you cannot do it. Plus, if you can avoid a expenditure by future action, then you can't have a provision for that. For example, I know this air conditioner is to be replaced after 5 years. So should I make a provision for buying a new air conditioner right now? No. I can basically shift from this premises only. Or I can basically leave this AC and I can have a centralized air conditioning system also afterwards. So it's not necessary. I know this is to be replaced as such after 5 years, but I don't have to make a provision right now for it, because I can avoid it by doing something else. Provision generally it is at undiscounted value. Provision generally is at what? Undiscounted. But if there is something which is related and time value is more over there, then you take a discounted value. Simplest example is provision for dismantling, which we take it at discounted value. Normally it is undiscounted, but in a few cases we have to take it as discounted value. Acha, provision may, it is not necessary that to whom I have to pay. To whom I have to pay is, the person is not necessary. I don't know the person as of now, it is fine. Like I have to dismantle. So can I say I have to pay to someone who will dismantle? Now do I know today which will be the guy who will be dismantling? No, that person to whom it is payable is not relevant. Okay. And constructive obligation does not come unless you announce to people. If at all board has decided internally we will do this, that doesn't create a constructive obligation until it is announced or communicated to people. Okay, staff retraining. If at all we have implemented a new ERP system, staff will require a training. Should I create a provision for training? No. I can directly hire a new staff which are already trained. Imagine someone who's working in SAP, I can directly take them. So it's not necessary that I have to give training. I can do something else. Can I say it can be avoided? So you don't make a provision right now. But our training is already taken. So can I say now I have to make a liability for payment? Second, I have to fit a smoke filters. Factory may say the smoke is coming, I have to fit a smoke filter. Government told me you have to fit it maximum by 31st March 23. Okay, 31st March 23, I have to fit a smoke filter. Is it a liability? Do I have to make a provision today? No. Today I'm not obliged to fit it. I have to fit it by. Okay, till 31st March I did not fit the smoke filters. Do I need to make a provision now? No. If I don't fit, what will government do? Penalty. Make a provision for penalty. Make a provision for penalty. Still you are not required to make a provision for smoke filter. But smoke filter, when you purchase, then only liability for smoke filter comes. If I don't fit, I don't have to pay for smoke filter. I have to pay penalty. Your breach law, you have to pay penalty. Make a provision for penalty. Next, contaminated land legislation is virtually certain to be enacted. You already contaminated a land, and now law is going to come which says if you have contaminated in past also, still you have to make it good. And law is virtually certain. And I already contaminated, so I know I have to make it good, so I should create a provision. Okay. Offshore oil field is fine. Now, coming over here to question number 1. Now, during COVID time, what happened is they wanted money in Prime Minister's Relief Fund. So, Prime Minister COVID Relief Fund money was required to fund the vaccine and all that things. So, what did they say is the year ends in March. You know, COVID was basically March, May, lockdown came and all that things. The government said normally, if at all I want to get a donation ka benefit, I should have done in this year only. If I do a donation in April, can I say that will be allowed under deduction next year only? But government said that due to this COVID, if you are contributing to Prime Minister COVID Relief Fund after year end but till June, they allowed you a tax benefit in this year only. They allowed you a tax benefit in, and this announcement was done by government on 31st March. This announcement was done by government on 31st March. So whether any company should make a provision for contribution which they will do in Prime Minister's COVID Relief Fund on 31st March. See, announcement came on 31st March. Okay, is it legally required to contribute? No. Today the government announced. So have we announced to people that I am contributing 1000 crores, I am contributing 100 crores, I am contributing 500 crores? No. If I have not announced, so can I say there is no constructive obligation? There is no legal obligation. There is no constructive. I should not be making provision. But now I contributed in May. If I contributed in May, can I say books May? Books May that is allowed as deduction, or books May that expense is coming in May, but tax May I was allowed deduction in this year only. So what happened is tax May I got benefit early. So next year I'll have to pay more tax. I should create a DTL. Clear with this? Shall I move ahead? Tax May I got deduction now. So next year in tax I'll be required to pay more tax. That is why it is DTL. Okay. Next, contingent liability. Contingent liability is a possible obligation arising out of past event, occurrence of which will be confirmed upon happening, non-happening of uncertain future event, not within the control of enterprise. Plus, we know that contingent liability can also be a present obligation under two cases, because for provision there were three criteria. Outflow should be probable, and you should be able to make a estimate. If outflow is not probable, it will be contingent liability. And if reliable estimate cannot be made, still it will be a contingent liability. So under two cases, contingent liability can be a present obligation also. Okay, do we record contingent liability in books? No, we just disclose it in notes to accounts, and it has to be continuously assessed. Whenever we feel now it's no longer contingent, pakka payable, then you convert it into liability provision. Contingent asset we will already discuss similar to it. Contingent assets are also not recognized in your book. Contingent assets will be recognized only when they become virtually certain. When they become virtually certain. Okay, now question. Can I record contingent? Can I disclose the contingent asset in books? I cannot record. Can I disclose? If? No. That was an accounting standard. Okay. Over here, if I can record when? virtually certain. Virtually certain is 95% से ज़्यादा probability. That's virtually certain. More than 95%. Okay. The chances of winning a case. I filed a case against someone. The chances of winning a case are more than 50. More than 50 is probable. If contingent asset is probable, you can disclose it. Contingent asset is probable, you can disclose. If it's virtually certain, record. Okay, the check over here. See, virtually certain is 95%. Okay, liability virtually certain, record liability. Contingent asset virtually certain, so now it's recorded as asset only. Okay, 50 to 95%. 50 to 95 means it's not virtually certain, but it is probable. Okay, liability probable, create a provision. Contingent asset probable, disclose. 5 to 50%. 5 to 50 is not probable. Okay, so 5 to 50% liability may come, may not come, contingent liability. And asset may not probable, contingent asset not probable, I cannot disclose also. Okay, less than 5% is called remote. If liability is remote, you may not disclose as a contingent liability also. And यहाँ पे also not permitted. So contingent asset can be recorded only when it becomes virtually certain. But if it is a probable, more than 50% chance are there, it can be disclosed. Next. This is fine. Okay, now you purchase some control equipments, process control equipments, and you are entitled to duty drawback if your turnover exceeds some limit. You are a manufacturing company and you get some duty drawback if the turnover exceeds some limit. But to claim a duty drawback, you need to make application within 15 days. Once the limit is crossed of turnover, how many days may you to apply? 15 days. If you don't apply in 15 days, then it is at the discretion of government. तो वो आपको देना है तो देंगे, otherwise they will not give you. For the year 1-2, the company has exceeded the turnover limit, so we are entitled for duty drawback. But the application is filed in April, which is after 15 days of meeting target. Okay, the one problem is the application is done, but when it is done? After 15 days. Now question, whether I'll get the duty drawback or not, can I say it is at a discretion of government? If it's at a discretion of government, I may get, I may not get. It is what? Contingent asset. I can record only when it becomes virtually certain. Now see, contingent asset, but don't see adjusting event, non-adjusting event. I can record only when it becomes virtually certain. So duty drawback is given to you on 28th of June and books are approved in July. Even though books are approved in July, this will not be adjusting. I cannot record on 31st March. यहाँ पे तो we have not applied also on 31st March. When did we apply? April. When did we apply it? April में apply किया. Even though it was applied on 31st March, still as it was applied late, we were not sure we'll get or not. So on 31st March, it is a contingent asset. It became virtually certain in June, recorded only in June. Next, whenever I'm booking a liability or whenever I'm making a provision, it should be the best estimate, whatever it is. Now, over here, there are two things: most likely outcome, expected value. If there are more than one option, 2, 3, 4, 5 probabilities are there. 1 lakh payment, probability 10%. 2 lakh payment, probability 30%. 3 lakh payment, probability 10%. 4 lakh payment, probability this much. So you do multiplication of all the expected outcome and then you take up your provision. There is a sum of all outcomes into the probability. This is called as expected value. And other one they are telling us most likely. So what is most likely? There are 5 chances. Usme the one which has a highest chance, that is called as most likely. Okay. Provision is measured before tax, that is fine. If there are some risk and uncertainties involved, uske karan you may increase the provision or you may decrease the provision. The extra risk is there, so you may do some extra provision. And present value you do it if it is material. Present value you do it of this if it is material. Acha, now expected gain on disposal of asset. Expected gain, like suppose I tell you dismantling cost, I make a provision, but I feel that after 20 years when I dismantle the rig, and the rig etc was basically built out of steel ke rates would have gone up too high after 30 years. So on selling that rig, I will have a profit. So while creating a provision for dismantling, should I consider the profits which I'm expecting when I sell that rig after dismantling? No, the expected profit on dismantling are not to be considered. Expected profit on disposal of asset are not considered. Fine. Check over here. Question. You have a present obligation to dismantle the plant. You cannot cancel the obligation. You estimate total cost 50 lakh. Present value is 30 lakh. So should I make a provision 50 or 30? 30. But there are some other risk involved. There are so many other risk involved because something is coming after 30 years. So I feel that because of that, there's a risk factor. Extra 5% outflow may come up. So should I make a provision 30 or should I make 3150? 3150. ठीक है. Now reimbursement. Sometimes what happens is you do a provision, but if you lose the case, you pay to your customer, but your supplier will reimburse you. I lose the case, I'll pay to customer, but my supplier will reimburse something. So reimbursements you can record it only when it is virtually certain, not probable. Probable नहीं क्या? More than 95% is virtually certain. So if virtually certain है, then you record reimbursement as an asset. Separately, reimbursement receivable. But if it is just probable, then it is a contingent asset. Probable hai, so it's a contingent asset. And remember, probable contingent asset are disclosed in notes to accounts. Changes in provision, you have to estimate the provisions, whether the change is required or not. Okay, if we have done a provision of something coming up afterwards, there's an unwinding of discount coming up. Fine. Onerous contract. Onerous contract is a contract in which the unavoidable cost of meeting the contract exceeds revenue. So whatever benefit is going to come, usse zyada the cost is exceeding, that is called as onerous. Now whenever contract is becoming onerous, I am required to make a provision for onerous contract. Now how much is the provision I have to do? Cost of fulfilling. If you continue, what will be the loss you will have? Or if you terminate, how much you are required to pay? Isme se whichever is lower. Okay, check question over here. You entered into a contract to supply televisions, 1000 televisions for 2 million. But now the cost of input has risen. So you have to supply TV. Aapka cost बढ़ गया, but you don't have an escalation clause. So can I say I have to still supply at 2 million? But now my cost will be 2.5. So can I say in this contract, if I fulfill it, if I give that 1000 TVs to them, I'll have a 0.5 million loss. Okay, penalty is 0.25. If I fulfill it, there's a 0.5 ka loss. If I cancel it, 0.25. So can I say you have to make a provision for onerous contract 0.25, whichever is low. So 0.25 million is the provision for onerous contract. Next is restructuring. Restructuring is a program which is planned and controlled by the management, and that will materially change the way you're operating, the manner in which you operate, and the scope of business undertaken. Suppose today you are in 3 different zones. You're working in zone A, zone B, zone C. You decided to shut down zone A. So that is coming under restructuring. Okay, today you are teaching only offline. You move to online also. That is also a part of restructuring. It materially changes the scope of your business or manner in which the business is done. Now, sometimes because of your decisions, what happens is, like suppose you decided to close down zone A. So can I say all the employees of zone A will go out in between? And in between, if they're going out, can I say I have to pay them termination benefit? So can I say it will be coming under a part of what? Restructuring. So you have required to make a provision for that. Similarly, whatever contracts are there of zone A would have done some contract with their suppliers. Can I say all that contracts are to be cancelled? Because of cancellation of contract, we would be required to pay penalties. So that you again create a provision right now. So because of that restructuring, then whatever is consequential expenses coming, you need to make a provision. But now, zone A ke employees will be moved to zone B. There will be relocation expense. That is not covered here. Relocation expenses are not covered under your restructuring provision. Okay, so check over here. Provision for restructuring is only when the general criteria for provision is recognized. And suppose we have decided to restructure internally, but we have not communicated to public. If you have not communicated to public, do we have a constructive obligation? No. Then should I make a provision? No. Provision is required only when you either have a legal obligation or you have a constructive obligation. Constructive obligation comes when you announce. Okay, the BOD decided to shut down one division. They have not communicated to people. It's communicated in April. When it is communicated? After year end, before books are approved. Adjusting event, non-adjusting event. Non-adjusting. 31st March, there is no constructive obligation. 31st March, there is no constructive obligation. If you announce to people on 10th of April, the provision should be done on 10th of April. Okay, let's now check over here. A management decision taken before the reporting period does not give a contractual thing. You have to announce it to people. If announcement is done after the year end, before the books are approved, still it is a non-adjusting event. And restructuring provision does not include retraining, relocating, marketing, investment in new systems. That all is not covered under restructuring provision. For example, we are doing offline classes, we decided to move on to online. So we know we have to buy a few laptops, we have to have some operating systems, some softwares. So we have to invest in new system. I cannot make a provision for that right now. Only when they really purchase, they will be coming as liability. Future operating losses. Future operating losses are again not included in provision. You will shift to new system. Can I say you are changing the way you are working? So starting may hiccups and troubles will come up, and because of that some operating losses will come up, or that provision is not required. And expected gain on disposal of assets are not considered. Question number 7 is important. Check. You have a wholly owned subsidiary. Board decided to discontinue G. From which date? 30th. No. Board has decided on 31st Jan only. They decided that we will discontinue in April. Jan May, board has decided will discontinue from April, and they made a public announcement in so February only we told to people that April May we are closing. So can I say announcement done? Expectation is there in minds of people. Should we create a provision? Yes. Okay. Now check over here. They have given on the date of public announcement. It was estimated G will have to pay 540 lakh as termination benefit. So how much I am expecting? 540 lakh. But this was estimated on the date of public announcement. Can I say in February? Now after year end, before the books are approved, the actual came up only to 520. Now already provision was done 540, but after year end, before books are approved, we understood actual is 520. So can I say there is an adjusting event? See, provision done hai, already kar liya hai, we can change it. But if announcement for restructuring was done after year end, then there is no constructive obligation in March. So should I make a provision 540 or now 520 only? 520. See, books are approved in May end. This is May 15, we are able to know. As a second, there is some relocation cost, which is 60 lakhs. Some employees moved here. Relocation cost. Do we create a provision for that? No. Just now we saw relocation cost is not covered. So I'll make a provision 520. Second, we had taken a property on lease, but now we are shutting down division. So when I say property is to be given back, but upon giving back, there might be non-cancelable clause. We cannot cancel the lease. We have to continue. So present value of future lease payment is what? 430, and eventually we settled it at 410. Okay, so 430 we were knowing, but before the books are approved, we understood it is actually 410. So I should make a provision for 430 or 410? 410. So one is basically 520, other is 410. Okay, the loss after tax of G is 400, and future further operating loss we are expecting 60. Should I make provision for further operating loss? No, that is not to be done. The provision is 520 plus 410. Total answer is 930. This is your chapter number 9, unit number 2. The chapter 9 is over. Chapter 10 will start after the break. It is 5:39. We meet back at 6 o'clock. Okay, 20 minutes break. We are meeting back at 6 o'clock and we'll start on time. Can someone check whether this YouTube link is working? If you have a YouTube link, just open it. Now my internet is not working. Working, no? Working? Okay. Chalo, let's move ahead. Now, we'll complete 5 more standards today. Chapter number 10 has 2 standards, that is your Ind AS 12 as well as your Ind AS 21. Your chapter number 11, they have again 3 standards, Ind AS 24, Ind AS 33 and Ind AS 108. So if we are able to finish this chapter 10 and chapter number 11, now what is pending is chapter number 3, Ind AS 115, chapter 7 ka unit number 3, that is 116, and your financial instrument plus the first time adoption. The first time adoption is something which can be done only at the end. That will be pending. So mainly your 3 standards are pending, that is your 115, 116 and your 109, plus together with that there is 101 which will be pending. So we'll try to finish up this 5 standards and remaining we'll be doing it tomorrow. Again, I remind you, tomorrow's timing will be 3 p.m. onwards till the time we finish it. Okay. Now let's go to Ind AS 12, which is on income tax. This is your deferred tax. So income tax is current tax as well as deferred tax, but mostly the standard is having things related to what? Deferred tax. Now we know that the profit as per books, profit as per income tax are not same, and there are timing differences and permanent differences which are there. When we used to do AS 22, we know that the deferred tax was created only on what? Timing difference. And permanent difference where we don't calculate the deferred tax impact. So the thing is, the word timing and permanent were used under your AS 22. Ind AS basically 12 does not use the word timing difference. Ind AS ke andar there's only word called as temporary difference, and they don't have a word called permanent difference also. So they just have the word called as temporary difference. So between the profit as per books, profit as per income tax, if there is a temporary difference, if there is a temporary difference, on that temporary difference we are required to create deferred tax. Fine. Now over here, if you see, they've written only the word, the concept stands revised over here. And whenever we are doing under your AS, we used to think from expenditure angle. Expense today is here, tomorrow will be there. We used to think from whose angle? Expenditure, yeah, income's angle. That was a P&L approach, but over here we don't have a P&L approach. We use which approach? Balance sheet approach. Under the balance sheet approach, we try to see what is the value of asset or liability in books and what is the value of asset or liability as per income tax. What is the value of asset or liability in books and what is the value of assets and liabilities in income tax. Now, if the carrying amount of asset in books, if the carrying amount of asset in books is more than the tax base, means asset in books is more, asset in income tax is less, then we are required to create a DTL, because asset in books is more, income tax में वो less है, तो future में it will be taxed under income tax, so we create a DTL. Again, if carrying amount of asset is more in books, we create DTL. If carrying amount of asset is less in books, we create DTA. If carrying amount of liability is more in books, we create a DTA, and if carrying amount of liability is less in books, we create a DTL. Clear with this? Okay. Now, if I see over here, this chapter is divided into following parts. One is called as tax expense, then the word comes current tax, then the word comes deferred tax, then there's some practical application, and lastly there is disclosure. Now first of all, part A, tax expense. Tax expense includes your current tax as well as your deferred tax. If you remember your SOPL, SOPL may be used to your profit before tax, then it was current tax, deferred tax, that is your total tax expense. Then coming to the word current tax is a tax for the period which we are required to pay right now. We have to pay it now, that is basically your current tax, and we create a provision for tax, and opposite side we might have some advance tax or TDS which is already there, and the net, if provision for tax is more, it appears under your current tax liability. If advance tax TDS is more, it appears under your current tax asset. So that is your current tax, which is for the current period, and current tax will be based on profit as per books or profit as per income tax. Current tax will be based on profit as per books or profit as per income tax, profit as per income tax. Okay, fine. This is for the period, and we always measure the current tax as per the laws which have been enacted. So what is the rate applicable for this year? We have to take the current tax based on that rate. This year ka current tax is based on this year's rate. Okay, fine. Now, offsetting current tax asset and current tax liability is important. You have a current tax asset, you have a current tax liability. Can I offset it? You can offset only when, if and only if you have a legal enforceable right to set off, and second, you intend to settle them on net basis or they'll be settled together. This is paid, this is received. So that is basically the things which are given. Now, normally what happens is you are allowed to settle it on net basis if they are related to same governing laws. If they are related to same governing laws, generally then you are allowed to set off. Otherwise, you are not allowed to set off. Now imagine parent has a current tax liability and subsidiary has a current tax asset. Can that be netted off? Answer is no. In consolidated financial statement, both are required to be shown separately. Because if parent has a current tax liability, they will be required to pay. And if a subsidiary has a current tax asset, the government will be giving them a refund. It cannot be settled on net basis. Now coming to the part C, deferred tax. Now, in order to calculate your deferred tax asset or deferred tax liability, there are certain steps given. Okay, remember we said that difference between your books, carrying amount of asset in books, carrying amount of asset in tax. And based on that difference, we calculate your deferred tax. So first of all, what do we need is the carrying amount of asset and liability as per books. Second, we need the carrying amount of assets and liability as per income tax. Then we find out the difference. Now we analyze the difference. Okay, because of this difference, do we require to pay tax in future? Is it a taxable temporary difference which will be taxed in future? Or because of that, there will be a allowance in future that is called as a deductible temporary difference. If it's a taxable temporary difference which will be taxed in future, we create DTL. If it's a deductible temporary difference which will be allowed in future I have to pay less tax, I should create a DTA. So we bifurcate that temporary difference. Okay, step 5 is certain exceptions. They have given certain exceptions. Because of this, DTA, DTL will not be coming. Like simplest example I tell you, whenever we have a business combination, assets and liabilities come under business combination at acquisition date, fair value. The asset has gone up, the carrying amount of asset is increased, but tax may does not happen, so we create a DTL for it. But now my question is, in your business combination, if you are paid more, you record goodwill. So goodwill is recorded in books. Tax purpose, there is no goodwill. Tax purpose, there is nothing called as goodwill. And remember, goodwill is also coming only in CFS. SFS mein to no goodwill. And you remember, tax is only from which angle? SFS. Parent is taxed separately, subsidiary is taxed separately. We don't have a CFS being again taxed. We don't have a group again being taxed. So if you just analyze, in your CFS, there's a goodwill being recorded due to business combination. Tax mein to koi goodwill hai hi nahi. So you might see that the carrying amount of asset goodwill in books is there, but income tax mein there is no goodwill only. So do I create DTL on that? Answer is no, it falls under exception. There are certain exceptions given. Then whenever there's a DTA to be recognized, DTA recognized karna hai, I should be basically certain that there will be income coming in future against which the DTA can be set off. So whenever there's a DTA, the evaluate it whether future may income will be there to set off or not. Now you determine the tax rate. Whenever you are calculating your DTA, DTL, can I say that this will be taxed in future or this will be deductible in future? So I should not take the tax rate which is applicable now. I should be taking a tax rate which will be applicable in future. The government has already announced. If government has already announced that next year ka tax rate will be different, then I should be having DTA, DTL based on next year's tax rate. The word yahan pe used is either the enacted tax rate or substantively enacted tax rate. Then we have the difference, temporary difference is there, the rate is also available, multiply the difference with the rate, you get the figure of DTA, DTL, you account for DTA, DTL, and for presentation you are required to show net in your balance sheet. But again, offsetting is allowed only if it is basically again offsetting is allowed when so they are of same governing laws and you intend to basically settle it on a net basis. Okay, now how do I find the carrying amount of asset or liability in books? Now all the steps in detail. Carrying amount of asset or liability in books is basically available from your books of accounts. Fine. How do I find out the tax base? How do I find the tax base? This is nothing but the carrying amount of asset or liability as per income tax. Now they've given over here a definition: tax base of an asset, tax base of a liability. But the thing is, if you go by definition, it will be more confusing. Rather than that, you normally understand in a simpler way. I'll go directly to the examples to understand tax base. I'm not basically going into all this directly. I go over here to the examples. Now again, I just repeat, if carrying amount of asset as per books is more, we create DTA. If carrying amount of asset is less, we create DTA. If carrying amount of liability is more, DTA. Carrying amount of liability is less, DTL. Acha, one more thing. Whenever something is not taxable under income tax or something is not deductible under income tax, then the tax base is equal to carrying amount, not zero. Tax base is equal to carrying amount, so that there will be zero temporary difference. So something not taxable, something not deductible, can I say it's a kind of permanent difference? Not taxable, not deductible, so permanent difference ho gaya. I need to ensure the temporary difference comes, and when this temporary difference comes zero, when we say that the tax base is equal to carrying, something not taxable, something not deductible, the tax base is equal to carrying amount, and that's why there will be zero temporary difference, no DTA, no DTA. Fine. Now check over here certain examples. We are required to tell whether to record a DTA or DTL. Interest revenue is recognized in arrears. Arrears means it is outstanding. Interest income is outstanding. Books may we have recorded interest income. So entry will be interest receivable to interest income, and it's included in accounting profit on time basis. Tax may, it will be taxable on cash basis. Okay, the books may you have interest receivable. Tax may, the thing is they are telling, tax may they are telling the interest income will come only when I receive. So can I say tax may it will come in future? So book may we have interest receivable, tax may interest receivable is not there. So can I say carrying amount of asset is more in books? If carrying amount of asset is more in books, DT. Okay, next one. Revenue from sale of goods is included in accounting profit. The books may be recorded sales. We have a debtor. Okay, when goods are delivered. But tax may it will come only when cash is collected. The books may be recorded debtors to sales. Tax may the sales is not booked. Okay, tax may if income is not booked. So can I say asset is also not there? The books may be recorded asset. Tax may it will come up in future. So again, carrying amount of asset is more in books. We should create DTL. Next one, development cost has been capitalized. So books may we have a development cost capitalized. There's an asset and it's amortized in P&L. But in taxable profit, in determining taxable profit, they are deducted in the period in which they are incurred. Okay, so books may we have shown a development cost as an asset, and we are amortizing over certain years. But income tax may it is allowed as deduction in first year only fully. The books may we have an asset, income tax may asset is zero because it has gone fully in expense. Income tax may has gone fully in expense. The books may asset is there, tax may asset is zero. The carrying amount of asset in books is more. We'll have a DTL. Anywhere if you're stuck up, stop me at the same time. Next, prepaid expense has already been deducted on cash basis. Okay, the thing is, while determining taxable profit, the tax may, if I paid some extra, they allowed me deduction right now. I paid something extra, they allowed me deduction right now. So can I say they have taken it under expense only? But books may it is a prepaid. The books may we have an asset, tax may there is zero asset. So again, carrying amount of asset in books is more. We should have a DT. Next, depreciation of an asset is accelerated for tax purpose. So can I say tax may there is more depreciation? Depreciation is accelerated kahan pe? So tax may there is more depreciation. So can I say carrying amount of asset in tax will be less? The books may asset is more, tax may asset is less. We have a DTA. Okay, retirement benefit cost. They are deducted in determining accounting profit. Remember, we create a provision for gratuity. The books may we have a provision for gratuity, we have a liability. Tax may there's nothing like that. Tax may they say whenever you pay, expense will come. The books may we have an expense, we have a liability. Books may we have expense, we have a liability. Tax may there is no expense, so there is no liability. Expense is there, then liability can come. So tax may there is no liability. The books may liability is more, tax may liability is not there. Liability more in books, we have to create DTA. Okay, accumulated depreciation in financial statement is more. Okay, books may accumulated depreciation is more. Books may accumulated depreciation is more. So can I say books may the net block is less. So books may asset is less. Tax may asset is more. We have to create a DTA. Next, the NRV of inventory or the recoverable amount of PPE is less than the carrying amount. So can I say if NRV of inventory is less, books may the inventory is carried at its NRV. The books may inventory has gone down. Tax may they don't allow that loss. Tax may they allow the loss only when you sell it. The books may inventory has gone down. Tax may the inventory is still higher. The books may asset is less. DTA. Next, income is deferred in balance sheet. Income is deferred in balance sheet. So can I say we have not recorded an income? The books may there is no income. Income is deferred. Means it will be recorded in future. Okay. If you have paid money right now, I have not recorded income. I would have shown it as liability. The books may, if you have paid me money, I have not shown income. I have deferred. Future may record. So today I am showing it as liability. But tax may it is included in income. The books may it is shown as liability, but tax may liability is 0. The books may liability is more. I need to create DTA. Depreciation of an asset is not deductible for tax purpose till the asset is sold. Milega, but when the asset is sold, the books may we give depreciation. Asset has gone down. Tax may there is no depreciation till it is sold. The asset in book taxation is more. So again, asset in books is less. We have to create a DTA. Next, you record a loan. Borrower has recorded a loan at a proceeds which you have received, less the transaction cost. Now, as per Ind AS 109, if I take a loan, 50 lakh rupees. So, can I say you gave me 50 lakh? Loan processing fee was 1 lakh. So, bank to loan 50. Loan processing fee is 1 lakh. That will be loan to bank 1 lakh and net loan in my book is 49. And now I am paying you interest. Suppose I am paying you interest 6%, I'll be paying you 6% on 50, but effective rate of interest is not 6% because effectively on 49 I am paying you that interest. Effectively the interest will be more than 6%. The books may will follow the effective interest rate, correct? The books may the loan is 49, but tax purpose the loan is 50 only. Books may the loan is 49, but tax purpose the loan is 50. The books may liability is less. Liability less, we have to create a DTL. The books may loan is 49, tax may the liability is 50. Next, the financial assets are carried at fair value, which exceeds the cost. Financial assets are carried at fair value, which exceeds cost. The book may financial asset is more. Tax may is still at the same value. The tax may value is less. Books may asset is more. I create DTA. Financial assets are carried at fair value, which is less than cost. The books may asset has gone down. There's a DTA required. Then you revalue a PP. Books may you revalue. Tax may it is not done. The books may asset has gone up. DTA. Okay. The carrying amount of asset is increased in books due to business combination, but no equivalent adjustment in income tax. So carrying amount of asset is increased in books. Carrying amount of asset in books goes up. It's a DT. Carrying amount of asset is decreased to its fair value. The books may asset has gone down. Tax may nothing has happened. It will be a DTA. Carrying amount of liability increased. Liability increased in book. We have to create a DTA. Liability decreased in book. DTL. Fine. Unrealized losses from intra-group transaction. Intra-group transaction may unrealized losses. Remember that stock may unrealized profit. The books may stock has gone down, not for tax purpose. Remember standalone may the stock will remain same. So stock in standalone is still 120, but CFS may make the stock as 100, and tax purpose is always standalone. Books may stock has gone down, tax may stock is still the same. The books may asset has gone down. I have to create a DTA. Did you understand all? Shall I move ahead? Okay, so this was basically step number 1, 2, 3, 4. 1 was finding out the carrying amount as per books. 2 is finding out carrying amount as per income tax. 3 is finding out what? Your temporary difference. 4 is evaluating whether it will be taxable temporary difference taxed in future, or whether it is a deductible temporary difference which will be deducted in future. If it will be taxable in future, I have to create what? DTL. If it will be deductible in future, I have to create a DT. And simple, if asset is increased, DTL, asset is decreased in book, DTA, liability increased in book, DTA, liability decreased in book, DTL. Fine. Now exceptions. Exceptions. I told you under business combination we have a goodwill coming, but goodwill is coming only in books. For tax purpose there is no goodwill, but we don't create what? Book made goodwill, so asset increased, but we don't create DTL on it. So that's the first exception, initial recognition of goodwill in a business combination. Other assets and liabilities which are increased, decrease, I create a DTA, DTL. But for the goodwill amount, we don't create DTA, DTL. Okay, second. The first exception done. Now coming to exception number 2. Okay, before that, I just take one question over here. I think, yeah, this one. Illustration 2 I'm taking, important one. H acquired 100% in S for how much rupees? 15 lakhs. Book value and fair value of identifiable assets and liabilities are given. Okay, acquisition date, book value. This is a tax base. Can I say tax base is the value as per income tax, and these are the fair values. Now, because of business combination, the assets and liability come in our book at, okay, so now in our book, these are the values. Tax purpose, these are the values. The first one is of no use. In our books, fair values are there. For tax purpose, tax base is there. So now let us calculate DTA, DTL which is coming. Now, tax rate of holding company 30%, tax rate of subsidiary is 40%. Okay, tax rate of holding is 30, tax rate of subsidiary is 40. Okay, the fair value of asset is your basically as per books. So as per books it is coming 1070, and as per income tax the net asset is coming 920. So can I say in simple words, asset as per books is more? If asset as per books is more, I have to create DTL. Question, 30%, 40%. 30%, 40%. Simple. These are assets of whom? Parent or subsidiary? Subsidiary. So who will have to pay tax in future? Subsidiary. The subsidiary has to pay tax. Subsidiary will pay tax at what? 40%. DTL will be at 40%. The assets and liabilities are of subsidiary. Okay, we included a higher value. But now we included higher value. Subsidiary has to pay tax really when they are really sold in future. But subsidiary has to pay tax, so it will be at 40%. So into 40%. Clear? Okay, now coming to the second exception. The second exception is initial recording of asset or liability. Day 1, you are recording asset or liability. Okay, and this is not due to business combination, and it does not affect the accounting profit or the taxable profit. Okay, so day 1, it doesn't affect what? Accounting profit, or it doesn't affect what? Taxable profit. Now I tell you one thing. Imagine, books may you have recorded an interest income, tax may it will come in cash basis. So books may interest income recorded, the entry is interest receivable to interest income, and tax may it will come up in future. The books may asset has gone up, tax may asset is not there, we were creating DTL. But can I say here it was impacting accounting profit? So wahan pe it was impacting accounting profit. This exception says what? Something which is creating a temporary difference, it is not due to business combination, and it neither affects what? Accounting profit or tax profit. Now, sir, example of it. Okay, you got government grant which was in kind. You got a government grant, land, free of cost. How do you record in your books? Nominal value, or second option, fair. Okay, if I record land at fair value, land debit to deferred government grant, and deferred government grant will come as income over the life. Okay, does it come as income in P&L on day 1? No. So can I say it does not affect? It does not affect accounting profit. Okay? And now if they say that the land The land will not be depreciated, nothing will be taxed for land in taxation also. So can I say it does not affect tax profit also? Book may also it is not affecting today. Tax may also it is not affecting. And I see land you got it for free. Book may it is recorded fair value. Tax may to nahi hai. So tax may the value is 0. The book may value is something. Tax may 0. You feel there is a DTL, but don't record. It falls under exception. So it is not due to business combination. You got a government grant, land. Oh, it's not due to business combination. So this is a initial recording of asset or liability, which is not a business combination. And at the time of transaction, day one, it neither affects accounting profit nor tax profit. Okay. Exam angle, this is not relevant much. Okay. Now exception number 3. Exception number 3. Now tell me one thing. If you have a subsidiary associate, you have basically subsidiary associate JV. So when you are preparing a CFS, can I say your share of profit is included? Associates and JV, you follow equity method. When I follow equity method, our share of profit in subsidiary associate is coming in our books. Yes, no? And how we were recording? Our share of profit we include in consolidated P&L. Opposite, we have not got cash, so we are adding it in investments. So asset went up, book may investment went up. Tax purpose, no, tax purpose I will be taxed only when they give me dividend. So there will be a dividend income of mine, I will be taxed. So book may the profit has, asset has gone up. Tax purpose the investment is still the same. So can I say I have to create what? DTL? Yes, no? So question is, should I create DTL on it? So they have said over here, this gets reversed when? So I have my share of profit included. This will get reversed whenever they declare dividend. जब वो dividend देंगे, in my SFS only income will come, and at that time I'm required to pay tax. Okay, now just tell me one thing. Subsidiary, who is controlling? I am only controlling. Subsidiary, I am only controlling. Now subsidiary's profit is included in CFS. You will say, sir, I don't have to pay tax right now. I have to pay tax whenever they give me dividend. Profit I already included right now, but when they declare dividend, SFS may income will come, and then I have to pay tax. I know I have to pay tax in future. So you will say it is a DTL to be created, future may tax to be paid. But I know my subsidiary, I only control them. I know my subsidiary, I only control them. We are not in a mood to declare dividend in a foreseeable future. So in a foreseeable future, dividend is not going to come. If dividend is not going to come, is any reversal going to happen in that foreseeable future? No. So then don't record only DTL, because it's under your control now. It's under my control, and foreseeable future may we are not going to declare dividend. But if something is not under my control, then you record DTL. For example, associates and JV. Do you control associate? So then that whether they will declare dividend or not, it's not in my control. JV may we have a joint control. Imagine dividend policy ka decision you take. Joint control may we might have distributed. Na, you take this decision, I take this decision. If dividend policy ka decision you take, and again foreseeable future you feel dividend is not going to come, then you don't record DTL. Otherwise you have to record DTL. So check over here. This is existence of undistributed profit. Our profits have included in CFS, but tax angle, they will declare dividend, then only I have to pay tax. So what do I do? So there is a temporary difference created. Should I record DTL for all these cases? You should record DTL except you are able to control the timing of reversal. Reversal will happen when they will declare dividend. If I am able to control dividend, and it is probable that temporary difference will not reverse. It's probable that in foreseeable future we are not going to come out with dividend. Then only, if I know dividend is not going to come only, so today I included profit, it will get reversed when dividend comes, but dividend is not going to come only. So don't record DTL because reversal is not going to happen. But if you do not control, then you have to record DTL. So for associate, I do not control, so I have to record DTL. So share in profit of associate when you record it, opposite you also have to record a DTL for it. JV में, if you control the dividend policy and you know dividend is not going to come up, then you don't record DTL. But you don't control dividend policy, then in that case you have to record DTL. Did you understood? Okay. Now, next step is assess the deductible temporary difference. Deductible means which will be deductible in future. If deductible hai, to uske upar I have to create what? DTA. For deductible ones I have to create is DTA. Now, normally when you create a DTA, it's fine. But they say that if I have to create DTA, DTA ka benefit comes when future I don't have to pay tax. But can I say future mein there has to be a profit? If future there is no profits only, then this benefit of DTA will not come. So you need to see that future may the taxable profits are probable. If future may the taxable profits are probable, then you record a DTA. Or future may, whenever you are having this DTA, there will be a sufficient DTL balance against which the DTA can be set off. So either there will be a future sufficient taxable profit, or either there will be a DTL balance against which DTA can be set off. These are the two things. Now, suppose a company has a carry forward losses. Remember, under taxation we are allowed to carry forward losses for 8 years. So now next year I earn profit. Can I say still I don't have to pay tax? So it will give me a benefit in future. So today I have to create what? DTA on it. But now DTA is to be created whenever future profits are probable. See, here we are making losses. We're making losses. So generally I can say the future profits are not probable. So now you need a highly convincing evidence that there will be a future profits. So if you want to record a DTA for accumulated losses, if you want to have DTA for what? Accumulated losses, then in that case you should record only when there is a highly probable convincing evidence that future may profits will be there. So check over here. Okay, I'll just take this first. If you have a tax losses, you should record a DTA cup only when there's a convincing evidence that there will be a sufficient taxable profits. Because as you are making losses, we can't say future may profit hoga unless you have a convincing evidence. Don't record DTA on it, or you should have a balance of DTL. Okay, now coming back, the entity can record DTA even if each point of time there will be a sufficient deductible temporary difference. Deductible temporary difference will be fully reversed against the taxable temporary difference. Okay, now pay attention. They've given one example. This is the balance of temporary taxable difference and deductible one. First one leads to DTL, second one leads to DTL. Now see, first one leads to DTL. Yahan pe balance 5, yahan pe balance 3, yahan pe balance 2. And can I say the below balance are all lower? So can I say every stage of time there will be a sufficient DTL against which the DTA can be set off. But now if you see second case, this is the DTL 5, 3, 2. But niche you see this is 4. Okay, yahan pe 4k against 5, sufficient DTL balance is there. But here against 4 there is only DTL of what? 3. So do we have a sufficient DTL balance second year may? No. Then I can't record DTA on. How much is extra over here? 1000. So do one thing, rather than 8000 pay, you record DTA only on 7000. Rather than 8000, you record DTA only on 7000. Yes or no? You need DTL ka balance at every point of time. Today DTL is there. You might say sir DTA and against DTL is there. But yeah, DTA now, this DTA is not going to reverse in next year only. It is going to reverse over a period. So if it is to be reversed over 3 years, so over that 3 years, every time you should have a sufficient DTL balance. Last bench? Clear? Okay. Tax loss is done. Now coming to the tax rate. Tax rate for DTA, DTL is basically the enacted one or substantively enacted one. If government has already announced that next year tax rate will not be 25%, it will be 20%, the DTA, DTL has to be as per 20%. But imagine government announced after year end. If government announced after year end, then on 31st March it is not substantively enacted, then in that case it is a non-adjusting event. You continue as per 25%. Okay, so it is either the enacted or substantively enacted. Now check this question. We have December ending. We have which ending? December ending. February, May, government came and said that the tax rate from 25 will increase to 30. Okay, now year ends in December. Government came up when? Feb, May, 31st March. Was there anything? No. I should continue as per the old rate. What is the old rate? 25%. But imagine it's a March ending. Same question, but it is what? March ending. If it is March ending, when did government announce that next year new rate will come? Feb. So can I say in March I already know that next year it will be not 25%, it will be 30. So now I should be using 30%. Did you understood? Okay. Now manner of recovery of asset. This is also very important. Now pay attention. Suppose imagine you are having a land which you are using for business purpose, or you are having some asset which you are using for business purpose. If at all you use that asset, from that you are getting production, say you are getting goods you are selling, you are having profit. Okay, that profit is taxable at what rate? I repeat, I produce goods, I sell that, usme profit happens, that profit is taxable at what? Normal 30% rate. Normal what? 30% rate. But imagine I sold off that land and building only. If land and building is used, factory building is used, and I do production, I get goods, I'll sell off the goods, the profit is taxable at 30%. But if land and building is sold off, can I say it will come under capital gain? Then it will be taxable at 20%. So should I create a DTA DTL at 30%? Should I create a DTA DTL at 20%? Depends on how you're going to use it. If you're going to sell off the land and building, so I know I have to pay tax at 20%. So DTA DTL should also be as per 20%. But if I'm not going to sell off the land and building, I'm going to keep it for production wala purpose, then the tax will come at 30%. The DTA DTL will also be as per 30%. So can I say manner of recovery is how you are going to use it. Is it clear? Okay, now you have the tax rate, you had the difference, you multiply difference with the tax rate, you have a DTA or DTL, you record it, you account for that DTA DTL. Now question, if I'm recording a DTA, normally entry is DTA to PNL. Is it mandatory that when I record a DTA, difference will, opposite effect will go in PNL? No. Is it mandatory opposite effect will go in PNL? No. See, if DTA DTL is related to some item, if that item ka income expense goes in PNL, DTA DTL will also go in PNL. But if that item ka income expense goes in OCI, the DTA DTL will go in OCI. If that item ka income expense goes directly in equity, the DTA DTL will also go directly in equity. Did you understood? If related income expense comes in PNL, DTA deferred tax impact also comes in PNL. If related income expense comes in OCI, the deferred tax will also come in OCI. Simplest example, you revalued a fixed asset. Revaluation surplus comes in PNL or OCI? OCI. Now, when you do a revaluation, books mein asset went up, tax rate has not gone up. So, can I say I have to create a DTL? So, that effect of DTL, entry will not be PNL to DTL, entry will be OCI to DTL. Because item went in OCI, uska tax effect will also go in OCI. Clear? Now offsetting, you can offset if and only if you have a legal enforceable right and it is basically the same governing authority, then only you are allowed. Same taxable entity, and different taxable entity generally will not be allowed, but if the department allows you to set off to chalega, otherwise so DTA of parent, DTL of subsidiary can not be set off. Okay. Next is the practical application. This is a share-based payment transaction. Now tell me, under share-based payment transaction, Ind AS 102, we record expense over the vesting period. So we recorded employee benefit expense first year, second year, third year. Yes, no? Okay, but income tax people, they charge it to tax to employees. When they charge it to tax to employee, when they actually exercise, and they allow a deduction to us when they are actually exercised. So we booked expense over 3 years, but can I say exercised in 4th year, exercised in fourth year. Income tax people will allow us deduction only in fourth year. So can I say it will be allowed as deduction in future? So today I paid more taxes. Future I have to pay less taxes. I have to create ATA. Yeah, that clear? Now we book the expense what? We book the expense based on fair value of option. And remember I told you that whatever is the market price on the date of exercise is of no use. But department people will allow the deduction based on actual market price on the date of exercise. Department people will allow you deduction based on actual market price on the date of exercise. The books ka expense and what will be allowed as deduction. Can I say it can be different? It can be different. And there can be permanent difference. Like यहाँ पे we have expense 100, income tax में allowed you होने वाला है maximum 50. So there can be remaining permanent also. So check this question. So we understood DTA is to be created because books में expenses now, tax में it will be allowed in future. Future I have to pay less taxes. ठीक है. Now check this question 7. You have granted 1 CR के option worth 4 crore. The fair value of option is how much? And 2 years is wasting period. So can I say in your books, first year you book 2 crore, second year you book 2 crore. Books में first year is 2 crore, second year is 2 crore. ठीक है. तो books में expense is 2 crore in first year. Tax में it will come up allowed when? Future. ठीक है. तो I have to create basically DTA. So now we feel 2 crore books में it is today, tax में it will come up in future. So I will book a DTA on what? 2 crore, right? Okay. Now pay attention. Normally yes, but see the question. The tax law permits deduction at the time of exercise based on the value going on at the time of exercise, based on intrinsic value at the time of exercise. The intrinsic value of option at the end of first year is 1.6. What is the intrinsic value of option at the end of first year? Based on the rates going on under income tax, you are going to get a total deduction of 1.6. Then that's a total deduction. Total deduction 1.6 is for how many years? 2. So can I say income tax may for 1 year the deduction is 0.8. So I will get deduction 0.8 only in future. For the first year I'll be getting deduction how much? 0.8. Would I be getting 2? No, the 1.2. 2 minus 0.8. 1.2 is anyways permanent difference. So uske upar to no DTA DTL. So DTA DTL is only for 0.8 into 30%. DTA will be 0.24. If you check out solution, you'll find a DTA of only 0.24. I repeat, you might say, sir, books में 2 CR, but tax में 2 CR मिलने ही नहीं वाला है. Tax में you're going to get, based on the rates going on now, you're going to get a deduction of 1.6, and 1.6 is also for 2 years. So for 1 year it becomes 0.8. So books में for 1 year is 2, tax में it will be 0.8, but again in future. So, but 1.2, can I say 1.2 is permanent? Ignore it. So DTA, DTL is only on 0.8. At 0.8 pay, we are creating a DTA over here. It's 0.8 into 30%. Did you understood? Now, can I say books may again second year 2 expense? First year 2, second year 2. Now, second year tax may, now you see what is the intrinsic value? 4.6. So tax may it will be allowed total. Okay. Books में कितना है total? 4. Books में 4 है, वहाँ पे 4.6. Extra 0.6 is what? Permanent. तो उसके ऊपर no DTA DTL. And now books में 4, वहाँ पे 4 they are allowing now only. Second year end only they are allowing 4. So can I say now there should not be any balance of DTA DTL left? Last year we had created a DTA how much? 0.24. That you reverse it. So that 0.24 ka DTA is getting reversed. Did you understand? Okay, next question, question number 8 is good one. RTP November 18 and 19. Acha, suppose exercise is in third year. That's your question. Suppose if exercise is in third year, then our DTA should be there on full 4 crore. 4 crore ka 30% is how much? 1.2. DTA required is 1.2. Already 0.24 was created. So balance 0.96 will create now. And third year when they are exercised, it will get reversed. But यहाँ पे they are exercised at the end of second year itself. That's why there should not now be any balance of DTA. Okay, now coming to this question, question number 8. PQR, a manufacturing company, they prepare a consolidated financial statement. They were wholly owned subsidiary. They incurred some loss. Okay. They will be able to utilize the loss in future, but a parent or other group companies cannot use it. So loss of subsidiary, can it be set off against profit of parent? No. And we feel that this subsidiary will not have a profit in foreseeable future. Remember, for loss, if I want to create a DTA, there has to be a convincing evidence of future profit. If there's no convincing evidence of future profit, then in that case, should I create a DTA? No. So check the answer over here. No DTA can be recognized. Second question. We are committed to close a division. Okay, we are committed to close a division. We have announced we are closing a division. Yeah, restructuring provision. So can I say books may would have done a restructuring provision? Tax may it will be allowed only when you pay. The books may there is a liability. Tax may liability is not there. The book may liability has gone up. We should create a DTA. So check the solution. Second may DTA can be recognized. Third one. You have capitalized some development costs. So in your books, you capitalize 16 lakhs and the project started on 1st January. So can I say books may you capitalize, it started project, so 3 months you would have depreciated also. And now you will be depreciating over 5 years. Development expenditure is fully deductible under income tax. So books may you have an asset, tax may asset is 0. The book may asset is more. I should create DTL. So check out DTL is created. Fourth one, we borrowed some 1 crore rupees. Borrowing cost is 2 lakh. So can I say book may the loan will be 98 lakhs, but tax may loan will be 1 crore. The book may loan is less. Liability is less in books. We create a DTL. So check यहाँ पे DTL will be created. This is loan given or loan taken? No, loan taken. So liability books में 98. ठीक है, and this cost qualified for deduction on first. That's fine. Just a minute. Yeah. No interest was payable, but the amount is repayable this much. Effective annual interest rate is 10%. Acha. So if I want to understand first year end, what will be the loan in books? Day one it is 98. Can I say now interest effective interest rate is 10%? So plus 10% you do it. How much it comes? So book में the asset will be 98 plus 10%, it becomes 107.80. Tax में the loan is still 1 crore. Tax में the loan is still 1 crore. Books में the loan became 107. Interest is accrued. We have not paid. We are going to pay directly after 5 years. Interest accrues. We are paying directly after 5 years. So books में the loan has become 107. Tax में the loan is still 1 crore. So liability in books is more, that's why it is a DTA. Clear? Did you understand it, Aditya? Sure, because here the question is not DTA on first day. यहाँ पे the DTA DTL का question is on last day. Check the question you are asked. What will be the deferred tax impact as at 31st March 18? So last day the loan in books is 107,800. Tax में the loan is still 1 crore. Liability in books is. Then next question. Okay, now this is kind of a simpler question. We have some DTA, we have some DTL. Earlier tax rate was 40. Now the tax rate is becoming what? 45. If tax rate is becoming 45, you're going to have to bring the DTA, DTL at 45. So I can understand 40% is 80,000. So 45% will be how much? 40% is 80,000. So 45% is how much? Tell me how much? 90. So 10,000 DTA goes up. Same way DTL also goes up. But now thing is it goes up. When will the opposite effect go? Remember, if item is going in PNL, effect goes in PNL. If item goes in OCI, effect goes in OCI. Now uske liye they've given out of the DTA balance 80, 28 is temporary difference. This has been previously recognized in OCI. Okay, the 28 is going in OCI, and out of 80, 28. So can I say balance is 52? Yeah, 28 is OCI item, 52 is what? PNL item. Now I have to bring this were at 40%. I have to bring it at what rate? 45. Okay, so 40% was 28. So 45% will be how much? 40 was 28. 45 will be नहीं 31,500 तो can I say it goes up by 3500, so DTA goes up by 3500, but this effect will go in OCA. And now 40% was 52, so 45% will be how much? 58.5. So can I say this goes up by 6.5, वो 3.5, ये 6.5, total 10, 80 becoming 90. 3.5 related to item which has gone in P&L, that will go in P&L. 6.5 relates to item which has gone in, so 3.5 had gone in OCI and 6.5 had gone in P&L, this will go in P&L. Did you understood? So total DTL from 80 becomes 90. But 80 becomes 90, उसमें 80 का bifurcation if I want, 28 is becoming 31.5, 52 is becoming 58.5. Done. This is over. Next one, disclosures. The last point of this standard disclosure, they are telling only one. We are required to have a reconciliation. We are required to have a reconciliation which explains the tax, expense, accounting, profit in either or both of the following. Either or both. Now, imagine your book mein profit is 1 lakh. Book mein profit is 1 lakh. The tax rate applicable is say 30%. If you try to do 1 lakh into 30%, so can I say your tax comes 30,000? Now, current tax plus deferred tax together should match as 30,000. It will not match only when there is a permanent difference. So, reconciliation may the effect will come only due to permanent. If something was a temporary difference, because of that DTA, DTL is created automatically. If I say tax, current tax plus deferred tax, total mila ke it will match 30. When it will not match only when there is permanent difference. Okay, so check over here how to do reconciliation. One, I have to give reconciliation of tax expense, and second, I have to give reconciliation of tax rate, and I can give as per one of them or I can give as per both. Let's see a question, it will be more simpler. Okay, question number 10. Not question 10, this example I'm taking. Chalo. What is the book profit? 1 lakh. What is the tax rate? 30%. So can I say normally 1 lakh into 30%, the tax should come 30,000. Okay. Now in computing this, there is a penalty 10,000. Can I say penalty 10,000 is not allowable under income tax? Okay, the books may profit is 1 lakh, but penalty will be disallowed. So can I say tax may profit will be 110? Tax may profit will be 110. So 110 ka 30%. Actual tax will not be 30,000. Actual tax will be 33,000. Did you understood? Okay. Now if I go over here, accounting profit 1 lakh, tax rate 30%, tax is coming 30. So sir, why this is not matching? I am getting 30. Actually, it should be 33. So extra 3,000 is tax coming due to a item which is a part of permanent difference penalty, which is disallowed. 10,000 ka 30%. So tax effect of expense that are not deductible, penalty 3, and now it became 33. The book mein 1 lakh, uska 30%, it should be 30, but tax mate is actually 33. Why? You're showing a reconciliation. Okay, second is rate wise. Second is which wise? Rate. The tax rate is 30. Now you paid how much extra tax due to penalty? You paid how much extra tax? 3,000. 3,000 you paid extra on a book profit of 1 lakh. So can I say 3,000 you paid extra on 1 lakh? How many percentage? 3. So you add 3. Now average effective tax rate became 33%. Remember, you paid on 1 lakh 33,000. So this is tax rate wise. This is amount wise. Did you understood this reconciliation? And this question is important. There's a question related to that. Your profit as per books is 100. Taxable profit is 104. 100 is books profit. Tax profit is 104. Difference why it is there? One is due to some depreciation. Books may there is some depreciation. Tax may, remember, depreciation is for 6 months or full year, half year, full year. Wahan pe books may it can be 3 months also. So one is due to depreciation, and other 8,000 is due to donations which are not deductible under income tax. Okay, now depreciation, can I say it's a temporary difference? So that will get adjusted in DTA, DTL. But what will not be adjusted? Donations. Okay, so if you just see accounting profit is 100, donations which are not deductible will add, and there's some excess depreciation under income tax 4, so net taxable profit becomes 104. Now if I want to prepare a reconciliation, if I want to prepare what? reconciliation, what will happen? What is the tax rate given? 25%. Okay, the book pay 100. 100 ka 25% is 25. So if I just prepare, it is 25. But this is not matching. This is not matching with what? The actual tax. Why it is not matching? Due to permanent differences. Due to what? Permanent differences. Now permanent differences is how much? 8. 8. 8 ka 25% is 2. So now can I say because of that the tax expense will become 27. And if I want to match this 27, 27 will match. So we have a current tax of 26. How do we get 26? 104 into 25%. And because of depreciation, we have a deferred tax of 1, 4 ka 25%. So current tax is 26, deferred tax is 1, total tax is 27. So accounting profit is basically 100, uska 25% should become 25. So sir, why it is appearing 27 in P&L? It is due to this donation. If I want to go rate wise, so we have 25%. Okay, donation. Uske upar, how much you are paying extra tax? 8 ka 25%, 2 rupee. 2 rupee on a profit of 100. So can I say extra you are paying is 2%? So now your tax rate became effectively 27. If someone wants to match it, current tax 26, deferred tax 1, 27 is the tax on 100. It became 27. Did you understand this? This is a good question, important one. Done with this, going to the next one, Ind AS 21. I don't want to complicate it right now, so better is we discuss this after the class because it's not relevant for exam purpose. This is only one question given over here in ICI. They will not go here and there. They will stick to this thing. Otherwise, it will be more confusing currently. Okay, now moving to the next one, Ind AS 21, which is effect of changes in foreign exchange rate. Now, two things are there. One is foreign currency made transaction, and second is your foreign operation. When I buy goods in foreign currency, it's a transaction. But I have a subsidiary abroad. I have a branch abroad. They are all foreign operation. Two separate things. Now, this standard does not apply to foreign currency derivative or hedge accounting related to foreign currency. They all are covered under Ind AS 109. Okay, so now, first of all, whenever you have a transaction in foreign currency, first of all, the transactions are to be recorded in your books at functional currency. Now, functional currency is the currency of primary economic environment in which you operate. Functional currency is what? The currency of the primary economic environment in which you operate. Now, imagine you are in India, you are selling some goods, but the pricing of your goods is based on all US market. The pricing of your goods is all based on what? US market. Then in that case, for you, the functional currency is dollars. So you just have to see the primary economic market in which you are operating. That is basically to be seen. So over here, it's a primary economic environment in which the entity operates. And this is not the currency in which the transactions are there, but the currency which determines the pricing of the transaction. The transaction कौन सी currency में वो मत देखो. The transactions का value are determined by which economic environment. Okay, fine. This is basically there. For that, certain indicators are given. It's not relevant. I'm just moving ahead. Now, how do I account? How do I account for a foreign currency transaction? Whenever you enter into a foreign currency transaction, you sold goods, you purchased goods, you took loan, you gave loan. It should be recorded at the rate prevalent on the date of transaction. So I sold goods today, I'll record debtors to sale based on today's rate. Okay? So it is at the rate prevalent on the date of transaction. But now it will be first recorded in which currency? Functional. Now the problem is, imagine your company is in India, but for you everything is based on US market. If everything is based on US market, then can I say for you the functional currency is dollars? So the financial statements, all that things, first the figures will come in dollars. Now can I give balance sheet to basically our ROC in dollars? No. So then that functional currency is to be converted into presentation currency. Functional currency is the currency of primary economic environment in which you operate. Presentation currency is the currency in which you are presenting financials. First, they are converted into functional currency. From functional currency, if presentation currency different, you convert into presentation currency. Fine. Now, so initially they're recorded at a rate prevalent on the date of transaction. Sometimes if you have a lot of foreign currency transaction, you may use an average rate of a week or average rate of a month also. That is also allowed. Now, then there's a classification of monetary and non-monetary items. Monetary items are those whose value to be received or value to be paid is fixed. Debtors, creditors, loan, they are all which item? Monetary. I know how much I have to receive or I know how much I have to pay, okay, in any currency, but I know how much I have to receive or pay. They are all monetary items. But your PP, your intangible assets, your inventory, they are all which item? Non-monetary. Now, monetary items are to be brought to its which rate? Closing rate. So, year-end pay, the monetary items are to be brought to closing rate. Non-monetary item will continue at what? Historical rate. They are not to be brought to closing rate. But if I have a non-monetary item which is valued as per fair value, remember in PP we can have a revaluation model. So PP is revalued, it is in foreign currency, $50,000, and now it is valued at $60,000 into the rate prevalent on the date of revaluation. The rate prevalent on the date of revaluation. Then you don't continue the original rate, then you have to take the rate on which the fair value is determined. The rate on date of which the fair value is determined. Otherwise, only monetary item are brought to closing rate, non-monetary are not brought. But if non-monetary are at fair value, the fair value will be based on the rate prevalent on the date when the fair value is determined. Now, sometimes you get a value of an asset by comparing two things. Inventory may cost or NRV, whichever is lower. Yes, no? Okay, so now what should I do? Should I compare cost in foreign currency, NRV in foreign currency, and then compare? Or I should convert cost in INR, NRV in INR, and then compare? So cost, NRV both in foreign currency I compare, or cost I convert into INR, NRV I compare into INR and then compare? Answer is no. Cost you convert into INR, cost will continue at which rate? Historical. NRV you convert into INR, NRV is nothing but estimated selling price, kind of fair value. NRV is today, the NRV may you will take today's rate. So cost will continue at original rate, NRV will be based on today's rate. Now both figures are in INR, now you compare. Did you understood? See the line written, cost and NRV should not be compared in foreign currency, but they should be compared after converting into functional currency. But cost will be converted at historical rate only, NRV will be converted at the rate prevalent on the date when you are determining NRV. If you are determining NRV today, it will be today's rate. So cost $5,000 into what was the rate when you bought? NRV, let's say for example $4,000, but into today's rate. So now you have cost in INR, NRV in INR, and now you compare it. Clear with this? Okay, recognition of foreign exchange gain or loss. Okay, monetary item you brought to closing rate. Can I say gain loss will come? That gain loss always goes where? PN. Non-monetary item. Non-monetary item. Gain loss is recognized in. I'm saying normally for non-monetary item, can I say we don't have to bring it to the closing rate? If I don't have to bring it to closing rate, can I say gain loss does not come? When does gain loss come in then? It's only if at all they are carried at fair value. If they are carried at fair value, then only the gain loss will come. So if their fair value goes in PNL, the exchange loss ka gain loss will also go in PNL. But if their fair value change goes in OCI, like PP revalued upward, that's revaluation surplus, where that will go OCI. So now that exchange rate may be difference, whatever will come, that will also go in OCI. So normally non-monetary item gain loss doesn't come only, but if they are carried at fair value, gain loss will come. If the normal thing goes in PNL, exchange gain loss will also go in PNL. Normal thing goes in OCI, exchange gain loss will also go in OCI. Check example over here. You have one PP which is as per revaluation model. Can I say there is a non-monetary item at fair value? Okay, cost is USD 10,000. When you purchase, it was 60. So first day the building recorded at 6 lakh on the date of transaction. Later on, revaluation model, now it became 12,000. And $12,000 into which rate should I apply? The rate prevalent on the date of fair valuation today. Today rate is 75. So can I say now it became 9 lakh? So 6 lakh becoming 9 lakh, total 3 lakh, full 3 lakh goes in OCI. Now in this 3 lakh, some change is due to rate. How you found some change is due to rate? The total full 3 lakh is not increase in value. There is some increase in value and there is some increase in rate, but both has gone in OCI. Did you understood? Okay, now this question is very important. You have a loan taken in foreign currency. ठीक है, 6 million FCY is the loan, and there is a issue cost. Loan taken का cost is what? 2. And remember, 6 million is 60 lakh. So 60 lakh FCY is the loan. Loan processing fee is 2 lakh. So can I say in your book the loan is 58 lakh FCY? The book mein loan is 58 lakh FCY, and loan is repayable at premium. Effective tax rate comes as 12%. If I want to understand in FCY, opening loan is how much? 58 lakh. Now plus interest will accrue. Okay, how much is interest rate given? 12%. What is 12% of 80? This 58 lakhs? 696. Okay, and I might be making some payment. Let's see if we are making some payment. Interest of 6 lakhs is payable annually. I'll be paying 6 lakh FCY. So minus we pay 6 lakh FCY, and now can I say this is the closing loan? How much? 5896 FCY. Now if I want in INR, opening loan will be converted at the rate prevalent on the date of transaction. What is the rate when I took the loan? 2.5. Interest will come at average rate. What is the average rate? 2.4. I paid some money. When did I pay the money? When did I pay the money? Last day, end of the year. So take closing rate 2.75. Okay, so find out what is the loan coming. 58 lakh into 2.5. This is coming 145. Interest 696 into 2.4. 1670400, and 6 lakhs into 2.75. This is coming 165. 4 times 0. What is the loan coming? 1670400 minus 1450000. This is coming 14520,400. But now loan is a monetary item. This is to be brought to which rate? Closing. The closing rate is 5896 into 2.75. What is 5896 into 2.75? 1621,400. Okay, and your books mein it is this, it should be this. What is the difference between both? Books mein it is 145, it should be 162.14. Difference is coming 16 lakh 93,000. That's a exchange loss which will go in your PNL. So check the solution over here. I just directly go to the last line. You'll find 16 lakh 79,680. So day one loan was 58 lakh. It came at opening rate. Interest accrued, it came at average rate. You repaid something, it came at closing rate. Now you have a loan in your books 1 crore 45 lakh. But in FCY, I have to bring it at closing rate. It should be at 1 crore 62 lakh. It is at 1 crore 45 lakh. Difference 1679 is your exchange loss, which will go in your P. Okay, next question is also very good. This question is also there in your Ind AS 109 as well. Now we have purchased bonds. Okay, we have purchased bonds. So can I say this investment in bonds? Purchased bonds, not issued. Investment. How much? 1,000. Bond is giving an interest at 4.7% on what? Face value. Face value is 1250. So would I get interest 1000 into 4.7%, or would I get interest 1250 into 4.7%? I'll get 1250. But accounting wise, we don't do that. Accounting wise, we follow effective interest rate. The effective interest rate they would have given somewhere is 10%. The effective interest rate is I bought at 1000, 1000 का 10% is interest income. So in your books, first 1000, interest accrued 10%, 10% of 1000, 100. You received how much? 1250 into 4.7%. 59 you received, and now can I say this is the value of bonds in your book? This is all in which terms? Dollar terms. Day 1, 1000, interest accrued, effective interest rate. How much is interest accrued? 100, 10%. I received how much? 59, and this is the closing. Now opening, when I invested, it's at opening rate. Interest accrued is at average rate. I received on last day, it's at closing rate. So in my books, it is coming 41545. Did you understood this? 41545. But now can I say I have to bring it to which rate? Closing rate. So 1041 I bring at closing rate 45. So can I say now it becomes 46845. 41 becoming 46845. How much is the difference coming? 5000. It's your exchange gain which will go in P&L. It's an exchange gain which is going in P&L. Yeah, the clear? Now another thing. The bond which you have purchased. It meets the FBT OCI category. So bond which we have purchased, we might not be holding till maturity. We may sell off in between. The as per Ind AS 109, it will be fair value through OCI. So now fair valuation is 1060. Fair valuation is 1060. So 1041 becomes 1060. So can I say 19 increase? That 19 into 45. So can I say now it will be 47,700 total? 1060 into. So 41 became 46 was only due to exchange difference. But now this 46 is becoming 47. That is due to revaluation, and that is going in OCF. So this goes in P&L. This goes in OCI. Did you understood? The first part went in P&L, exchange difference. Second part went in OCI. Okay, so there is some gain in P&L is this, and there is a difference gain which is coming in OCI is this. Next is net investment in foreign operation. Now what is this net investment in foreign operation? Net investment in foreign operation is sometimes I have a monetary item. I have given a loan to subsidiary. I have given what? Loan to subsidiary. Remember, loan is a monetary item. But now that loan given to subsidiary is such that the repayment are not stipulated, and for a foreseeable future I feel the loan will not be coming back. So can I say it is in effect a net investment in subsidiary? In effect it is a net investment in subsidiary. Okay, it's a monetary item. I'll bring it to which rate? Closing. SFS mein when you bring it to closing rate, the difference will go where? In P&L. But in CFS, when you bring it to closing rate, you can't have that. You can't say I have a loan to subsidiary. First of all, loan to subsidiary only will go away. CFS mein. Now CFS mein loan to subsidiary will go away, but uska exchange gain loss tha na, that will not go away. That exchange gain loss was in P&L in your SFS, but in CFS it will not be under P&L. In CFS it will be going under OCI. So whenever monetary item forms a part of net investment in foreign operation, SFS mein gain loss comes in P&L, but in CFS it will come under OCI. Did you understood? Shall I move ahead? Now, if presentation currency is other than functional currency, when I say first of all figures were converted into which currency? Functional. Now I have to convert into presentation. How do I convert? All assets and liabilities are at closing rate. All incomes and expense are at average rate. Difference will come in OCI like a foreign currency translation reserve. Did you understood? Same way, if you have some foreign operation, foreign branch, foreign subsidiary, so their figures are in dollars, are to convert it to INR. How they are to be converted? Same way as the change for functional to presentation currency, means all assets and liabilities are at closing rate, income expenses are at average rate, difference goes in OCI, and difference will be removed from OCI, gone to P&L whenever that subsidiary is sold off. Okay. Now difference in reporting dates. Imagine parent has a year ending of March, subsidiary has a year ending of December. Subsidiary का December है, मेरा March है. Remember, if 3 months gap is there, it is allowed. So I am adding the figures of subsidiary which are of, I am adding a figure of subsidiary which are of December. But now subsidiary is abroad, so उनके figures are of December. They will be converted into INR at December's rate or March rate. Balance sheet is prepared in March, but their figures are of which date? December. So now when I am preparing a consolidated balance sheet, their figures are coming. December figures are coming. But question is, should it be converted into INR at December rate or March rate? Answer is December rate. Because the figures are of December, it should be converted at December rate. So it should be the exchange rate at the end of reporting period of foreign operation. Foreign operation ka what is the reporting period? December. So December ka rate has to be taken. Next is intra-group transaction. Now see, whenever there are intra-group transaction, parent sold to subsidiary, subsidiary sold to parent, so what will happen is that debtor creditor will go away. But the debtor creditor, whichever was brought to the closing rate, uska exchange difference will not go away. What will go away is debtor creditor. Exchange difference on it will not go away. Let's see a question. So, intra-group balances are eliminated. Related foreign exchange gain loss will not be eliminated. Check over here. Parent P functional currency USD, subsidiary is a euro, and parent P has given USD 100 to S. Parent P has given how much rupees? USD 100. Now pay attention. So parent P USD 100 is given to them. Now subsidiary is getting USD how much rupees? 100. Now parent ke liye USD is the functional currency. Subsidiary ke liye which is the functional currency? Euro. But subsidiary got what? Dollars. So subsidiary has to convert the dollars into euro. Subsidiary has to convert the dollars into euro. So they got it on day one. Day one is 1.5. $100, 150 euros. Day one they recorded bank to loan. Bank to loan. Now when I say loan, they have to bring it to closing rate. So they will bring the loan to closing rate 2 rupee. So 200 ho gaya. So 50 rupee is the exchange loss booked. Okay, so now if I ask you in subsidiaries book, how much is the loan? 200 euro. How much is the loan in subsidiaries book? 200 euro. Now, if you remember, when parent is consolidating, subsidiary ke figure, assets and liabilities will be converted at closing rate. 200 euro divided by 2, so can I say it becomes $100? And then that liability, $100, and back they had given a loan, asset $100 are getting knocked off. So once it became 200, closing rate say it gets converted at $100, then that is getting knocked off, but this 50 exchange loss will not be knocked off. So what is knocked off is, the intra receivable payable gets knocked off, but the exchange difference related to it is not getting knocked off. Okay, just 1 minute. Yeah. Okay, now check this question. This is important. One complication is also there over here. Actually, this is not solved correctly in ICI book, but exam purpose I'll again recommend do what ICI does. Okay, now pay attention. M limited. If you have your book, please keep this open in your book so that you're able to understand ICI has done what. So we might be required to make changes in our book. Now, M Limited is manufacturing bottles. They are a pharma company. They have a wholly owned subsidiary what? G. They have wholly owned subsidiary G. Okay. The demand of G is very high and the foreign operations are there. G purchases bottle from M as well as other companies. Fine. Purchase are made at competitive rate. Okay. Who is the parent over here? M. And subsidiary is G. Okay. Parent sold some bottles to G 12 lakh euro. Parent sold bottles to G. What rate? Cost of bottle is 830 lakhs. Okay. Parent is in India. Subsidiary is abroad. So parent sold how much? G को 12 lakh euro में and the cost of bottle is 830 lakhs. ठीक है. The parent will record sales. What rate sales will be recorded? 12 lakh euro into 83. Day one they will record a sales at 12 lakh euro into 83. 3. So what is the sales amount coming? 980, 996. They recorded a sales 996. Fine. Cost is 830. Okay. At the year end, all bottles are lying in stock with G. So can I say now the bottles are in stock with whom? G. Question is, how should be the accounting treatment? Question over here is, what will be the unrealized profit? Now, practically what will happen? I tell you. They purchased bottle. They will have 12 lakh euros only. They will have what? 12 lakh euros only in their books, and for them the functional currency is euro. They will continue everything in euro. In their books 12 lakh euro is inventory. Now when we have consolidating, can I say their figures will converted, and if you remember, assets and liabilities are converted at what rate? Closing rate. So the 12 lakh euro inventory will 12 lakh euro will come in our books at 85. So 12 lakh into 85, how much it comes? 1020. So inventory is coming back at 1020 in your CFS, but can I say in this our profit is there? So I need to remove the profit. Now how much is our profit? If I try to understand, when I sold, rate was 83 going on and my cost was 830. Rate going on was 83 going on and my cost was 830. So can I say total 10 lakh euro was my cost? My cost was 10 lakh euro. I sold at 12 lakh. So can I say I made a profit of 20% on cost? I made a profit of 20%. Now 1020 is not cost. 1020 is what? Selling price. So cost pay 20%. On selling price, the profit is 20 by 120. So I used to say over here, cost pay basically is 1020. 1020 is there. Cost pay 20, sales pay into 20 by 120. Unrealized profit has to be 170. But this is what we do. ICI may this is different, and ICI may actually it's a wrong thing according to me. What ICI has done is they are telling the inventory will be valued at cost or NRV, whichever is lower. Inventory ka cost. Inventory ka cost. Now they continue inventory ka cost as 83 pay, but they don't understand it's a foreign operation. If it was a foreign currency transaction, it was understandable that inventory cost is at 83, NRV you are determining today, it will be based on 85. But this is a foreign operation. Okay, all assets and liabilities will come at what rate? Closing. So actually inventory will come to you at 1020. Now many people what they do, it comes at 1020. Our cost was 830. So what is 1020 minus 830? 190. If they remove 190 profit, to bhi chale. But what ICI has done is, they say that inventory, if I open up ICI solution only, it will be more easy for you to understand. And the thing is, every material of ICI answer changes. The first edition and third edition, the answer will be different. Module, this is the latest edition. Which is this unit number? Chapter 10, unit 2. And what's the name over here of the company? I'll write pharma, it will be easy. Pharma. Okay, yeah. M and this pharmaceutical 83, 85. Can I say the same question? Okay, 83, 85 euro, same. And you sold 10 lakh euro at 12 lakh, cost was 830 lakh. Now just going down, they say inventory will be valued at 12 lakh euro, cost is 83. Assuming NRV is same 12 lakh euro, but now it is 85, so NRV will be 1020. Okay, now cost or NRV, whichever is less, so they're telling your closing stock will be 996. Practically, it will not be 996. Reason, it is 12 lakh euro in their books. It will come in our books at closing rate. All assets, liabilities come at closing rate. So actually, in our books, it will not come at 996. It will come at 1020. But they say it will come at 996. Our cost was 830. Profit is 166. It will come back at 996. Our cost is 830. Profit is 166. Actually, this is wrong. But if exam mein question comes, sir, what do I do? Please do whatever is done by IC. Yeah, if at all we have a different answer in our book, just write over there, refer ICAI material. If you want the page number of ICAI material, it's 10.96, the latest edition. 10.96 is the page number of ICAI book, latest edition. Now, I'll come to another question which is a bit different. This question, parent sold to subsidiary. So can I say stock is lying with subsidiary? And it will come in our book, all assets and liabilities of subsidiary are converted at closing. But imagine if subsidiary sold to parent. If subsidiary is sold to parent, the inventory is lying with parent only. If inventory is lying with parent only, I've already recorded in INR, it will continue at historical rate. I sold to them, they have inventory, their assets and liabilities will come at closing. But if they sold to me, inventory is with me only. Day one, I would have recorded the rate prevalent that time. And for me, now this is not unke operations coming. Now it is inventory with me only. So now I don't have to bring it to closing. If subsidiary had sold to parent, if subsidiary had sold to parent, then in that case, inventory will continue at 996. If subsidiary had sold to parent, parent would have recorded at 83. And parent ki book mein inventory is not to be brought to closing rate. Parent ki book mein inventory is not to be brought to closing rate. So inventory will continue at 996 and now cost was 830. Then this answer would have been correct. This answer would have been correct if subsidiary had sold to parent. But if parent sells to subsidiary, subsidiary's book there is a 12 lakh euro. They all assets are coming at which value? Closing rate. Remember, for foreign operation, all assets and liabilities come at which rate? Closing. So inventory comes at 1020 and now you have to have 1020 minus 830. So then you should have 190. So this answer is correct if subsidiary would have sold to parent. Okay, now just coming over here, यहाँ पे they've given journal entry, it will become more simple for you to understand. You sold at 12 lakh euro. You will record that the rate prevalent on the date of transaction, G limited to sales 996. Now G limited is actually 12 lakh euro you have to receive. So can I say you have to bring it to the closing rate? Okay, the closing rate is what? 85. So 12 lakh, 83 became 85, 2 rupee. So exchange gain is 2 rupee. So G became 996 plus 24 is 1020. Now what will happen is, this is basically 1020 receivable. Now in G's book, can I say they have a payable? They were payable 12 lakh euro. Their all liabilities come at which rate? Closing. Closing rate is 85. So liability will come at 1020. Asset is 1020. That gets knocked off. This 24 exchange difference will remain. Clear with this? Okay. Now let's go to the next question. One more thing before that. Whenever I acquire a foreign subsidiary, whenever I'm acquiring with subsidiary, foreign subsidiary is there, and now goodwill I find out. Okay, so would I find out goodwill in the foreign currency or would I find out goodwill in Indian currency? If I acquire a subsidiary which is abroad, so goodwill will also be found out in foreign currency. Goodwill will also be found out in which currency? Foreign. And one more thing, goodwill which we found out in foreign currency, they say it will be regarded as a part of asset of that subsidiary. If it is regarded as a part of asset of that subsidiary, the asset of the subsidiary come in our books at which rate? Closing rate. Every year it will come at which rate? Closing rate. So every year goodwill value will change. Every year what will change? Goodwill value will change. So see, goodwill will be treated as an asset or liability of what? Foreign operation. So any goodwill or fair value adjustment, they are treated as a part of assets liability of foreign operation only. Okay, and they will be converted into this at a closing. All assets liabilities come at closing rate. Now see this question. Global Limited, Indian company. They have 70% in mark. Okay. Now the fair value of mark of net asset is 23. Consideration paid is 17.5. Okay, so now first of all we'll find out the goodwill in which currency? Foreign currency. See, you have net asset coming 23. You are paying 17.5. NCI comes 6.9. Difference is goodwill 1.4. In which currency? Foreign. every year this goodwill will be converted at closing rate. The goodwill on balance sheet date will be 1.4 into closing rate 84. Mila, did you understood? Okay, so here goodwill will keep on change. Okay, now second question. Mark sold goods to Global. Okay, who is selling goods to? Subsidiary to parent. Subsidiary sold goods to parent. How many million? Costing 2.4 at 4.2. I purchased at 4.2 million. What is the rate on the date when I purchase? What is the rate on the date when I purchase? Which date is purchased? Not given. Average rate you take it. Purchase. Achha, date of purchase exchange rate given is 83. Okay, so 4.2 into 83. I'll record at 348.6. Okay. Now, in my books, I purchased inventory from you. It's not for an operation now. I just purchased inventory. It's there in my books. My purchase is 348. Now, year end, can I say I have to value the inventory at cost or NRV, whichever is lower? My cost is 4.2 million. NRV, if I assume same only 4.2 million, and now the closing rate has increased, so it will continue at the same rate. If it inventory was lying over there, it will come in my book at closing rate. But yahan pe inventory is with me only. I don't have to convert to closing rate. Remember, inventory is a non-monetary item. We don't convert at closing rate. So yahan pe it will continue at the same amount. Now it is continue at same amount. So now what do I do? So how much is the profit element over here? The profit element over here is 2.4. They sold at 4.2. 2.4. They sold at what rate? 4.2. 2.4. They sold at 4.2. 1.8 into the rate which was going on only, because the inventory is same in my books. So into the rate 83, you will find unrealized profit is 149.4. Did you understood? See, if inventory is in my book only, it continues at the same rate. If inventory is in their book, there is a foreign operation, there all assets and liabilities come back at which value? Closing. So this question and last question is different. This question, subsidiary sold to parent. Last question, parent sold to subsidiary. Okay, appendix, last point of this standard, advance consideration. Imagine customer paid you advance, or for purchase of goods you paid advance to customer. So whenever advance is paid in foreign currency. Imagine when you're paying, the dollar rate was 70. Okay, after 2 months they give you goods. If after 2 months they are giving you goods, can I say record purchase after 2 months? Okay, the purchase is recorded after 2 months. Normally we record purchase at the rate prevalent on the date of transaction. But whatever advance was paid now, continue purchase for that at same rate. The advance diya at that time rate was 70. Actual purchase happened, rate is 72. If 100% advance was given, to continue purchase not at 72, continue purchase at 70. If advance was less given, to the extent advance given, purchase is at 70. For the remaining amount, the purchase is at 70. Did you understood? For the advance which was given, the rate of purchase sale will continue same. The exchange rate to be used on initial recognition of asset, expense, income should be the rate on which the advance was received or paid. Check question over here. You enter into a contract with customer. Total is 50 million. You receive upfront how much? 20. Okay. And the goods are delivered. 20 million you receive upfront on January. And the functional currency INR, goods are delivered in March. And 30 million April, May it is received. Advance ke din, 1st January the rate was 72. And 31st March the rate is 75. So when I am booking sales, 50 million, how much advance was received? 20. For the advance which was received, can I say I would have passed entry as bank to advance from customer? Okay. Now when I am making sales, can I say it is debtors debit? Okay. Advance goes away. Advance goes away and to sales. So this was 20 million. What was the rate when I got on 1st January? 72. 20 into 72. Is it coming 1440? Okay. Now 31st March we are giving the delivery. Okay. Advance goes away 1440. Debtor is 30. Today's rate. What is today's rate? 75. 30 into 75. 2250. And sales 20 into 72 only continued, and 30 into 75. This is the total. What is the total sales coming? 3690. For the portion advance received, the sale is recorded at the same rate. The full 50 is not at today's rate. Whatever was basically earlier, that rate is continued. Same for the extra 30 will take today's rate. Yes, no? Next one we are having chapter number 11, unit number 1. Yes, please. 3 more standards. 8:30. Yeah, difference goes in OCI. Foreign operation, foreign operation translation. This is nothing but foreign operations translation. Okay, next one is chapter number 11, unit number 1, Ind AS 24, which is what? Related party disclosure. Keep smiling. Okay. First of all, who is a related party? Related party is either a person or an entity which is related to the reporting entity. It's a person or an entity which is related to the reporting entity. Now, when do I say a person is related? When do I say a person is related? The person has a control, joint control, significant influence over the entity. I repeat, the person has a control, joint control, significant influence over entity, or a person is a KMP of the entity or parent. So he has a control, joint control, significant influence over the entity, or he is a KMP. KMP kahan pe wo? Either in the entity or parent. So then that guy will be related. If that guy is related, uske close family members are also related. If that guy is related, the close family members are also related. Who are the close family members? Father, mother, brother, sister, spouse. Your children are there. Domestic partner is also included. And children of domestic partner and spouse. Like you married second time, they also might have married second time somewhere else. So unke jo kids hai na, they are also your related parties. But just one thing, the father, mother, brother, sister of theirs, spouse ke father, mother, brother, sister, they are not your relative unless they are dependent. So your father, mother, brother, sister, spouse, your children, your domestic partner, and your spouse or domestic partner's children from somewhere else, they all are related party. But the thing is, the father, mother, brother, sister of the spouse, or father, mother, brother, sister of domestic partner, they are not your related party unless they are dependents. ठीक है. So when do I say person is related? If he has a control, joint control, significant influence over the entity, or he is a KMP of entity or parent. ठीक है. And their close family members are also related. Now when do I say another entity is related to me? When do I say another entity and I am related? So one, we are a part of same group. Same group is parent, subsidiary, fellow subsidiaries. This doesn't include associate and JV. ठीक है यहाँ पे. Second, one entity is associate or JV of reporting entity, other entities, or of the other entity of group. Okay, so my associate JV, my group members associate JV, they are also my related party. My associate JV, my group member. Group is what? Parent, subsidiary, fellow subsidiary. Unke associate JV, they are also my related parties. Third one, both the entities are joint ventures of third party. Okay, there is A Limited. A Limited holds 50% in B. A Limited holds 50% in C also. So can I say B is a joint venture where A is a there? C is also a joint venture of A. So B and C will also be related. Can I say both are the joint ventures of same entity? Okay, now actually for C, D and F, for C, D, F I had given a simple thing. Remember, one place there is control, joint control, significant influence or KMP, entity or parent. opposite has to be control or joint control. So suppose there is A Limited and now यहाँ पे B and C. So whether B and C are related, so one place there has to be control, joint control. Other place there can be control, joint control, significant influence, KMP. Okay, now just a question. There is A Limited, B and C. Okay, he 30% in B, 30% in C. Whether B and C are related? No. One place is significant influence, opposite is also significant influence. Then B and C are not. One place has to be control or joint control. Other place can be control, joint control, significant influence, or K. These are basically your B, C, F. Sorry, not B, C, F. C, D, and F. Okay. Now E. The post-employment benefit के लिए entity is created. Like Infosys created Infosys Gratuity Trust. The Infosys Gratuity Trust will be a related party of Infosys and all other related parties of Infosys. So whichever entities are related to Infosys, to them also Infosys Gratuity Trust is a related party. Okay, sixth one is also covered over there. Seventh one, any entity or a member of group, which is a part who provides a KMP services to the entity or now see sometimes KMP services are provided by someone else. Who is providing services of KMP? Entity. I have hired one company, that company provides me board of directors. So I am not appointing individual directors. I have appointed a company who appoints directors and manages my company. So that company which is appointed to give me KMP services, that company is a related party to me. If they are giving KMP service to me or they are giving KMP services to my parent, they are related party. Okay. Now check over here the question. The question is actually this. There is P, subsidiary, they have SA, SB. SB as a subsidiary SC. P as associate A, and A1, A2, and SC as associate A3. Okay, now who are related party for everyone? First of all for P. Who are related party? So first of all, member of the group are related party. Group includes what? Your parent, subsidiary, fellow subsidiary. So who are the subsidiaries of P? A, SA, SB, SC. A point mein these three are covered. Second, they've written associates and JV. Associates JV of not only yours but also of your group member. So associate JV of yours and associate member JV of group member. Can I say sab aa gaya? So for P, everybody is related party. For P, who is related party? Everybody. Now think from SA angle. For SA, SB, SC. For whose angle? SA, SB, SC's angle. Okay, for SA, SB, SC, who are the members of the group? Parent P is covered. Subsidiary we don't have. Khatam ho gaya. Fellow subsidiaries are SB, SC. They are all fellow subsidiaries. So actually, if I talk for SA, parent, and these are the fellow subsidiaries. This all covered. Second point says your associate JV or your group members associate JV. So parent ke associate JV, my group member, fellow subsidiary ke associate JV. So can I say everybody is covered? So related party for P is everyone, related party for SA is everyone, related party for SB is everyone, related party for SC is everyone. Now let's go to related party of A. A1. Who is the related party of A1? The question comes first, A1 and A2, are they related party of each other? Okay, so now if you see यहाँ पे P holds 30% in A, P holds 30% in A2. P holds 30% in A1, P holds 30% in A2. So can I say it's nothing but one place is significant influence, other is also. So A1, A2 are not related to each other. Same way A1, A3 are also not related to each other. So who is not related? A1, A2, A3 are not related. A1, A2, A3 are not related. All others are related parties. So for A1, my parent, related party. Subsidiary, associate, these are also related. Why these are related? Because यहाँ पे P has a control, यहाँ पे they have a significant influence. One place control, one place significant influence covered. So for A1, A2 and A3, who are the related party? P, SA, SB, SC. But A1, A2, A3 are not related to each other. Next one, you have a director. This is fine, not sitting fees wala question, simple. Okay, now Mr. X has 100% investment in A and is a KMP of C. So Mr. X 100% investment A and KMP of C. So can I say one place he has a control, other place he is a KMP. Remember, one place control, joint control, other places control, joint control, significant influence, KMP. So can I say A and C are related? Okay, now second case. B has 100% investment in C, that's fine. Now second case, examine related party relationship of C for A if X is a KMP of whom? B. Okay, X is not a KMP of basically C, X is a KMP of B. But can I say B is a parent of C? B is a parent of C. KMP of yours or KMP of parent is also fine. So what happens over here? One place is control, other place is a KMP of parent, then also they will be A and C will be related. You are not KMP in C, but you are a KMP of parent of C. Okay, now what if there is a joint control over A? Okay, you don't have a control over A, you have a joint control. यहाँ पे joint control, यहाँ पे KMP. So one place joint control, other place KMP, fine. But what if he has a significant influence? यहाँ पे significant influence, यहाँ पे KMP? No. Then no. One place has to be control, joint control, other place has to be control, joint control, significant influence or KMP of the entity or parent. Then this is fine. Now, who are not related parties? If both the places KMP, then they are not. The common directors, if I have, they are not related parties. Both the places significant influence, they are not related parties. Second, two venturers, A Limited, B Limited, they formed AB Limited. So A and B are called as what? Venturers. They are not related to each other. They are not related to each other. But agar ye opposite hota, what is opposite? There's a company called AB Limited. They have a JV called as A and they have a JV called as B. So can I say AB Limited has a joint control over A, AB Limited has a joint control over B. So one place joint control, other place also joint control, fine. So then A and B are related. Okay. Next, a provider of finance, trade union, major customer, major supplier, sole distributor, they are not related party just because of your business relationship with them. So they will not be regarded as related party. Related party transaction is nothing but a transaction with the related party, whether you are taking money or not. Now, disclosures, related party disclosures, category 1, category 2. Category 1 disclosure is you have to disclose the relationship, whether transactions are there or not. Category 2 disclosures, you have to disclose the relationship only when there are transactions. So category 1 mein you have to disclose the name of parent, ultimate controlling party, whether transactions are there or not, you have to disclose. Category 2 mein one I have to give disclosure about compensation of KMP. KMP ko whatever compensation I am paying, usme bifurcated into all short-term benefit, long-term benefit, retirement benefit, everything. That way. And second, transactions. If I have a transaction with someone, then only their relationship is to be disclosed. So when I have any transaction, you disclose what? One, the nature of relationship and the transaction with them. Nature of relationship and transaction with them is to be disclosed. Okay, this is fine. Now I just go down. There is one last point, exemption to government related entity. Now pay attention. There is a government, there is A Limited, there is B Limited. Suppose यहाँ पे there is a control or joint control. यहाँ पे there is a control, joint control or significant influence. So can I say this both are related to each other? Normally they are related to each other, but they will be exempted from disclosure requirements. They will be exempted from. So just because a government is having control at both the places, or one place control, joint control, significant influence, other place control, joint control, so you become related party just because government is holding in both the company, you are exempted from disclosures. So you are exempted from disclosure between whom? Between you and government, and between all such entities where government is having control, joint control, both the places. Okay, so check over here the question given. You are exempted over here from disclosure, but still they have given you are required to disclose the name of government, nature of relationship with government, and you are required to give detail about individually significant transaction. Which transaction? Individually significant transaction. And sometimes individual transaction are not significant. You can just have the significant when they are aggregate. Otherwise, you are exempted. Okay, now government G. I go to the table. Government G controls entity 1, entity 2, and this all also. So can I say this all entities are related to each other? Why? Because government controls. So now this all as such are related party, but all these entities are given exception. Now think from entity question में entity A. Think from entity A's angle. Entity A's angle, your transaction with government are exempted from disclosure. Your transaction with entity A1, B, C, D2 all are exempted, but your transaction with Mr. X, the KNP of your parent, that is not exempted. Exemption is given between two entities, both are under that control, joint control of government. वहाँ पे entity को exemption. But if I have a transaction with Mr. X, who is Mr. X? KMP of my parent, that is not exempted. Government owned entity is your so that is what they're telling, government or government owned entity you're telling. Imagine यहाँ पे government की जगह it is NMDC Limited. This is your question. The government owned entity is having control like this. So this all are treated to be all government entity only. So still it will be the same way it is there. Only thing is transaction with Mr. X is not accepted. The answer will remain same. Entity providing board of directors. See, you are asking from government wala angle or normal angle? Normal. So entity which is providing a board of director, they are a related company if they provide a board of director to me or they are providing a board of director to my KMP, to my parent. So यहाँ पे mix मत करो, it will be better, you will get confused. Okay, going to the next one. Last two standards, come on. Ind AS 33 and 108. Otherwise, tomorrow will not be able to finish. Max 30 minutes. Okay. Now EPS, earning per share. Now tell me, this EPS is from whose angle? Is it from all shareholders angle or only ordinary shareholder angle? Ordinary. So we want profit attributable to ordinary shareholder divided by weighted average number of equity share. Profit attributable to ordinary shareholder. Now I have a question. Profit coming in your PN. Profit coming in your PN is PAT. Now suppose there are preference shares. If preference shares are classified as a liability, then dividend on preference share will come under your finance cost. So can I say dividend on preference share is already deducted? I repeat, if preference shares are classified as liability, the dividend on preference share will come under finance cost. Dividend on preference share is already deducted. So now profit, whatever is there, is fully attributable to equity shareholders. But if preference shares are classified as equity, if preference shares are irredeemable, if irredeemable preference shares are there or they are classified as equity, then dividend on preference share will go under your equity. Okay, then out of profit, is the dividend yet deducted? No, then the dividend of preference share has to be deducted. The preference share classified as liability, dividend has gone where? In financing activity in P&L, then there is no adjustment to be done. But if the profit, if the preference shares are classified as an equity, the dividend on preference share has gone in other equity. वो retain earnings में गया. Has it gone in P&L? No. In that profit, that dividend of preference share is not deducted. For the purpose of EPS, you deduct it and then you find out EPS. Did you understood this? Okay. So whenever preference share is classified liability, we did it. So anything related to preference share, if it has gone directly in other equity, it has to be adjusted for finding the profit, has to be adjusted for finding the profit attributable to ordinary share. Because it has gone in equity, it is not deducted here, you have to deduct it. Remaining is the profit attributable to ordinary shareholders. Fine. Now come to this question. Question number 1. Now you have 5% redeemable preference share. Tell me, redeemable preference share, the interest would have gone where? Finance. So can I say interest has already gone in P&L? The profit coming in P&L is after that dividend. So do I need any adjustments? No adjustments. Okay. Second, we have an increasing rate cumulative non-redeemable preference share. Okay. Non-redeemable means they are treated as equity. So income dividend 18,000 would have gone where? Other equity or retained earnings mein. So profit may say, can I say it is not yet deducted? If I want profit for ordinary shareholders, that is to be deducted. So from your profit, I'll deduct 18. Did you understood? Third one, non-redeemable, non-cumulative, irredeemable. Irredeemable is again which one? Equity. Now they are basically over here in this, we repurchased it at a discount of 1,000. When I repurchased at a discount of 1,000, that's a profit to me, but that profit would have gone directly where? Other equity. That profit has gone directly to other equity. Whenever I'm finding in my PAT adjustment is not yet done, to find out the profit available to equity shareholder, that needs to be adjusted. So that 1,000 rupee I need to add in profits. It has gone in other equity, I have to add over here. See, this is non-cumulative. That's why. Fourth one, we have some convertible preference shares. Now, whenever there are convertible preference shares, many times you change the terms of conversion in order to induce them to go for shares. You give some favorable terms. When you give a favorable term so that they are motivated to take shares. As per Ind AS 109, if at all you change the terms of conversion to induce them to take shares, because of that the fair value will go up. Because I'm trying to give them extra benefit. That always goes in P&L. So here the terms of conversion were also amended, and because of that some extra fair value of 300 came, but that would have always gone in P&L. So when you change the term to induce them to go for conversion, that goes in P&L as per 109. So can I say it's already gone in P&L? So do I need to make any adjustment to profit? No. So only two adjustments were there in your profit, and this is the revised profit. Did you understood? Next. Weighted average number of shares, we know how to calculate. So I'm not going for that weighted average number of equity shares. Only thing is, whenever I'm finding a weighted average number of equity shares, suppose I have an agreement where I have to give you shares. If shares are to be given mandatorily, we assume that shares are there from the date the agreement is entered. But if shares are to be given based on certain conditions, so they will be included only when the conditions are fulfilled. They will be included only when the conditions are fulfilled. Okay, now come to change in number of shares without the change in resources. Now what is this change in number of shares without change in resources? Bonus, split, consolidation. Whenever we come out with a bonus, the number of shares increases, but the resources, assets and liabilities of company will remain same. So how to have an effect under EPS? So they are assumed to be there from beginning. So sir, how do we give the effect when I'm solving sums? So all the period prior to bonus, all the period which is prior to bonus, you multiply it with the bonus factor. You multiply it with bonus. Now what is this? Just check over here. You have 1 lakh, 10 lakh shares. You issued 2 lakh shares for cash, and then you come out with a bonus. Okay, the 10 was there plus 2. 10 plus 2 total became what? 12. Now bonus is what? 1 share for every 3 shares. Okay, so for 12 lakh, the bonus will be how much? 4 lakh. Now not 4 lakh, it is coming 3 lakh. Now 1 share for every 3. Acha, for 12 lakh, yeah, it's 4 lakh. But you can't say that 4 lakh shares were there from very beginning, because beginning mein 12 lakh shares only were not there. Did you understand? If beginning mein 12 lakh shares were there, I can say okay, uske upar 4 lakh bonus also was there from beginning. So yahan pe how do I solve this up? So day 1, 1st January to 28th February, can I say 10 lakh shares were there? 2 months. 28th February to 31st March, 12 lakh shares were there for 6 months. But do one thing. When 10 lakh shares were there, multiply with this bonus factor. Bonus factor is for every 3 share 1 bonus. So when I say with bonus, it will become 4 into 4 by 3. I can't add 4 lakh shares from day 1, because why I can't add 4 lakh shares from day 1? Day 1 there are not 12 lakh shares, there cannot be 4 lakh bonus. So into 4 by 3. Same way here also 12 lakh, but now it will into 4 by 3. And now September onwards, I've already added the bonus 4 lakh. Now it became 16. So now don't do again 4 by 3. 16 already includes bonus. And then 16 wale, later on again you issued 250. Can I say it became 1850? But 1850 already includes the 4 lakh bonus. So period before bonus multiply with what? Bonus factor. This is what you should do. Now, second, same thing will happen for right also, same thing will happen for that split also, same thing will happen for consolidation. Now coming to the right issue. Under right issue, can I say shares are given to the existing shareholder at a price which is generally lower than the market price? Okay, if I am giving shares, just a minute, whether this is fine or not. Yeah, if I am giving shares which is at what rate? Lower than the market price, can I say this some bonus element? So I need to find out the right factor. Now how do I find out the right factor? The right factor is nothing but your fair value of share before right issue divided by what? Theoretical ex right price. Now what is theoretical ex right price? See, there are certain shares which you are having and the value of share is going on in market. The number of share before right issue into the fair value before right issue. Plus, now what happens? You are issuing certain right shares and you are getting some money. Think from company's angle. What is the value of company? Already this many shares are worth this much. Plus you are issuing this many shares at this much. So this becomes the total value of company divided by total number of shares. This is nothing but the theoretical ex right price. So theoretical ex right price we got. Now how do we find out the right factor? Price going on before right issue divided by the theoretical ex right price. So suppose in this question we are getting price going on before right issue was 21 and theoretical ex right price is 20. The right factor is 21 divided by 20. Can I say it's 1.05? Okay, so now 1.05 is there now. All period before right issue you multiply it with 1.0. All period before right issue, and the previous year's figures are also to be restated. It's also to be restated for bonus as well. So bonus may be previous year shares, whatever it was last year may into 4 by 3. Here it will be into 1.05. Okay, so EPS of last year originally reported, last year EPS restated into 1.05 कर देंगे shares. Current year EPS, when did this right came? When did this right came? 1st March. And we have a calendar year. So can I say January and February we had 5 lakh shares? Don't say 5 lakh, it's 5 lakh into 1.05. But 1st March onwards we had basically 5 lakh plus the right was what? 1:5? Yeah, so right is 1 lakh. Now we have 6 lakh. Now don't do into 1.05. Only for the period before right issue you had to do 1.05. So 1.05 was done only for before, now not to be done. So first 2 months may into 1.05. Next 10 months may it is not into 1.05. This is basically your basic EPS. Second word is what? Diluted. Now how do I find diluted EPS? We have some potential equity share like convertible debentures, convertible preference shares, stock options. Can I say employee may take the shares in future? So diluted EPS is found out considering that potential equity shares have been converted. How they are found out? Considering the potential equity shares have been converted. Imagine convertible debentures are converted. If convertible debentures are converted, so can I say now interest on debenture is not to be paid? Okay, so profit attributable to equity shareholder will increase, and below the number of shares also increased, but interest is not to be paid, so tax benefit of interest will also go up. If preference shares are converted, so can I say dividend on preference share is not to be paid, that will be added in numerator. Denominator may the number of shares which we are issuing, that is that. So if that potential equity shares are converted, what will be the EPS? We are just trying to show that effect right now. Actually they have not been converted. If वो convert हो गए, what will be the situation if profit is remaining same? That we are trying to show it right now. Okay, so check over here. It is after considering all potential equity shares have been converted. ठीक है. Now if I go over here, the weighted average number of shares, suppose I tell you there are some potential equity shares. We assume that they have been converted at what? The beginning of the period only. Assume the potential equity shares have been converted when? Beginning. But now problem will happen. Imagine debentures are issued in this year. When did we issue the convertible debenture? 1st July. So while finding diluted EPS, I cannot say that the debentures were there from beginning of the year because they were issued only when? 1st July. So their interest cost was of 9 months. So numerator mein interest cost will be added back of 9 months. So denominator mein the shares will also be for 9 months. Did you understood that? Numerator mein interest cost was for 9 months. The denominator mein the shares will also be for 9 months. Okay. Now second, if potential equity shares are cancelled or lapsed, if they are cancelled or lapsed during the year, imagine they are getting lapsed in the month of 31st December. When they are lapsed? 31st December. But can I say they were there for first 9 months? So for the purpose of diluted EPS, we will assume that they were there for how many months? 9. So unka interest is added back of 9 months and shares also they will be added back for 9 months. Okay, suppose they have been converted during the year. See, once the debentures have been converted, really, can I say they will be a part of basic EPS only? They are really converted. The new shares have came up. They will be a part of basic EPS. But for diluted EPS, we will include as if they have been converted from beginning. As if they have been converted from beginning. Now, effect from the date they have been converted is already there in basic. So diluted may have to take the effect only for the period from 1/4 till the date of conversion. Once they have converted, can I say interest is no longer there? So in the profit only interest was there for 6 months. After 6 months they were already converted. So when I'm finding diluted, I'll add back interest only of 6 months and niche bhi I'll add the shares only for 6 months. Other 6 months the shares are already there under basic EPS calculation. Did you understood? Okay, next, suppose we have a conversion of debentures. Now there are options given. They can convert at the end of first year, they can convert at the end of second year, they can convert at the end of third year. If option is given to them, when they will convert or how they will convert, so holder will convert in a manner which is most advantageous to him. So diluted EPS should be based on how the holder will convert most advantageous to him. Okay, we have a question on this. And one more thing, if I have convertible debentures, convertible preference shares, many things are there. So should I take effect of all of them together in diluted EPS? No. You have to take the effect one by one. So out of all the potential shares, you need to understand which potential share is most dilutive. How do I understand which potential share is most dilutive? I need to find out an incremental EPS. So because of that, what will be the change in earning? Because of that, what will be the change in number of shares? That is called as incremental EPS. One which has a lowest incremental EPS is the most dilutive. One which has a lowest incremental EPS is most dilutive. So first give effect of the one which has a lowest incremental EPS. Then give effect of the another one. Then you give the effect of third one. So first I assume that preference shares have been converted. Then I assume debentures have been converted. Now when I'm assuming debentures converted, the diluted EPS is going up. So then that stage becomes anti-dilutive. We don't have a question on this in ICI, but it's okay. It was there in intermediate, such question. Now check this question. For debentures, debentures are getting converted. When debentures are getting converted, what will happen is the net profit mein interest is added, but a tax benefit of interest will go away. This is your profit, and number of shares mein, how many shares are given to them? If you check out, they have written number of shares on conversion is 110. So denominator mein 110 10 will be added. So in denominator mein, instead of 10 lakh share, it becomes 11 lakh 10,000 shares. This was easy. Now sometimes what happens is, whenever your debenture gets converted, interest is not to be paid. Interest is not to be paid. So can I say profit goes up? But now we were giving bonus based on percentage of profit. Okay, the profit goes up. So also what will go up? Bonus will go up. So that effect is also to be considered. Like in this question, bonus was based on 1% of PBT. Now because of basically interest getting converted, there is a reduction in interest 1000 and uska tax benefit goes away. But now interest reduction is 1000, bonus will increase now. So profit went up by 1000, so bonus will go up by 1% of it is 10, and now bonus goes up, uska tax benefit will come 2%. 20% is 2 rupee, and this will be the profit. Okay, now check 7th question. This is a good one. If you check this question, we have shares 10 lakh. We have convertible bonds of rupees 1 lakh. And they are convertible how? 120 share for rupees 100. For rupees 100, how much shares are given? 120 shares. Now, holder of rupees 25,000 bond, they converted in March. Okay, if they converted in March, can I say their figures are already included in basic EPS from March? Their figures are already included in basic EPS from March. So, if I calculate basic EPS, there were 10 lakh shares for full year. And this came from March, can I say for 9 months? For 9 months, this is 22,500 share. How 22,500? For every rupee 100, they got 120 shares, right? For every rupees 100, 120 shares are given. For rupees 25,000, how many shares will be there? 30,000. But I have to take only for 9 months. That's why it is 22,500. So basic EPS may they are included from 31st March. Now when I am calculating for diluted EPS, what will happen? When I am calculating for diluted EPS, then for first 3 months, can I say they were not considered in basic EPS, but for diluted EPS they will be considered. So when I am starting with this many shares, 1022, they are already included for 9 months. What were not included? 3 months. So for that, if you see yahan pe, it's only 3 months. Converted shares I'm taking for 3 months, and a converted share ka interest will also be added back only for 3 months, because once they were converted there was no interest in PNL. So in PNL the interest has gone only for 3 months. So yahan pe for converted ones the interest is also for 3 months. Now for the unconverted one, total rupees 1 lakh debenture, converted was rupees 25,000. Can I say rupees 75,000 debentures are still not converted? If they are still not converted, so can I say that in basic EPS they are not there, but diluted EPS I'll assume they are converted. If I assume they are converted from day 1, so converted mein 75,000 into 120 by 100, and uska interest is also for full year, because their interest came full year in PNL also, so we'll add back also full year interest. So this is the revised profit, this is the revised number of shares. You find the diluted EPS is 0.181. Okay, next one, this question, the holder has option to convert in June 6, June 7, June 8, June 9. Now if he converts in June 6, can I say I will get 135 shares? June 7, 130 shares. June 8, 125. Will choose which one? Most advantageous is 135. He will be converting in June 6. That way it will be there. So 135 shares is basically to be taken. The number of shares which are to be issued will be based on 135 shares. Number of shares which are to be issued will be based on 135 shares. This was the important point in this question. Next one. Now, when I'm having a consolidated financial statement, EPS, remember out of consolidated profit, some profit is attributable to owners of parent, remaining goes to NCS. So EPS will be based on what? The total profit, or the profit attributable to owners of parent, or NCI, what? No, EPS is always based on profit attributable to owners of parent. If you check over here, profit for the year, OCI for the year, profit attributable to owners, NCI. And now, whether the EPS is based on the normal profit or EPS is based on normal profit plus the OCI. Whether EPS is based on normal profit or normal profit plus the OCI. Only normal profit. So normal profit for the year attributable to parent is 39. EPS will be based on 39,000. EPS will be based on 39,000. Remaining is fine. You can just read this question. Now, option warrants and their equivalents. What is this option warrants and their equivalents? Suppose we are given ESOPs to the employees, and ESOPs we are going to give them at a subsidized rate. Now ESOPs के अंदर once ESOPs are converted, so we don't add anything above. Debentures getting converted, interest not to be paid. Preference shares getting converted, dividend not to be paid. But under your ESOPs, we try to find how many shares are issued for consideration without cash. What do we try to find? So shares issued for consideration. If I give you at full consideration, 100 rupee share, if I give you at 100, you will give me 100 rupee. I'll invest in business, profits will grow. So it will have no impact in EPS because money received, invested, profit grown, shares grown, it will remain same. But if I give you shares without consideration, then in that case, profit doesn't grow, shares grow, EPS will go down. So for this, we find out the number of shares which are to be issued without cash. How to find out the number of shares which are to be issued without cash? Imagine, if I check example over here, I am going to give you, assume I am going to give you 100 shares at rupees 100 only. So can I say I'm getting total 10,000? 100 shares I am going to give you at 100, 10,000. Now average market price going on is basically not today's, average market price for the year going on is 200. So actually average market price going on is 200. So for 10,000 rupees, I should have given you 10,000 divided by 200. I should have given you only 50 shares, but I am giving you 100. So extra 50 are given for consideration without cash. So we assume it's like 50 are given for full consideration, 50 are given without consideration. For the one which is given full consideration, it will have no impact in EPS. Money comes, we invest, profit grows, shares grows, EPS is same. But for the one which is given without consideration, what will happen? Profit doesn't grow, but shares grow. So for this, only the effect is taken in denominator. Numerator it is 0, but our denominator we take only the shares which are issued for consideration without cash. And for finding that consideration without cash, whatever consideration I'm getting 10,000 into 100 into 100, 10,000 divided by the normal price going on is 200. So I should have given you 10,000 divided by 250 shares. I gave you 100. So extra is other than cash. Okay, for this we are required to take the average market price which is there. Okay, so check over here. In this question, they have written, we granted option 70 rupees pay, option outstanding were 6,30,000. So can I say you'll give 630 into 70? So you'll give me 44 lakh 10,000. What's the average market price going on? 120. So I should have given you 367,500 shares divided. How did I get it? 6,30,000 pay, 70 rupee you will give me. So you will give me 44,410. And divided by, what is the average price? 120. So I should have given you how much? 367,500 shares, but I am giving you 630. So extra shares are for other than cash. So that is without consideration. So that extra shares I'll include in denominator, nothing to be included in numerator. But our average price in next year is different. The number of shares without cash in next year will also be different. So you have to find every year the number of shares which are other than cash. Did you understood? So for next year, it is, we are getting 630 into 70. We are getting 630 into 70, 4410. But now what is the average market price? 160. So I should have given you 275,625. I gave you 630. So how many shares are without cash? The figure will get different. So first year mein figure other than cash was 354. Second mein other than cash is becoming different. How much it came? 367, and this is 275. 625. So this is basically what you need to do. You need to find it for every year separately based on the average price which is there. Which a percentage dilution is nothing but EPS was 15, now EPS is 14. So can I say EPS went down by 1? So do one thing, it's 1 divided by 15. So percentage आ गया. 6.67 is 7 only ना, round off किया है उन्होंने. EPS was 13, it became 12. 1 divided by 13 करो. How much are you getting?
7.6.
Percentage dilution will be based on this only. The whatever EPS has gone down divided by the basic EPS. ठीक, चलो. Next is contingently issuable shares. Now, what is contingently issuable shares? It is issuable subject to certain condition. They will be included in your basic EPS only when the condition are satisfied. So when I'll include them in basic EPS, conditions are satisfied, at that time I'll include it in basic EPS. But for diluted EPS, I have to take them from the beginning of the period. I repeat, diluted में कब से लेना है? Beginning of the period. Now suppose condition is satisfied on 1st May. So basic May it will come from 1st May. But for diluted it will come from 1st April. Did you understood? Okay, so check this question. We have some 10 lakh shares. Agreement says 5,000 additional share for every new retail shop open. New retail shop open, extra 5,000 shares. And 1,000 shares if your profit exceeds. So 1,000 share for every rupees 100 profit in excess of 20 lakh as at year end. Okay, year end ka profit is more than 20 lakh. Suppose it's 20 lakh 50,000. The extra is 50,000. You will get extra 50,000. So you will get 1 share per extra rupee of profit, but what profit is for the year. Question, would we know our profit for the year before the year is over? No. And see, in between profit exceeded 20 lakh, can I say afterwards loss may come in quarter 3 and overall the profit may go down. So this condition will get satisfied only at year end. Now retail site open, first one is in May. So May mein retail site open, 5,000 shares I'll add it in May. Another one opened in September, another 5,000 share added in September. And now the data they have given is Q1 profit, then till Q2, till Q3 and total full year. As the data is given quarter wise, the sum has been solved quarter wise. Q1, Q2, Q3 and Q4 and total. Now your profits which are there, it is found out. Q1, Q2, Q3, Q4 and total. Total is 29 lakh. Now number of shares are basically this. Okay, retail side opened on 1st of May. 1st May opened. So can I say for Q2, we have calendar year. So Q2, 1st May. So can I say May and June? So it is for 2 months. Another retail side opened when? September. September may open. So now that retail side is opened. Uske 5,000 shares were there in Q3. New retail side opened on 1st September. Can I say it's only for 1 month? And these two retail side opened basically in September, so they were all there in October, November and December. Okay? But if I see from full year's angle, first one came in May, it is for 8 months. Second one came in September, it is for 4 months. Profit wala is not to be satisfied till the year is over. So it is not yet satisfied. That's why it is not taken in basic EPS. Now coming to diluted EPS. Diluted EPS may the effect is to be taken from the beginning of the period. Okay, the period is Q2. So Q2 may not for 2 months, take it for full 3 months. Yahan pe it's 1st September, Q3 may don't take for 1/3, it is taken for full. So that is basically the effect. And second, coming for this profit wala thing, if you check out, they've given the profit at Q2 end. Can I say profit has become 23 lakh? Okay, so can I say that now it is increasing to 20 lakhs increase ho gaya by how much rupees? 3 lakhs. So while calculating diluted EPS, we will consider the profits which are available till that reporting time. So what are the profits available? 23. So how many extra shares will be given? 3 lakh. But This is only for diluted. Basic में the condition is getting satisfied only at year and I can't take it in basic. But if I just read one line of diluted, there's one line given. Where is it? No. Attainment is there, it must be maintained. No, that is not there. Additional number of contingent shares. Acha. Number of contingently issuable shares included in diluted EPS will be based on the situation prevailing at balance sheet date. So Q2 end May, the situation is such that 3 lakh shares will be issuable. We will include them in diluted EPS. But when I came to Q3, again the profit has went down. So now I feel shares are not there, so I have taken 0. When I again came to Q4, it's 29 lakh, the total will be 9 lakh. This is how it is taken only for diluted EPS. Then, now this question is important, the next one which was asked. Now, we have a continuing operation, we have a discontinuing operation and total. EPS of continuing operation, discontinuing operation, total we find separately. But now whether it is a dilutive or not, whether the shares are, whether EPS is dilutive or not, we don't consider based on total EPS, we just consider the effect on what? Continuing operation. If continuing operation EPS is going down, it's dilutive. I repeat, continuing operation the EPS is going down, it is dilutive. Total EPS nahi, continuing operation EPS is going down, it is dilutive. So whether it is dilutive or not, I just have to see the effect on continuing operation. For example, continuing operation 30 lakhs, discontinuing operation negative 36 and total is negative 6. Your weighted number of shares how much? 10 lakh. Incremental shares under option. Incremental shares under option is options, shares which are to be issued without cash. So this is directly to be added in denominator. Okay, so when I'm finding basic EPS of continuing is 30 lakh divided by 10 lakh. Can I say 3? And basic EPS of, diluted EPS of continuing will be 30 lakh divided by 12 lakh. 30 lakh divided by 12 lakh is coming 2.5. So can I say basic was 3, diluted is 2.5, continuing operation may the EPS is going down, it's diluted. Now someone if sees from total angle, if you see total was negative 6, negative 6 divided by 10 lakh, can I say negative 0.6, and negative 6 divided by 12 lakh, 0.5, so negative 0.5, negative 0.6 and negative 0.5, can I say EPS is going up? Negative 0.6 tha, now it is negative 0.5, EPS is going up. So you might feel it's anti-dilutive, but whether it's anti-dilutive or not, I don't have to see effect from total angle, I have to see the effect from continuing operation angle. If continuing operation is going down, it is dilutive. Okay, so over here continuing operation is going down, it will be dilutive. And the last question of this standard, shares of subsidiary associate JV. Now imagine you don't have a potential equity share, subsidiary has a potential equity share. I repeat, I don't have a potential equity share. Who is having potential equity share? Subsidiary. Now if subsidiary ke potential equity share gets converted, can I say outsiders will have more share in subsidiary? If outsiders will have more share in subsidiary, can I say my holding in subsidiary goes down? If my holding in subsidiary goes down, can I say my share of profit in subsidiary also will go down, leading to a decrease in consolidated EPS? Okay, so I don't have potential equity share. Who is having potential equity share? Subsidiary. Uska effect, how do we give? Okay, so check over here. Just 1 minute. Okay, shares of subsidiary associate JV. I don't have potential equity share. Who is having potential equity share? Subsidiary associate JV. Now check over here. There is profit 12,000. Profit 12,000 before taking any earnings or dividend from subsidiary. Before taking any earnings or dividend from subsidiary, you have some 10,000 shares. Now you hold in subsidiary 800 ordinary shares, 30 warrants of subsidiary and 300 preference shares of subsidiary. ठीक है. Profit of subsidiary is 5400. Ordinary shares they have 1000. Out of 1000 I was holding 800. Can I say 80%? Okay, they have 150 warrants. Out of 150 I hold 30 warrants. Can I say 20%? And they have 400 preference share. I hold 300. Can I say 75%? Did you understood this? ठीक है. Warrants में exercise price is 10, market price is 20. So can I say market price is 20? I'm giving you at half rate. So kind of half of the shares are for free. So half are with full consideration, half are free. So out of 150, 75 are with full consideration, 75 are free. Kind of that way. Now no inter eliminations are there. Now let's solve this. First of all, subsidiary ka basic EPS. What is subsidiary's profit given? 5400. But now if you see, subsidiary has a preference shares. How much preference shares are given of subsidiary? 400. And I assume the profit is before preference dividend. Question is silent about it. And they have given dividend on preference share 1. So can I say 400 rupees preference dividend? Okay, so what is the profit attributable to ordinary shareholder? 5000 divided by number of ordinary share 1000. So EPS is 5. Now diluted EPS. Diluted EPS में convertible preference shares are converted. So convertible preference shares are converted. So can I say dividend not to be paid? So 5000 था उसमें add back dividend 400. Numerator will become 5000. Denominator में this was 1000 share. 400 shares are issued for preference. Preference में they are convertible into one ordinary share. And now options getting converted. How many are shares without cost? 75. So now the EPS will become 3.66. This is basic diluted of whom? Subsidiary. Now I go to parent. Okay, what was your parent's profit given? 12. But this was without considering what? Any income from subsidiary. Okay, subsidiary declared dividend. On preference shares, they gave 1 rupee per share. We hold 300 preference shares. So can I say I got how much? 300. So can I say now it becomes 12,000 plus I got 300. 300 wo mila. Now their profit is 5,000. After preference dividend, their profit is 5,000. My share is 80% in that. So can I say 4,000? So now my consolidated profit is yours plus coming from subsidiary related to you, related to NCI would have gone in NCI. So they had 5,000, coming to me is 80% 4,000 and plus 300 rupee preference dividend coming. So total, did you understood 14,300 this 4,300? Okay, consolidated profit is this. Consolidation में shares are only from parent's angle divided by only whose share? Only parent के shares. Parent के shares are 10,000. This is the basic EPS. Now diluted. Oh, now this pay attention. You had 12,000 share, 12,000 profit. Now diluted में, can I say subsidiary का now the diluted EPS is 3.66. Okay, this 3.66 is per share profit. Okay, on this 1000 share, how much is profit of subsidiary? 1000 into 3.66. Out of 1000, how many you hold? 80%. So do it into 80%. Can I say it is 2928? So that I have added 2928. How did I got 2928? Again, I am telling. Their EPS is 3.66. Okay. This is basically for all this many shares. 3.6 is per share for all this many 1000 plus 75 plus 400. Okay. Now 1000 into 3.66. So profit attributable to 1000 share is 3660. I hold 80%. I added 80%. Now profit attributable to 75 shares. 75 into 3.66. Now I hold out of 75. How many percentage? 20%. ESOPs I was having 20%. Into 20% you do. Is it getting 55? And third one, profit attributable to 400 shares. 400 into 3.66. 1464. Out of this, how much I am holding? 75%. So this is 109. So now once they have converted their shares, unke potential shares are converted. This is how my earnings in CFS will be divided by here the number of shares only from parent's angle, which is 10,000. How did I got all these figures? My profit was 12,000. My profit was 12. Now in CFS, profit coming from subsidiary. Once their potential shares are converted, how profit will come? They have a profit 3.66 per share. and this is on this many share. Okay, what is the profit for 1000 share? 1000 into 3.66, I hold 80%. What is the profit for 75 shares? 75 into 3.66, I hold 20%. What is profit for 400 share? 400 into 3.66, I hold 375%. Did you understood this? This is done, and one more question is there. Let me just finish it. If suppose they have participating preferences. What do you mean by participating preferences? First of all, some dividend is paid to preference share. Then after certain dividend is paid to ordinary, the balance profit will be shared by both. So in this question, if you check over here, they have given preference shares will get 5 rupee dividend. Then ordinary shareholders will get 2 rupee dividend. And then afterwards, the preference shareholder will participate at a rate of 50% of additional dividend which you pay to ordinary share. So first pay 5 rupee to preference, then pay 2 rupee to ordinary. Then whatever is there, now whatever you will pay to ordinary shareholder, how much you have to pay to preference? 50% of it. If I pay to ordinary shareholder another 5 rupee, I have to pay to preference shareholders 2.5 rupee. Did you understood? Now, how do we calculate the basic and diluted EPS? So check. The profit was 1 lakh. There are preference shares 5,000, ordinary shares 10,000. First of all, on 5,000 shares, we paid 5 rupee to them. So 5,000 into 5 is 25,000 bond. Then we paid 2 rupee to whom? Ordinary. 10,000 into 2, 20,000 bond. Now, the undistributed is 55. Now, how this undistributed will be distributed to them? If I give something to ordinary, can I say I have to give half to preference? Now, don't divide this in 2:1. ऐसे मत कर. If I give 2 rupee to ordinary, 1 rupee to preference, this is correct, but you can't do like this. Reason, I also have to consider the number of shares. So if you check over here, they've given 50% of additional dividend payable on ordinary share. If I give on ordinary share 2 rupee dividend, so can I say now on preference share I have to give 1. If I give 5 rupee there, I have to give 2.5. So what I will do is, I should not convert only in 2:1. I also should see the shares 5,000 and 10,000. यहाँ पे there are how many shares? 10,000. यहाँ पे there are how many shares? 5,000. Now you see this becomes 20,000, this becomes 5,000. The ratio is coming 4:1. So divide total 55 and 4:1. 4:1 में आप divide करो. Can I say 44,000 and 11,000? 44,000 divided by 10,000. It's 4.4. And 11,000 divided by, they are 5,000 shares. So 2.2. So distributed is 5 and 2. Undistributed is 2.2 and 4.4. Now it matches. And see, per share, if I paid 4.4 to ordinary, half 2.2 went to preference. But per share, not the total. You can't have total in 2:1. 55,000 is not in 2:1. 55,000 will go in 4:1. Yes or no? Yes, no?
Yes, sir.
Okay, the last standard we'll be doing it tomorrow. I'm not taking it right now. This much we have done. And just remember one thing. Tough times don't last, but tough people definitely do. I know this is a hard time. You're required to study a lot, but this will get over easily. पता ही नहीं चलेगा how this 15, 20 days, 30 days are getting over. But then you all people will be there later also to enjoy. So don't think that, sir, this time is very pressing, this time is pressing, but this will definitely go over. So just focus on your studies without thinking anything negative. Whatever situation is, just continue your studies. The day when you stop your studies, that is going to create a trouble. If at all I'm not feeling good, but if I continue, I'll feel good. If at all I'm not feeling good and I shut down everything, I'll feel more bad. So please don't shut yourself down. Continue studying. Automatically things will be good. Tough times don't last, but tough people do. See you all tomorrow at 3 o'clock online. Okay, so all the online people, we are continuing with the remaining standards which are there. Tomorrow we'll be meeting at 3 p.m. 3 p.m. onwards, till all the standards are over, we'll be having it. And the link, okay sir, what is the YouTube link of this? The YouTube link, I'll send it on our Telegram channel tomorrow morning, because I don't have a link as of now. The link needs to be created. So by tomorrow 12 o'clock, I'll send the YouTube link on our Telegram channel. Bye bye, take care and enjoy. Thank you. Audit बाकी है यार. Audit next Saturday, Sunday will meet. Actually, I told my friends earlier that we'll be going out at 6 o'clock. Then I told them we'll be going out at 8 o'clock. Since 8 o'clock, they're sitting in Yashash Academy. 98792 31 835. Thank you so much. Bye. Thank you so much. अब जब मैं फ्री रहो तब
Institute I got it from Evaluator. I myself can't believe I got 54
in order. Good, na? Don't worry. See, you prepared really well. I saw your SPAR paper. It was really well written. Only thing is like if you have not written that 3 questions wrong, the complete wrong chala gaya, 80. One question you have not attended. Plus, and these 2 questions were completely wrong written.
that
Billing code wala, and there was another question.
integrated.
If at all you write that thing only, मतलब नॉर्मली ना आपके 3-4 क्वेश्चन पूरे गलत है. अगर वो गलत नहीं होते तो पक्का एग्जाम्शन होते.
Even in this audit also, like I'll revise it again. So anyways, I'm gonna attend now. Not even one. All the three attempts I haven't got more than 40 a day. I don't know how I got. But your fast track only.
Huh?
So that was all December.
Huh?
Thank you.
Bye.
Bye, sir.
Bye bye.
It was so nice seeing you, sir.
I also enjoyed.
I feel the vibes.
अकेले होते हैं we get kind of feeling नहीं आता.
Feel the inter vibes.
Face to face is only good.
Bye, sir.
Bye. Bye bye.
Face to face, right? Audit.
Yeah. Next Saturday. One day we'll ask you about it. Again.